Optimism for a U.S. trade agreement with Vietnam was tempered by data showing private hiring fell unexpectedly in June. The Dow shedding 11, the S&P 500 gaining 29, and the tech-heavy Nasdaq up 190. President Trump announced on Wednesday that the U.S. has reached the framework of a trade deal with Vietnam. Details of the deal were only posted on Trump's Truth Social platform, but include a 20% tariff on Vietnamese imports to the U.S. and a 40% trans-shipping tariff for goods that originated in another country and then transferred to Vietnam for final shipment to the U.S. The announcement comes less than a week before a 90-day pause on the president's so-called reciprocal tariffs was set to expire. The latest payroll report from ADP showed the private sector lost 33,000 jobs last month. Today's report badly missing analyst expectations for an increase of 100,000 jobs and marking the first monthly decline since March 2023. ADP cited a hesitance among employers to hire workers and a reluctance to replace employees who left their roles. But the report doesn't always indicate the direction of the job market. The government's non-farm payrolls report will provide a better picture of the broader market when it comes out tomorrow. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. But let's also hear in some opinions that have come in from Wells Fargo's Scott Wren on where U.S. market is headed now and what we should be expecting.
We think the market's come, it's come a long way. Stocks are rich right now. We're trying to trim back. If you look at consumer discretionary sector, industrial sectors, those have done pretty well lately. We're taking money out of there. And to be honest with you, clients are either holding some cash because we think there's going to be a pullback here. We want to stick with quality bonds, 3 to 7 year intermediate part of the curve. We want to stick with large cap U.S. stocks, S&P 500. We also like U.S. mid caps. We don't want to be overexposed to the emerging markets or really developed international either. So quality, if you want to sum up what we're trying to do right now portfolio-wise, it's quality. You want to be patient. We think there's going to be a pullback, and you need to be ready to step in if a pullback should occur.
Some more updates that are coming in from the United States. President Donald Trump, he's announced that he had struck a trade deal with Vietnam under which the country would face a minimum 20% tariff and opens its markets to U.S. products. The deal comes less than a week before Trump's self-imposed July 9th deadline for steeper tariffs on U.S. trade partners to take effect if agreements are not reached. The U.S. president also said and would also be meeting with a faction of conservative lawmakers at the White House who have threatened to sink his signature tax legislation over its $3.4 trillion price tag as lawmakers cast doubt on whether it can be passed by July 4th. Now, that's all the global market action that we have for you all this morning. How is all this going to be impacting our Indian markets? We have a team of research joining in with us to tell you what are the stocks to watch out for, set you up for trade, what's going to be happening in the world of F&O as well. First up, Hormaz is here to tell us what are the market cues we are watching out for today. Hormaz, obviously we've seen a deal coming in with US and Vietnam, but how is the Indian market expected to react to this? A lot of numbers that we are seeing in terms of Q1 updates as well that we will be reacting to.
Morning, Vinny. And the way to look at the market is completely subject to what side of the spectrum you are on. Because if you are a bear, you would say, okay, you are down 200 points in the last 3 trading sessions. If you are a bull, you would say, okay, we tested the lows of the day yesterday, but we recovered almost 80 points from that despite ending lower. So it's both sides. If you take a look at that, and it was the Nifty Bank that was the underperformance of the banking index that dragged the Nifty lower yesterday, predominantly because of the PSU Bank Index, which snapped a 6-day winning streak yesterday, and that took the Bank Nifty lower in yesterday's trading session. Of course, the broader markets had a very volatile trading session. They recovered from the lows, then fell to the lows again, and then eventually ended up recovering as well. But the advanced decline ratio was firmly in favor of the declines in yesterday's trading session. And it was the metals index, though. Most of the other sectoral indices were underperforming. It was the metals index that bucked the trend over some developments that took place in China. That was the top sectoral performer yesterday. And an important session lies ahead. ahead today because, of course, it's the weekly expiry for the Nifty contracts. The Vietnam deal that you spoke about, that will keep a lot of these apparel makers in focus as well. The subject to what happens to our negotiations now going forward. The spotlight will be on that even further. And, of course, as you mentioned, there are multiple business updates that we'll be reacting to today. And the US market shut early today as a slew of macro data reported later this evening. So that will have a reaction tomorrow as well. Among the key levels, of course, yesterday's low remains the key for the Nifty, 25,378. And of course, it's struggling to cross that 25,600 band on the upside. So it's that 200-250 point range that the Nifty remains stuck in for now. At least for now, the GIFT Nifty is indicating a positive start for our own markets.
Okay, as of now, a positive start for our own markets is what we're watching out for. But which are the stocks that you should be keeping on your radar today? We have Upasna joining in with us to give us that list. Good morning, Upasna.
Good morning, Vinny. Lots of stocks on our radar on the back of Q1 updates. First up is M&M Finance. Overall, it's been a weak update. The disbursement growth stood at just about 1% on a one-year basis, and collection efficiency stood at 95%, dipped sequentially. Indian Bank also in focus. The total business is up about 10% on a one-year basis, and total deposits also saw a growth of 9.3%. So overall, it's been a good update. PNB Bank also in focus as domestic business is up about 1.5% sequentially and 11% on a one-year basis, and deposits have also seen a growth of about 1.7% sequentially and 12% on a one-year basis. So overall, it's been a steady update. V2 Retail also came up with its Q1 update. It's a strong update, revenue up 51%. Same store sales growth for the quarter stood at about 5%. Hindustan Zinc also came up with its Q1 production numbers. The mine metal production stood at 2,605,000 tons with an uptick of just about 1% on a one-year basis. Vedanta also in focus as the demerger hearing is delayed. The NCLT to resume hearing on August 20th. Now the legal representative from the Ministry of Petroleum and Natural Gas has requested additional time to present their observations on the scheme on the next hearing, which is why the hearing is delayed to 20th of August. Now lastly, on Nykaa, according to sources, Hardinpur, Singal Banga and Indra Banga is likely to sell nearly about 2.1% of their stake via equity block deals. Now the block size is around 1,200 crores and floor price for the deal is likely to be set around 200 rupees per share. So all in all these stocks likely to win focus.
Okay, Upasna, thank you so much for that. But Mangalam is here to tell us what should we be watching out for in the world of F&O. Today we do have the weekly expiry as well, Mangalam, and a bit of consolidation that we've seen so far. So what are we watching out for today now?
The market has been biding time, and today's weekly options expiry, my sense is that this one will go to the bulls. Why do I say that? Because, you know, yesterday there was weakness on the Lal Street, but remember, the GIFT Nifty is indicating a positive start, and from lows yesterday, the Nifty actually rallied about 80 points as well. So we've tested recent lows of 25,280, there was 25,473, and then yesterday was 25,378. Now the question is, can we test recent highs? Remember, the highs on the Nifty on June 27th and the first day of the series, July series, 25,669, remain to be watched. Remember, FII sold about 1,500 crores in cash markets yesterday, but that was more than bought over by the DIs at 3,000 crore of inflows. There were some shorts added by FIs in index futures. Remember, they've been adding a couple of long positions. So 38% was their net long position earlier. Now that's fallen to 33%. They added 6,800 short contracts and unwound around 3,700 long contracts. That's positive because if they do not get follow through, and as the GIFT Nifty is indicating a positive start, we will obviously see them running for cover out there. And similar is the case for options as well. Yesterday, some of those short put writers had to close their positions out, and a lot of short call writers have come in ahead of expiry. Remember, the put call ratio has fallen from peak of 1.25, 1.28 now to close to 0.78, which is at the lower end of the range. So the market has tested the lower range. Now the question is whether it can go ahead and test the higher end of the range, and my sense is today could perhaps be that day. The 25,400 call writers, very active, premium at 99 rupees. 25,500 call writers as well, equally active, premium at 50 rupees, telling you that if the Nifty sustains about 25,500 and crosses past 25,550, there could be a further rally because these call writers will have to cover their positions. But the question is whether we hold on to yesterday's lows or not, and that's where put writers believe that we will, because there is 25,450 puts which have seen a fair amount of writing, premium of 65, so around 25,400 is important support.
Okay, keep an eye on the support levels over there as well. So thank you so much for that, Mangalam. On that note, we're going to actually slip into a very short break and we get you excerpts from an exclusive interaction with Telecom Minister Jyotiraditya Scindia. Stay tuned in for that.
On what must be a big day back home at SBI.
Thank you, Lata.
Welcome back. Thanks for staying tuned to Power Breakfast on CNBC-TV18. Now, Telecom Minister Scindia has ruled out any increase in the government's stake in Vodafone Idea. Speaking to Parikshit Luthra, Scindia made it clear that the government has no intention to make Vodafone Idea a public sector unit. The minister also confirmed that the Telecom department is evaluating Bharti Airtel's proposal to convert spectrum dues to equity similar to Vodafone Idea. Listen in to what more he had to say.
When it comes to further equity conversion, I think you've said earlier also that it's not as possible.
There cannot be. There possibly cannot be further equity conversion unless the government share gets diluted to lower than 49% to enable us to increase it back to 49%. Because we can't increase it beyond 49% because the minute you do that, then it becomes a PSU, which is not our intent.
But are there other options being considered?
At this point of time, the equity option, increasing the equity option is not an option. As far as other options are concerned, there's not much discussion happening at this point. If there is, we will let you know.
Analysts have said that 2-year deferment of Vodafone AGR dues is the most possible thing that the government could do.
That is, as I said to you again, that is not for us to decide. That is for the management of the company to decide.
Right. Now, also,
I do not happen to be the CEO of Vodafone, and neither do I happen to be the CEO of BSNL.
Let me also ask you about Bharti Airtel. Now, Bharti Airtel has also applied and made an application to you for equity conversion. The government seems to be considering this. What's your view right now? Has a call been taken?
The Department of Telecommunications is evaluating it. Once they evaluate it and they bring it up to me, then I shall exercise a view based on the analysis that has been done. At this point of time, they have not brought it up to me.
You've met representatives of Starlinks over the last few months. They've got one approval from the government. InSpace is waiting for them to respond to their draft and they may give an approval soon. But finally, how long would it take to clear the decks for them to operate in India?
Well, I think that the process is on. They have to get permission for their satellite Earth gateways to be located in India. They've got to get in-space permission. They've got to get security clearance. And then they have to get spectrum. These are the major 4 milestones, if you will, to be able to operate in India. I am of the opinion that the sooner my SATCOM companies operate, and by that reference I mean not only Starlink, whether it's OneWeb or it is Reliance Jio, I'd like them to offer services as soon as possible in as many areas as possible so that there is a fair degree of competition for those that are not connected. And I see that happening, as I said, in the next couple of months. This process should get ironed out.
Okay, that's an interesting conversation there. But on that note, we're going to actually slip into a very short break. But up next, we'll come back and we'll talk to you about what's happening in the world of commodities. So stay tuned in for that. Welcome back to Power Breakfast on CNBC-TV18. Now, US President Donald Trump has hinted at reaching a potential trade deal with India, claiming it's going to be a different kind of deal. This comes amid the hectic negotiations between India and US. The India's top negotiator extending his stay in Washington. Both sides are at a stalemate on a contentious agri and dairy sectors. Now, here is former RBI Governor Raghuram Rajan on the sticking points that are hindering an agreement right now. Listen to what he's saying.
First, there are easy sort of wins. India can buy more natural gas from the United States, which has a surplus of that. It will require sort of positioning Indian purchases. But there's sort of politically difficult places that India doesn't want to go. For example, agriculture, dairy products. Indian dairy farmers, it's a huge source of living, and they don't want to be swamped by cheap U.S. dairy products. So in that sense, there will be some red areas that India will not want to go to, but there are many other areas where I think agreements can be reached. There are other sources of oil nearer India than the United States. But certainly, as far as natural gas goes, LNG is something that India has increasingly used. And as it transitions to cleaner sources of energy, LNG may be the transition sort of energy source. So it is sort of win-win if India buys more of that, and certainly the US has a surplus.
We also spoke to Atul Keshav, the president of a US and India Business Council, on the likelihood of a trade deal before the 9th of July deadline. And here is what he had to say.
The US Chamber, the US India Business Council, all of our members want to see this deal happen. It's very important for the United States and India, the two greatest democracies on earth, to have such a deal. I understand the trade negotiators are in town and working away. Secretary Bessent said the other day that a deal with India is very, very close, and we are cheering wholeheartedly for this deal to happen. Chamber's view, ideologically and theologically even, is that zero tariffs are the best for ensuring the greatest amount of prosperity and happiness and consumer choice. And so we've been on the record many times about that. You know, if we can get to a point where we have the minimal amount of tariffs between the United States and India, where we also have the minimum amount of non-tariff barriers, because it's not enough simply to reduce your tariffs. You have to be sincere about reducing all kinds of government machinery and bureaucracy and regulations and red tape that would impede the movement of goods despite having a low tariff regime. But it is also true that the Indian agricultural sector not only employs an enormous proportion of the population of India, but also represents an increasingly smaller proportion of the GDP of India. And if you contrast that with agriculture in Brazil or in America or in other places around the world, India hasn't had the waves of modernization that other countries have had. In a way, if India were to look at this as an opportunity to inject a measure of innovation into its agricultural economy in a way that can actually catalyze growth of revenue, economic growth, help people transition into higher skilled jobs, it could actually be viewed as a positive.
On that note, let's talk about what's happening in the world of commodities this morning. And we have Manisha Gupta joining in with us to give us that wrap. Good morning, Manisha. What are we keeping an eye out on today?
Well, I'm looking at the crude oil prices because we've seen 3% of gains in the overnight market, and not just crude oil, heating oil gained up by 3.5%. Natural gas was up 2% as well. This is after Iran suspends cooperation with the United Nations, saying that future inspection of nuclear sites by IAEA will only need approval from Tehran's Supreme National Security Council. So clearly this brings in a bit of a concern into the markets, and we've seen that premium come back. Also, while you're looking at the US-Vietnam strike trade deal agreement, that gives in some positivity as well in sense of demand. And now the US jobs data is something that would be in focus. Further cues would come in from that. But it's not just the crude oil prices. If you look at precious metals, base metals, everything is trading in positive. Platinum gained 4.5% overnight. Palladium was 5%. Gold gained 1%. In metals, you had the ferrous metals running the most. 2 to 3% of gains for steel and iron ore prices is what we are dealing with. And the gains have just about continued when it comes to copper. That one is trading at a new 3-month highs in the Asian markets right now. This is after a strong manufacturing data coming in from China.
Okay, Manisha, thank you so much for that. Surely we'll be keeping an eye out on crude, natural gas, as well as metals in the trading session and how they move going forward as well. But with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, your Bazar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me as always Nigel D'Souza and Reema Tendulkar. And what we have is another mixed set of cues. A little bit of caution in global markets, but hey, there's at least one trade deal on the table now.
Indeed, counting down to 9th of July, Vietnam, US done. Yeah. Though we still don't have the trade agreement. You know, the final contours of it, but will India be next?
Well, we've got the social media posts. It starts with that.
Yeah, hopefully you show some love to us, you know. So let's see how that goes. But interesting times. I think by the end of today, we'll be on our own steam because US markets as well will be shut tomorrow. So they have a long weekend. Yeah. And me too. But let's get straight to the action.
That's true. 4th of July, I think Nigel's also going to celebrate in a different way. But let's get to the action then. What we're talking about is what was a slightly mixed close on Wall Street. The Dow didn't participate, but look at the other indices. The S&P 500 finally hitting a fresh all-time intraday high. And you even had the NASDAQ. The NASDAQ didn't quite touch that high, the all-time high. But it did end at a record close, and it's inching towards the all-time high, almost at 20,400. So good day for U.S. equities. Now, the markets were looking at, two different aspects, one positive, one negative. The positive was the fact that there is a trade deal with Vietnam. At least it's a deal. At least it's the promise of some stability, some finality coming to it. So what do we know? That it's going to be 20% tariff. All goods coming in from Vietnam to the U.S. will be tariffed at 20%. But that's not all. There's something called a 40% transshipment tariff that Vietnam would be subject to. What does that mean? That means that if there are goods originating from other countries, but they're being routed through Vietnam, shipped out of Vietnam, then they will be subject to 40% tariff. And that takes care of a lot of the issues and a lot of the, the claims that were being made that a lot of Chinese stuff was being routed through Vietnam and then being exported onto the US. So that's what we have. In exchange, the US is also getting absolute free, no barrier access to the Vietnamese market. So that's one deal done. Let's see whether India is next, which country is next. Now, that was the positive news on the trade deal. The negative or slight negative was on the jobs market front, because yesterday we had the private sector payrolls report, the ADP employment report come through. And there, surprise, surprise, I mean, there was a loss of 33,000 jobs versus estimates of a gain of about 100,000. This is the first time the ADP report showed a loss in monthly job additions since March of 2023. So that took the market by surprise. Though people argue that, the accuracy of the ADP report cannot be always verified. The big one is the non-farm payrolls report, the US jobs report, the government report, which comes out today because tomorrow is a US market holiday. Now, on the non-farm payrolls report, we're going with the expectation that in the month of June, over 110,000 jobs would have been added by the US economy. So let's see. This is the big market event that we are watching out for today. In terms of the action in the money markets, yields have been inching slightly higher. We saw that yesterday as well. The US 10-year is now inching to almost 4.28 was the level yesterday. This morning it's cooled off a little bit. That's because the market's also digesting the passage of this big, beautiful bill through the US Congress. And that we know it's going to add over $3 trillion in terms of US deficit. So that was weighing on sentiment. The dollar managed to finally gain. The dollar has been slammed down last many days. But yesterday it managed to gain a little bit versus a lot of global currencies, including the yen, the Swiss franc, the euro, and of course the pound. The dollar index managed to inch back close to the 97 mark in intraday action yesterday. This morning, again, the dollar index has cooled off. Let's pull up the DXY on the screen once again. It's again showing a slight flattening trend, but there was some buying that we saw yesterday. 96.73 this morning on the USD. Oil is not a concern, but it remains a big watch point for us. And yesterday we had a 3% move in oil prices. Brent is now back towards $69 a barrel. And why did that happen? Because Iran has decided not to cooperate anymore with the UN Atomic Agency, which is the IAEA, in terms of further inspections. Iran basically is saying that IAEA is always siding with Western interests, so why should we let them come in and inspect our nuclear program? So that led to a bit of a risk premium coming back in oil prices, something to watch. The Nifty, we've been battling with this range, and it's become a bit of a small, tiny resistance. This whole zone of 25,500 to about 25,600 to 650. Now, can the bulls punch through that? We'll have to wait and watch. The action's been very, very stock specific. And the problem with the large caps is that while DII buying might happen, FPI selling is still a phenomenon in the market. And Rima will talk more about that, and we'll get to it. But for the time being, it's this range, and we need to take it out decisively for the next move up, perhaps.
Okay, but just to get back to the big story which is shaping sentiment today, that's the US-Vietnam trade deal. And the question is, what could be the potential implications for India? For instance, can India become more competitive with Vietnam facing 20 to 40% tariffs? India is still subject to the 10% universal tariff. So even as we negotiate our final deal and iron it out, can we make ourselves more competitive? Secondly, with a full market access to Vietnam, with US enjoying a full market access to Vietnam at 0% tariff, can Vietnam become a more attractive export base for US-bound production, especially for US firms looking to relocate from China? Or will it put pressure on India to liberalize tariffs and market access? Will US, for instance, expect similar concessions from India in the bilateral negotiations which are going about? And just to that point about that ADP data, because it's the private sector data which is captured, it just ties in with the headlines that we're getting. Microsoft, for instance.
Yes.
Microsoft announced that they're laying off 9,000 employees in the latest rounds of cut. This will impact 4% of their workforce, and this is the second big wave of layoffs coming through from Microsoft. Or even Amazon. Amazon said that they're deploying their millionth robo at their facility. So clearly signaling a rise of automation, the rise of AI, which is impacting jobs to some extent. Once again, to revisit the flows number that we had yesterday, the DII's net bought about 3,036 crore in the cash market. The FI's net sold 1,561 crore. What to watch today back home? Well, it's the Nifty weekly options expiry. Q1 updates we'll get to in greater detail, but they're coming through from Avenue Supermarts, M&M Financial, PNB, Indian Bank. There is a block deal in Nykaa, a QIP in Shakti Pumps. Keep an eye out on the April textile stocks after the US-Vietnam deal. And just to remind, US markets not just have the Independence Day holiday tomorrow, today they also have a truncated trading session. So will it impact European trading action? Nigel?
Well, that's right. The top two cues today will be on the global front. The US, well, they have given a pretty okay deal to Vietnam, so that's going to be in focus. What's India going to get? That's the big global cue out there. Jobs report, as you all mentioned, later this evening. And on the domestic front, we have the weekly expiry that plays out that always has some bit of a zing to it. So we'll watch out for volatility in the second half of trade. Moving to the cues. And I'm still not too worried with regard to the Nifty. Yes, trading has been a little bit subdued in the last few trading sessions, but the VIX continues to remain at very depressed levels, and that's normally a bullish indicating. And yesterday, though we had the Nifty that was lower, the VIX as well cooled off. That's one bullish indicator. So that's point number one. Second factor is the FIs are getting confident on the short side. If you look at what they did on, index futures, they added close to 6,800 contracts or thereabouts. They remain net short with close to around 67% on the short side. And if you're looking at the options data as well, they wrote calls yesterday, and they wrote calls, quite aggressively. But first, let's look at the positioning. In yesterday's trading session, the FI net short positions, well, it went up by close to around 10,000 contracts, while the clients, the net long positions went up by close to around 3 times. So that's how they're positioned right now. FI is net short at 50,000 contracts. Clients are net long. This is the data point that I'm talking about. The FIs not only shorted the index futures, they also went ahead and they wrote calls. Close to around 1 lakh calls were written yesterday. So that sort of a confidence actually is not such a bad thing, because these shorts can get caught on the wrong side, and a market that's devoid of any kind of shorts actually is a bit of an issue, because you're not going to see big kind of inflows in the cash market. Then you're hoping that in the FNO market there are shorts in the system, which is the case right now. The PCR, that as well has come down to the lower end of the range. It's at around 0.78 or thereabouts. At around 0.65, 0.7, that's where we see it base out. And the reason the PCR has come down is because the call writers are getting very, very confident. Even in yesterday's trade, 25,500 call, 25,450 call. Between them, more than 1 crore shares are added. Which brings us to the levels. The 20 DMA is going to be important. That's at 25,100 or thereabouts. And the recent resistance level now becomes a support. So in terms of levels that we're looking at, that's the important mark. 20 DMA, and this is the recent resistance mark, which now becomes a support. So you don't want this level to break on the downside. For today, the 25,350 should be the level that should hold out, by the end of today. On the upside, the recent high, 25,670, that becomes important. Let's look at, the Nifty Bank. That as well, it's seen some kind of a pullback in the last session or thereabouts, but it continues to defend this 20 DMA, which is, around this mark. So that's going to be important. You want it to defend that mark. The stock that I'm looking at is CPCL, that's Chennai Petro. The stock in yesterday's trading section actually was quite strong, and it's continuing to defend this 20 DMA, which is at around 660 rupees or thereabouts. And, fundamentally as well, things are working for them. Refining margins have moved up. Next couple of quarters will be quite good. And replacement cost actually is, much higher in comparison to the EV that's trading at. And if it's a debt repayment, then that could be an additional trigger. And yesterday, massive delivery-based buying on this counter. I think for the next couple of results, I'll keep an eye out on CPCL, going by the fundamentals and going by the delivery-based buying I'm seeing on this one.
Okay, all right. So Chennai Petro is going to be on our radar. Nigel, thanks for that. Let's get started then with the equity call of the morning. This one's coming in from Vikas Jain of CLSA, who says that with a 2-year EPS CAGR of 11%, Nifty earnings growth is now mediocre. But India has again become the most expensive market in the world on a PE basis, and is at a very rich premium versus emerging markets, Asia ex-Japan and China. Nifty's valuation versus bonds is below the danger mark, and investor sentiment still is in the neutral zone as per CLSA's proprietary India Bull Bear Index, and this may be the silver lining for bulls. CLSA has added Bajaj Auto to its portfolio and removed Britannia. Vikash adds that a combination of extended valuations and risk of earnings downgrades makes them cautious in the market in terms of near-term returns. CLSA prefers the defensives along with autos, energy, realty and banks. Okay, so that's CLSA's call. They remain cautious on the market. But let's revisit that big global story. Trade deals finally seem to be happening. The US president has hinted at reaching a potential trade deal with India as well, claiming that it's going to be a quote-unquote different kind of a deal. This comes amidst hectic negotiations between India and the US, with India's top negotiators extending their stay in Washington. Both sides are at a stalemate right now on the contentious issue of agri as well as dairy products. Here's former RBI Governor Raghuram Rajan on the sticky points that seem to be hindering an agreement, at least right now.
First, there are easy wins. India can buy more natural gas from the United States, which has surplus of that. It will require positioning Indian purchases. But there's sort of politically difficult places that India doesn't want to go. For example, agriculture, dairy products. Indian dairy farmers, it's a huge source of living, and they don't want to be swamped by cheap U.S. dairy products. So in that sense, there will be some red areas that India will not want to go to, but there are many other areas where I think agreements can be reached. There are other sources of oil nearer India than the United States. But certainly, as far as natural gas goes, LNG is something that India has increasingly used. And as it transitions to cleaner sources of energy, LNG may be the transition energy source. So it is sort of win-win if India buys more of that, and certainly the US has a surplus.
Okay, let's tell our viewers then the interactions we've lined up on the show today. So coming up first at 8:35, Peter Maguire of Trading.com joining in to discuss the recent rally in metals. 9 a.m., we'll be joined by Abneesh Roy of Nuvama Institutional Equities to talk about the likely GST relief for middle class. 9:20 a.m., Vineet Sambre of DSP Mutual Fund will be our market master for the day. 9:30, we'll invite the management of Blue Star to discuss the summer demand trends. A little later, 9:50, Pavan Goyal of Naukri.com and Abhishek Kumar of JM Financial Institutional Securities will join in to talk about the June JobSpeak Index and what to expect from the IT majors this earnings season. At 10:15, Ajay Sahai of Federation of Indian Export Organization, FIEO, and international trade expert Abhijit Das will be joining in to talk about the US tariff deal with Vietnam and the likely implications and impact on Indian exporters.
All right, time to slip into a short break, but we've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Avenue Supermarts, V2 Retail, Indian Bank and CSB Bank. They'll be reacting to positive news flow. And today, the stocks that open in the red, well, they outweigh the number in the green because we have Nykaa, Shakti Pumps, Hindustan Zinc, Mahindra & Mahindra Financial, Vedanta, all of them will react to negative news flow, while actually PNB is the one that could see a mixed reaction to its Q1 numbers. Stay with us. We get into further detail on the other side.
Welcome back. So the cues across Asia have been a little mixed. We had a mixed close on Wall Street as well. But there is a trade deal that's finally been signed. I'm talking about the US-Vietnam deal, at least when there's an in-principle agreement, so to speak. And let's see if that's going to be enough to cheer up the markets. Let's discuss this and more with Hartmut Issel, head of APAC Equity at UBS Global Wealth Management. Hartmut, great to have you with us. Thanks so much for joining in. So let's start right there. You know, originally when those Liberation Day tariffs were announced, Vietnam got a real raw deal, right? They were threatened with over 90% tariff. The reality now seems to be 20%. How do you think the market will take this? And, of course, the deals to come.
The actual number, I think, is more or less what we expected, maybe a touch higher. The transmission side, right? So for these kind of also trading partners, especially what comes via or from China, rather, right? It has probably been a bit higher than we expected. Nonetheless, if we look at markets, whether it's Vietnam, whether it's China, perhaps, right, it doesn't take it too negatively. So yeah, certainly, I think we're looking forward over the next couple of days that more is coming, because also what we understand from the US, right, they're trying to do it a bit around the 4th of July, which is tomorrow already. So, yeah, I think we're going to see a lot more in the next couple of perhaps even hours, but certainly days.
But Hartmut, just dwell a little bit more on the point about China. How do you think China will react to the 40% tariff on trans-shipped goods? Because this is a direct message to China saying that if you are bypassing our tariffs by rerouting your goods via Vietnam, we're not going to allow it. Pay 40%. How do you think China will react to this?
Yeah, we have to bear in mind, if we count this from China's point of view, right, and the transshipments there via Vietnam, we think are close to 1%, so it is not that large. Actually, what you could argue is maybe on a corporate side, right? So some of the companies that go that route, maybe they try to put a bit more production directly into Vietnam so that it, is seen or counted a bit differently. So these are probably the impacts. So none of these impacts is particularly large from a China point of view.
Hartmut, what about India? We were hoping that we get a favorable deal. And, India could be the one that actually gets the sweetest deal. Do you think we still get one? Because the commentary in the last month or so indicates that it could be anyone's guess. What are your expectations?
Yeah. Look, if I look at it, certainly from an India standpoint, right, and I think India was certainly here in APEC in the region, right, one of the first, if not the first one, right, that since January basically started the negotiations also much earlier than anybody else. Right? You know, PM Modi was in the US and vice versa, right, JD Vance. So all these things have happened. So one thing is clear, right? Both the Indian side as well as the U.S. side, right? The U.S. also, they need to show progress, right? They cannot just say we have negotiation and nothing happens, right? They need to show that with some countries it is possible to reach these deals even before the 9th of July. So given also that the Indian delegation actually apparently stayed longer in the U.S. than initially was planned, that shows they're onto something. So I would argue from a trade point of view, India is more or less, it's clear that, at least an interim, right? It will not be the final deal, of course. It can never be. It takes a lot longer, but an interim is reached before 9th of July, and that I think is a given. But it's also probably the consensus in the market. So I'm not even sure if that in itself would drive the Nifty, for example, a lot higher. However, we do see the Nifty higher over the next 12 months. We have an attractive rating, but it's for different reasons. It's no longer so much for trade reasons. I think everybody has understood it and has that already to some extent priced in.
Yeah, I'm glad you brought that point up, Hartmut, because I was just getting to that a trade deal with the US obviously is very important for us, but it's not a make or break situation for the economy here or for the market here. And coming to the market, just tell us a little more about where your optimism on India comes in from, because I was just looking at Asian markets across so far this year in the last 6 months. And look at South Korea, look at Hong Kong. I mean, these markets have done so well, 20-25%. We are up only 7% this year. So people talk about earnings concerns, valuation concerns. But what makes you optimistic?
A couple of points. First one for me, is much more important than trade, if you ask me, at least from now on, right? Because trade is well understood and I think is in consensus. So we're looking at the earnings side, right? We need to understand all the way going back to the fiscal year 2024 for India, for Nifty, right? I mean, almost in our numbers anyway, almost 25% growth. It's clear that, the Nifty cannot give you several years of that, right? And we had at the point already forecast that it's going to come in lower. So now for the just closed fiscal year, in our forecast, we have close to 7% probably earnings growth, which is fairly low. So if you're a company, an average company that says, okay, I compare myself with 7% with only, so to speak, 7% before, that's much easier to beat than if I compare myself with a 25% growth base, right? So that is easier, but there's also many sector-specific reasons. Certainly on the financial side, although that's probably a bit more fiscal year 27 focused, but then it's really when it takes off. So as an investor, only sort of 9 months away, but you want to start positioning for that. And then also what comes to my mind is also a sector we like a lot is the consumer side, right? With the pay commission, of course, doesn't decide each and everything. There's other reasons, but of course that also comes inside and it only happens every 5 years. And we have an estimate that over 2 years, it benefits the GDP by an additional just slightly over 1 percentage point. So that's not small, also for the earnings outlook. So all of these things lead us to double-digit earnings growth, we think, for 2 years in a row after we had sort of a mid-single digit. And then why wouldn't I invest in this market?
Oh, wow, that's fantastic. And it's good to get that perspective from the outside. You said that you're expecting the Nifty to rise over the next 12 months. What's the target you have for the index? Or what's the kind of upside you're penciling in?
Look, if I have an earnings estimate that goes up by slightly over 13%, right? And you mentioned before, and I think it's a valid point, right? What about the valuations? We're back to slightly over 20 times now, which is, we have seen a Nifty also higher, right? But it's not particularly cheap, right? I will admit that. But in an environment where the 10-year yields are continuing to come down, we have them below 6% to be precise, 5.8 I think for mid next year. That is always supportive for the valuation side, right? Even if it's not particularly low, but that also helps. But even if we count that out, right? So the 13% alone, we have an estimate of upside for the Nifty of about, give and take 11%, maybe 12, somewhere thereabout. So we could talk about 27,500, somewhere there in that area over a 12-month base. So I find it difficult to suggest to anybody not to go into it at these current levels.
Thank you very much for that. 11 to 12% upside for the Indian markets, the Nifty heading to 27,500, perhaps in the next 12 months. That's the word coming in from Hartmut SL of UBS. Let's drill it down then to the individual stocks you should have on your radar this Thursday morning. Our research team is standing by bright and early with CNBC-TV18's list of top stocks for the day. And first up, it's Vivek on Nykaa.
Well, that's right. Good morning. So, large block deal is expected as far as Nykaa is concerned. So, as per the term sheet, there are two sellers, Harinder Pal Singh Banga along with Indira Banga, are looking to sell a little over 2% stake in the company. The floor price for this particular block deal is at a discount to yesterday's closing, and it's at 200 rupees a share. Total size of the block is 1,200 crores. So, watch out for Nykaa. Could see a red opening as far as today's trading is concerned.
Okay, all right. Thanks a lot for that, Vivek. Well, let's go across to Hormuz. He's here. He's tracking Shakti Pumps. Hey, Hormuz.
Morning, Nigel. And Shakti Pumps has launched yet another QIP to raise funds. This comes almost a year and a quarter after they did their previous exercise. So this time around, the floor price of around 966 rupees is almost a 2.5% premium compared to yesterday's closing price. So keep an eye out on that. Of course, the board has mentioned that they'll offer a discount of up to 5% on the floor price as per their discretion. And they had approved raising around about 400 crore rupees through this QIP route in January of this year. So now they're exercising that mandate. And the last time they had done a QIP was back in March of 2024. And they raised 200 crores through that. Most of those shares were issued to funds belonging to LIC and SBI. And since that last QIP, the stock is up almost 300%. So expect the stock to open in the red, but may see some recovery over the course of the day.
Okay, all right. So Shakti Pumps on our radar. Thank you very much for that, Hormuz. Let's talk about Avenue Supermarts, V2 Retail. A lot of companies coming up with their mid-quarter updates. Mangalam, how's it looking?
Well, for Avenue Supermarts, the standalone revenue for the company grew by 16.2%. They added 9 stores during this quarter. And if you look at last year and now, the store addition has actually been 14.3%, which implies that, the same-store sales growth could be low single digits, around 1.5 to 2%, which is not the best. But then again, the sentiment has been such with the competition for quick commerce, etc., and the stock which was slightly under pressure yesterday. I would like to, believe that there would be mild green on DMart today, because the street will now await numbers coming in from the company in which they will watch out for the product mix. They will watch out for how DMart Ready, the consolidated business, has performed. And at the same time, pace of store expansion is something that the street is betting on for DMart. On the other hand, V2 Retail, very strong update coming in, 51% jump in the revenue for the company, and this is on a high base already. The same-store sales growth, however, is just 5%, and the situation is similar to what happened with V-Mart Retail yesterday. For V2 Retail, if you adjust for the Eid shifting, the same-store sales growth is at around 10%, so see some green on V2 Retail.
All right, Mangalam, I think I'll do some ground research. I'm going to be in UP by this evening for the next 3 days or so. I'll come back and give you some feedback in terms of
Bag with shopping bags.
Yeah, I mean, some kind of bags. But yeah, I'll do some checks out there, because the malls out there, they really have a lot of footfalls out there, much more than actually Bombay as well. Thanks, Mangalam, for that. But now it's time to welcome Gaurav, who's the new member of our team. And watch out for this guy, making a debut today. And solid one. Gaurav, tracking banks and financials today, PNB and Indian Bank on your radar. Tell us more, please.
Well, yes, Punjab National Bank. First, let's talk about this bank, because when we look at the system growth, we've already seen some slowdown in the banking system. The growth is at around 9.6%. And when we look at Punjab National Bank, it seems that the bank is also following the same trend, because advances grew only by 9.7%. It was actually a little bit lower than their own estimates for FY26. On the other hand, when we talk about deposit, we saw a strong growth of around 12%. But let's not forget that the CD ratio for the bank is at around 71%. So definitely bank needs to focus on the growth on loans from the time going ahead. Other than that, Indian Bank actually came up with good set of numbers, because when we look at the advances there, we saw a growth of around 11%. That was largely led by RAM segment, which grew at around 15% on a year-on-year basis. On the deposits front also, we saw a good set of number in line with what the bank had estimated for FY26. So definitely good set of number is what we saw from Indian Bank in the quarterly updates for this quarter.
All right, Gaurav, but we can't let you go only at that. We'll come to you for a few more stocks and maybe a treat later in the day. For the time being, I'll take over. We'll talk about Hindustan Zinc and then come back to you. They came up with a quarterly update. It's not a big mover of the stock at all, but the number looks a little bit subdued. So the mined metal production, that's mildly higher by close to around 1%. But if you look at the saleable metal production, that's down by 5%. Refined zinc production as well down by close to around 4%. And refined lead production as well is a little bit lower. In addition to that, silver, which where the big bet is on, right? Because silver prices have perked up. In number of tons, it's come down to around 149 tons, which is down both on a year-on-year as well as on a sequential basis. So, one of the factors that could contribute to the stock going down. But remember, in the last 1 month or so, from the time we highlighted that 520, there's that temptation that someone will come and sell, either the government or the promoter. And that's what happened. The stock has already corrected from 530 all the way to this 450 level. But as promised, Gaurav, you're on the list today, you're on the watch list with few more stocks. Tell us.
Well, yes, first let's talk about Mahindra and Mahindra Finance. A very weak set of numbers is what we saw in terms of disbursements for Q1 FY26 because disbursements increased only by 1% on a year-on-year basis. Now, let's not forget in the same quarter last year, the disbursement growth was at around 5% and it is also lower than what the street was expecting. On the other hand, when we talk about collection efficiency, there we saw a little bit of deterioration. And in fact, when we look at the street's expectation now, they are also a little concerned about the growth because now analysts believe that the loan growth could be somewhere around 12% if the same story continues in the quarters coming ahead as well. On the other hand, when we talk about CSB Bank, a strong set of numbers is what we saw in this quarter as well. A loan book growth was at around 33% on a year-on-year basis, and this was led by the gold loan portfolio that the bank has. When we talk about deposits, there also we saw a strong set of number in the tune of around 20%. So definitely good set of number from CSB Bank. But on the other hand, M&M Finance is coming up with weak set of numbers for Q1 FY26 so far.
Okay, all right. Thanks for that, Gaurav. Well, I'm looking at Vedanta. And yesterday, the stock was excited. In the last few trading sessions as well, it was excited because all eyes were on the NCLT hearing. We don't have a verdict coming out of there, and there are, various technical factors that are still out play with regard to the regulators. So we'll have to wait for the outcome from the NCLT. For the time being, the next hearing is on August 20th. So that NCLT trigger didn't really play out the way the street anticipated. So that's why, because of the delay, we're working with a bit of a red today on the stock. The management, though, says they're committed to enhancing shareholders' value and they believe that this will ultimately get through. So management is confident that things will, move ahead in the right direction. Why are we saying, the stock opens up in the red? Because there'll be a delay to the timeline. Earlier, they were saying by September 2025, we'll have this demerger totally completed, which currently will not be the case. So from Q2, it becomes a story of Q3 FY26. However, the stock after opening up in the red could see some buying. Why is that? Because this demerger actually gives a big value unlocking proposition. The stock trades at less than 5 times EV upon EBITDA. And when you do the sum of parts, in fact, it can unlock value. Second factor is, the valuations, as I mentioned. And the third factor is the dollar index is weak. When the dollar index is weak, it's good for base metals. And Vedanta is the play on all of those base metals. So stock opens up in the red because of the delay in the demerger timeline. But some kind of bottom fishing could be seen at lower levels.
Okay, all right. So Vedanta is going to be on our radar. But yes, it's not a full green signal from the NCLT just yet. Let's quickly recap then our list of top stocks to watch. The ones that have positive news flow this morning are Avenue Supermarts, V2 Retail, Indian Bank and CSB Bank. Stocks with negative news flow would be Nykaa, Shakti Pumps, Hindustan Zinc, M&M Financial and Vedanta. PNB, we're keeping it on the yellow side. Perhaps a mixed reaction expected to the Q1 update.
Okay, let's also track Tata Power. Why is that? Vivek is joining in with the details. Vivek?
Well, that's right. An interesting update to the exchanges late last evening. So, what's actually happened is that there was an arbitration going on between the company and its Russian mining partner. And yesterday, the Singapore International Arbitration Center has ruled against the company. And in fact, they've asked Tata Power to pay close to $490 million in damages to his Russian partner, which is Kleros Capital Partners. Now, the payment has to be made along with interest as well as other legal costs that were borne by the partner. Now, what does Tata Power say? Tata Power says that it is in process of reviewing contents of this particular award and is evaluating all options, including maybe looking to challenge this particular award that has happened at Singapore. Now, what is this particular case all about? The case regards to a Russian mining partner where, remember, Tata Power and the Russian partner actually had a JV where they were looking to explore mining as far as Russia is concerned. And the main case revolves, given the fact that Kleros alleges that Tata Power breached confidentiality as well as non-circumvent clauses in the NDAs. So overall, watch out for a knee-jerk reaction as far as Tata Power is concerned in today's trading session.
Thank you very much for that. And let's round up all the action from the commodity and the currency space. Manisha Gupta joins in as always. Manisha, it's crude, which has risen overnight.
Oh, well, absolutely. 3.5% of gains coming in for crude oil prices, heating oil, even natural gas prices gained up by 2%. In the Asian markets right now, there's a bit of a profit-taking coming in, and that is because there are mixed cues. But the support definitely is from the fact that Iran is now suspended cooperation with the United Nations. Iran says that they are enacting laws that the future inspection of nuclear sites by the IAEA will need approval from Tehran's Supreme National Security Council. So clearly, that is what is adding premium back to the prices here. But markets also are looking at surprise buildup in the U.S. crude inventory. The demand doesn't seem so strong. That is what is capping gains in Asia right now. The U.S.-Vietnam strike trade deal agreement could add some positivity to many of these industrial commodities as we see more trade agreements come through. But what is going to be in focus today is going to be the U.S. jobs data. Further cues would come in from that. And it's not just the crude oil prices. Almost everything across precious metals and base metals seems to be doing well. Gold gained up by 1% overnight. Platinum, palladium gained between 4 to 5%. Iron ore and steel are up by 2.5% overnight as well. And then you have 3-month highs continuing in case of copper, zinc as well. So good going across commodities in Asia yet again.
All right. Thanks a lot for that, Manisha. Well, for the time being, we'll slip into a short break, but we'll take that discussion forward on commodities. Peter will be joining in on the other side to decode the recent rally we have seen in metals. Later on, Prakash Diwan as well will be joining us to help us out with some fundamental stock talk. Welcome back. It's a Thursday morning. Hope you're having a good start to the day. Well, we'll talk all things commodities, and to help us out with that, we have Peter McGuire, CEO at Trading.com, who joins us. Hi, Peter. Good to see you this morning. Commodities seem to be perking up a little bit. Tell us, how are you feeling about the space? You know, there is this hope that China is going to stimulate its economy. However, if I look at the recent prints that are coming out, actually June is showing some kind of indication of an improvement in comparison to May. What are you working with in terms of a stimulus coming out of China?
Well, good morning, Nigel. I think, there's no doubt the second half we're going to expect to see significant firepower coming from China. We understand where it is from a stock market perspective and from property and the property overhang. The other side, of course, has got to be internal demand. We understand that we're fairly along the road. I don't know what the deal smells like or sounds like or looks like as far as tariffs with the US, but there seems to be, from President Trump's words, that they're making some significant headway. So that should be a fairly good sign for second half of the year. I'm looking forward to seeing Q3 bid up as far as industrial metals. And as you mentioned, the overall theme moving forward, the likes of platinum is up 40% in the last 8 weeks. So the market's certainly on fire.
That's right. Platinum overnight as well, I think, was up more than 5% or thereabouts. What about steel prices first? Let's address that. There was a news report yesterday that suggested that a couple of provinces in China are going to be told, you cut down production because that's what will support pricing. The pricing in China has been very, very weak. If I plot a last 18-month trajectory, pricing has corrected from what? $690 per ton to sub $500 per ton. Do you think bulk of the bad news is in the price? And as these sort of prices, well, they'll be forced to reduce production, which in turn will support steel pricing. Are you in that camp?
Yeah, I am in a lot of ways, as you highlighted, down, the best part of 30% in that window of time. So naturally, the only way to get prices up would be restrict production, and in turn, that might add to, a rising tide lifts all boats. So I'm thinking as industrial metals gain some traction, copper's over 10,000 a metric ton now, all of these metals could see a nice bump to the upside over Q3. So that's the general theme. Also, that sell-off as far as US dollar can't be discounted.
Yeah, that's working well for base metals, actually, the kind of weakness that we're seeing in the US dollar. But give us a couple of levels. Do you think that, global steel prices, give and take everything, demand, tariffs, China stimulus, would you be leaning to an uptrend from here on Chinese steel prices, which in fact, is a trend setter for the rest of the globe? Should we expect steel prices in China to move up, say, by 5 to 10% in the next 6 months?
Well, I think so. I think they'll nudge up because I think that 30% sell-off that you've seen is really going to say, it's bottomed out. There it gets a point in time, like all commodities, they get oversold and overbought, and possibly they're quite simply oversold at the moment. So I wouldn't be surprised to see a bump up. Let's see what happens naturally, the likes of some of those industrial metals as well. And the overall consumption, I think, you've only got to go to a city like Mumbai and see the steel production and steel consumption. So the world is certainly building and it requires steel, Nigel.
Yeah, indeed. And from an India market perspective, we used to do 110, 120 million tons 2-3 years ago, and now we're doing more than 150 million tons. At the similar time, the global steel production has not gone up, neither has demand moved up. And we know on a per capita consumption of steel, we're much lower than the global averages. So India clearly is standing out, and the center as well has done well to protect us from imports. Got that. So that's out of the way. Let's talk about gold, because no conversation is complete without gold. It's holding around the $3,300 per ounce. Where do you see that one headed? Is the bias to the upside, or you wouldn't rule out, say, a 10% pullback from here?
I think the bias is to the upside in a couple of things, because one, you've had that big sell-off as far as US dollar. You can't discount it. Secondly, the overall demand from central bank purchasing and, of course, retail land. The next part is, and from a store of wealth, the next part is interest rates and the Fed, what's happening if we get that non-farm payroll tonight and it's better than expected. I think that'll really put pressure on Fed Chair Powell as the tariffs come into play on the 9th of July. All of these factors, I think, is going to push gold higher. So I think the second half is going to be more dynamic than the first half. That's a big call, but I still believe that end of Q4 will be higher than where it is at the moment.
Peter, hi. Great listening into you, your call on all the metals out there. I just want to round it off with oil, because overnight we had this development of the Iranians saying that they don't want IAEA to come in and inspect, given what's happened. And then we're moving towards this meeting as well, right? OPEC, or is it OPEC Plus, the meeting that's happening a couple of days down the line. So for the oil markets, what are you watching, and what's the kind of immediate range?
I think where it is, and good morning, Surabhi, a couple of things. First off, you've seen it pretty well, range bound. All the geopolitical noise and excitement has been drained out of the market. So I think it's going to hold these sort of levels. That's 64 for NYMEX, up to, say, 67, 68. I think it'll range trade unless you see something dramatic happen. There's talk as far as Iran. Well, this is... it's geopolitical talk. It's going to be very fascinating how this all develops, and it's only early in the storyline. So it doesn't surprise me, and I don't think it surprises many pundits at all. So we've just got to see what goes on over the rest of this month. But I think OPEC are going to significantly improve or increase their production, and there's going to be no shortage of oil.
Okay, so you're expecting, say if we talk about Brent, you're expecting it to range between what? 65, 60, 65, what's the range?
Mid-60s up to possibly a 69, 70 handle. But I think if they increase the production, I feel as though you're going to see, again, softness come across that crude complex. And that's I think the overall theme moving forward into Q3. I still believe there'll be a glut in the market by end of Q3, early Q4.
Okay, got it. So mid-60s to 70. I think we'll take that. We can handle that. Anything more than that is a problem for us here in India. But that's good to know. Thank you so much, Peter. You have a great rest of the day, and we look forward to connecting again soon. Thank you.
Thank you.
All right, with that, let's shift the focus to a lot of the fundamental stock ideas for the day, a lot of the analysis that we have to do, the top 10 list that we were just talking about. Prakash Diwan is with us. Prakash, I have, first of all, a disclosure and admission. I spent only 2 days in Goa, and I couldn't help feel envious thinking about you through and through. So I wish it was longer. Maybe next time, maybe we'll catch up. But yes. Coming back to, some of the updates that are coming in, lots of the financial updates have been coming through. Indian Bank seems to have done well. But for M&M Finance, those disbursement numbers are still in single digits. I don't know if you had a chance to see any of the financial updates. Any thoughts?
Thank you, Subhi. And thank you for the lovely compliments for Goa.
Kept thinking of you, yes.
Thank you. So, I think the financials have started not so much on a very, promising note as yet. I mean, it's too early days. It's just the first of the month, second of the month, and you'll start seeing things come up. And of course, you'll have to wait for the meatier part of the market to kind of report, share the updates. But my sense is that this is a quarter where things are going to likely to start changing. The gears will start shifting. The results will probably happen in the September quarter. Nothing much has happened in June. And more importantly, it's the ability of these larger financial services businesses, especially the lenders, to be able to grow credit at a pace where, it starts impacting the margins positively. Now, if you can take advantage of growth opportunities in the market, and surprisingly, a lot of the PSUs have also done very well, apparently, as far as what I can make out when I talk to a lot of banks and all at the ground level is concerned. So there will be improvement, which will be all across, but not very significant. So what happens is the bar is raised, but it will not make things so dramatic for the sector to kind of start getting those kind of valuations yet. But towards September is where things could probably look up, provided nothing else happens, nothing untoward happens during the next 2 months for the markets to kind of go negative. But I would expect the smaller banks will probably do very well as we start getting the updates from most of them.
All right. Hi, Prakash. Good morning. And good to see you as always. Goa, that's on my mind. I'm wondering which month I can make it there. But anyway, for the timing, I'm headed north over the weekend. Goa is something, but before the end of this year, and hopefully we'll have a drink out there. That said, let's talk about Vedanta. Yesterday people were tanking up in the last few days. There was a fair bit of delivery base buying on hope that the NCLT will get a green signal, give them a green signal for that demerger. I think there was a change in the bench as well, various other reasons why the demerger didn't get a green signal yesterday. But now it gets pushed by another 50 days for the next hearing, which is on August 20th. What is your view on the stock? In all probability, it starts off in the red today. As we have discussed in the past, there is value out there. Valuations are in favor. And the promoter as well appears that, they want to do the right things from here on. Deleveraging the parent, that's Vedanta Resources, giving a higher amount of dividend as well. And hopefully there is no big capex that is announced. Would you be a buyer on the dip, or would you wait for a sharper correction, say towards 400, 420?
So, good morning, Nigel. So, I don't think Vedanta is going to see very sharp correction unless, again, there is something in terms of, some news flow that upsets the commodity complex. But what this does is it gives another opportunity to investors. If today's dip is because of the delay or the, push out of the decision, it's going to be an opportunity for people who have not bought into it earlier. Simple. The math is absolutely in favor of buying pre-merger, because what you end up getting after the demerger is actually far more valuable, very clearly, whichever way you cut the math, it's going to be favorable. So it is important that people understand it's a question, it's a waiting game. Okay, it's not as in if it's about Vedanta finally getting to do things in a sequence which will probably be a bit longish. So if you're holding on for the next 12, 18, 24 months, there's enough value that's going to get unlocked. So it's a play which you can use very smartly with stocks and with some call options and all of those. I know people are very smart at all of these. I don't need to tell them that, but that's where you kind of sit in this. I don't expect sharp corrections. If you're waiting for that, you should keep accumulating. Look at accumulation. That of course it also has to be fitting into your risk reward profile as per overall portfolio sense.
Prakash, how should investors, retail, go about thinking about this US-Vietnam deal and the implications for India, say particularly the exporters in textile, for instance? What would your thoughts be?
Good morning, Rima. So I think this is definitely going to put some sort of a pressure on the India side, just because Vietnam competes with us very directly in some of the elements, and textile is probably garments particularly is primarily one of the biggest. It does end up putting pressure because if we don't do that, there's always an alternative source. The advantage that we have is the textile setup also has a lot of complexity, especially technical textiles, garments made out of a particular range of fabrics and price points is not something which Vietnam is very good at. So you'll only be left with that niche. So I think it does put pressure. I don't know how it pans out in terms of the overall deal that's likely to be announced, but you'll have to wait for it. There's nothing very attractive because of the deal today that you would want to buy. But my sense is that it's just that most of the markets in Southeast Asia have done very well in the last month and a half. We haven't done it primarily because of the lid that's been put on this FTA or DTA, which we are looking at. So this only accelerates the process, is my sense. It may not necessarily change the outcome, but it just changes the direction to the outcome.
Okay, all right. Stay with us, Prakash. We have a few more questions for you for the time being. Slip into a break, come back. Prakash still with us. He'll help us out with some fundamentals. And Sudarshan and Mitesh will join in to help us out with the technicals.
Welcome back. Yesterday, markets opened flat but inched lower and finally closed with a cut of about 90 points on the Nifty around the 25,450 mark. This morning, the GIFT Nifty is suggesting a mildly positive start. Sudarshan Sukhani and Mitesh Thakkar, as always, join in to help us with the technical setup on the markets and how you should approach trade. Gentlemen, good morning. Sudarshan, let me start with you. Your thoughts on the opening and the way to go about trade on the index?
Yeah, good morning. Well, we've had 3 days of consolidation and a minor dip, and the idea was look for a 200-point dip. That has also come about. We will still be in a consolidation in the sense it will be a trading range. I don't think the Nifty is ready for a very big up move, but today is a different day. I would be a buyer today. the consolidation and the minor dip could give us a decent tradable bounce. So buy the Nifty, keep a tight stop just below 25,350, and then see where we go ahead. But I would be a buyer.
Okay, look at the North America Class A truck orders. There is a decline on a month-on-month basis, 8,900 versus 12,000 in the prior month. So that's a 25% decline month-on-month. And on a year-on-year basis, it's a fall of close to about 36%. So Bharat Forge should be on your radar this morning. So Mitesh is buying, Sudarshan is buying the markets today, at least at the index level. Mitesh, what would your approach be?
Good morning. So, I think broadly the markets have been in some kind of a move, and last few days we have talked about the fact that we are overbought, we are hitting a supply pivot, and therefore some pullback can happen. I think 25,400 was my first target. That's been met, and in the worst case I'm looking at 25,200, but for the time being, assuming that 25,400 holds, and there's a good chance of that, then I think longs can be taken here. Keep a stop below 25,340, 330 zones, and on the upside, as we get closer to 25,650, 700, which is the falling gap area which we did last year in about September, October, I think that's where you would want to take profits on your trading positions.
Okay, all right. Good morning, gentlemen. Mitesh, you go first. Tell us what's your stocks on your radar, and if you have a view on CPCL, that's Chennai Petro, where highlighted that there was big delivery-based buying, and it continues to defend the 20-day MA. If you have looked at the chart of that one.
So I'll take Chennai Petro first, Nigel. I think, the stock has been doing a good consolidation in the last about 12 to 15 sessions between 710 to about 670. And the overall setup is quite positive. So I think once we start getting past 710, 715, I think the stock should signal next leg of an up move and possibly head towards levels of around 795 to 800. So very positive over there. I think wait for a breakout about 710, 15, and then take a 25-point kind of a stop loss. Look for another 80, 90 points on the upside. Coming to my stock recommendations, I have Steel Authority. In fact, the entire metal pack on the ferrous side is looking very interesting. I've chosen SAIL as a trading pick. So buy here with a stop at 134. Look for targets of 146. A buy on GMR Airport with a stop below 87 for targets of 92. IGL is a buy with a stop at 215 for targets of 230. And a buy on Apollo Hospitals. Keep a stop below 73.65. Look for targets of 76.50.
Okay, all right, got it, Mitesh. Thank you very much for all of those trading ideas. Let's come to Sudarshan as well. Morning, Sudarshan. What's your stock list looking like today?
Well, it's an all-buy list like the last few days. The trend is still up. Canfin Home is a buy with a stop under 795. Polo Tires is a buying opportunity, the stop under 458. And in the same sector, roughly the same sector, Balkrishna Industries is a buy with a stop under 2500. And finally, my last and fourth call is Deepak Nitrates, again a buying opportunity with a stop under 1950. There is something going on in mid caps, and you should focus on that.
Okay, something going on in mid caps. Got it. Thank you very much, gentlemen, for the trading calls. We'll come back to you a little closer to market opening. For the time being, we'll take a break. On the other side, of course, we'll have the pre-opening rates. And also, we'll be in conversation with Abneesh Roy of Nuvama Institutional Equities. We'll talk about the consumer sector. There's a lot of interest suddenly. Are there any interesting stocks where growth and valuations could find a good match? We'll discuss it when we come back. Welcome back. 2 minutes to go and we'll have our pre-open rates very, very soon. Let's discuss some more stocks with Prakash in the meantime. Prakash, consumer, I mean, we're going to get into a full-blown discussion anyway, but looking at the updates that have come in, Mangalam's been telling us Avenue Supermart and a couple of the others, V2 retail was good. Vishal was pretty decent as well. So would you look at picking up anything over here? Because the market's hope is that this is the pocket which hasn't worked for years now. And maybe there's a revival. At least the stocks haven't rallied. At least you're not buying at all-time highs all the time. Your thoughts? Maybe on Avenue or any other consumer stock?
No, absolutely. So if you recall when we saw the numbers come through for some of these other names, and remember the market has grown in terms of the number of listed plays that are available. Earlier, it used to be just a battle between Avenue and a Trend or something like that. Now you have so many newer options coming up. And all these options tell you that the leadership still rests with either Jio or with DMart, depending on what you seek out of these plays. Jio, of course, is looking at restructuring itself, getting ready for a potential float and all of that. But we don't know the timelines, and you can't participate in that except for buying the Reliance parent share. But DMart happens to be the only option that you have to actually make a proxy out of this entire sector or whatever. Now, if FMCG companies start sounding positive, and which they could possibly in this current quarter, given the monsoon has been timely and widespread, or blah, 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 you will probably see the retail segment also grow. And DMart has done what they've done smartly. They've started adding newer stores in potentially very promising pockets. And my sense is that they've done so much of internal efficiency exercises that you'll probably start seeing all of that expansion get them operating leverage far better than a V-Mart or a Vishal Megamart or whatever. So I would believe that if I had to allocate some money, it would only be to Avenue. But the valuations are still formidable. So you'd wait for a market softness in the market to give you that opportunity. But DMart definitely, as I mentioned last time, it's not about retail. They actually understand that business far better than anybody to be able to carve out that 10 basis point on every step of the value chain. And if that continues, you'll probably have a very, very formidable kind of an option to look at. But the valuations are a bit of a stretch for me, so I would wait for some softness.
I think someone told me the store addition for Avenue Supermart in 9 stores this quarter is the highest in the last 3 years. So I think as same-store sales growth, Mangalam was saying, is perhaps moderated because of the switch towards quick commerce, store addition has been very strong for Avenue Supermarts. And the top line growth is about 16%, slightly lower than the 17-18% seen in the prior 2 quarters. Prakash, share your thoughts on, we spoke about Nykaa, but what about some of the banking updates that have come through? So whether it's PNB, Indian Bank, Catholic Syrian Bank, any key takeaway?
Yeah, so, of course, it's too early, as I said earlier, that you will see a lot of more updates which will give you some sort of a trend. But if you ask me, I'm anticipating, I've not seen numbers yet, but I'm anticipating far better numbers from the smaller banks. Look at Indian Bank, for example. I mean, compare it with PNB. PNB is much bigger, Indian Bank is smaller, but at least there is very clear this thing about improvement. And when that happens, see, this is the base level formation, Rima. You will probably see credit quality improve. And of course, the softness in pricing itself helps them increase margins as they improve credit growth. The smaller banks have a higher delta in that because they've always got compressed NIMs, and this kind of takes that away. But CSB, Indian Bank, these are numbers that are far more encouraging. And I would allocate some money to smaller banks this time around because it's the overall sector that's going to grow in the September quarter. And when that happens, you have far better delta that comes through rather than a SBI and an ICICI and an HDB. See, all of those banks will grow as well. I'm not taking that away. But what I'm talking about is that the delta is far more significant here. So you'll generate some alpha. And there you have. This is a sector to allocate more money this quarter into, but the smaller banks will probably be leading the charge in terms of outshining the other ones.
Okay. All right, Prakash, thanks a lot for joining in and filling us in with all of those details. By the way, If you have to look at some of these names that in pre-open are giving you a bit of an uptake, we had look at the top line growth of V-Mart, case in point. That's in mid-teens at around 13% from the quarterly update. V2 retail actually was up closer to around 51%. So that in fact is showing a sharper uptake. I think it's up closer to around 5% just in pre-open. I think that's the circle limit as well. And Bazar style retail, that's a smaller one as well in there. That growth in revenue terms was up 37%. So that's another smaller one out there. That as well has perked up a little bit, 2.5% higher on that one, Surabhi.
Okay, absolutely. And by the way, since we're checking all the important news-based stocks in pre-open, should also put Vedanta on the table. Vedanta, I mean, at least in the pre-open, there's not much of a big reaction. It's down about 0.5%. Because the company has reiterated that they're very firmly standing behind this four-way demerger. They just think it's it's just a bit of a delay at the court to get the approvals in. But they think that this is the way to create shareholder value, and they're quite confident of pushing it through. So that's Vedanta, down just about ₹1 at this point. But as promised, let's get back to that conversation on the FMCG and consumer space. We have Abneesh Roy joining in, Executive Director at Nuvama Institutional Equities. Abneesh, thanks so much for being with us. Everyone's looking out for these FMCG and other consumer/retailing companies, hoping that there'll be that burst of growth where finally the market attention can get back, especially on staples. What are you working with? Let's get your sort of broad brush expectations, consumer expectations for Q1.
Sure. Thanks and good morning to everyone. So yes, we are seeing the macro improving. If you see, most of the parameters which are needed for a consumption boost are coming into place. Yesterday, there was a talk about GST rejig also, and they're talking about 40 to 50,000 crore kind of a consumption boost. This is over and above the 1 lakh crore tax rebate which happened in the union budget. Monsoon is good, palm oil in control, crude oil in control. So a lot of the macro, we are seeing improvement. In Q1, you will see still a slight lag in terms of recovery in consumption is there. Our sense is from Q2, you will see the initial signs. Some companies are already seeing some level of improvement. For example, in Hindustan Unilever, which I think is the barometer of the sector, we expect 3% plus kind of volume growth in Q1 versus 2% previously. Avenue Supermart update was decent with a 16% sales growth. They are adding now UP as a new market. That's obviously India's largest population. So next 3-5 years, I expect Avenue Supermart store addition to be strong. In this quarter, you will see the summer category being quite weak. So Varun Beverages, Imami will be weak number. We are also slightly underweight on Maharashtra liquor spirits market because of this new development. So you will see that overall starting Q2, United Spirits numbers will be weak. Even in Q1, slightly weakish numbers from United Spirits. So in the alcohol, we'll have a clear preference for United Breweries as the stock. They will see beer consumption go up in Maharashtra. In the core staples in Q1, we expect good numbers from Britannia, almost high single-digit sales growth and margin expansion because palm oil has corrected. We also like Bikaji. We like Nestle. Yesterday, they have opened more expansion for the Maggi, which shows the confidence coming back.
Okay, very quickly, since of course you've mentioned lots of companies, if I were to once again ask you, top 2 or top 3 companies that are likely to showcase the highest volume growth in this quarter, which ones would they be? Top volume growth drivers?
Yeah, absolutely. So Marico update will come anytime. We expect 7% volume growth for the India business. Bikaji will be 8% volume growth. These two, if I have to highlight, Bazar also quite positive. We expect almost 6-7% volume growth. In our view, paint stocks bottoming out is there. Gradual recovery will start. Consolidation has happened. Axo has gone away, and now JSW is there. So we are positive on the paint sector from a longer term. But Bazar and Indigo, there is a revival in Q1 itself.
All right. Hi, Abneesh. Thanks a lot for joining in. You briefly mentioned HUL, the 3% growth, I think is what you mentioned. A lot of investors say this, that everyone says buy high pedigree names, good quality, good products, etc. So some of them would have bought HUL 5 years ago. To their bad luck, the Nifty is compounding at more than mid-teens in the last 5 years, but their stock price is the same. Do you think the time has come now for HUL to perform? Because we have seen this in the past. I think in that period from 2008 to 2018, it didn't do much. And then the stock went up 3 times or more than that. Do you think the time has come now that HUL deserves to be a buy?
I think very good question. In many large caps, we did see in other sectors 4-5 years nothing happened and suddenly stocks have gone up. I think in case of FMCG, HUL will be still slightly lower in pecking order. Yes, stocks should revive because ultimately for any FMCG, volume growth is very important. And Marico stock, if you see 7% kind of volume growth has really supported the stock. So yeah, I like Hindustan Unilever. My preference in terms of pecking order, we like Britannia more, we like Nestle more, because food categories will grow faster. In case of HUL, the issue of Horlicks continues to remain as a challenge in terms of growth. And in terms of D2C competition, Minimalist is a good acquisition. Near term, the issue for HUL will be the lower margins which they are already guided. I think Q2, there is a surprise positively possible because palm oil, there is a correction. And coffee costs have also come down by 30% in the last 1 month. But in terms of preference, HUL will be lower in the pecking order. But yeah, I think from the next 6 to 12 months, it could give a 10 to 15% return.
Got that. Just to get back to the point about GST and the likely relief for middle and lower income. So they would target items like toothpaste, tooth powder, umbrella, sewing machine, pressure cookers, kitchen utensils, bicycles, etc. So do you want to tell us 2-3 stocks which would, directly benefit if this were to come through? We should keep on our radar.
I think in the listed FMCG space, not much. Toothpaste is at 18% rate, so it's not at 12%. At 12%, we have very limited niche products in FMCG. So I don't think the listed space, any direct play is there. So we are talking about ghee, we are talking about, say, drinking coconut water, etc. Those are very small segment. The real boost will be in terms of customers saving on those because he will pay lesser. And there can be 40,000 crore kind of stimulus program, but very early days, we need a consensus in the GST. But again, if you see, this is in sync with what government has done. They have reduced the import duty on edible oil a few weeks back. They have given 1 lakh crore kind of stimulus in terms of tax rebate. So clearly, government is looking for a lower inflation and more stimulus because urban demand continues to remain quite challenging in terms of the lower end. So I think they will address.
So Abneesh, what you're saying is, and I know, we don't want to speculate and guess too much on this right now. It's within the realm of the policy. But you're saying that from the listed FMCG universe, you're not expecting the slab changes or the rate rationalization to be too material for listed FMCG companies. Is it right?
That's one scenario. For example, if 12% moves to 5%, no big direct benefit, small here and there can happen. As I mentioned, ghee and some of the other segments are at 12%. Tooth powder is at 12%. So, but that's very small part of the listed oral care companies. Toothpaste is the big segment, which is at 18%. So yes, the other scenarios could be they do a complete rejig, right? If they do, for example, instead of a 5%, 18%, 26%, they have a different rate, then we'll have to see. But as of now, the more likelihood is that 12% merges into...
Moves to 5%.
Got that. Thank you. Thank you very much, Abneesh, for your, providing that clarity. 9:10, Sudarshan is back with us. What would your calls be?
Well, Canfin Home is a buy with a stop under 795.
Okay. Mitesh?
I'll go with a buy on Steel Authority for targets of 146.
Thank you. Let's talk about the US-India trade talks now. Government sources say that an interim trade deal could be signed with the US within the next 2 days. Abhimanyu joins in with the details that he's picked up.
Well, intense negotiations are underway in Washington, D.C., where India's chief negotiator, Rajesh Agrawal, has gone along with the entire trade negotiation team, and several issues, several tariff lines are being discussed. Of course, government sources have also communicated that none of India's interests would be compromised, particularly in the dairy and agriculture sector. And also, it has been indicated by sources so far that the entire sectors of dairy and agriculture cannot be opened. However, some piecemeal relaxations may be given to niche products, premium products, which are often imported into India from the United States, which may involve pecan nuts or even Washington apples and walnuts for that matter. It remains to be seen how early the negotiations are going to conclude, even as the 9th July deadline for the end of the stay on reciprocal tariffs is fast approaching. So, of course, both the sides are keen to seal a deal. However, there is no desperation per se. That was the word which had initially been communicated from government sources. Now, negotiations are continuing between both the sides, and also the US is negotiating with several other geographies. India is also negotiating FTAs with several other geographies to hedge its overall risks, even as all options remain open with respect to signing of a trade deal, of a bilateral trade agreement. Now, this is an interim deal being negotiated at this point of time, and following which the first tranche of a BTA would be discussed, and for that, of course, both the sides are looking to sign the first tranche by September or October of this year, which would be followed by a complete trade deal. So the interim deal will involve several tariff lines, thousands of tariff lines, followed by the first tranche of the deal, which will also involve several other goods and also possibly some bit of services, which would be followed by a full-fledged deal. So an interim deal right now is being discussed, and it remains to be seen how early it is going to be concluded, and more importantly, which all tariff lines are going to remain a part of it.
Got it. All right, Abhimanyu, thank you very much for that quick update on that important development. So we'll keep watching out for more on this. But before we hit market opening, let's quickly look at Brigade Enterprises. The company is looking at raising some funds for one of their arms. Sonal has more details. Sonal.
Oh, well, it is a valuation setting exercise that Brigade Enterprises is doing for its hotels arm, which is Brigade Hotels Ventures Limited, which is the wholly owned subsidiary of the company. They've gone ahead and issued shares to some of the investors, which includes 361 Alternative Asset Management. 1.4 crore shares have been issued at 90 rupees per share. Now, this gives 361 around 4.74% stake in the hotels division, and it values the hotels business at around 2,658 crore rupees. Now, do remember, Brigade Hotels has filed for a 900 crore rupee IPO. They have 1,600 keys, 8 hotels, average room rate at 6,260 rupees per room. So this is just the start of that valuation setting exercise which Brigade is undertaking.
Okay, all right, got it. Thank you very much for that, Sonal. We are counting down to the open, and the start is going to be almost 50 points higher. So we're right in the center of that range, and this is where we spent the last 4 trading sessions now. Between 25,500, 550 to going up to about 25,600. So let's see how it plays out. Yesterday, the Bank Nifty played spoil sport. Let's see if it can be any different this time around. So just waiting for the countdown and the opening bell to go off, and here we go. All right, so we have a 42-point gain, 50, now 60-point gain on the index. And leading it from the front would be some names like Power Grid, Tata Motors, Shriram Finance, Wipro, Infosys. So these are the early movers. On the downside, some of the banks are still dragging. Some of the financials are still dragging, which was the issue with the market yesterday. So names like HDFC Life, SBI Life, lower this morning. Kotak, down over 1%. IndusInd Bank is still down. Yesterday, it was reacting to a downgrade coming in from a brokerage note. So these are stocks which are still on the lower side. Nifty is just about trying to digest that gain of 40 to 50 odd points. Let's see. Bank Nifty is absolutely flat, but mid-caps off to a better start this morning.
Okay, let's quickly run through the large cap action then. In the Nifty, the top gainer today is Power Grid. Asian Paints too is shrugging off news about that CCI probe. Yesterday also it recovered nearly 3% from the day's low to close higher by 1%. It's added on another 1%. Eternal is up. Moving with strength are a couple of these commodity names, metal names, Tata Steel, Hindalco on the buyers list. IT heavyweights like Infosys, Wipro seeing buying. The gains are up about 0.5 to 1%, but in the green now for even a Power Grid, Shriram Finance, L&T. These are some of the stocks holding up in the green. On the way down, you've got Kotak Mahindra Bank hit, IndusInd Bank, where there is a Macquarie double downgrade. So after Goldman's downgrade yesterday, there is another negative brokerage news, and the stock is open with a cut of about 0.5%. Bajaj Finance has lost 3% of its market cap this week. Reliance Industries is retracing. In the morning, there was news about, in one of the pink papers, about how the company is looking to consolidate all the FMCG business into one entity so it can get the investor interest and the management interest focused and targeted. Reliance Industries, a little bit of a profit booking. But other than that, it's mildly positive now for the benchmark indices. Outside of that, it's Nykaa, Avenue Supermarts, Nigel, which are under pressure.
Well, that's right. Nykaa, that large trade has taken place, which is up for you on the screen. 6 crore shares getting, changing hands out there. So that's out of the way. Let's see what the stock does. 204 thereabouts. Let's see if there's a recovery inside. Avenue Supermarts, that's taking on the chin. But the other smaller players, V2 Retail, that's up 3%. Bazar Style Retail, that as well is up close to around 2%. So contrasting reactions is what you're seeing on that one. V2 Retail still up close to around 3.5% in trade. Vedanta, actually, it's a good day for them to come up with that NCLT deferment to August, because global cues are fairly okay. The street is a little bit optimistic on metals. So the stock is down only around 0.5% or thereabouts. There is value. However, that demerger timeline could get stretched a little bit. For the time being, stock down only around 0.5%. PB Fintech, there's that upgrade that's come about. So that stock's up close to around 2%. Mahindra Financial with that as well is reacting favorably. Bharat Dynamics, that's the one actually that's pulling back today. That's down close to around 2%. Remember, some of these defense names have seen a big run. But, now, in fact, that one has come in for some mild profit-taking as we speak. But the market's up 60 points. Let's see whether or not we have enough to go to around 25,600 or thereabouts. Today, remember, U.S. markets will be shut early, and tomorrow they are on holiday. So the bulls will be going according to their own steam.
One thing that's quite evident in the market action is the propensity to start moving towards consumer stocks. And we keep seeing instances of that day in and day out. Look at the stocks on the move today as well. Rima, of course, highlighted Asian Paints. There's accumulation that started. Now, whether this continues and becomes a lasting trend or not, we'll have to see. There's Eternal, which is doing pretty well. And there are names like Tata Consumer as well on the upside. So interesting move coming in, 63 points higher on the Nifty.
On Asian Paints, Abneesh had earlier written, we had spoken to him, but he had written it will be difficult to prove the CCI probe into Asian Paints abusing its dominant position. Many times, disgruntled distributors initially complained, but eventually they retract. This is very similar to the JSW complaint about 6 years back, but eventually CCI dismissed the complaint, saying that there was no conclusive evidence.
Yeah. So maybe not as damaging.
Not as damaging, and perhaps the CCI could dismiss it. At least that was Abneesh's, one way of thinking about it, which is reflecting in the way the stock moved yesterday also.
Absolutely.
And even today now, 1.5%.
It's also a lot about where you are in the market at what point in time. Now, if Asian Paints was coming off, after a strong 1 year, 2 year rally, then maybe the market reaction on the news of a CCI probe would have been very, very different. But we're in a very different space when it comes to the paints sector. But let's discuss this and more with our next guest. Vineet Samre, Head of Equities at DSP Mutual Fund, is joining in. Vineet, great to have you on. Thanks so much for being with us. We were just discussing amongst ourselves, because we look at so many views coming in from the sell side, and it's almost like a perfectly balanced market between the bull camp and the bear camp. CLSA, and we were just highlighting this. We spoke to, Vikash Jain of CLSA, just earlier. And they're obviously very cautious. They're going with the narrative that earnings are not really picking up and the market's expensive. On the other hand, we just spoke to UBS, Hartmut Issel, their Asia equity strategist, and he says, hey, earnings will pick up. You've got a low base. You'll have double-digit earnings. There's a fiscal boost coming in as well in the form of the income tax cut. So why wouldn't I buy India? He's more optimistic and constructive of the market. Which of these views is more palatable to you?
So clearly, as long-term investors, I think the second view is more palatable. But let me say that I think at the moment, both the views are somewhere, I would say, balanced. And I think it is a time frame with which each of them are sort of looking at the situation at the moment. And clearly, as we have recovered from the market lows, which we had seen in the month of March to now, valuations have seen, it seems to be a bit punchy across the board, not just a few sectors, but across the board. And on top of it, we are entering the first quarter with a slightly moderate kind of an expectation. Demand momentum has still not maybe caught up, to the expectations. And we believe that all the factors, the macro factors which are required, like you mentioned about the taxation, interest rates, and all of those, I think definitely those will have a positive effect on the growth, on the economy. But maybe it takes 2 quarters or 3 quarters down the line, maybe through the festival season, we start seeing some improvement. But I think from my perspective, I would say that the macro factors are now more conducive for growth versus last year. And all of these factors should eventually mean that, and with the low base of last year, maybe this quarter, next quarter, we still have a slightly lower growth. So from that perspective, I would say that the growth outlook should start improving maybe towards the second half, and that's where one should start looking at some directions for the market.
So how has this, Vineet, morning influenced your portfolio decision making, say, in the last 1 month? Can you tell us what you all have been doing at DSP Mutual Fund?
Yeah, so see, broadly, I think the portfolios really doesn't change as much really from the very short-term perspective. But broadly, what we are trying to align our portfolio towards is these macro factors which are going to mean that the balance of trade could shift to consumers as a category towards the maybe end of this year. The banking and the lending space could start again becoming good because we have actually reached a stage where the credit growth is lower than the nominal growth of the economy. So that's something which is alarming, and that could sort of start becoming better as we go forward. And incrementally, I think there are some sectors where we believe they have been in the low cycle over the last 2 to 3 years, including the rural side of the economy, the agri input as a category, the specialty chemicals. All of those are something where we are seeing some bit of recovery trends coming about, while it still remains very volatile globally. But we believe that after having seen a consolidation over the last 2 to 3 years, these segments could also maybe provide a decent opportunity again from the next 2 to 3 years perspective.
Hi, Vineet. Good morning. Good to see you, Vin. What about allocation? There was a time, I think around 4 to 5 months ago, where those small and mid caps that gone through the roof. Then they went through a cooling off period, actually, which would have been a great time to enter. And if I remember correctly, somewhere in the month of March, you were saying that maybe it's a good time actually to allocate to some small caps at this point of time, small and mid caps. Post the recent run up, some stocks have bounced up 30-40% as well. What would your capital allocation strategy be?
No, so I would, Nigel, I'm very biased towards the small and mid cap. Having seen the segment for long now, I believe that generally there are broader opportunities which one is able to play through these categories, and one has to really take a long-term view because we have seen many companies. In fact, let me give an example that 5 years back there was no EMS as a category in India, and look at the market capitalization of the largest company out there. So I would say opportunities are also sort of coming up. One needs to keep a much more diversified view and also a long-term view around these categories. And hence, I would say that having a decent size allocation, if one is thinking of next 7-10 years, towards a small and mid cap is not an issue at all. Short-term movements are very difficult to capture and forecast, and hence I think one should clearly take a longer term view around these.
Vineet, let me quiz you a little more on the consumer call, because that's also becoming, I mean, not a really consensus call in the market, but increasingly people are veering around to the view that at some point consumer stocks have to perk up. Which segment are you relatively more optimistic on? I mean, while discretionary consumption anyways, when we were discussing this actually on the editor's playbook yesterday, and that show will play out soon enough on, on CNBC Access. But discretionary consumption stocks like Indian hotels, etc., they've already gone through the roof. But more mass consumption, do you expect that pick up? And how would you play it? Retail, apparel, FMCG, I don't know, coolers, ACs, how would you play it?
No, so I think you're right. And very frankly, it is a bit confusing because very difficult currently to understand the demand trends. While we broadly know that consumption as a category should do well given what's happening. But like you said, I think it is going to be a bit tentative because as we look at, different categories, the quarterly numbers or the commentaries are not, very clear in terms of how the trends are going to sort of sustain going forward. So maybe it would be a good way to create a basket of categories, a basket of companies within subcategories, maybe a white good as a category, apparels, innerwear, QSR. Some of these, and take a broader call that if we broadly are with companies which are sort of leading companies within those spaces and likely to be beneficiary of the macro trends, I think we need to take them as a basket approach, and which is what we have also done as a part of our portfolios. And especially if you look at a small cap fund, I think we have even more broader segments to sort of look at. And from the other perspective, I think we are also thinking that the mass consumption, which you mentioned, I think the low income category definitely, which was hurt a couple of years back. Now, I think we are seeing them also maybe going to participate in this consumption trend. So that's one area. The other, other which is from the macro front, we have a bit of a contra trend, which is the auto ancillary today, where we are seeing the growth for the OEs bit low. But I am generally positive on the auto ancillary front because I think these companies have created very strong franchisee and they are able to capture the global markets and capture even wider areas beyond auto, let's say aerospace, defense, and all of those. So I would imagine that it is also going to be good to have allocation towards those categories because the companies there have created very strong, franchisees for the products which they are into.
Okay, so advisable to take more of a basket approach, basically, because you don't know where the wallet will open and where the money will be spent, whether it's shoes or apparel, like you said. So maybe better to take an overall approach to these things. What else, Vineet? I mean, where else are you optimistic looking at the second half of this year? You mentioned financial services. Again, that's a very wide universe. So there, as we go through this rate cut cycle, I mean, where are you more optimistic? Banks, non-banks, maybe some of the side plays like maybe insurance, capital markets, etc. What do you like here?
So I would say that in the order of, let's say, preference, I would first go for the non-banking financial companies because there the benefit of cost of funds will flow through maybe 2 quarters down the line and they will see much better growth prospects. Again, the low base should sort of help these segments. Beyond that, I would also say that the life insurance companies, while they have moved up and the valuations particularly are not very attractive, but still, I would imagine that the sector is coming out of a very strong regulatory headwind over the course of last 1.5 years. And maybe, and despite those headwinds, I think the sector has performed quite decent in terms of their overall performance. So having a positive view around those as well. And capital markets, actually, it's very cyclical. Maybe next 1 or 2 quarters, if we have more market volatility and some of these names become slightly more palatable in terms of valuations, we are open to look at those as well.
Vineet, thank you very much for joining us this morning. Moving on now to the consumer durable space. Now, channel checks suggest that weak sales and demand for room air conditioners amid the early monsoon and weak summer has hurt sentiment, especially compared to last year. So we have with us B. Tyagarajan, Managing Director at Blue Star, with us on the show. Thank you very much, sir, for joining in. Would it be fair to say that Q1, the room air conditioning market, RAC, could see a drop of 20-25% given the monsoons that we've seen, the fact that summer demand, consumer sentiment has been weak? Is a 20 to 25% decline for the industry or for your company a realistic assumption?
Good morning, Rima. Wonderful to talk to you this morning. This has been in the news for quite some time. From April onwards, there has been a monsoon and the temperatures did not go up at all. It's a weak summer. So prior to the end of the quarter itself, the industry has declared the degrowth over last year would be around 25%. Remember, last year was a bumper summer. It was more than 57% growth. Now that has been in the news, so nothing is going to change now. It's a quarter which was bad for room air conditioners, may not be that bad for commercial refrigeration products. Having said that, to take a CAGR, still it is holding up at 15% CAGR, and even after this weak summer. So if you are part of this industry, one will have to cope with these unfortunate seasons. That's perfectly fine.
So you're saying a 35% drop for the industry in Q1 for room air conditioners? Did I get that right?
My estimate is the industry should have grown by around 25%. Blue Star also, I have been stating this for the past 2-3 months that that it is so. And I have also stated one more thing. Whenever the summer season is weak, the festival season and the subsequent Q4 always have done well. And, I have plotted all the weak summers in the past. Eventually, some 10 to 15% growth is really possible. It should happen.
Okay, so 25% lower for Q1, but for the full year, 10 to 15% should stay intact.
Yeah, I am maintaining that this has been...
You're maintaining your full year guidance. Got that.
Yeah.
Okay. Sir, so, the other issue was this whole compressor issue. That was something that was hurting the industry till a couple of months back. That has resolved itself completely now?
I would say provisionally, because there was an extension that was given. This is a non-tariff barrier. So let us get the big picture right. There is a PLI, component ecosystem is coming up, and for compressors, the facilities are coming up. And I think by 2028, India should be self-reliant on compressors. In the meanwhile, the extensions are being given. It's sometimes 6 months, sometime 1 year. So at least at this point of time, there is respite still around June 2026, and industry will have to work together to ensure that we become self-reliant. I think by 2028 it should happen.
Hi sir, good morning. Good to see you in. You're sounding optimistic about the next few months, though the start to the year has been quite soft. You had pushed through a price increase in line with what the industry as well had done. What is the trend in terms of pricing from here on?
See, whenever the summer season is weak, so one would like to clear out the stock. Stocks are not at abnormal levels, but one will have to clear out the stock. And remember, there is going to be an energy label change that's coming up on 31st December 2025. And so there will be huge sale of old energy label products, and moving into 2026 there will be demand for new energy label products. The consumers will behave both way. Someone would like to buy today's 5-star, somebody would like to buy tomorrow's 5-star. So the festival season is going to be exciting. At this point of time, I don't think there is a huge price drop that is happening. But I can imagine whenever there is a weak summer, you will not have opportunity to improve the margins. I don't think so. So next 3 years, Nigel, we talked about it. It's like the Duckworth-Lewis method. So you don't know really whether to score runs or hold on to the wickets, and that's how it is. We will do so.
It's been actually a good start to the test match. I hope so, that our boys can pull it through. We put up more than 300 runs on day one, and it seems, hopefully we'll have this covered. That said, getting back to business, your market share has been gradually improving, and you have outgrown the industry. Could you give us the targets for the next few years, Mr. Tyagarajan? Where do you see your market share headed?
No, as we have declared that our immediate goal is 15%. We were somewhere near 14%. And that is something which we could not do it last year. I think we will persist with that. The strategy behind that will be to have products at all price points and to differentiate ourselves through exceptional customer experience. The consumer expectations are also changing. They are used to now quick commerce. So they would like the air conditioner to be delivered the same day, installed the same day. The service level expectations are going up. So we continue to invest in these areas so that we are a differentiated player, and we have the products at all price points and continue to expand the distribution network. I think we will be able to get to 15% or closer to 15% at least by end of this financial year.
Sir, considering that Q1 has been a bit of a washout, what will this do to your margins? I think you're guided for about 8.5% in terms of EBITDA margins. Will you be able to manage that in Q1? And for the full year, what are the raw material trends that you expect?
Our policy has been clear that if there is a raw material price increase or input cost, we'll pass it on to the consumers. We will roll it back if it is coming down. I do not see a major problem in margin management rest of the quarter. The Q1, of course, was always known that you are planning for 25-30%. When that didn't happen, right from April, May, we have been declaring that this quarter will be a quarter which is disappointing. I won't call it washout. The degrowth is compared with the previous year, which was a bumper year. So if you are to be taking average of the 2 previous years, still it would have been a flat growth. So there is nothing to worry about that. So it is just that your expectations were high based on the IMD forecast. Therefore, one is disappointed. That's about all. So the industry has been playing responsibly, is my view. And let's say, what are we talking about? We are talking about 8 to 8.5% operating margin on a full year basis, whether this category can deliver. I continue to maintain that it will be possible.
That. Just a quick word on commercial AC, CAC as you call it. What's been the growth in Q1? Because data center demand is really fueling, growth in this category for you. So what is your revenue contribution from commercial ACs? What is it growing at? And give us some projections, say in the next 2 or 3 years, what could that number look like?
I will not be able to talk specifically about Q1 because we are on a silent period that till the results are declared. But commercial refrigeration has the potential to become another room air conditioner category for the simple reason the penetrations are very, very poor. The growth projections are at a CAGR of around 25%. And Blue Star is a leader. We are present in every part of this segment, whether it is deep freezers or bottle coolers or cold chain, and we are not present only in the transport refrigeration part of it. But unfortunately, the market size is very small. It is less than 5,000 crores, and I would expect this to triple by 2030.
Yeah.
And driven by consumption of frozen food. Right now, the growth is driven by also the quick commerce delivery platforms. A lot of cold storages are set up by them. And the pharmaceutical industry is expanding. And most importantly, the traditional retail or what we call as Kirana stores, they are modernizing.
Correct.
It's an exciting part of business for us.
Sure. So commercial refrigeration, that's a segment to watch. Sir, very quickly before we let you go today, could you just tell us, with Q1 being as lackluster as it was, what are your inventory levels now? How do they compare with average inventory levels? And also, roughly speaking, what is the utilization rate at which your plants would be operating?
Again, much before the end of the quarter, I have disclosed this to you and the financial press. The productions were cut down by 25 to 30%, depending on the SKUs. And because manufacturing is happening locally, I do not think finished goods inventory is an issue at all. One will have to look at the dealer inventory, whether they all, if you recollect in March, they purchased for the rest of the quarter, and they are also diluting it. And I don't think inventory is a major issue. Perhaps, 2 to 3 weeks more inventory maybe in the system, that is perfectly fine. And the good thing that has happened is with the local manufacturing, you do not have this issue. Earlier, prior to 2021, containers of air conditioners would have reached India, and you will struggle for 6 months till the onset of festival season to liquidate. That's not the case anymore in the industry.
And sir, the capacity utilization at present?
Going forward, forget Q1. Going forward, it will be on an annualized basis. We are running tight. We will be close to around 100% because our expansions are happening modular depending on the demand.
Okay. All right. Got that. Good to know, and lots of details over there. Thank you, as always, for joining in and giving us some perspective on how things are shaping up now that Q1 is over. That's Blue Star talking about things picking up in the second half and retaining their guidance of about 15% growth this year. Let's move on then to a CNBC-TV18 exclusive. Karnataka Bank saw a leadership shake-up after its MD and CEO Sri Krishna Harihara Sarma resigned, citing personal reasons. The company's executive director, Sekhar Rao, also resigned, citing personal reasons and the inability to relocate to Mangaluru. In an exclusive conversation with Lata Venkatesh, P. Pradeep Kumar, the chairman of Karnataka Bank, spoke about the interim arrangement and the impact of these leadership changes on the bank's business. Take a look.
Yes, both the MD and ED have resigned. Mr. Raghavendra Bhatt was an ex-CGM of the bank, is a retired CGM of the bank. We have just inducted him as a COO. We have recommended an interim MD to the Reserve Bank of India. We are awaiting Reserve Bank of India's approval for the new interim MD.
Fair enough.
And we trust that the Reserve Bank's approval for the interim MD will be in place before the 15th July when Mr. Sri Krishnan will be resigning.
Okay, fair enough. What is the more longer-term plan? Have you all already started a search for a new MD? And is it, some organization, an HR company, or is it an advertisement? What is the procedure?
We have already constituted a search committee on the same day when the resignation was accepted in the board. They are in the process of appointing an HR firm. Okay. And maybe in the next 1 week, we'll appoint the HR firm and then go forward with the selection of the new incumbents.
Okay. By when do you think the entire process will be completed?
I mean, it's very difficult to estimate. Maybe 2 months for month and two for selection, another couple of months from RBI for approval, maybe 3 to 4 months.
Okay, okay. Did Mr. Raghavendra Bhatt retire recently?
No,
is he familiar with the bank? Is it just like a very
He retired
recent...
in 2019. He's very familiar because he was with 38 years with the bank.
Okay.
He knows the bank inside out, including the people.
Okay.
That's a great advantage. That is why we thought is the right choice to bring in as a chief operating officer so that the operations don't suffer.
Okay. Is there any preference in terms of the terms of reference you give the search committee? Will it be internal candidates who will be preferred or any such term of reference?
I think we look at the entire universe, internal and external, and choose the right candidate for the bank.
Okay. Is there anything at all that Reserve Bank has communicated to you in the last few days? You did say that you are awaiting Raghavendra Bhatt's, appointment as the interim MD.
No, I am not told that Mr. Raghavendra Bhatt is being appointed as interim MD. Mr. Raghavendra Bhatt has joined today, the 2nd July, as the COO.
As COO.
We have recommended to the Reserve Bank of India person for the interim MD.
Yes.
We are awaiting Reserve Bank of India's approval. I think we will be able to get it from Reserve Bank by the 15th July.
Okay, so the COO is not the person being recommended as interim MD?
I can't say anything at that time who is the new interim MD.
Okay.
I mean, these are all, unless the regulator approves and I tell the stock exchange, I can't tell anybody else.
All right, fair enough. Any other intimation at all from the Reserve Bank? Or any other conversation you may have had?
No, see, conversations will happen with the regulator continuously. So we've had conversations.
Okay. Well, we were given to understand that under the previous MD, there was a process of digitalization and retailization. This is what we heard from people close to the bank. Are those processes likely to continue? Do you expect any disruptions?
Whatever changes have been initiated will continue. All the changes are for the better growth of the bank. I don't think there will be any disruption.
Okay, okay. And did you notice any withdrawal of deposits, any problem at all in the bank because of the resignations?
Here and there were some small withdrawals, but nothing significant as to affect the bank. The bank's liquidity position is very comfortable. Okay. And if you had observed our capital adequacy ratio is at 19.85, I think, which is one of the highest in the industry. So we have enough capital for growth for the next 3-4 years, and we have sufficient liquidity. I don't think neither liquidity or capital or growth is going to be affected.
Okay. Well, if you can dwell a little on the past, we heard about some auditor reports on 1.5 crore of expenses which were not authorized or above the authorization for the MD and the ED. But the resignation letter said personal reasons. Is there anything you can add in terms of the reasons for their sudden quitting?
I think these are two different events.
Okay.
Yes, there were some differences which have been resolved amicably. That's what we have said in the press release also. These resignations, they have said, is due to personal reasons. The MD wants to move back to Mumbai.
Okay.
And in case of ED, there has been some move by RBI to stay more often in Mangalore, which he says finds it difficult because of his personal circumstances.
Fair enough. So, you know, the separate issue which investors in the share market have is that in many old private sector banks, when a new person with new ideas of maybe digitalization or computerization are introduced, there is a dissonance. Have you noticed any such dissonance? And is this something that the bank will have to tide over?
The digitalization process, I think, started somewhere in 2018, much before I joined.
Okay.
BCG were our consultant, so this is not something new. Okay. He was taking forward those initiatives and some more new initiatives. So I think there is no dissonance in the bank. I mean, without digitalization, I don't think the bank can survive or any bank can survive nowadays.
Okay.
We are like any other bank, depending on more and more on technology and digitalization for improving customer service, for retaining customers, and for growth.
Okay. So there is no dissonance between the management and the rank and file of the bank. That's what investors would worry. That's why I'm asking.
I don't think investors have anything to worry.
Okay.
All initiatives will be continued.
Okay. Any other message for investors? That's largely the viewership that is listening to you.
The investors need not worry. All the initiatives will continue, and the plans for growth, digitalization, increasing number of products, all this will continue. And I am sure the profitability will substantially improve in the coming months.
Okay.
Months and years.
All right, well, time to slip into a short break. On the other side, we have Pawan Goel of Naukri.com who's waiting for us, and Abhishek Kumar of JM Financial Institutional Securities who's waiting by to tell us about the latest in terms of hiring trends. Don't go anywhere.
Welcome back. You're with us on Bazar Morning Call, and we're looking at trends from the IT space now. Of course, what companies are saying, what's happening with respect to the business and overall hiring trends. So let's actually talk about this, because hiring activity seems to have picked up pace. This is as per the Naukri JobSpeak Index. This index saw an 11% jump in June. IT hiring has seen a turnaround after months of muted activity. To talk about this and how companies are positioned, we have with us Pawan Goyal, Executive Director and Chief Business Officer at Naukri.com. And we also have Abhishek Kumar, IT Services Research Analyst at JM Financial. Gentlemen, thanks so much for joining in. Let's start with the good news first, Pawan. So it's great to hear that the JobSpeak Index is now pointing towards an 11% improvement. This at a time when, global headlines are still weak, whether it's Google or yesterday it was Microsoft. I mean, the layoff announcements are real. So you tell us, how should we interpret this 11% increase in the JobSpeak Index? What level of jobs are we talking about? Is it large IT services companies, mid-sized? Tell us more.
Yeah, so I think we should, while there is a month-to-month JobSpeak variation, if you take a quarter view, the quarter view is more subdued. The April was at 9%, May was flattish, June was 11%. So for the quarter, it turns out to be about 6%. So it's a reasonably, not a doom and gloom, but not a very, I should say, ebullient scenario as well. Now, when
6% over Q1, you'd say, right? That's the average increase.
Yes, 6% in the full quarter.
And this we're talking about routine, IT services jobs.
No.
Some more color on this. What kind of companies?
Yeah, I'll give more color. Yeah. So this is for overall white collar hiring. Now, if you double click on IT, April was give or take 1 or 2%. May was negative, and June is slightly positive, which is 5%. Now, so that's a turnaround from a flattish or negative to +5, but it is still only 5%. And if you average for the quarter, it still remains flattish. Now, in IT, it includes several other sub-classification. You have services, you have software companies, technology companies, and all of that. So if you go by another next level double click, IT services is still negative. I don't have the specific number there, but in IT software and technology, they are more positive.
So what's the quarterly average for IT services? Like you said, 6% is average for white collar jobs overall.
For
IT services?
IT overall is flat.
IT overall is flat. Got it.
And how would Pawan, but is there any trend? How would this number of 6% and even flat for the IT services compare with the prior 2 or 3 quarters?
So if you take the full 5-quarter view for IT, so starting from, let's say, Q1 of last year, there was one quarter, which is July, August, September of last year, Q2 fiscal, Q3 calendar, which saw robust 10% plus growth.
Okay.
All the other 4 quarters have been very similar. It's like either 1%, 0%, -1. It's varied in that range, except for that one quarter. So IT overall has remained muted. There are months where it seems like perhaps it will buck the trend, but other than that one quarter, it's not sustained.
So it's the same for the last 3 quarters at least?
Yes.
Correct? 3 or 4 quarters?
Absolutely.
And what about the open positions going into the next quarter? Do we have any numbers indicating a trend, or what would the number stand at?
So JobSpeak is a measure of that. It's both open, whatever as people have searched for, and all of that. So it's an all-encompassing metric. So I don't, how things will change into July, it's hard to predict. But IT long-term view has been flattish.
Okay. Abhishek, you want to come in? Starting next week, we will be asking the companies about their hiring plans for FY26. Last year was a muted year in terms of at least fresher hiring. Now that increasingly we are seeing automation or AI, becoming more mainstream, even in coding, what are your thoughts on IT hiring going ahead?
Yeah, hi. Good morning. Thanks for having me here. I think as far as hiring is concerned, for large cap IT, especially, there are a lot of dynamics that is playing out, not just automation. First is just demand, right? Demand still subdued. The players still trying to improve their pyramid, trying to bring in more efficiency. So we see utilization levels for most of the IT players elevated, and they will probably stay elevated. They don't want to build capacity right now. They are probably just replacing attrition with with freshers, and that's why that's how they are trying to improve their pyramid. But apart from that, they are not positioned for growth, because the visibility still remains low. So I expect on a net basis, hiring for IT services companies to remain subdued. Any hiring that they might do might be for specific skill set or for improving their pyramid by just replacing attrition.
Okay, Abhishek, that doesn't sound too great. I mean, from overall economy perspective either, you're expecting IT hiring to remain muted. Abhishek, maybe it's a little hard to answer this, but what's your sense? How much of this absolute flattish trend on IT hiring, how much of it is just because projects are getting delayed, there's global uncertainty, etc. I mean, the business deals, and most companies have been telling us that, right? Even business conversations, deal ramp-ups, everything's getting pushed back. How much of this is pure business related? And how much could it be because of the changing nature of jobs? Maybe more AI, more automation. What's your sense?
Yeah, I mean, difficult question to answer. It's a combination of both, but I would say that it is more because of the delays in ramp-ups, deals not getting closed. There are margin pressures, so nobody wants to build capacity. So it's a lot more to do with the demand environment than because of AI. AI obviously has a role to play, but I don't think that is very prominent right now.
All right. Hi, gentlemen. Good morning. Good to see you all in. Well, Abhishek, I wanted to ask you a question with regard to earnings. Will a revision in Infosys's guidance to the lower end of the range that they've already guided for, will it excite the street? What are you penciling in?
Yeah, so our expectation is that they will raise the lower end of the guidance. At the beginning of the year, they said that their lower end of the guidance bakes in deterioration in the demand environment. That has not panned out. So we expect them to raise the lower end of the guidance, and then obviously a couple of acquisitions got concluded. So overall, we expect them to raise the guidance from 0 to 3% to 1.5 to 3.5%. That includes 50 basis points of inorganic contribution.
Okay, but will it be a positive trigger, Pawan? Or do you think it's in the price and it's only the lower end which gets upgraded?
So,
sorry, I meant the question is for Abhishek. Apologies.
Yeah, I think that should be taken as positive because, we saw it last year also. Infosys through the year raised its guidance. So that should be taken as positive by the street.
You've also downgraded Tech Mahindra to a hold. Can you take us through the rationale behind that?
Yeah, so Tech Mahindra, since 31st of April, has been the best performing large cap IT services stock, up 18%, significantly outperforming both its larger peers and Nifty IT. And now, its multiples forward, PE multiples are at a slight premium to Infosys. So we think that kind of caps the upside, and we are expecting a soft quarter for Tech Mahindra. So I think the stock can consolidate, and investors should wait for a better entry point to play the turnaround story. We still remain constructive on the on the turnaround path that they are on, but I think at this valuation, there could be some consolidation in the stock.
Okay, all right, got that. Abhishek, we want to actually, talk to you more about a lot of your picks, etc. Maybe we'll have a longer discussion. But right now, to wrap this up and go back to the hiring point, Pawan, while you're telling us about muted trends across IT, what is the indication? What are you hearing from companies? Why is demand low? And what are you anticipating on this whole AI piece, AI automation? Also, I mean, I don't know if there's any indication of salaries. Wherever there is hiring, because the market is so muted, I mean, is there wage deflation, so to speak, as well? Or could that be possible in the coming months?
So, from a demand standpoint, it's all that we are hearing is uncertainty. Now, there are several geopolitical events which have contributed to it. And so the uncertainty in terms of where the business is what we are hearing. Now, in terms of AI, we see a significant demand for AI jobs. It's up in the 40% kind of a range, and it has sustained in that range for a long period. So AI demand is very, very robust. That's also leading to premiumization of talent. If you look at talent which is paid highly with respect relative to their experience. Across experience segment, we see demand for that talent. Okay, so it's a demand for, let's say, this 20 lakh plus segment is in north of 20%. So by salary, it's the premium talent, more experienced talent that is in demand. Less premium talent, that's where we see demand being much softer. In IT, there's another trend we also see. The demand is higher in tier 2, tier 3 cities. So perhaps that's an indication of talent availability at the right price point. So that's also what we are seeing. Now, with respect to AI and its overall impact, it continues to remain a question on everybody's mind. But one indicator that I look at is growth in ITES and BPO segment. And for the quarter, that segment has grown by 9%. Okay, and June is an aberration and it's much, much higher at 19. But for the quarter, nevertheless, still is 9%. So that is where one would expect an impact. But while it may happen in future, it is yet to materialize in our numbers.
Gentlemen, thank you very much for joining in. You know, last month I'd read some article which said that in the US, like graduates, so in the age of 22 to 27, so the degree holders, they're not getting jobs, and the unemployment faced by that category is the worst in a decade, barring the COVID period. And so, you know, so many of the computer science graduates who perhaps 2 years back would have, 3 years back, would have had 10 job offers, this time are struggling. You know, and that's, what's happening on the AI front.
And that's also telling us that I think the IT landscape is now starting what could be a tectonic change phase from, low-level, entry-level jobs and mass hiring. What we were just hearing Pawan say, that the demand now is for experienced talent, for high-quality talent, people who've upskilled themselves. So the Indian IT landscape seems to be definitely going through a major, major change. Gentlemen, thank you very much for that. Great conversation. Thank you for all the perspective. But with that, we have to shift the focus back to the market. Let's look at the Nifty again. Nifty is doing very well, actually, 88, 89 points higher. So the morning has turned out to be fairly robust. The mid-cap index and the bank Nifty, those indices are also up a little over a 0.25%. So there was that early dip, it's gotten bought, and the mood seems to be up for now. Good time to bring in Mitesh to get some more ideas. Mitesh, welcome back. So tell us, how do you size up the market now? What are the trades, index and stocks?
So the market, today we talked about that 25,400 has acted as support, and therefore, good chance that we will see a bounce back. I think we already started that process. We will head towards maybe 25,650, 700 zones, which is where some kind of, a supply could emerge, and that's the short-term target. I'm still not sure whether we'll immediately clear 25,750. So for the timing, we'll keep 25,700 as the target area and suggest traders to take some profits over there. And then see, if it shows further strength, then we'll maybe add at higher levels.
Okay, all right. What about individual stocks, Mitesh?
I have one buy and one sell, Nigel. On the buying side is Axis Bank. I think, it's been doing a range of about 1,065 to 1165 to about 1250 on the upside. And it's bouncing back from the lows of that lower end of the range. So today, I think we got a low of around 1169. So buy here with a stop below 1160. Look for targets to begin with in the range of 1220, then eventually 1240, 45 on the upside. On the selling side is Bajaj Finserv. I think, that's a stock which after having a good rally is now showing mild signs of profit booking. So sell here with a stop just above levels of 2006 and look for targets of 1940.
Okay, all right. Thanks a lot, Mitesh, for that. And the stock we discussed in the morning, CPCL, which is Chennai Petro. We had highlighted that yesterday delivery was very, very large in comparison to averages. The first hour volumes, in fact, are very, very large in comparison to what we have seen. Massive volumes. And the stock, in fact, has perked up a little bit as well. The 20-day MA comes in at around 660 rupees or thereabouts. Well, time to slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll turn the attention to the commodity space.
Welcome back. Equity markets having a good morning. Let's move on to the world of commodities then. And we have Manisha Gupta in the house for all the latest action. Manisha, so what's on your radar today?
Well, I'm looking at metals because yesterday was a good day, and today as well, we're looking at the Asian markets trading on the positive side here. So if you look at the overnight gains and movements, you will see that it's more than 2% of gains that we've seen in iron ore, in steel rebar, and even better gains, as you can see, in platinum, palladium, between 4 to 5%. It's been a good overnight session, and the Asian markets actually seem to be doing a bit of a buying at those current levels. But I also want to talk about copper because we're trading at a new 3-month highs. $5.1 is how it's trading in the COMEX markets there. And of course, there's a bit of a disparity because when you look at LME, the first half of this year has seen gains of 12%. But it is the US markets which are trading at a premium because of these concerns about or whether or not there are potential tariffs coming in. And is the reason you've seen the prices gain up by 26%. The dollar index trading at a 3.5-year lows has been supportive. The Chinese manufacturing data has come in on the positive side, better than what the street was anticipating. And there are more trade deals happening now, one between US and Vietnam as well, does do well for the sentiment there. And it's the Goldman Sachs says that the Chinese 2025 copper demand is expected to rise by 6%, also supportive. So the markets are anticipating that going forward, while the supply could be a concern and so could be tariffs, but it is going to be a stronger demand period. Also, when you look at the US copper at spot premium, that one is trading at a $1,200 a ton. So there is more demand right now than later. You have copper prices trading in a backwardation, and that tells you that there is supply tightness, also supportive. Roadblocks also by informal miners in Peru. That report came in overnight, has disrupted transportation. And then the street also is looking at disruption at Panama mine, Congo as well. So just not that it's tight supplies, but there are supply disruptions coming in as well, which are supportive for copper going forward. A quick word on aluminum, and because of the Trump tariffs at around 50%, the US consumers are paying $1,250 a ton above the LME prices right now, keeping the prices also supportive. Same case for zinc as well, with the kind of steel demand and steel positivity that we are seeing. The zinc prices, the galvanized metal, also has seen some support. Having said that, the International Lead and Zinc Study Group says that the world zinc mine is expected to see higher supplies in this year, could keep the prices in check. But it's all going to be about the US jobs data today. Further cues to come in from that.
Thank you very much for that. Let's talk about some of the big movers in the morning. On the way down, it's Avenue Supermarts. Manglam joins in. Manglam?
Well, brokerages aren't very happy with the 16% growth that the company's reported in the revenue. If you look at, the notes that have come in this morning, Morgan Stanley has an underweight rating on the stock target of 3260. They say that, they were expecting a number of 17.4%. So to that extent, it's been slightly below their expectations. The implied same-store sales growth is close to around 3 to 4%. Macquarie too has an underperform rating and a target of 3,000 rupees on the stock. They say that sales growth moderated slightly from the fourth quarter, and there was a marginal miss, and healthy pace of store additions is what keeps them slightly upbeat on the stock. Goldman Sachs, on the other hand, they have a sell rating. They too have a target price of 3,400. They said the sales growth was weak, but they also expect margin contraction by the company in the first quarter when the company actually goes ahead and reports their results. They believe that the company will continue to face competitive pressure from large, quick commerce players in the urban market. So that keeps them slightly cautious on the stock.
Okay, all right. Got it. Explains why there's no enthusiasm really there on Avenue Supermarts there after the Q1 update. Thanks for that, Manglam. Let's move on to Tata Power. Tata Power is dealing with a bit of a legal blow, arbitration that's not gone in the company's favor in Singapore. Vivek is here with more details. Vivek, fill us in.
Well, that's right. Like we highlighted earlier today, what's actually happened is that Singapore Court Tribunal has actually ruled against the company in a dispute with its Russian mining partner. Now, the company has been asked to pay a significant amount, almost $490 million in damages to its Russian mining partner, which is Kleros Capital Partners. The payment has to be made along with interest as well as other legal costs too need to be covered. Now, the company says that they are in process of reviewing the contents of the award, and they are evaluating all options, including the right to challenge this particular award that has gone against them. Now, what is this particular case pertaining to? Kleros earlier claimed that Tata Power breached confidentiality as well as non-circumvention clauses in the NDAs that both the company has earlier entered into. This is for a coal mining project in Russia. Given the fact that there's a significant number, almost over 4,000 crore rupees, is the damages that Tata Power will have to bear, there has been a negative reaction on the stock.
Thank you very much for that. Get into a break. On the other side, we'll have Ajay Sahai of Federation of Indian Export Organization and international trade expert Abhijit Das joining in to talk about the US tariff deal with India and with Vietnam and the likely impact on Indian exports.
Welcome back. We're getting back to the big global story, and that is trade deals that the US is signing and perhaps all set to sign. Now, we know that one has been announced between the US and Vietnam overnight. Of course, we are keenly awaiting developments on the India-US trade agreement. Donald Trump yesterday announced that Vietnam trade deal. Maybe it gives us some clues into what the alignment with India could look like. Though, of course, it's very specific bilateral agreements that the US is going in for. Indian exporters perhaps could be looking at higher tariffs. We still have sticky issues around areas like dairy and agriculture. Let's talk about this and the implications for Indian exporters. We have Ajay Sahai, FIO Director General and CEO at the Federation of Indian Export Organization. We also have with us Abhijit Das, international trade expert and former head of the Center for WTO Studies. Gentlemen, thank you very much for joining in. Abhijit, if I could open the floor with you first, and let's start with what we can infer or take away from the way the US-Vietnam trade deal got done. I mean, they started with 90% tariffs, they've ended at 20%, and they've tried to plug the leakage areas, which is this, the tariff to plug any kind of transshipment, which is happening via Vietnam as well. Let's look at the implications for India here. Now that Vietnam doesn't seem to be getting a very raw deal, would you say it's bad news for, say, Indian textile exporters?
First and foremost, it's not entirely correct to say that Vietnam is not getting a raw deal. let's bear in mind that before the Trump reciprocal tariffs were announced, Vietnam was benefiting from a significant access into the US market at preferential tariffs. So even if the deal which was announced last night, even if it's implemented, it would still be a setback for Vietnam. So let's bear that in mind. Coming to the aspect of what can our exporters expect, the key point over here is that when the reciprocal tariffs were announced in February earlier this year, there was some optimism that Indian exporters would face 26%, Vietnam would face 46%. And there was some optimism that our exporters might increase their share in the US market. Now, that was subject to many caveats and constraints. And I, for one, never really believed that really because of higher tariffs on Vietnam, we would have a huge export opportunity opening up in US. Now, what the recent announcement of the deal between US and Vietnam has done is it has certainly dampened that optimism. Having said that, this should not be a trigger for making sure that India and US come to an agreement immediately before 13th July. To my mind, the real determining factor will be agriculture, and we will have to see how positions on agriculture are accommodated. And that, to my mind, will determine whether we have a deal or not. And if we do end up having a deal, maybe our exporters, even in textiles and clothing sector, might be able to enjoy some benefits compared to Vietnam.
Ajay, any lessons India can draw from the US-Vietnam deal? And secondly, as my colleague Surbhi was also asking, particularly on exports, where India directly competes with Vietnam, what could be the impact on India as things stand right now?
In fact, I consider it a very positive development. The very fact that US has carved out a deal with Vietnam after doing one with UK shows their willingness to engage with other countries. And since India is proactively engaged with the US, we can look forward for a deal. Secondly, we are now very clear that Vietnam will have market access in the US at a minimum tariff of 20%. If we work out a BTA where we get zero tariff, we will have 20% advantage. Even if the reference tariff of 10% remains, we will have 10% advantage. So this will be very, very positive for India. Now, if we look into the products, in fact, India's export to US in the calendar year 2024 was around 80 billion. Vietnam was in 110 billion, and we are competing in many of the sectors, including electrical and electronics, machinery, apparel, in particular, furniture, footwear, saddlery goods, rubber goods, plastic goods, automobile and auto component. And therefore, in these segments, if we enjoy a tariff advantage of 10%, which happens if we work out a BTA, and even if the 10% tariffs remain, it will be a huge gain to India. So definitely we can look forward for that gain. I'm pretty sure that a lot of US companies who are looking into India for export, a lot of them are relocating from Vietnam and China also. They will definitely move towards India. Let us bear in mind that one of the reciprocal tariff fallout has been that global companies are looking into setting manufacturing base in a lot of countries. They are already in China and Vietnam, and therefore they look forward for investment in India in a big way.
No, but we have to see, Mr. Sai, I take your point completely, but those are the things that we'll have to see. This separate transshipment tariff, whether something like this gets worked into the contours with India as well, because we know, Mr. Trump has been very vocal. For instance, he's called out the Apple CEO saying that you are making your phones in China. Now I hear you want to make them in India and then bring them to the US. Doesn't fly. And then separately, we've seen the reports just over the last 24 hours, right? Foxconn sending a lot of its engineers back, etc. So we need to see how this...
He has not clarified on transshipment. The general impression of transshipment is that if the goods of third country get routed through a country which is having preferential tariff, you try to circumvent those provisions. So in fact, this also infers that US is not looking into duty beyond 40% on China and ASEAN, because if China and ASEAN goods are allowed transshipment to Vietnam, not subject to 40%.
40%, which should be the duties in line for China that they're speaking of. I take your point. Just a clarification, Mr. Sai, like you mentioned, that, even if the duty on a lot of items that we're exporting to the US comes at 10%, and you named a lot of items, textiles, electronics, maybe even furniture goods, etc., there will be a differential. What would be the average blended tariff on some of these items now for us, for our exporters, as they were being exported before Liberation Day? Just to understand what the increase will be, assuming we remain at 10%.
On the most of the item, the tariff in the US was in the range of 2 to 5%. Thereafter, now we have moved to 10% reference tariff. I'm not sure when we are negotiating the VTA whether MFN will come to zero. Reference tariff or 10% will remain, because US has collected over $300 billion of duty in a single month, and probably in that way they may not provide exemption to reference tariff. Even they have not provided to UK. So I'm basing my assumption that if MFN becomes zero, reference tariff remains at 10%, Vietnam will be having 20% duty, we will having 10% duty. If reference goes, Vietnam will be at 20% duty, we may get zero duty.
Oh, that would be sunny skies.
All right. Mr. Das, wanted to get your thoughts in on this rules of origin restriction, the punitive tariff of 40% on transship good. If that is a part, is a part of the India-US deal, how will it impact India and Indian exporters?
There are two ways of looking at this 40% punitive tariffs on transshipment. One, of course, is it will prevent countries from circumventing the tariffs which they might themselves face. And over here, China is an obvious target. Other ASEAN countries could be equally on the radar screen. But there's the other way of looking at it. While we are awaiting the fine print, the legal details of how this 40% tariffs will be calculated, what will be the rules of origin, if it's purely based on transshipment, I don't think we have anything to fear. However, if the rules for the transshipment suggest that if you're importing parts and components or inputs from China, and if that is treated as transshipment, then I'm afraid our exports in the sectors of electronics and pharmaceuticals, they may be at the crosshairs of this 40% tariff.
Yeah, that's a great fine point that you've raised, Abhijit, that we need to see that even if the components or the APIs for pharmaceuticals, if they start getting counted as transshipment, then we could be in for a lot of complexity. Very quickly, last 30 seconds, Abhijit, on this. End by telling us about the core sticky point. We know that agriculture and dairy is where things have been stuck. The Americans want to come in. They say we need complete market access, remove non-tariff barriers, allow us to come into your market and compete. What is the workaround, or what would you expect? What kind of a different deal would you expect, which the US president has spoken about?
What we might think of in terms of a landing zone is, while we will not allow GM products to come in, there could be some concession to the US in terms of more predictability in terms of time frames within which we will take a decision on whether to allow GM products to come in or not. On key sticking agriculture products, maybe a possibility would be something called a tariff rate quota, whereby we allow imports of some agriculture products at lower tariffs up to a predefined quantity ceilings. So this could be one option, and maybe this might be perhaps the only viable practical option which protects our domestic interest as well as gives some market access to the US in the agriculture sector.
All right. That's a great perspective to have as we look at the final contours and maybe an eventual announcement of the India-US trade agreement. Thank you very much, gentlemen, for joining in and giving us your views. And with that, it's curtains on this edition of Bazar. Thanks for watching. Chartbusters coming up next.
Shares of Nykaa trade with cuts of nearly 4% after a block deal worth nearly 1,200 crore rupees took place. Sources say early investors Harinder Pal Singh Banga and Indra Banga are likely sellers. They sold 2.1% stake.
Avenue Supermarts falls close to around 2.5 to 3% on the back of its Q1 business update. The company's revenue sees a 16% uptick, while store addition grows 14% year-on-year. Goldman Sachs, they maintain a sell rating on the stock, citing weaker than expected sales growth.
Tata Power trades lower as the company is set to pay $490 million in damages to Kleros Capital Partners following a partial award by an arbitral tribunal under the SIAC.
And Punjab National Bank falls in trade after its Q1 business update failed to enthuse the street. Analysts say the bank's loan growth reflects system growth slowdown, while deposit growth is strong.
And Coromandel rises in trade after receiving a CCI approval acquisition of majority stake in NACL for about 820 crores.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam, and the markets are in perfect form today. The Nifty is up close to under 100 points, going by like how our captain yesterday played. Gill scored a century. The markets are up 100 points. I'll tell you what, we'll want a triple century coming in for the Nifty Bank. That's what will take us higher.
That's what will take us higher. But, you know, for the Team India, we need a score over 400
I think so.
us to have a bit of a chance. You know, given the last two games where the tail did not perform as well, today the lower order batters will have to perform well. That's about the Indian cricket team, but that's also about the Indian markets, because you have to have the second half of trade do well in today's session, because there has been a fair amount of call writing. If we sustain at these levels for a bit, those call writers will be taken to the cleaners. If our lower order bats well, England will be taken to the cleaners.
Well, that's right, Mangalam, and I'm hoping, you know, just on the cricket first, that I hope Jadeja, you know, he stays there longer, because then the runs come faster, right? Pant, Jadeja, they are scorers, and in fast time as well. So
and Jadeja about time as well, and you know, what a great player that he's been. The last few games haven't been very good, so let's see where Jadeja goes from here on, especially for Team India and his own career. It is an important knock that he has to play. But enough about the markets and cricket for now. Let's go back to the markets at the high point of trade for the frontline index. Sachidanand, taker of Trade Bulls, joins in. Sachi, you know, you can tell us about the Nifty chart, and you can also tell us about Team India's chart.
Well, I think both the charts are looking positive, have always been positive. So if you look at Nifty itself, you know, the way it has responded to that support at 25,400, 450, where it's 20-day exponential moving average, 5-day exponential moving average is staged, you know, Nifty has been sustaining above it on a closing basis. Even today, the call writing action at 25,600 would be significant. But if you look at the way the Nifty is rebounding, plus the constituents which are pushing it higher, there's a good chance that we may see this particular swing extending towards 25,700 during the day. We are expecting the expiry to shape up somewhere close to 25,650, 550 kind of a zone. So the bias for the Nifty for the day at least remains positive. Even right now, some momentum longs can be considered, keeping a stop loss at 25,510 on closing basis. On the higher side, eventually we see the Nifty, you know, scaling towards 26,000. When we look at Nifty Bank, there is a very strong, hurdle at 57,500 at least for the day. So we are not expecting any major turnaround there. But overall, both the indices should stay in the positive zone.
All right, it will be very interesting to see if the Nifty Bank sustains past the current levels as well, because 57,150 to 57,200 were important supports when the Nifty Bank was a lot higher, and that was the support that was broken yesterday as well. So we'll watch out for that. But individual stocks, they're doing a lot, in today's trading session. So say, for instance, Blue Star, we had the management join us today. That stock's moved to the high point of trade. Quick Heal is another one which is up 4%. We're seeing good traction in names like RateGain as well, up 7.5%. Dodla Dairy, a wide swathe of stocks doing well from across sectors. Would you have long positions as trading ideas, or maybe you think that this rally should be used as shorting opportunities too?
Mangalam, clearly the bias remains positive for the index. And if you look at all the constituents, right now the focus is on Nifty Auto. Now, if you look at the overall chart structure, it looks like, the sector itself is positioning for a 10% upside. We have seen that on on its weekly scale, it had been consolidating for almost 8 weeks. We saw narrow range action within this particular pocket. But if you look at the overall structure, it looks like a classic bullish flag formation ready for a breakout. On an immediate basis, we may see a swing towards 24,120, but eventually, we see this particular swing extending towards 24,500 in a day or so. And the pattern target is placed somewhere close to around 26,700. So I think Nifty Auto should be in your radar. Nifty Auto should be on your radar. And from that pocket, we have recommended to our clients a stock like Maruti. Now here, if you look at the weekly, monthly charts, it has been consolidating very well. It maintained a very strong support bias near to that 12,400 zone, where its 50-day exponential moving average was placed. Yesterday, despite of the market weakness, this particular stock displayed strength, and bullish formation was displayed on its daily scale. And from there, the momentum has been sustaining. So we are expecting that this particular rally may continue towards 13,160 and extend towards 13,600. And hence, we are still recommending building fresh long positions in a stock like Maruti, keeping a stop loss at 12,600 on closing basis. The other stock is Hero MotoCorp. Even here, the consolidation has been very healthy. A similar kind of a structure, it has rebounded well from its 50-day exponential moving average support, which is placed at 4180. The overall structure looks interesting because 6 weeks of consolidation is now looking mature, and we may see a rebound back towards 4400. So keeping a target at 4440, we are recommending building fresh long positions in Hero MotoCorp. The stop loss for the trade should be placed at 4160.
Okay, all right. Cut that, Sachi. Before we let you go, just one quick word on Vodafone Idea. We had Mr. Scindia, who's been talking about that in any industry, a duopoly doesn't work. He wants a larger number of players. So in all probability, Vodafone Idea survives. And that would be good news for customers. But will it be good news for shareholders? As we speak, the stock has moved to the high point of the day.
The stock has been outperforming since last 2 weeks. Now, if you look at the overall structure, it looks like a classic, breakout from a downward sloping wedge. Now, such kind of formations are, signs of a near-term bottom. So probably the support that it displayed somewhere close to around 6.5, I think that particular support may not be breached quickly. And we may see this particular rally getting extended towards 8.5 to 10. So I think it's better to remain intact, keep a stop loss at 6.5 on a weekly closing basis, keep accumulating this counter. We may see this particular rally getting extended towards level close to 10. So I think it's a positive setup, and the structure is getting better day by day.
All right. And do you have a call on M&M Financial? Because that stock also has moved to the high point of trade right now. Reported a decent set of first quarter update coming in, and the stock is extending its gains right now. So it's up around 4.5%. And a large part of the gains have come by in the last 20, 30 minutes or so. M&M Financials.
Mangalam, it's a good, strong rebound. The stock has already almost, engulfed 3 days of its price formation. So we may see further rally above 280 zone. So I think 280 would be an intraday target. One can continue holding long positions with a stop loss at 268 on the lower side. In case if we see this particular level getting breached, the rally may extend towards 296 in a day or so. So probably one can retain their long positions.
Take that point, Sachi. Thank you so much for joining in, giving us a view on the indices and a lot of stocks today. We'll take your leave on that note. With that, we'll also get you some ideas for profit. This one comes in from our colleagues at Money Control Pro, and today we have Neha Dave joining in. Neha.
Today's idea is CSB Bank, which reported muted earnings in FY25 as profitability was dragged down by a sharp fall in margins and elevated operating expenses. However, the management has guided return on asset to be in the range of 1.5 to 1.8% and return on equity around 15 to 17% in FY26. Now, what will drive the improvement in profitability going forward? CSB Bank will benefit from the sharp fall in interest rates because 60% of its loan book is fixed rate in nature, which will not get repriced lower immediately. Also, around 45% of its loan book consists of gold loans, which will continue yielding around 11 to 12%. Hence, management is confident of maintaining the net interest margin of 4% in FY26. ROA kicker can also come from non-interest income as the bank's investment book will benefit from the fall in the GSEC yields. The key growth constraint for a small bank like CSB Bank was the liability book or the deposit book because of the tight liquidity in FY25. However, with the liquidity condition improving, the management is much more confident of the asset growth in FY26. Most importantly, CSB Bank benefits immensely from its gold loan portfolio, which offers higher yield but has lower credit costs and lower risk weights. In terms of valuation, the stock is currently trading at around 1.2 times the book value estimated for FY27. The valuation is attractive given the return ratios and a growth potential on a small balance sheet.
Okay, all right. Well, time to slip into a short break. But remember to tune in to the all-new CNBC TV18 Prime. We bring you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon. That's for the global reset. At 1 p.m., we talk commodities, currencies, as well as cryptos on the Big C. And then Global Lens at 8:30 p.m.
Welcome back. You're watching us here on Chartbusters on CNBC TV18. Let's talk about GMR Airports. Vivek joins in to tell us why the stock is buzzing in trade today. Vivek.
Well, good morning. You know, it's an important development as far as GMR Airports is concerned. It's a technical development and also some relief coming in as far as regulatory concerns were concerned. So first, yesterday, the company gave an update to the exchanges late evening. So what's actually happened is that the TDSAT has recently squashed AERA's earlier HRAB calculation for DIAL Airport. You know, what does this mean? Let's first simplify it. Number one, the TDSAT, the regulatory authority that actually goes ahead and decides the tariffs as well as the calculation for tariffs as well as calculations for the computation of what exactly Dial Airport, which is the Delhi airport, can actually claim from authorities. Now, there has been a development and there has been an order coming in that actually favors GMR airports. So now, what they are actually saying is that HRAB, which is the notional asset base, which is the hybrid regulatory asset base, which is key to setting aero tariffs, they are saying that this particular tariff base itself was set wrong earlier, which implies that there could be a higher upending as far as the HRAB is concerned, indicating that GMR airports retrospectively could actually gain further tariff revenue. Now, this is an important development as far as GMR is concerned. In fact, what Jeffrey says is that if the final ruling actually favors Delhi Airport, the revised HRAB could significantly raise allowable tariff recovery due to past under-recoveries.
Okay, all right. Thanks a lot, Vivek, for joining in and explaining that to us. But yesterday, we had a few debutants in Team India. And today, in fact, getting off the mark on CNBC-TV18 is Gaurav, who's joining us yet again to do a quick analysis on the newly listed stock, HDB Financial. Gaurav, tell us more.
Well, yes, when we talk about HDB Financial, we have already seen that the stock listed at 13% premium yesterday. And even today, the stock is up more than 5%. And the reason being that when we look at the business model and the valuation, they seem to be in a little favor of the stock. So first, let's understand the business. Company has AUM of 1 lakh crore rupees and the growth of around 20% CAGR over the last 4 years. And what is actually positive about company is that the gross NPAs have been a little lower than other peers. Other than that, when we talk about some other diversification in terms of portfolio, there also we are seeing company is well placed if we compare it with the peers. But on the other hand, there are some hiccups for the company. So first, let's talk about loan book CAGR, growth CAGR. It is actually at 20%, a little lower than other peers like Cholamandalam and Bajaj Finance. When we look at some other factors like ROA also, there also we are seeing a little bit of lower ROAs from company if we compare it with the other peers. And as a result, when we look at the listing scenario, valuation was a little below what other peers are trading at. It came in at around 3 times price to book on a 1-year forward basis. But given the current market price also, it is trading at 3.4 to 3.5 times, which is still at a comfortable level. So when we look at the valuation, even if we consider 30% upside from the listing of 740 rupees, the stock will still trade at around 3.9 times the price to book value, which is actually comfortable when we compare it with the peers like Cholamandalam Investment, because the stock now currently trades at around 4.7 times. While Bajaj Finance also trades at around 5 times. So definitely, when we look at valuation, it still gives some comfort in terms of valuation for the company. When we look at the other factors, now let's not forget that the grey market premium for this stock was at around 1200 rupees. And if we consider that price, now there it seems a little stretched because the valuation then comes at 4.9 times. And given the return portfolio, it will be a little difficult for the company in terms of fundamental analysis. But definitely at this moment, it seems that the stock is trading in a comfortable level in terms of valuation, and it still has some upside to go.
Take that point. Thank you, Gaurav, for joining in and giving us an update on HDB Financials. What we'll do with that is slip into a short break. And as we do that, here's some good news for all you viewers. India's business news leader, which is CNBC-TV18. It's now just a click away. You can see the all-new CNBC-TV18 mobile app, which gives you instant access to breaking news, in-depth articles, all the financial world updates at your fingertips. All you got to do is download the app from either the Apple Store or the Google Play Store, or what you can do is just scan that code, which is up for you on the screen.
Welcome back. A lot of traction actually in the broader markets. Though the headline index is mildly higher, there are quite a few stocks actually that are doing a thing of their own. Pull up RateGain. That stock is now up close to around 6.5%. So good move is what we're seeing on that name. Narayana Health as well. The stock has actually seen a bit of a re-rating in the last few years. It continues to move well. So good up move on that name as well. But let's talk about the US-India trade talks. Government sources say that the interim trade deal could be signed with the US within the next 2 days. Abhimanyu joins us to fill us in with more details on that. Abhimanyu?
Well, intense negotiations are underway in Washington, D.C., where India's chief negotiator, Rajesh Agrawal, has gone along with the entire trade negotiation team, and several issues, several tariff lines are being discussed. Of course, government sources have also communicated that none of India's interests would be compromised, particularly in the dairy and agriculture sector. And also, it has been indicated by sources so far that the entire sectors of dairy and agriculture cannot be opened. However, some piecemeal relaxations may be given to niche products, premium products, which are often imported into India from the United States, which may involve pecan nuts or even Washington apples and walnuts for that matter. It remains to be seen how early the negotiations are going to conclude, even as the 9th July deadline for the end of the stay on reciprocal tariffs is fast approaching. So, of course, both the sides are keen to seal a deal. However, there is no desperation per se. That was the word which had initially been communicated from government sources. Now, negotiations are continuing between both the sides, and also the US is negotiating with several other geographies. India is also negotiating FTAs with several other geographies to hedge its overall risks, even as all options remain open with respect to signing of a trade deal, of a bilateral trade agreement. Now, this is an interim deal being negotiated at this point of time, and following which the first tranche of a BTA would be discussed, and for that, of course, both the sides are looking to sign the first tranche by September or October of this year, which would be followed by a complete trade deal. So the interim deal will involve several tariff lines, thousands of tariff lines, followed by the first tranche of the deal, which will also involve several other goods and also possibly some bit of services, which would be followed by a full-fledged deal. So an interim deal right now is being discussed, and it remains to be seen how early it is going to be concluded, and more importantly, which all tariff lines are going to remain a part of it.
Abhimanyu, thank you so much for that. With that, we're out of time on this edition of Chartbusters. All 4 lights on your screen in bright green. So what we'll do is leave it to the team of Trading Art to take the market action forward. Thank you for watching.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutran. With me is Hormaz Patakia. Hormaz, good morning. You know, we've been talking about how markets have been quite volatile throughout this week, actually. But today there's some green, and I chose the right color today. So Nifty is up around 96 points. We have actually majority of the indices in the green today, barring 3 sectoral indices. But if we look at the top gainers in trade today, it has got to be the Nifty auto space that is contributing to the gains that we are seeing. Nifty IT2 is doing well. We have the energy and the CPIC basket, which continues to do well. Small caps and mid caps have made a comeback. So a lot is happening, a lot of green on the screen, and it's a lot about individual names as well. Be it something like an Oil India, ONGC, all these stocks are higher right now. And again, it's the weekly options expiry as well. So the second half will be important.
That's exactly why the color of my shirt for the weekly options expiry.
Oh, you're balancing well.
But yeah, it's as Sonal was mentioning, right? It's all about stock-specific activity, and we had that initial dip. That dip was very quickly bought into. The good part is we managed to respect yesterday's low, which was 25,378, and we have reversed from there yet again. So it's a 100-point recovery from the morning lows. And speaking of movers, you look at Astra DM, that's up 5.5%. Honeywell Automation is up 5.5%. Almost 6% higher now in today's session. The top 2 gainers on the Nifty 500 today. Motilal Oswal is making a move higher in today's trading session. The asset under management for its unit crossed around 1.5 lakh crores. So that stock doing well for itself, 5% higher today. On the losing side though, it's Nykaa, of course, on the back of the block deal. DMart has recovered slightly from the lows of the morning. At one point was down almost 4%, but since then it staged a brief recovery. It was 2.5% lower still. And since we are on the subject of Avenue Supermarts, along with it, there were other business updates from retailers as well, including V2 Retail. So Mangalam is here with a breakdown of those numbers and how the provisional numbers look like for the quarter, Mangalam.
Well, for Avenue Supermarts, it was a 16.2% growth that the company reported in their standalone revenue. This compares with their 2-year compounded average of close to around 17.3%, so slightly 1% lower than what they've been doing over the last 2 years. But more importantly, even the brokerages, they were expecting about 17.5 to 18% sort of growth because of the growth that the company's reported in the last 2 quarters. But mind you, this by itself, not particularly bad number, because the year-on-year store growth has been just around 14.3%, which implies that there has been a same-store sales growth, a mild positive same-store sales growth, which Morgan Stanley estimates could be around 3 to 4%. One can be, thinking that it could be about 1 to 2% odd itself. They've added about 9 stores in the first quarter, so that is something that is in line with street additions. Now, if the street is looking at the first quarter numbers that the company will report, 3 things will really stand out. One, what is their product mix? Are they selling more of their general merchandise and apparel products because they are margin accretive? Secondly, how is their store expansion pace going to be? Because they recently opened a store in UP. Are they going to increase their presence out there and other parts of the country as well? And finally, these are standalone numbers. So the performance of DMart Ready, which will come in the consolidated numbers, is something that the street will be eyeing as well to gauge how sentiment has been ever since they've launched DMart Ready or upped their operations in DMart Ready as a competition to all the Q-commerce players. Now, coming to V2 Retail, that reported a very good set of numbers, 51% revenue growth. The stock is lower because the same-store sales growth has been subdued at just around 5%. The company alludes that to the weakness that we've seen in terms of, the festive season shifting from the first quarter to the fourth quarter. So if you normalize that, that's about 10% same-store sales growth. But that's also the reason why V-Mart Retail was yesterday, and also Bazar style retail is lower today, because the festive season shift has caused negative same-store sales growth for Bazar style retail.
Okay, all right. So some of these retail stocks on our radar. Thank you so much, Mangalam, for joining us with those updates. And we are kicking off the earnings season, so it has to be a lot about quarter four updates. Not only the retail space, even banking stocks, they are in focus on the back of quarter one business updates. Gaurav is joining us with more details on this one. Gaurav.
Well, let's talk about Punjab National Bank. A weak set of numbers is what we saw from the quarterly updates, because when we look at loan book growth, that came in at around 9.7%. Now, let's not forget that for the entire industry, the banking industry's loan book growth has been slower for this quarter, and it seems that bank is actually reflecting the same weakness. But on the other hand, when we talk about deposits, there also we saw a good set of number at around 12% growth. Now, when we look at CD ratio for the bank, it is now currently at 71%, and that is the reason why the loan book growth weakness is something to be focused upon, because CD ratio can also drag down margins. Other than that, Indian Bank, on the other hand, came up with good set of numbers. The growth for loans were at around 11% on a year-on-year basis, and this was actually supported by the RAM segment, which is retail, agri and MSME. There we saw a very strong set of numbers. In terms of deposits also, a good set of numbers is what we saw. The bank grew its deposit at around 9.5%, which is actually in line with what the guidance they had given for FY26. CSB Bank also came up with good set of numbers, and this time again, bank reported a very great set of numbers with more than 30% growth in terms of loan book. When we look at loan book growth, that was at around 32% growth, which was supported by the gold loan portfolio, which grew at around 35% on a year-on-year basis. In terms of deposits also, a very healthy set of number is what we saw with a growth of more than 20%. So definitely good set of number is what we can call for CSB Bank as well as Indian Bank. But on the other hand, on the back of weak set of numbers for advances growth, PNB Bank is going to be in focus.
Mixed trends emerging from the banking updates that have come out so far. Gaurav, thanks a lot for that. The other one in focus today is Tata Power, and that is currently under some bit of pressure. It opened lower and has staged a bit of a recovery from the lows of the day. Vivek is joining in to tell us why so, Vivek.
Well, this particular one caught the eye simply because of the fact that the amount involved is quite large. So what's actually happened is that the court tribunal, the Singapore court tribunal, has gone ahead and ruled against the company. This is in a dispute that the company had with its Russian mining partner called as Kleros Capital. So now the company has been asked to pay $490 million in damages to Kleros Capital partners. Payment has to be made along with the interest as well as other legal costs. Now, this is a partial award given by the tribunal under the Singapore International Arbitration Center rules. Now, what is Tata Power saying? Tata Power is in the process of reviewing the contents of the award, and the company is evaluating all options, including the option to go ahead and challenge the award that it has received. Now, what is this particular case pertaining to? This is an old case pertaining to Russian mining partner Kleros Capital, where Kleros has claimed that Tata Power breached confidentiality and non-circumvention clauses in prior NDAs that were signed. Tata Power saw a bit of a negative reaction but has recovered, given the fact that at this point of time it appears as though the company will challenge this particular appeal.
Okay, all right. So that's what's happening with Tata Power. The stock has recovered, though, from the lows of the day. Thank you, Vivek, for joining in. But with that, we'll slip into a break. Up next, we'll discuss what's buzzing in the commodities space with Manisha Gupta.
Welcome back. A century on the Nifty on the weekly options expiry session. So 25,557, still 100 points away from Monday's high. That is the important barrier that the index has to cross to make that dash back towards that 26,000 mark. But for now, good going for the Nifty at the highest point of the day, a century on the index. Amongst the movers, of course, and after 2 days of upper circuits of 20% each, Gabriel India is seeing some bit of profit booking today, 6% lower on that stock in today's session at the lowest point of the day. But shifting focus to the commodity space now, Manisha is here and to talk about crude oil prices yet again going into the holiday weekend, Manisha.
Oh, well, yes. And ahead of that, the markets do not believe that you could be looking at a very sharp decline in the crude oil prices. Well, actually, in the overnight markets, we've seen prices gain up by 3% for crude. Heating oil was up 3.5%, and natural gas prices gained 2% as well. That bit of a decline on your screen comes in after there has been a surprise build-up in inventories in the US markets. That is what is capping too much gains here. Well, remember, this is the demand season. This is summer demand season in the US. The Atlantic season is not too far away, starts in the mid of August. But you have seen inventories pile up for crude, for heating oil, for gasoline especially. So not too many people driving there, and the inventories actually are at a 9-month highs at this point in time for the seasonal levels there. But what in turn also seems to be supporting markets is the Iran statement, which says that they are suspending cooperation of any type with the United Nations, and future inspection of the nuclear sites by the IAEA will need to be cleared, approved by the Tehran Supreme National Security Council there. So that is what led to the 3% gains in the overnight markets there. Further news, further statements from that is something the street will keep an eye on. The second is about the US-Vietnam striking a deal there. That also seems to be coming in as a positive. As more countries come into the foray, the tariff concerns, the uncertainty, and the fact that the demand could be coming back could be a supportive factor there. But it all boils down to the US jobs data today. Well, the non-farm payroll numbers today in the evening would tell you or give you a further direction before that long weekend.
Okay, so crude lower right now, higher inventory. You, crude and Hormaz, all of you are actually in the same color, Manisha. So I don't know which way things will go. But thank you so much for joining in today and telling us all about crude oil prices and important events to watch out for as well. It's time for a short break now. Up next, we'll discuss the market fundamentals with Nilesh Shetty, Portfolio Manager of Quantum Advisors. Stay tuned for that. Welcome back. You're still tuned into Trading Hour on CNBC TV18. Well, it's time for some fundamental conversations on the markets. Nilesh Shetty, Portfolio Manager at Quantum Advisors, is joining us now. Nilesh, good morning. Thank you so much for joining in. Well, you know, markets are waiting for a lot of things, be it the US-India trade deal, be it earnings, a lot of macro factors as well. Which one do you think is the most important right now? And what is the outcome which the markets would like?
Yeah, I mean, the markets, actually, I don't think they're waiting. They've already run up quite materially ahead of all these events. And it's not specific to India. There's been a global rally which has unfolded. India, in some sense, has underperformed this rally over the last 3 months. But again, the key driver for India remains earnings. And you saw evidence of a slowdown in Q4 of last financial year. More corporates that we met in Q1 of this year suggest that slowdown continues, it's not materially altered. So there has been a disconnect between what is happening in the markets versus what is happening in sort of corporate India. The assumption is that at some point there will be a recovery, and people will be watching for that commentary quite closely, where the corporates indicate that recovery. But as of now, it looks like earnings season may disappoint in the near term relative to where valuations are. And given the rally that has unfolded, you may actually be disappointed in the near term in equity returns.
You know, by the way, just a couple of minutes earlier, you were seeing some flashes on your screen with regards to the CEO of Adani Airports making remarks that airport access, lounge access at the airport no longer requires middlemen, and the fintech revolution in the country proves that middlemen can be eliminated and they don't need that, and users can now directly access lounges via the digital platform of Adani Airports. Remember, this comes after Dreamfolks, in that exclusive conversation that the management had with us exclusively yesterday, had mentioned that airport operators are pressuring clients that Dreamfolks has to move away from the platform and sign on to theirs. And as you can see, the comments coming in there from the CEO of Adani Airports, Madhya, has had this interaction, and we'll get you more on this in just a bit. But these are remarks from the CEO of Adani Airports just a day after Dreamfolks had accused airport operators of pressuring clients from their airport lounge access platform. But Nilesh, good morning. Thank you for joining in. You know, you mentioned that earnings, you might see some near-term disappointment. When do you see that recovery happening? There was this earlier view that FY26 would be better than FY25 because there would be a low base of FY25. But do you see that now being pushed to the second half of the financial year, and the first half will be just as disappointing as the last 2 quarters of the previous financial year were?
Yeah, I mean, the reasons for this slowdown is slightly perplexing. I mean, when we interact with corporates, they themselves are trying to figure out. The answer that is coming through is urban slowdown and sort of slowdown in urban consumption, which is causing this drag. And again, there are anecdotal evidences that southern cities, which are more exposed to IT, may be creating some of this slowdown because people are worried about job security there. And the expectation is that combination of this tax cut, monsoon, and interest rate cut will combine to sort of pull up demand. But again, that is sort of hypothetical. We'll have to wait and watch because, like I said, nobody's figured out what is causing this slowdown. So the tax revenues that the government was reporting, which was strong till a month ago now, even that is reporting a slowdown. So it is more in hope that there will be a recovery in the second half, assuming these factors combine of great monsoon, tax cuts, interest rate cuts. But we'll have to wait and watch. The point is valuations are far ahead of where they should be, given the news flow that is coming through on earnings. That is a bigger concern. So earnings may recover, but valuations are assuming that there'll be a strong recovery, which may not happen.
Okay. Nilesh, you know, going back to that flash that we just saw where Adani Airports did indicate that they will not require any middlemen for any lounge access for flyers. I'm not talking about a specific stock because I believe you won't be able to answer to that. But in an industry like this, do you think the investors should now book profits or just take away whatever they have in their hands? Because a lot of competition is coming in, and not only this sector. Are there any other spaces where competition could be a problem with companies which were seen to be having moat and being very efficient with that particular business?
Yeah, that is, India has been a classic case of if any specific company starts making supernormal profit, you have unrelated businesses entering that sector and disrupting it in a meaningful way. You saw that in paints happening quite materially. You're now seeing in cables and wires, where essentially it was a 2 or 3 player market. Now other players are entering. But that has sort of been the norm. It is not surprising. The problem happens when you price it assuming there is no competition that can ever come. And then you get surprised negatively and you see a big destruction in your portfolio for these specific companies. So at least for us, when we model sort of long-term valuation for these companies, our assumption is that there will be competition and we bring down margins back to averages which we think are sustainable and then value companies based on that. As long as you're doing that in your long-term portfolio analysis, you're not that negatively surprised and you tend to buy companies at valuations that make sense.
And just as we spoke of this, the shares of Dreamfolks have taken a sharp knock as we speak. So 4.5% lower on that stock. It had opened higher, but is now very quickly hurtling down towards its 52-week low, which is at 209. The intraday low today is 211. So almost there. At that 52-week low is Dreamfolks, and now is looking to see some bit of recovery from the lows of the day. But Nilesh, since you mentioned within this competition space, the one space that comes to mind other than paints is of course the wires and cable space. You had Polycab, you had Havells, now you have other conglomerates entering the space, be it Ultratech, be it Adani, and more competition in this space. Do you justify the kind of valuations that these companies currently trade at, be it the likes of Polycab or Havells, not specifically, but the valuations of the sector in general? And is this one of the ways to play the real estate proxy, if so?
I mean, to their credit, these companies have built specific brands in a very commoditized business. I mean, some of the names that you mentioned do make superior margins compared to others. But again, the assumption is these margins are sustainable, which may not be the case. Like I said, if you make superior margins in a commoditized business, you can make slight premiums, but apart from that, you will see competition coming in. And like I said, there are large conglomerates in India who are always eyeing sectors to enter. They generate a lot of cash in their core operations, and you will see them enter that space, which is what has happened. So the valuations were a bigger problem. It's not that these companies will not generate cash in the future. Margins may see correction as other players enter, which again, if you're making much higher than sort of normalized ROEs for these businesses, it will revert to long-term normalized ROEs in 15 to 20% range.
Okay. Nilesh also wanted to understand which other sectors are you seeing some value emerging in? Because you said we've already seen that run up, though India has underperformed the globe. Any space where you think that there could still be some valuation uptick?
So the portfolio follows a value style, and our largest allocation has remained private sector banks, which is where we think valuations are reasonable. They have delivered sort of better returns this year compared to last 3 years. But we still believe when you look at the long-term averages and where they are trading right now, there is significant upside left. Over the last 2-3 years, we found names, specific names in the saving side of the household balance sheet, be it asset management, insurance, broking companies, which we've added to the portfolio. We continue to have large weights in IT services, primarily in the large cap names. I know discretionary spend in the West has been deferred, and near term there could be weakness in growth that they report. But I think they still have tailwinds where, especially if you look at the rupee versus what has happened to the European currencies. I mean, over the last, over this calendar year, the depreciation has been in the order of 15%, which is quite massive. And they do have significant exposure to these geographies outside after US. So we think there is tailwinds there, and you may see some uptick in that sector over the near term.
You know, Nilesh, a sector that has been in the spotlight over the last couple of days has been the hospital sector. There's been a lot of consolidation that has taken place. You recently heard from Apollo that they're going to demerge their other operations from their core business into one listed entity, the digital operations that they have, the pharmacy business as well. What within the hospital sector, or what's your call on this sector here? Do you expect that the sector leader in this space will continue to do what it does and be the preferred pick for the analyst community, especially because now that the holding company discount there goes away as well? Or do you see better value opportunities not in hospitals but in other pockets of the pharma sector?
I mean, it's a fantastic macro story given the underpenetration in that space. But again, valuations are so expensive in that space. It's sort of, we've never had allocation there. It's one of those great top-down stories. But if you want to own any company in that space, and you look at valuations, it's just difficult to justify holding them in the portfolio. We've always had exposure to large cap generic names where we found specific names come to valuations which were comfortable for us. But apart from that, it's a sector we would like to own, but it's just priced assuming abnormal growth and high margins for the next 20 years, which makes it very difficult for us to own in a value portfolio.
Okay, all right. Take that point, Nilesh. Thank you so much for joining us with your thoughts on the markets and individual names and sectors as well. With that, we'll slip into a break. When we come back, we discuss market technicals with Vishal Malkan of Malkan's View and also discuss the top trading bets.
Holding on to gains are the markets. Flashes on your screen as well. Some NBCC has signed an MOU with NFDC for the redevelopment of the Sirifort Auditorium in New Delhi. They won an order as well yesterday. The stock, in line with some of the broader market moves, has come off the highs of the day. But a quick chart check then from Vishal Malkan of Malkan's View. Vishal, good morning. Thank you for joining in. still that elusive 25,600, 700 range proving to be a resistance for the index. Do we have enough legs to cross it sometime in the near future? And if so, what are the levels you're watching out for, and your stock ideas as well for the morning?
Yes, good morning. I think Nifty has been showing resilience in staying above that 25,600, which is a good sign. The range was actually around 25,300, 400, which was not crossed for a couple of months. Now we are well above that, maintaining that, closing above that. So it shows strength. So the next target to look out for is 25,800 and then 950 on the Nifty. As well as on the Bank Nifty, would look at same levels around 58,000 should be our next target for Bank Nifty, which is also showing good strength. Now, a couple of stock ideas. I'll go with the first one, which is CDSL, which is breaking about that range, about 1780, 1790, and staying about at 1800 levels consistently. So I'll go with a buy on that with a stop of 1760 for targets of around 1840 and 1875. And the second one would be on Manappuram Finance, which is all the financial stocks, finance sectors, non-banking stocks are looking good. And that Manappuram Finance looks good as a stop loss, with a stop loss of 270 for targets of 285 and 293.
Okay, all right, Vishal, thank you so much for joining in with those individual bets and the market levels as well. Let's bring you a corporate conversation now. Dhanuka Agritech is planning to ramp up its capacity and new product launches. To discuss more on this, we have Mahendra Kumar Dhanuka, the Vice Chairman and MD of the company, joining us now. Mr. Dhanuka, good morning. Thank you so much for joining in. Before I ask you about your product expansion and the capacity addition as well, generally I wanted to understand what's happening with the supply chain currently and the availability of materials as well, because we did see insecticides saying there's shortage of some herbicides. China has stopped imports of certain important key materials as well. Has that impacted your industry at all and the company as well?
Good morning. Let me first correct you that from last 1 year, I am the chairman of the company, not the vice chairman and MD. So this is one correction.
Yes.
And secondly, the availability of raw material is not an issue right now. It is easily available. Definitely, the herbicide demand is increased because of the good rainfall, and some of the herbicide, especially two molecules, glyphosate and paraquat, they are in shortage right now, and it will take time because the planning was for a normal season, but since the demand for the herbicide is much more, so that's why the availability is an issue right now, and it will take another 30 to 45 days to further receive the material from China. Only the material which is in pipeline that will come, but that will not suffice the total requirement as on today.
Okay, so you're saying there is shortage of materials which is used in glyphosate right now. Am I correct?
Glyphosate and paraquat, these are the two molecules which are herbicides, basically used in various crops to kill the weeds, unwanted plants.
Okay, so how much is that as a percentage of the overall industry and the company as well?
For the company, it will be around 2% of the total sales, not very big. And overall, for the industry, it may be around 3 to 4%.
Okay.
Mr. Dhanuka, good morning. Thank you for joining in. Speaking about your facility at Dahej, you had earlier guided for 60 crores of revenue coming from this facility as compared to 40 crores that you had reported last year. How has the quarter been so far? And I don't expect specific numbers from you, but what has the situation currently been on ground with regards to demand, as you just mentioned, for a certain amount of products here? But do you expect the performance that you had in the previous quarter to be better this time around?
We are manufacturing only one product, bifenthrin technical, at our Dahej unit, which is an insecticide. Initially, in the first quarter, there is major sales of herbicide. After the usage of herbicide, then comes the insecticide, and in the last, fungicides. So, bifenthrin being an insecticide, the major sales will come in the second quarter. So, first quarter has gone as per last year. There is no major growth in the first quarter, but second quarter we are expecting good growth in the bifenthrin technical sales which we are manufacturing at Dahej. Secondly, we are going to start another molecule at our Dahej unit in the Rabi season from October onwards.
So just on the on the Dahej facility, Mr. Dhanuka, you had indicated that 60 crore of revenues will come in FY26 itself. How has Q1 panned out so far? Will it be EBITDA positive this year?
No, we don't expect EBITDA positive unless we are able to have the export registration for the export of bifenthrin technical from there. Presently, we are running at around 30% capacity only. Unless the capacity utilization reaches to the 70 to 80% level, we don't think that EBITDA positive we can go. It will take another 2 years' time to be EBITDA positive at the Dahej unit.
And what about the overall performance, Mr. Dhanuka? You had earlier guided for growth in the high teens this time around. So fair to say that 18 to 20% would be a fair assumption this time around when it comes to your overall growth?
So 18 and 20% will be higher, but definitely around 14 to 15% growth we are targeting. And we definitely hope that because of the good monsoon forecast, we expect that this much growth we will be able to achieve. The second quarter is the most crucial quarter because the actual consumption of even BD sites starts when the rainfall comes, and rainfall comes by the mid of June onwards. So actual consumption starts from second fortnight of June, and July, August and September. These are the highest sales month for any agrochemical company. So we expect that the second quarter should remain good and we will be able to deliver the envisaged growth in the second quarter.
Mr. Dhanuka, global MNCs, they are still talking about pricing pressure. They are very cautious about calendar year 25, 26 as well. Dhanuka does not have a lot of export exposure. Do you think this problem is contained only to global markets and not India? What do you have to say about pricing going forward?
You see, our 50% ratio of the sales is for specialty molecules, which we are importing from Japan and doing with some American companies. So there is no pressure of price on these molecules. Only the pressure is on generics which are coming from China. So right now the prices are more or less stable or they are on the rising trend. Like glyphosate prices have increased to the extent of 15% in last fortnight. So some of the molecules which are in shortage, the prices are on the rise. So either they are stable, I don't foresee any reduction in the price in near future.
What about the products that you're about to launch, Mr. Dhanuka, the new herbicide called Dinkar in partnership with Hocco, and the fungicide as well from Nissan Chemicals? What is the kind of market size that you are expecting from that and the revenue potential that it can generate for your company?
You see, Dinkar is a paddy herbicide, which is used to control the weeds in the paddy fields. So the market is big, but initially when you introduce a new molecule, farmer is not aware about that. So you have to basically show the results to the farmer, and it takes 2 years time to get a reasonable sales volume from the product. So we expect that around 10 crore sales from the Dinkar in the first year, but we hope that we will be able to double, triple in the second year itself.
Okay, all right. So we'll be watching out for that, and we'll be speaking to you soon after Q1 results as well, Mr. Dhanuka. We'll correct your designation as well, Chairman at Dhanuka Agritech. Thank you so much for joining in and giving us all those details. With that, we'll take a short break. Remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m.
Welcome back. On to the big talking point for the markets, and that's the trade talks between India and the US. Now, government sources say that an interim trade deal could be signed with the US within the next 2 days. Abhimanyu is joining in with more details on this. Abhimanyu.
Government sources have told CNBC-TV18 that an interim trade deal between India and the United States may be signed within the next 2 days. Now, intense negotiations are continuing between both the sides, and negotiations are at their final stages. Speaking of demands, India is seeking more market access for its labor-intensive industries. On the other hand, the United States is seeking more access in the dairy and agriculture sector as far as exports of these products into India is concerned. However, government sources have assured that India's farmers' interests will not be compromised at any cost, and both these sectors, namely dairy and agriculture, cannot be opened up completely. It is likely, though, that several niche and premium products from the US may be allowed sale into India as part of an interim deal which is being negotiated. It remains to be seen how early the negotiations are going to conclude, even as both the sides look to seal an interim trade deal before the 9th of July. That is when the reciprocal tariffs are slated to kick in. Earlier this week, CNBC-TV18 had reported that in case talks fail, 26% tariffs would be imminent. So all eyes, of course, would be on the talks which are taking place currently in Washington, D.C. And based on that itself, any further steps would be initiated by both the sides.
Abhimanyu, thank you so much for those details. Here is former RBI Governor Raghuram Rajan on the sticking points that are hindering an agreement between India and US. Listen in.
First, there are easy sort of wins. India can buy more natural gas from the United States, which has surplus of that. It will require sort of positioning Indian purchases. But there's sort of politically difficult places that India doesn't want to go. For example, agriculture, dairy products. Indian dairy farmers, it's a huge source of living, and they don't want to be swamped by cheap US dairy products. So in that sense, there will be some red areas that India will not want to go to, but there are many other areas where I think agreements can be reached. There are other sources of oil nearer India than the United States. But certainly, as far as natural gas goes, LNG is something that India has increasingly used. And as it transitions to cleaner sources of energy, LNG may be the transition sort of energy source. So it is sort of win-win if India buys more of that, and certainly the US has a surplus.
We also spoke to Atul Keshap, the president of the US-India Business Council, on the likelihood of a trade deal before the 9th of July deadline, and here's what he had to say.
The US Chamber, the US-India Business Council, all of our members want to see this deal happen. It's very important for the United States and India, the two greatest democracies on earth, to have such a deal. I understand the trade negotiators are in town and working away. Secretary Bessent said the other day that a deal with India is very, very close, and we are cheering wholeheartedly for this deal to happen. It is my sincere desire and hope that both negotiating teams will push on through, because the only people who will really be gleeful about this deal falling apart are, frankly, Beijing and Rawalpindi and others. We need to have this deal go through. It's important for optics. It's important for business confidence. Chamber's view, ideologically and theologically even, is that zero tariffs are the best for ensuring the greatest amount of prosperity and happiness and consumer choice. And so we've been on the record many times about that. If we can get to a point where we have the minimal amount of tariffs between the United States and India, where we also have the minimum amount of non-tariff barriers, because it's not enough simply to reduce your tariffs. You have to be sincere about reducing all kinds of government machinery and bureaucracy and regulations and red tape that would impede the movement of goods despite having a low tariff regime. It is also true that the Indian agricultural sector not only employs an enormous proportion of the population of India, but also represents an increasingly smaller proportion of the GDP of India. And if you contrast that with agriculture in Brazil or in America or in other places around the world, India hasn't had the waves of modernization that other countries have had. In a way, if India were to look at this as an opportunity to inject a measure of innovation into its agricultural economy in a way that can actually catalyze growth of revenue, economic growth, help people transition into higher skilled jobs, it could actually be viewed as a positive.
Well, as we slip into a short break, the markets have cooled off significantly from the highs of the day in a matter of minutes. We'll get back to that in just a bit, but here's some good news for our viewers, and that is India's business news leader, which is just a click away, and that is the CNBC TV18 all-new app, which gives you instant access to breaking news, in-depth articles and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen. Take a short break, back on the other side with more.
Welcome back. You're still tuned into Trading Hour. Well, markets, they have come off sharply from the highs. It's around a 60-point uptick on the Nifty that we are looking at. When we started the show, it was up around 100-odd points. And if we look at what has gone down this hour, something like an M&M, L&T, Tata Consumer, Hindalco, all these stocks have come off from the highs of the day, putting some pressure on the Nifty as well. We do have ICICI Bank and Jio Financials and Trent. These are some of the stocks which have come off from the highs and are at the day's low as we speak. Talking about markets, earlier today we spoke with Vineet Sambre, the head of equities at DSP Mutual Fund, about the market sentiment and growth outlook. Listen in.
Long-term investors, I think the second view is more palatable. But let me say that I think at the moment, both the views are somewhere, I would say, balanced. And I think it is a time frame with which each of them are sort of looking at the situation at the moment. And clearly, as we have recovered from the market lows, which we had seen in the month of March to now, valuations have seen, it seems to be a bit punchy across the board, not just a few sectors, but across the board. I would say that the macro factors are now more conducive for growth versus last year. This quarter, next quarter, we still have a slightly lower growth. So from that perspective, I would say that the growth outlook should start improving maybe towards the second half, and that's where one should start looking at some directions for the market. I think the portfolios really doesn't change as much really from the very short-term perspective. But broadly, what we are trying to align our portfolio towards is these macro factors which are going to mean that the balance of trade could shift to consumers as a category towards the maybe end of this year. So maybe it would be a good way to create a basket of categories, a basket of companies within subcategories, maybe a white good as a category, apparels, innerwear, QSR, some of these, and take a broader call that if we broadly are with companies which are sort of leading companies within those spaces and likely to be beneficiary of the macro trends, I think we need to take them as a basket approach, and which is what we have also done as a part of our portfolios.
Well, it's time to call time on this edition of Trading Hour. We leave you with the Nifty off the highs of the day. The mid-cap index still holding on to gains of around 200 points. We count down to the second half of the weekly options expiry, starting with halftime report on the other side. From Sonal, me and the team that put this show together, thank you so much for watching.
Stocks perk up on hopes of an India-US trade deal after America's Vietnam trade pact. IT and energy lead the charge while utilities drag.
DMart owner Avenue Supermarts takes a knock after missing estimates on Q1 sales and concerns over rising competition from quick commerce that some analysts believe can also dent margins going forward.
The stock of FSN e-commerce, promoter of Nykaa, sulks after early investors Harinder Pal Banga and wife Indra Banga sell over 2% equity for near 1,200 crore rupees. Fears of further selling is an overhang.
Karnataka Bank Chairman tells CNBC-TV18 that the recent exits of its MD and ED won't stall any new business initiatives and the profitability of the bank will improve in the coming months, even as the hunt for a new managing director is on.
CNBC-TV18 learns that negotiations on an India-US interim deal are in the final stages, with sticky points being a greater access for India's labor-intensive industries and some protection for its farm and dairy sector.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's been a decent afternoon so far. For the last few trading sessions, the Nifty was consolidating lower. Today, it is consolidating mildly higher, even as the Nifty Bank faces some resistance around that 57,150 to 57,180 sort of mark. It will be very interesting to see where the second half of this trade goes, and that's largely on account of the fact that it's a Thursday today, which means it is Nifty weekly options expiry. Hi, Vinny.
Hi, Mangalam. Good afternoon. After those couple of days of consolidation, at least Nifty had recovered from the day's lowest point so far today. Broader end of the market, as of now, is managing to hold on to some bit of a gain. Now, what's not doing well, like you mentioned, banks, that's down and out. But autos, that's managing to hold on to gains, as well as media is managing to do well in today's trading session. So those are some of the names. And with that, mild gains coming in for IT as well as metals is what we're watching out for. So an interesting day surely coming up there, but a lot of updates that have come in on operational front, and especially on the FMCG retail side, and banks also are there. But let's start with retail then.
Yeah, so before the result season, there's always the result preview season. That's exactly what is taking place right now. Yesterday, we got numbers from Avenue Supermarts, V2 Retail, as well as Bazar style retail. Let's talk about Avenue Supermarts. The company reported a 16.2% jump in their revenue year on year. Remember, the last 3 or 4 year compounded rate has been around 17.3%. Analysts themselves were pegging anywhere between 17.5% to 18%. So to that extent, it's been a mild miss by about 1.5%. But remember, consumer sentiment itself has been weak. The festive season actually shifted in the previous quarter as against this quarter. So, which is why the company's reported 16.2%. The thing is that they've added 9 stores during this quarter. And if you look at the total number of stores which have been added over the last 4 quarters, the store addition year on year is 14.3%. Store addition 14.3%, revenue growth 16.2%. What does that mean? That there is some same store sales growth. Morgan Stanley pegs that to be 3 to 4%, could be anywhere between 1 to 3% itself for the same store sales growth. But the street believes that maybe, this is slightly below expectations, especially at a time when margins are something we will be watching out for. There is high competition in the large metros from quick commerce players, and which is why we will watch out for product mix improvement, the store opening plan for the company. Have they increased the pace of store expansion? And finally, the scale up of DMart Ready, with the company reveals in its consolidated numbers. We will watch out for that when the numbers come by. For V2 Retail, we have revenue growth of 51%. On a high base, it's grown very well. But the reason why the stock is mildly lower is because it's largely come on the back of store expansion and not so much on same-store sales growth. Same-store sales growth is just 5%. Even if you adjust for the Eid factor, which moved into the 4th quarter, the company says it is about 10% in terms of same-store sales growth. Bazar style retail, that one is another stock which is lower after opening higher on a 37% revenue growth. The same-store sales growth was actually a negative because, again, the festive season shifted in the previous quarter. So if you pull up the intraday chart of Bazar-style retail, you would see that the stock that opened higher has now moved lower and is currently at the low point of trade. So we'll watch out for that one. That is Bazar-style retail, down about 8% from the highs. That's not the only stock which is on our radar, though. We also have GMR Airports, which is in focus. This after the TDSAT has quashed Airports Eco-Regulatory Authority's earlier hybrid regulatory asset-based calculation for the Delhi airport. What does this mean for the stock and the company? Vivek joins in. Vivek.
Well, that's right. A very important development as far as GMR Airports is concerned. It's a directional positive, and there could be some past dues too that GMR Airports could hope to accrue from this particular development. So like you rightly mentioned, the TDSAT, which is the Telecom Dispute Settlement and Appellate Tribunal, went ahead and recently squashed the airport's economic regulatory authority's earlier hybrid regulatory asset base, which acts as the notional tariff base for calculating the aero as well as non-aero tariffs. This relates, or this particular case pertains to the Delhi International Airport. So now, what's actually happened is that the TDSAT has said that Aero's method is incorrect to go ahead and calculate the hybrid, when you're talking about the hybrid regulatory asset base. So the base on which aero as well as non-aero tariffs has been calculated has been deemed incorrect, indicating that there will now be a higher base which will be taken into account, indicating that there could be further tariff hikes that GMR Airports could enjoy. Jeffries has written on this particular development. They say that if the final ruling favors DIAL or Delhi International Airport, the revised HRAB could significantly raise allowable tariff recovery due to past under-recoveries. Along with that, they say this and other debated under-recoveries could mean major upside to Delhi Airport's tariff as well as profitability.
Okay, Vivek, thank you so much for that. So those are some of the stocks that we're keeping an eye on, and keep an eye out on some of these pharma healthcare names as well. They are buzzing in trade. Aster DM, we have Eros Life Sciences, Narayana Hrudayalaya, which are also buzzing in trade. So keep an eye out on the broader end of the market specifically. But on that note, we're going to actually step into a very short break. Up next, we'll get chatting with the management of Godrej Industries on their mega capacity expansion plans that they have. So stay tuned in for that.
Welcome back. Good time to look at the F&O setup of the market right now, and that's largely because it is, 2 hours ahead. 2 hours from now, we'll have the expiry. 3 hours, 20 minutes to be precise. So we'll keep an eye out on the Nifty, which is up around 50 odd points. This is off the day's high, slightly over 25,600 was today's high, coincides with yesterday's high as well. And the Nifty Bank is the one which was under pressure in yesterday's trading session as well. Today too has moved mildly off highs. No problems with the mid-cap index, which is holding higher by about 1/3%. And we have, some of the important stocks, the large cap stocks, doing a lot better and supporting the frontline index. So we have HDFC Bank, which is up 2/3%. Reliance is up, 2/3%, as is Infosys. So if these stocks continue to hold up, then, the lower end of the Nifty would see a fair amount of support. The advance decline too is in favor of advances. Even though those lines have come closer, now they're diverging a little with the green line on top of the red one. So that's a positive. The 25,400 call has been very active in today's trading session. All those call writers have begun to cover their positions. The question is whether the higher level call writers will also cover their positions or not. The 25,500 put writers also equally active, premium of 20 rupees, telling you 25,480 thereabouts could be strong support. In fact, the levels that we are right now are very close to a level from where there can be a bounce, which is expected. And the 25,600 call writers too have begun to unwind their position. So are we bracing ourselves for an up move in the last hour of trade or not is the big question that option writers are positioning themselves for. Fresh longs added on Blue Star. We had the management join us this morning on the channel as well. Over the last few trading sessions, we've seen, a lot of these consumer durables being very well bid. There was Voltas, there was Amber Ent, Blue Star as well, seeing some long positions being added. Fresh shorts have been added on Avenue Supermarts, but remember the stock has recovered from the lows. At the low point, it was down around 4%, so it's about 1.5% recovery from lows. If these shorts continue to maintain their positions, then and the stock continues to recover, then there could be some short covering on Avenue Supermarts as well. So we'll watch out for that stock. Winnie.
Absolutely. So that'll be interesting to watch out for, especially given that it's Nifty weekly expiry as well. But on that note, let's bring on the first management for today. We have Godrej Industries that had actually announced significant capacity addition under which it will invest 750 crore rupees in the chemical business for expansion. Now, to discuss their capex plans, the business outlook of the company, we have Vishal Sharma, Executive Director and Chief Executive Officer of the chemicals at Godrej Industries, joining in with us to talk to us about their business. Thank you so much, Vishal, for joining in with us this afternoon on the show. 750 crores for this chemical business is what you all have planned. One, what is the time period over which you all will be making this investment of 750 crores? And what is the asset turn that is expected for the same as well?
So the time period, first of all, thanks for having me. And, the company is on an expansion plan. We are looking at becoming a $1 billion business before 2030. So we are not giving it too much time. We want to move fast. This capacity expansion that we've announced, which involves 750 crores, is to be spent between now and roughly 2028. So between now and the next 3 years is what we are talking about. And let me also add, this will not be the only investments that we'll be making. There'll be more coming. So as we decide to make further moves, we'll be announcing that as well.
So roughly, I would not like you to, say something to us before you say that to your board. Roughly, what is the capex plan that you have from now to 2030 to reach that $1 billion target? And also, what is the internal rate of return that you are expecting in all these investments that you are making? What are the asset turns in a business like yours typically?
So let me answer the first point. When we say the total investments, so we are talking about 750 right now. There'll probably be another 400 to 500 going in. Now, I can't give exact numbers naturally, so I'm giving you, just a range. There'll probably be another 400 to 500 going in as we get towards 2030, because we'll need that. When you say asset turns, it can be defined in different ways, but I'll probably put it like this. I think these investments that we are making will give us an annualized revenue of a couple of thousand crores. Probably even more than that, probably up to 3,000 crores. So that'll be the impact that this will have on us. You asked about IRR. That's not a number I'd like to share right now, but what I will say is that it'll be above industry average IRR for sure.
Okay, above industry average IRR and couple of 1,000 crores additional revenue is what you're talking about, right? From this capacity addition that we're talking about.
Annually, yeah, that's right.
Yeah, okay. And the funding right now, what is the funding situation like? Will this be through internal accruals? Would you have to raise some money? Could you explain us that as well?
Yeah, great question, actually. We are a pretty well-performing company financially. This entire spend will be funded by our business itself. So we'll be generating enough cash flows, enough EBITDA to fund this ourselves. There'll be no external borrowings being taken for this.
All right, no external borrowing for that. 750 crores over 3 years obviously would not require you to take any more money. Your geographic expansion strategy, if you could state that as well, because currently 30% of your revenue is coming from exports is what we understand. For you to reach the $1 billion mark, how much of that would be export-led? How much of that would be domestic-led? Also, because there is so much uncertainty around trade, tariffs, etc., right? The global environment is not as smooth as what it was, say, in the last 5 years or so. So going forward, what's your strategy here?
So we consider ourselves to be fortunate that we are in India. A large market, largest population in the world, a growing market. Yeah, the growth may have tapered down a little bit recently, but medium to long term, we are very, very bullish and confident on the Indian market. So currently, domestic to international revenues sit somewhere around 75-25. The aspiration is to take this to about 60-40. Because when we look at market shares, we've got a much higher market share in India than we have internationally. So we want to keep growing the India domestic business in strong double digits. We want to grow the international business in very strong double digits. When I say that, I'm talking of 25% upwards. So as we go forward, we'll probably end up at a 60-40 kind of ratio.
So domestic grows upwards of 25% and international grows between 10 and 15%.
So domestic will grow double digits. So let's say between 10 to 12%. International will grow 25% upwards on an annual CAGR basis.
The other way around. Got it.
Okay. 25% plus growth for exports. You're going to be expecting that in the international market. Just one more point I want to understand, given these geopolitical tensions, could you highlight any concerns that have come in right now for exports on the freight cost front or container availability, any issues that you've seen in the recent times? Because there was a lot going on, whether, in the recent past, obviously there was Russia-Ukraine because of the Red Sea issue. Then we had the Strait of Hormuz issue, which came in. No closing of that, but any concerns or increase in rates that you have specifically seen?
So let's take it one by one. When we talk of geopolitics, let's talk of the Trump tariffs or the US tariffs. I think we got to deal with issues like that. We are seeing wars happening in multiple places. It was only one, then it became two. We don't know where the third one is coming from. So I think building agility inside the business, inside a management team, with our entire business construct and ecosystem, I think we've done that fairly well. So we ensure we are managing the whole value chain in a manner where even if we have some disruptions in different places, we are able to deal with it. And that's going to be an ongoing process. I think all of us in business have to forget about a world which is completely stable. That's probably history now. And we need to be prepared for ongoing, black swan events coming up on a continuous basis, probably annually or even twice a year. Coming to your point on container freight rates, etc., yes, that is also part of the ongoing, dynamic business environment, I would say. We got to keep adjusting prices. We take positions in the market as far as our raw materials go. So we import raw materials as well. We have a bunch of exports as well. I think this is ongoing management. This is not something you can plan for today, saying this is what I'll do 6 months down the line. The event happens. You need to think about it. You need to have a contingency plan in place. And when the event happens, you trigger the contingency plan and act. That's how we've been doing it fairly successfully. I'm confident with my team, we'll continue doing it successfully in the future as well.
Right. You've been giving us a fairly detailed outlook for the future of the company. On the top line front, yes. On the geographic front as well. You've been talking about the near-term concerns, etc. as well. From the operational standpoint, if you could give us a sense on what kind of margins are you targeting? Because if I look at your, pre-tax profits, your margins are high single digits, between 8 to 9%. And I ask this specifically because when you're looking at that $1 billion target, say a few years from now, what will that revenue comprise of? How much of that will be specialty? How much of that will be core chemicals? How much of that will be value driven? How much of that will be volume driven? And as a result of which, what happens to your margins?
So I won't talk specific margin numbers here, but I will give you the broad picture. So let's talk of it as bulk versus specialty. Yeah, I won't use the word commodity because what we call as commodities are actually essential products that we sell.
Yeah.
Customers can't survive without those. You know, it's a necessity. It's like cement.
So we're not saying that commodities are inessential. We're just saying they're commodities.
Well, we prefer to call them as essentials. I'll put it like that. Yeah. So when I look at that, we currently have about a 80-20 ratio between the bulk and the specialty. This ratio will change as we go forward. So when we are talking about the investments, a significant part of the investments, half of them or even more than half, are actually going into a specialty space. We are significantly focusing on the biotech space, making products, green products using fermentation technology. That's an area we are specifically making investments in, both in terms of infrastructure as well as in terms of R&D. So the 80-20 which we have today is probably going to become 60-40 and maybe even 50-50 as we approach 2030. That's the plan we have, and hopefully we'll get there.
And what does that do to your operating performance? Because obviously specialty will have a couple of 100 basis points higher margins, right?
The specialties and the biotech will definitely have a higher margin profile than a current margin profile. So as
what's the current split right now? What's the current split?
80-20 roughly right now.
No, in terms of margins, what?
So currently the specialty and biotech margins are above our average margins by at least 4 to 5 points.
4 to 5 percentage points. So that's 400 to 500 basis points. If that increases by 30 percentage points in your calculation, then you're obviously looking at low double-digit sort of margin at a $1 billion revenue front. You know, the street likes that because the stock, which was marginally in the red while you were talking about your plans, it's moved back into the green. That's not to say that, you know, we're so minutely observing what's happening here. But the important question from a Godrej industry standpoint, a lot of people who buy this stock are also buying a lot of holding company discount because of the portfolio that you have. Has there ever been any consideration of, you know, unlocking some of the value in the stocks that you hold? Because we're looking at the kind of moves that we've seen in either Godrej Consumer or Godrej Properties. At the same time, Godrej Agrovet was a good value unlocking exercise earlier. You hold almost 91% stake in Godrej Capital as well. We saw what happened with HDB Financial and a lot of these other companies which are looking to list their financial arms. So have you looked at these parts of the business at some point?
So actually, that's a question I would have, you know, probably Pirojsha Godrej answer. I don't think I'm the right person to be answering that question.
All right, take that point. We will definitely pose this question to Pirojsha when he joins us next. For now, thanks a lot, Mr. Sharma, for joining in and giving us the outlook on your business for the next few years. With that, we'll take a short break. Come back. Aditya Agarwala of Invest for Edu joins in with some trading strategies.
Welcome back to Halftime Report on CNBC TV18. Now we have Aditya Agarwala joining in with us from Invest for Edu to talk to us about the technicals on the market. Aditya, good afternoon and thank you so much for joining in with us. Obviously today is expiry day. Right now we've seen a bit of a run-up coming in the stock from the day's lowest point, 25,500. Nifty is holding on to that. But what are the levels that we should keep an eye out on today?
Good afternoon, Vinny. Thanks for having the show. 25,000 actually happens to be a key support area for the market. If you take a look at the options data today being an expiry day, there's a lot of put writing that you see that's taking place between 25,400 to about 25,500. With a lot of open interest built up, especially on 25,500. With having said that, there's a lot of open interest that is also building on the 25,500 call and 25,600 call as well. So my sense is market will try and expire between this zone of 25,500 or 25,600 on the upside. And it's more of a consolidation. If you take a look at our last few trading sessions, nothing really much, so to say, on the headline index. 25,700 is a stiff resistance. 25,400 is a good support area for the market. And towards the fag end of the trading session, being an expiry day, as I mentioned, I think markets could scale closer to 25,600 and expire somewhere there. Same holds true for Bank Nifty. If you take a look at it, it's more of a consolidation that you're witnessing on the Bank Nifty as well. Nothing much really to read between that. So 57,500 is a major hurdle for the Bank Nifty as of now. And as we speak, 56,900 or 57,000 is a good support area. So it's almost there, Bank Nifty. My sense is towards the end, you could see some bit of a short covering rally, both on the Nifty and the Bank Nifty.
Take that point towards the end of short covering. That's what the data is suggesting as well. Speaking about short covering, moments ago we had highlighted Avenue Supermarts. A lot of short positions added on that stock, and the stock has recovered a fair bit from the lows. Right now, as we speak, just pull up the intraday chart, you would realize that at the low point, the stock was down 4%, and now is nearly erased all of its losses. It's down by just about 1.5%. So just watch out for that one. A lot of shorts in the system. Stock's recovering from the lows. If it continues to move higher, then these shorts will have to unwind their positions. Individual stocks, are you playing on the long side or the short side?
I'm playing on the long side because I am waiting for a short covering rally. So a couple of stocks. One is Pidilite, looks interesting. And there's a change in texture also. If you take a look at the market, it's moved towards FMCG and two-wheeler space. So Pidilite is something which is looking interesting to me at current levels. Will buy for a target of 3,250 on the upside, place a stop loss of around 3,070 on the downside. A good move in the offering can be seen in Pidilite. Second, from the two-wheeler space, Hero MotoCorp is something which is looking very interesting. After a bit of a consolidation, looks like stock is poised to cross its 200 DMA. So at current levels, they'll be buying Hero Moto for a target of 4,450 to about 4,500 on the upside. Place a stop loss of 4,250 on the downside.
Okay, Aditya, thank you so much for joining in with us today, giving us those individual stock names that you're watching out for, as well as the levels we should keep an eye out on in terms of the Nifty as well. Thanks for joining in with us. But on that note, let's sip into a very short break. On the other side, we have Manisha Gupta joining in with us with Surendra Mehta, Secretary at Indian Bullion Jewelers Association. So stay tuned in for that.
Welcome back, and joining us now is Surendra Mehta. He is Secretary, India Bullion and Jewelers Association. Mr. Mehta, hi, thank you for joining in. And there seems to be a bit of a calm right now in the international markets. It's a risk-on trade, more trade agreements are happening, and the geopolitical tensions also seem to have taken a backseat, at least for now. And that is the reason you're looking at the gold prices very, very consolidating within a range there. Interestingly, having said that, we haven't seen the prices go below 3,200 or so. In the current kind of a scenario, what's your sense on where really could the gold prices go?
To understand one important thing, that after the geopolitical tensions have reduced, the new thing which is coming next week, especially for India, is the tariff deal. So as far as India is concerned, Indian gold market is concerned, I suggest all traders to remain very, very careful, because this tariff deal can finally end up having gold import from USA in a bulk quantity. And currently we are having 45 billion trade deficit with USA, and probably the entire game is not only about the trade deal or a tariff deal or a gold deal, but it is about the currency. So the currency is likely to become very, very volatile. And I think that is the reason why the market, India being one of the major importer for gold, the market is slightly calm and moving in the same range. There can be a deal with the USA, wherein USA may like to export gold to India, and with a preference, because currently we have a preference of import of gold from Dubai, wherein we pay only 5% duty against the normal duty of 6%. But if the preference is to be given to USA, then probably we'll have to go for further duty cut if we import from USA. So I would suggest all traders to, this calm market is actually a good for them, and not to carry over the trade for the next week at least.
All right, that's a cautious voice coming in. And but what's your sense on the prices itself? Because that takes in way more than just the US and India trade agreement, clearly, way more fundamentals and factors within that. How are you looking at the prices from here on?
Yeah, prices in the international market, I'm still very, very bullish because the prices are not going below 3,200 level, as you rightly said. It's almost moving in the similar direction how the silver moved. Silver were consolidating between $32 to $34, and we suddenly saw a surge in silver prices to $37. Something similar is likely to happen here, because there are non-farm payroll data. The US is likely to get into recession. There can be an interest rate cut. And all these factors, only one factor has reduced, that is the geopolitical tension, but other factors remain as it is. So in my opinion, I'm still very bullish on gold. It may cross $3,700 to $3,800 maybe in next 1 or 2 months.
Also, how would you look at the Indian demand now? We've all been waiting for a consolidation. We all understand that the last month or the last quarter wasn't such a great one. Again, most jewelers have come around and told us that the demand or the sales has been 40, 50, even 60% down for some of them. Do you see that improve as we go ahead?
Yeah, especially after the gold price crossed 1 lakh mark in the Indian market. Let me tell you, from the first week of June, the demand is on the retail counters are nearly down by 70%. And I think the Indian consumers are not able to digest the gold prices above 1 lakh rupees. And if this remains the story and whatever I think that gold prices are likely to go higher, it is going to be the tough quarter with all the festival season in the next quarter. I think Indian jewelry sector is going to have a difficult times in the next quarter.
Okay, could see a difficult time in this quarter, though prices could go up, is what is the word coming in from Mr. Surendra Mehta. Thank you so much, Manisha, as well as Mr. Mehta, for joining in with us for this interesting conversation there. But with that, we'll actually step into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Welcome back. Aditya had spoken about auto stocks and how he was positive on Hero MotoCorp. Just pull up a couple of these consumption names. So you have Bajaj Auto, which has moved higher, Maruti Suzuki. Okay, these are all entry-level consumption, themes that we were talking about. M&M too has moved to the high point of trade. But the newly listed stock, HDB Financial, is up in trade today after a good listing yesterday. So between yesterday to now, the stock has rallied almost 20%. After this 20% jump, what does the valuation mean for the company and how does it compare with peers? We have Gaurav joining in with the details. Gaurav.
Well, yes, HDB Financials is definitely in focus, and the reason being that this 1 lakh crore company has grown at around 20% over the last 4 years, and even when we look at the valuations and the listing, we saw company saw a listing at 13% premium, which was still trading at 3.4 times price to book value, and it still looks comfortable. And the reason being that there are some positives and negatives for the company. First, let's talk about positive. When we talk about gross NPAs, company has shown over the last few years, they have actually reported gross NPAs which were lower than its peers. Other than that, the product portfolio mix is very unique, and that is the reason why it brings company with a new perspective, with 73% of its loan actually linking to the secured loan portfolio. It gives upper edge to the company when we compare it with the peers. On the other hand, when we talk about profitability, there also we saw over the last few years, company has shown profitability growth of around 30%. On the flip side, when we talk about negatives, there are some factors which could act as a hiccup to the company. First is when we look at AUM growth, it is actually a little lower than we compare it with the peers. At 20%, we have already seen some peers growing at a CAGR of around 30% over the last 4 years. Second factor is the ROA. When we look at this profile, HDB Financial's ROA came in at around 2.2% for FY25. Again, a little lower than other companies. And the reason being that credit cost was a little higher. And from what we have picked up from the management commentary, credit cost is likely to stay at around 2%, which leaves a little upside for ROA. And that is another concern for investors. Now, considering all these factors, even at this price, when we look at price to book value, 1 year forward price to book, implied price to book comes at around 3.5 times, which is still comfortable. In fact, we also did a little bit of valuation analysis. Even if the stock is trading somewhere in the range of 1,000 rupees, which is 30% upside from its listing price, it will still give price to book of around 4 times, which is still comfortable, because when we look at other peers like Cholamandalam Investment and Bajaj Finance, they trade somewhere in the range of 4.5 to 5 times price to book. Another thing to point out here is that when we look at some media reports, it suggested that the unlisted price for HDB Financial was somewhere in the range of 1,200 to 1,300 rupees. Now, this price is a little unachievable at this moment, and the reason being that considering all these factors, the price to book, implied price to book for 1,200 rupees would come somewhere in the range of 5 times, which is a little difficult. But for now, it seems that the stock is trading comfortably in the price to book value of 3.5 times.
Okay, Gaurav, thank you so much for that analysis that is coming in on HDB Financial Services as well. Thanks so much for that. But on that note, step into a very short break. On the other side, we'll connect with Shweta of Elara Securities to discuss what we're watching out for in Q1 FY26 from NBFCs, understand M&M Financial's Q1 updates as well. Welcome back to Halftime Report on CNBC TV18. Now we have Shweta Tapdar, Vice President at Elara Securities, joining in with us to talk to us about the NBFC space. We have a lot of Q1 updates that have come in also overnight. Shweta, good afternoon. Thank you so much for joining in with us. M&M Financials, IREDA, Hoodco, a lot of banking names also have come in with their numbers so far. What are you making of M&M's financials? Seems like weak disbursements that has come in. But as of now, the stock is managing to hold on to gains. What are we watching out for now? And what is your outlook here?
Yeah, good afternoon. So yes, few business updates have already been announced, and Q1 traditionally tends to be a subdued quarter seasonally for most of the NBFCs, especially for CV financiers. The challenges will continue to persist for the full year as we move ahead. Second is, if you look at the NBFC space, entire FY25, most of these NBFCs have navigated distinct challenges in the nature of developments on the regulatory front. And second is the asset quality woes, which have remained sticky in the unsecured and microfinance space. So the outcome of these two factors will be slightly anemic growth, which will weigh on earnings for Q1 FY26.
Right. And what about IREDA and Hoodco? You know, if you could give us a sense on what you've made of the updates that have come in from there as well. And what's your outlook here?
Yeah, so capex-driven stocks, I believe, will be gradually back in reckoning. And PSU financiers like Hoodco and IREDA, we definitely continue to maintain a positive stance. Particularly in Hoodco, if you look at the numbers, highly likely the loan growth scenario remains pretty healthy. And we are estimating around 25% AUM CAGR for next 2 to 3 years. Considering how the power finance space and the infra financing has been in limelight, especially after a relaxation of infra provision financing norms, I think PSU financiers are back in reckoning. For next 2 years, given that power is a very long-term story and this government is pro-infrastructure, I think Hoodco and IREDA, despite the expensive valuations, are still nicely placed from a long-term perspective.
Okay, nicely placed from a long-term perspective, even after these valuations, is what you're highlighting. Shweta, you know, I just want to understand overall for Q1 FY26 from NBFCs, what should we be expecting? Would they be doing better than banks, given that obviously those rate cuts also have come in? So how does NBFC fare in Q1 FY26 this time?
Yeah, so the current positive liquidity scenario and the low interest rate regime definitely bodes well, especially for upper layer, high credit rated NBFCs. So next 2 quarters definitely look pretty stable for NBFCs. However, case-to-case basis, microfinanciers and credit card players definitely still are reeling under pressures as far as asset quality is concerned. And in fact, we also believe that now the focus has shifted from asset quality challenges to business augmentation obstacles. So given the fact that there have been a plethora of regulatory changes, most of the microfinanciers and credit card players have to go back to the drawing board, reject the operational systems and dynamics, and that will have interim pressures on loan growth. Second is from the margins perspective, at least in the first half of FY26, we do not see a major uptick in margins, primarily because the pass-through or the transmission will happen only in the second half of the year. So second half probably could be better on the margins front. On the asset quality front, although the credit costs have begun to decline, but it's too early to call on the asset quality woes are completely behind. So net, not a very exciting quarter in Q1 for NBFCs, but definitely the year looks pretty stable as the regulatory environment, the macros have turned favorable.
I'm sure you haven't assumed any formal coverage on this one, but the stock of the last 2 days has definitely been HDB Financial. I wonder whether you went through the RHP and if you have any sort of view here.
Yeah, Mangalam, so I'm very positive on HDB Financial Services, especially from 2-year, 3-year perspective. Currently, Elara as a house and myself, we are confident and placing bets on diversified product profile businesses. I think that's a need of the hour. And coming back to HDB Financial Services, a well diversified, balanced, granular retail profile, concentrated across MSME, LAP, vehicle loans, and consumer credit, and operational in the small ticket segment, like 1.65 lakhs is their average ticket size. Over 70% of their branch network is situated beyond top 3, top 4 markets. And if you look at the financials from the financials perspective, as on today, where HDB is standing, while the credit losses have been in the range of 3%, and they definitely faced headwinds post or during pandemic, now they are poised on and sitting at an inflection point. So we believe 20%, 19 to 20% AUM CAGR and closer to 18-19% ROEs are imminent. So that juxtaposed with the high credit rating, the strong parentage definitely puts HDB in one of the top tier NBFCs. And considering the valuations, 3.4, 3.5x forward book multiple, vis-a-vis say Chola's and Bajaj Finance of the world, I think it's a very good fundamental bet. Very
Do you have a published target price on this one?
Not yet.
Got it.
Okay, Shweta, thank you so much for joining in with us this afternoon on the show, helping us understand NBFC is what we're watching out for this time as well in terms of Q1 FY26. But with that, we'll wind down this edition of Halftime Report on CNBC TV18. Thank you so much for tuning in. Up next, your Business Lunch to take all the market action forward.
Stocks remain steady on the hopes of an India-US trade deal after America's trade pact with Vietnam. IT and energy lead the charge while utilities are the big drags.
DMart owner Avenue Supermarts takes a knock after missing estimates on Q1 sales and concerns over rising competition from Q-commerce that some analysts believe can also dent margins.
Shares of FSN e-commerce, promoter of Nykaa, are sulking today after early investors Harinder Pal Banga and wife Indra Banga sell over 2% equity worth nearly 1,200 crore rupees. Fear of further selling remains an overhang. CNBC-TV18 learns that negotiations on an India-US interim deal are in the final stages, with sticky points being greater access for India's labour-intensive industries and some protection for its farm and dairy sectors.
Hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I'm Mamakshi Thoria and with me is Hormaz Fatakia. Hormaz, it's been a good day for trade so far. At least there's some green on the screen, unlike what we've seen in the previous few sessions. And the broader markets as well are rejoicing, with the advance decline ratio largely in favor of the advances.
A completely reverse screen of what was the situation yesterday, but the Nifty Bank continues to be a bit of a sore spot even in today's session. And that is the reason why the Nifty has also come off from the highs of the day. At one point, the index was up over 100 points. It has given up most of those gains. Now it's just trading 40 points higher, still fighting to hold that 25,500 mark. And the good part is that even though we made a low in the morning, the dip was quickly bought into, and that was the only saving grace so far. Of course, it's the weekly options expiry today, so we need to keep that in mind as well. So flashes on your screen, Bloomberg's reporting that the US tax bill, the one big beautiful bill, has cleared the House procedural vote. It will be interesting to see if there are any more amendments that are made to the bill, because if that is the case, then the bill will go back to the Senate for a vote and possibly putting that July 4 passage deadline under jeopardy. So we'll await more details on this. Now, for now, the Dow futures remaining steady. Of course, it's going to be a truncated session in the US today as they head into a holiday tomorrow, but a lot of macro data is lined up later this evening, so it promises to be an action-packed session, Mamakshi.
Well, absolutely, Hormaz. Let's talk about the US-India trade talks, because that is going to be one factor that everyone will be watching out for. Government sources are saying that interim trade deal could be signed with US within the next 2 days. Abhimanyu joins us with more details. Abhimanyu?
Government sources have told CNBC-TV18 that an interim trade deal between India and the United States may be signed within the next 2 days. Now, intense negotiations are continuing between both the sides, and negotiations are at their final stages. Speaking of demands, India is seeking more market access for its labor-intensive industries. On the other hand, the United States is seeking more access in the dairy and agriculture sector as far as exports of these products into India is concerned. However, government sources have assured that India's farmers' interests will not be compromised at any cost, and both these sectors, namely dairy and agriculture, cannot be opened up completely. It is likely, though, that several niche and premium products from the US may be allowed sale into India as part of an interim deal which is being negotiated. It remains to be seen how early the negotiations are going to conclude, even as both the sides look to seal an interim trade deal before the 9th of July. That is when the reciprocal tariffs are slated to kick in. Earlier this week, CNBC-TV18 had reported that in case talks fail, 26% tariffs would be imminent. So all eyes, of course, would be on the talks which are taking place currently in Washington, D.C. And based on that itself, any further steps would be initiated by both the sides.
Here's what former Reserve Bank of India Governor Raghuram Rajan had to say on the sticking points that are hindering an agreement between India and the US. Listen in.
First, there are easy sort of wins. India can buy more natural gas from the United States, which has surplus of that. It will require sort of positioning Indian purchases. But there's sort of politically difficult places that India doesn't want to go. For example, agriculture, dairy products. Indian dairy farmers, it's a huge source of living, and they don't want to be swamped by cheap US dairy products. So in that sense, there will be some red areas that India will not want to go to, but there are many other areas where I think agreements can be reached. There are other sources of oil nearer India than the United States. But certainly, as far as natural gas goes, LNG is something that India has increasingly used. And as it transitions to cleaner sources of energy, LNG may be the transition sort of energy source. So it is sort of win-win if India buys more of that, and certainly the US has a surplus.
Well, we also spoke to Atul Keshav, the president of US-India Business Council, on the likelihood of a trade deal before the July 9 deadline, and here is what he had to say.
The U.S. Chamber, the US-India Business Council, all of our members want to see this deal happen. It's very important for the United States and India, the two greatest democracies on earth, to have such a deal. I understand the trade negotiators are in town and working away. Secretary Bessent said the other day that a deal with India is very, very close, and we are cheering wholeheartedly for this deal to happen. It is my sincere desire and hope that both negotiating teams will push on through, because the only people who will really be gleeful about this deal falling apart are, frankly, Beijing and Rawalpindi and others. We need to have this deal go through. It's important for optics. It's important for business confidence. Chamber's view, ideologically and theologically even, is that zero tariffs are the best for ensuring the greatest amount of prosperity and happiness and consumer choice. And so we've been on the record many times about that. If we can get to a point where we have the minimal amount of tariffs between the United States and India, where we also have the minimum amount of non-tariff barriers, because it's not enough simply to reduce your tariffs. You have to be sincere about reducing all kinds of government machinery and bureaucracy and regulations and red tape that would impede the movement of goods despite having a low tariff regime.
Now, late last evening, US President Donald Trump announced a trade deal with Vietnam, and the agreement includes a 20% US tariff on Vietnamese goods, as well as a 40% trans-shipping tariff. CNBC Singapore's JP Ong gets us all the details.
6 days before the Trump administration's tariff reprieve expires, Vietnam clinches a trade deal with the United States. Though details are still scant, proposed tariffs on Vietnamese exports to the U.S. will go down from a proposed 46% to just 20%. It's a less severe blow on the fast-growing Southeast Asian country that counts on exports as a major economic driver, with 30% of these going to the United States. There is a catch, though, with the U.S. keeping a 40% tariff on Vietnamese goods that have been transshipped through the country from other places such as China. This was made to try and prevent other nations from using Vietnam as a backdoor from which to sell goods to the U.S. in an effort to avoid possible tariffs on their exports. In return, U.S. President Donald Trump claims that U.S. companies will get to sell American goods to Vietnam with zero tariffs and lower barriers. The clock is ticking for Asian countries like India and Japan to clinch a trade deal with the world's largest economy. However, the Vietnam-U.S. deal may provide a possible scenario or framework for other nations that are trying to get better terms and less punitive measures from Washington, D.C.
Thank you so much for those details, JP Ong. But as we slip into a very short break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Now, in first an exclusive conversation after the sudden resignation of its MD and CEO and Executive Director, Karnataka Bank Chairman P. Pradeep Kumar spoke to CNBC TV18 about the pending RBI approval on the appointment of an interim managing director and also on the bank's liquidity position. Listen in.
We have recommended an interim MD to the Reserve Bank of India. We are awaiting Reserve Bank of India's approval for the new interim MD. And we trust that the Reserve Bank's approval for the interim MD will be in place before the 15th July when Mr. Sri Krishnan will be resigning. I can't say anything at that time who is the new interim MD. I mean, these are all, unless the regulator approves and I tell the stock exchange, I can't tell anybody else. So the bank's liquidity position is very comfortable. And if you had observed our capital adequacy ratio is at 19.85, I think, which is one of the highest in the industry. So we have enough capital for growth for the next 3-4 years, and we have sufficient liquidity. I don't think neither liquidity or capital or growth is going to be affected.
Well, that was the chairman of Karnataka Bank. The stock as of now is trading with a cut of 0.4%. But let's put the spotlight on Vedanta today. NCLT has deferred approval for Vedanta's demerger to next hearing on August 20th. Ashmit joins us with more details on this. Ashmit?
Well, the demerger clearly in the works. This is a part of the regulatory compliance that is required. Vedanta required to move the NCLT to seek the approval. They've done so. They had a long hearing yesterday, about 2.5 hours, where they presented their case. They put forth the rationale for doing it. They mentioned that they have approval over 99%, not just from shareholders, but also over 99% approval from secured as well as unsecured creditors. Then going on to say that the rationale is to unlock value, to facilitate more focused investments, to ensure that, in fact, going forward, there is strategic autonomy to these individual units, and to that end, putting forth their case. Now, in response, what we understand is that the NSE, the National Stock Exchange, has said that they've already issued an NOC. They don't have an objection as far as this demerger is concerned. SEBI, on its part, clarifying that they are in receipt of documents that have been furnished by Vedanta, that they will be going over them. They will be vetting whether there is full compliance with all the relevant norms. Meanwhile, the Petroleum Ministry is also likely to come back with their reply going forward. But that will be at the next hearing. The approval hasn't come as of yet. We understand that the next hearing in this case for Vedanta seeking approval will be on 20th of August. That's next month. Back to you.
We'll keep an eye out on the 20th of August. Ashmit, thanks a lot for that update. Now, the Reserve Bank of India has introduced new rules to standardize the levy of prepayment charges on loans, aiming to address the inconsistent practices and enhance borrower protection. Ritu is joining in with more details on this. Ritu.
Well, good news for borrowers because the Reserve Bank of India has directed banks, NBFCs and other lenders to not levy any prepayment charges on floating rate loans, including those that are taken for business purposes by individuals and micro and small enterprises. But there is an exception. Small finance banks, regional rural banks, Tier 3 urban cooperative banks, state and central cooperative banks and mid-size NBFCs can levy these charges, but only for loans of above 50 lakh rupees. Now, these waivers are going to apply regardless of the source of funds being used for prepayment and without any minimum lock-in period. But in the case of dual or special rate loans with a mix of fixed and floating rates, the exemption will apply only if the loan is on floating rate at the time of prepayment. For other loan categories, lenders can charge these fees as per their board-approved policy, but for term loans, any prepayment charge will have to be based on the amount that is being prepaid, and if customers close their cash credit or overdraft facility before the end date, the lender can charge a fee but only on the sanctioned limit. Importantly, no prepayment charge can be levied if the lender itself has asked the borrower to repay. Now, the RBI had already barred prepayment charges on retail loans in the past, and this latest direction now extends that benefit to business and MSE loans as well. Now, this is positive news for borrowers clearly, but as far as the impact on lenders goes, there are two key points to consider. One, the directions apply only to loans sanctioned or renewed on or after the 1st of January next year, so existing loans do not get affected. And secondly, since borrowers typically don't close long tenure loans early, the impact on banks and NBFCs' fee income from prepayment charges will likely come with a lag.
Well, thank you so much for all of those details, Ritu. But a day after Dream folks accused two airport operators of pressuring banks to block or stop transactions or payments made to the company, Adani Airport CEO has made a clarification about eliminating middlemen in airport lounges. Madhya is here with all of those details. Madhya, over to you.
So Adani Airport CEO Arun Bansal has spoken about the airport's lounge business in a LinkedIn post. He said that passengers across India can now access lounges directly through Adani Airport's platform in a partnership with other lounge operators. He said this has been made possible by the innovation coming out of the group's in-house digital lab. Bansal said that the fintech revolution has eliminated the need for middlemen across sectors. In this case, he's referring to lounge access providers like Dream folks. He went on to say that today's tech-led world, only companies willing to disrupt themselves will survive, the rest will disappear. Now remember, this comes a day after Dream folks told CNBC-TV18 that it is being pressured by two large airport operators to exit the lounge business. They claim there's a coordinated campaign to damage their reputation and push them out of the market. For context, Dream folks is a lounge access aggregator. It offers lounge access not just at airports but also at railway stations, highways and even visa centers. Just to add some context for our viewers, here's how the lounge ecosystem operates. The airport operator awards the lounge contract or runs it directly. The lounge operator manages day-to-day services. This could also be the airport operator itself. The access provider, like Dream folks, connects passengers to lounges via partnerships. Payment gateways like Visa, MasterCard and RuPay enable the transactions. And finally, banks and credit card issuers tie up with access providers like Dream folks to offer free entry to customers. So when Arun Bansal talks about eliminating middlemen, this means doing away with lounge access providers. So in an airport where Adani is the airport operator, lounge operator, it will also be the lounge access provider. That's what we understand from what Arun Bansal said in the LinkedIn post.
Madhya, thanks a lot for that update. And as a result of that LinkedIn post, shares of Dream folks just took a very sharp knock when we were addressing this just a couple of hours earlier. And it's currently trading with losses of close to 5% at the lowest point of the day. Take a short break. More news and updates continue on the other side. Stay tuned.
Welcome back. You're watching Business Lunch on CNBC TV18. Let's now get you the latest updates on West Asia. Days after Israeli and American strikes, Iran suspends cooperation with the United Nations watchdog, the International Atomic Energy Agency. Meanwhile, the Pentagon report says that the US strikes have set back Iran's nuclear program by up to 2 years. CNBC's Dan Murphy gets us the latest updates on this.
Inspectors will not be allowed to visit nuclear sites without approval from Iran's Supreme National Security Council. This move comes after Israel's June 13 attack on Iran and an American strike on Iranian nuclear facilities. Iran is also considering an entry ban on IAEA chief Rafael Grossi after rejecting his request to visit nuclear sites. Iran has accused the UN's nuclear watchdog of siding with the US and Israel and say the IAEA board's June 12 resolution, which accused Tehran of non-compliance with its nuclear obligations, was a catalyst for the subsequent Israeli attack. Meanwhile, new intelligence estimates from the Pentagon indicate US strikes on Iran's nuclear facilities last weekend set the country's nuclear program back by up to 2 years. President Donald Trump said Iran's nuclear sites had been, quote, obliterated after the US used B-52 bombers to hit sites in Fordo, Isfahan and Natanz. There is little indication from the Iranians and the IAEA, who would assess the extent of the damage. And now, with the banning of the nuclear watchdog from the country, it's unclear to what extent the Iranian nuclear program has been impacted. Meanwhile, Hamas has said it is studying the latest ceasefire proposal, adding that any deal must lead to an end to the war with Israel. Israel has reportedly approved the 60-day ceasefire deal, according to the US President Donald Trump, who has been increasing pressure on Israel to end the war. It comes ahead of a visit scheduled by Prime Minister Netanyahu to Washington next week, his third since President Trump took office for a second time.
Moving on to news from Europe then, where a heat wave spanning across France, Italy, Germany, Greece and Spain has killed at least 8 people so far. The heat wave has triggered health alerts and forest fires across Europe. It has also forced a nuclear reactor in Switzerland to shut down temporarily. Now in France, heat wave related health scares have led to over 300 hospitalizations. Italy has issued red alerts for 18 cities, while the temperature is forecast to reach 40 degrees Celsius in Germany. Temperature is making it difficult for the hottest day of the year.
Well, that's all we have in this edition of Business Lunch. We're leaving you with the Nifty hovering around 25,500. The mid-cap end of the market also doing well, but the Nifty Bank in the red. That's a wrap for now. Don't go anywhere. Mid-cap radar comes up next.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Important second half of the day today. It's the weekly options expiry. We have already come off from the highs. Let's see which way things go.
That's right. Good afternoon, Sonal. And it's a banking pack, a whole host of BFSI updates that came in overnight, and that's keeping the banking space slightly subdued. But we have a lot lined up on the show, some important corporate conversations. So let's start off with the top headlines. Stocks hold steady on hopes of an India-US trade deal after America's Vietnam trade pact. Consumer durables lead the charge while PSU banks drag. Midcaps in line.
M&M Financial reports its Q1 business update, reports a sequential decline in disbursements while assets under management rise. CSB Bank, on the other hand, total deposits in gold loans surge on a YOY basis.
Bazar project gains after the company bags an order in the range of 300 to 400 crore rupees for a 400 kilovolt transmission line project.
Bazar style retail under pressure after reporting their Q1 business update. Standalone revenue surges 37% versus last year. However, same-store sales growth declines 3%.
The stock of FSN e-commerce, promoter of Nykaa, sulks after early investors Harinder Pal Banga and wife Indra Banga sell over 2% equity for nearly 1,200 crore. Fears of further selling is an overhang.
Okay, those are the top headlines, but let's talk about the markets now. The Nifty up 50 points. It has come off from the highs of around 70 points from the highs of the day. Has been stable around those levels since 11:30. The Bank Nifty is the one which has come under a bit of pressure. So that index is flat with some negative bias right now, closer to the day's low as well. Mid-caps doing well. The top sectoral gainer is Nifty Auto. We have Nifty IT, which is doing well as well. Nifty Pharma, small cap index is doing well, 0.3% higher over there. But very stock specific in terms of the quarterly updates that we have been getting in. Of course, that had to happen. We are kickstarting Q1 very soon.
Very soon, within next week, we'll all be, we'll have a whole host of results to analyze. A couple of stocks, that's hit the eye. A couple of stocks from the EMS space. The first one is Amber Enterprises, that stock near the day's highest point. And the other one that we don't discuss too often, is PG Electroplast, that is PGEL. That stock almost 3% higher. But in our special segment, Midcap Mover, Hormas is standing by the wall. He has a whole host of stocks from the broader end of the markets that are moving around in the session.
There's some bit of relief for the broader markets today, especially considering the fact that the advances are outnumbering the declines today, although that line is skewing towards converging again. But for now, we'll start off with the gainers then in the broader markets. And there are some of these names like DCM Shriram, which has surged to the highest point of the day. There was some tax relief announcements that came in yesterday. The stock is up 11.5%. Look at Transrail Lighting, Motilal Oswal. Rate gain at one point was up almost 8 to 9%, still holding on to gains of around 5.5%. Healthcare stocks are doing fairly okay for themselves, be it hospitals, be it pharma. Look at Aster DM, look at Eris Life making new highs. Natco Pharma and Ipca Labs too within the mid-cap pharma space, seeing healthy gains of anywhere between 3 to 4%. Now, the other space that's done well though are the auto ancillary names and the MNC ones in particular. Look at Bosch is up 5%, Honeywell Automation is up 5% as well. And look at Motherson Wiring, that's done fairly okay for itself even in today's session, 3.5% higher there as well. Stocks that have done well on the volumes front, have names like Confidence Petroleum, Latent View. KPR Mills was the stock that was supposed to be in the spotlight after the Vietnam deal with the US. So that's up 3.5%, and V-Guard too, seeing gains on healthy volumes. And lastly, stocks that are bucking the trend, at least in the broader markets, not doing fairly well for themselves. Look at Dreamfolks after the post by Adani Airports, its CEO, 5.5% lower. Bazar style retail, as you just mentioned, and Nykaa after the block deal, seeing some choppy moves, and Karur Vysya Bank is down to the lows of the day. Back to you guys.
All right. Thank you so much, Hormas, for joining us as always and telling us the stocks that are moving around in trade. And with that, remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Midcap Radar. Well, India Grid recently announced that it has partnered with IFC to develop a battery energy storage system project in Gujarat. Harsha, who's the managing director at IndiGrid, joins us now to discuss more. Thank you so much, Harsha, for joining us. First up, give us the contours of this particular development. So who are you partnering with in this particular project? Is it under the EnerGrid platform that you had earlier announced with BII? Has the PPA already been announced, and what is the capex commitment from your end?
Thank you for having us. This project is, first of all, it's a BESPA, so Battery Energy Storage Purchase Agreement, which is already signed with GUVNL. This was one of the first large utility scale project. Yes, this project is going to be under EnerGrid, where on equity side, we are partnering with BII and Norfund. And on debt side, IFC, who has been a long-standing partner on the lending side, is also participating. And then they have done a phenomenal structure for us in terms of debt for this project specifically.
Okay. So Harsh, give us some details then. What is the quantum of commitment? Does it come under the BI-backed IndiGrid platform? And is the PPA signed for this one? What would the tariff be?
Yeah. So the agreements are already signed for this. This total commitment is around 460 odd crores of debt facility that IFC have signed, which is around $55 million. IFC with this deal overall lent approximately $380 million to IndiGrid, which is about 3,250 crore, which is one of the largest lender on our books, and also one of the longest debt financier for us. We have up to 17 years of fixed rate loans with IFC or bonds with IFC. And this is incremental such facility, which is concessional in nature to support the project. And that's the tariff for this case is not finalized in terms of rupees per unit, but in terms of rupees, the lakhs per rupees per month megawatt.
That's right, yeah.
So this project was won a year and a half earlier. So this was won at approximately 4,50,000 rupees per megawatt hour per month. That's the tariff for this project.
4,50,000 rupees per megawatt per month, which is the tariff that you have mentioned. Okay, this largely compares in line with recent BESS projects. One worry, what's actually happened is that in the last 6 months, we've seen one project from JSW Energy, which was at a slightly higher tariff, actually getting, not getting the nod from CRC. Any risk to that, given the fact that you just mentioned that this is a project where tariffs were determined some time ago? So that is the first question. The second question is something slightly more structural. Why are you finding the need, or what is the need, which we asked you last time as well, the need to deviate from transmission assets and getting into slightly more capex intensive BESS projects? Will this dilute shareholder returns?
So to answer your first question,
right.
The BESPA is signed for this. GRC has already approved this. In comparison to the JSW project you were referring was approximately, if I'm not wrong, around 10 lakh rupees per megawatt hour per month.
Right.
Versus this one is less than half. There's also a long time gap between the two, so they're not strictly comparable. But in our case, the GRC has already approved the tariff. The project is started, and we are looking to commission in this financial year as well. So it's pretty advanced stage, so we do not see that a regulatory risk on this project itself. To answer your second question on why IndiGrid is doing this, for us, and IndiGrid is a critical player in energy transition. We think battery energy storage is a crucial requirement for energy transition for India, and it offers a phenomenal opportunities for players like us to build scale early on. And this is one such project where we are showcasing that. The contractual structure of these projects is similar to transmission in terms of take-or-pay, as long as we maintain the availability, which is pretty much similar. So for us, battery energy storage projects are like transmission, or I would say they are transmission projects. Even Ministry of Power, when they have announced the classification of battery energy storage projects, they have clearly identified the utility scale projects which are attached to transmission systems are part of transmission system. So for us, this is just an extension of transmission system, nothing beyond that. In terms of shareholder returns, this is hugely accretive to shareholders because the project was won at a good economics, and we are very well in time to commission these projects. And during the time of the project, we have seen the battery energy prices, battery energy storage
price is reduced a bit, which has added the returns for this project.
Okay. Harsh, then tell us about any fundraise plans to expand the AUM going forward in terms of the assets that you want to add in FY26. What is on your radar? You say this one is just an extension of the transmission biz itself. Are there any more such plans that you have on the horizon?
Certainly. We see our business in three buckets. First is transmission, where we are doing development as well as acquisition. Development happens in EnerGrid platform, where we are targeting over 50,000 crores of projects this year. Wins is not in our control, but we will be looking to bid for these projects. On the acquisition side, we have already acquired one project, which is solar plus transmission from Renew, which put together approximately 2,100 crores of enterprise value this year itself. We just closed it earlier this month. And the third is battery energy storage, where we already have around 900 megawatt hours of projects, and we are looking to expand and bid for more projects. So in all, we are seeing growth in all these three segments. We will look to do both greenfield and brownfield acquisitions in these three segments in this year.
Harsh, very quickly, so are you sticking to the dividend per unit guidance of 16 per unit for FY26? Any upside risk there?
No, I mean, the upside risk, I think is not there. I mean, upside, we have already factored in earlier this year, the 16 rupees a unit guidance, which itself is a almost 9% jump versus last year. We are confident of delivering that. In any case, we only increase DPU when we are very sure of delivering the DPU for next 5 to 7 years, irrespective of new projects coming in or acquiring new projects. So it's a fairly stable prediction that we have done for DPU. On top of it, we are looking at interest rate reduction that is coming in this year. And hopefully with more refinancing coming in, we'll be very, very comfortable delivering our 16 rupees a unit guidance for this year.
Okay. All right, Harsh. Thank you so much for joining in with all those details. With that, we'll slip into a break. With that, here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Net.
Welcome back. You're still tuned into Midcap Radar. Let's talk about the real estate sector. Latest report by Knight Frank suggests that there was premiumization of residential segment across markets. This is the first half of calendar year 2025. This is their half-yearly report which has come out, and it talks about what's happened in the residential segment as well as the official or the commercial segment as well. Ghulam Zia of Knight Frank is joining us now to discuss the same. Ghulam, good afternoon. Always pleasure speaking with you. Let's first up talk about the housing market. A 2% decline in overall sales across cities. We've seen that unsold inventory has increased by 4%. Are we at that juncture where the growth would slow down? Or I would say the decline could come about and unsold inventory will keep increasing?
Not really. First of all, let me put across another small data point that you missed mentioning is that in the same period, new launches have also shrunk by about 2 odd %.
Yeah.
So it's not just sales, but new launches. Both have moderated a little. However, the inventory that you're talking about, when you're looking at inventory as just one number, you may look at a particular picture. But when you realize that this inventory has to be seen in perspective of the velocity of sales. So if you look at last 8 quarters of rolling averages, the velocity of sales that we have experienced, continuing with the same velocity, whatever inventory that we are talking about would be absorbed in less than 2 years, which means it's a great healthy market for a developer. So whenever you're talking about inventory, you need to look at how, if suppose tomorrow nobody is launching a new product, how long will existing inventory take to be absorbed? And that's only a 2-year number. And that's something which not many people are talking about, that looking at the velocity of sales, inventory is not that much of a worry. In fact, it's a great number. So overall, what I'm worried about is not so much of an inventory shrinking or rather growing. It's actually a certain segment where we do see some worries coming up, which is 20 to 50 crore of segment, the product size. Product ticket size segment is where a little worry is there, where the velocity of sales shoot up to about 4 to 5 odd years. But except for that, everywhere else, any other segment of real estate, at least housing, there is no need to worry at all.
So, Ghulam, you're talking about the 20 to 50 lakh segment, if I'm not mistaken, where...
50 crore. Let me correct. 20 to 50 crore segment, the ticket size, that's only segment where you're going to take more than 4 years to absorb the inventory.
Understood that. But you're also talking about how the lower end of the segment, homes below 50% has actually seen a steady decline in sales. What is the reason for that? Do you see that picking up anytime soon?
Well, the reason thereof, it's very simple. Every developer is chasing the low-hanging fruits, which is the upper end of the market, luxury. Everything is about luxury. Whichever city you go to, developers are focusing only on the upper segment of the market because A, your margins are far better, and 2, your ability to quickly sell and move on is much better. And now, let's not forget, if you're selling 100 sub 50 lakh apartments, you may not make as much of profit as somebody like a DLF would sell one apartment of 100 crore and make much more of that. So please understand, this is economics, and developers have realized that it is a quick product, fast moving product in the upper end, margins are higher. So the lower end we've seen a mass exodus from the lower end of the market. Most of the developers have actually moved out from lower end and shifted to mid to upper end. And that's a worry. As you rightly said, not just the new inventories, but even the sales. Actually, what used to be 2/3 of your overall pie, below 50 lakh apartments sold, say about pre-COVID, used to be 2/3 of the market. Today, it has shrunk to less than 1/3. Actually, just barely about 1/4 of the overall market is that segment. So your question is valid, huge worry. Whenever the lower end of the market bounces back, for want of inventory, we shall not see good traction in that segment.
Got it. So, we usually just discuss the residential space, but so much is happening in the office space as well, right, Ghulam? What would your key takeaways be from the first 6 months? Do you think this is something we can replicate or maybe do better than that in the second half as well?
Well, just to sound very, very, a little worried about the excessive growth. What we have seen is almost about 50 million, about 48.9 odd million square feet of space absorbed in the first 6 months of this calendar year. That's unbelievable. And a few markets, like of course, Bengaluru has always been the leader on the top. This year, the first half yearly, they have done 18.2 million square feet of transaction, which is what they did in the last whole of calendar year. More than that is only in 6 months. So what my worry is that these numbers are fabulous. So if you, and typically every year we have been observing that the H2 always does more of office transactions than H1. Here the H1 itself is absolute earth shattering. So what would H2 be is a big worry. And if even if you are moderating it, we would still see more than 85 to 90 odd million square feet of office transaction in this calendar year, which will be far better than this about 71 that we did last year. But the problem here is slightly different. Not enough of inventory is coming up. Not enough of new office stock is coming up. Because again, most of the developers have actually moved to focusing on residential. They're making super premium houses and making their quick profits. Office sector is not getting enough of inventory. So the year has been fabulous, but the worry is hanging that not enough of inventory is going to cause a huge concern in times to come.
Gulam, very, very interesting insights. So most of the developers have actually shifted to the premium housing, and both residential housing as well as commercial is seeing a bit of a dip as far as inventory or new inventory coming in. Thank you so much, Gulam, for joining in, giving us your view as far as the entire residential as far as the housing market is concerned. Well, time for a quick market check. Have a look at a name like UPL. This particular agrochem name was under quite a bit of pressure whole of last week. But what's actually transpired is that this particular week, the stock has done extremely well for itself. In fact, if you pull up, as you can see, the 14-day chart, almost 9% higher as far as UPL is concerned. But with that quick chart check, it's time to take a leave on this edition of Midcap Radar Mutual Fund Corner when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala, with me Sonal Butra as well. Sonal, very good afternoon to you as well. Thursday again, and when we help our viewers with everything related to MF Corner and mutual funds.
That's right. So, you know, Vinny, today I thought we often talk about loans against property, loans against the assets that you have. There's a concept called loans against mutual funds as well. So should one do it? Should they go about it? And is it really something that helps an investor or not? We are going to discuss all this and a lot more with our guest today, Mohit Gang, the co-founder and CEO at Moneyfront, and Harshvardhan Roonghta of Roonghta Securities. Gentlemen, good afternoon. Thank you so much for joining in. Let me start with you, Mohit, and break it down simply for our viewers. What is this concept of loans against mutual fund investments? Do investors need to redeem the investments completely in this case?
Hi, Sonal. Good to be back with you on the show. And look, loan against mutual funds, it's also called as loans against stocks, loan against shares, or advances against financial assets, right? So this is basically a secured overdraft line, which is drawn on the existing mutual fund portfolio of an investor. So if you have an existing portfolio, you need to lien mark or hypothecate that portfolio. The lender will freeze the portfolio for you and give you an overdraft line against the holdings which you have. Now, this overdraft line typically enjoys an interest rate which is much lesser than the personal loan, which is more unsecured in nature. Because this is secured, it enjoys an interest rate which is much lesser. It's a sleeper line. You can withdraw as much as you want at any point in time. Interest will be charged only on the amount which you withdraw for as many days as you withdraw, right? So, and the good part is it keeps getting revalued every day basis the portfolio value of your mutual funds. There is a different hypothecation for debt funds and different value for equity mutual funds, which is provided against this. So it's a very user-friendly kind of a thing which an investor can always put into place against his long-term assets which he doesn't wish to redeem, so that he always has a placeholder or always has a liquidity drain which is available to him or her whenever they want to utilize the funds.
Right, Mohit, you know, as well as Harshvardhan, good afternoon. Harsh, you know, I'm going to actually come to you. Are there some rules or policies only post which an investor can actually go ahead and take a loans against their mutual fund in terms of investment? What are those policies that we should watch out for?
Well, very simply put, this is an overdraft facility. It's like a limit that you've been granted. And so let me take it process-wise, step-wise. So the first step is that as an investor, you have certain investments in your mutual fund. So we're talking about loan against mutual funds specifically. So we'll focus on that. So you have certain investments in the form of mutual funds. Say it's equity fund, for example, though you can get the limit against even hybrid funds, even debt funds. So for example's sake, we take the case of an equity fund. You have certain investments which you will need to pledge it to the lender. So whoever is the lender in this case, you will have to pledge your units to that lender, against which there will be a margin. So suppose you've hypothecated about 1 crore worth of mutual fund units as per current market valuation. And if it's an equity fund, and we assume a 50% margin, so you'll be given a credit limit of 50 lakh of rupees. Now that limit you can withdraw and get the money in your bank account to utilize it for whatever purpose you wish. So the lender is not going to ask you what is the end use of this money. So you can use this money the way you like it. Supposedly you use this money for say 15 days. So you will pay interest only for those 15 days of using that money. So you had a limit of 50 lakhs. Say you withdrew only 10 lakh of rupees and you used it for 15 days. You pay interest only for 15 days. The rate of interest in the current scenario is about 10.5%. So you pay interest only for 15 days and you can repay this money and close the overdraft limit. This 50 lakhs will still be available to you to be withdrawn again in future. Now, what safeguards you have to take care in this case is, in n number of cases, we've seen investors who are going a little overboard. Now, I'll tell you how. Now, you have a limit of 50 lakhs against an investment of 1 crore. Now, what they do is, in some cases that I've heard, is that investors use this 50 lakhs to speculate into stock market, to buy shares probably, or to reinvest it back into mutual funds. In the estimation, in the hope that they will make extra returns. With 1 crore, they're actually they're investing 1.5 crores in the market, so they'll make more money. So I think the rules that investors should follow in this particular case, it's a lovely product. It's like a credit line given to you. So you pay interest only on the amount that you've actually withdrawn, not the limit that you have. So use this very prudently for any temporary use of money. So say suppose you had some requirement 15, 20 days down the line or 2 months down the line. So you don't need to redeem your mutual funds. You don't have to pay capital gains. You don't have to pay exit loads, nothing. You just pledge them, get a limit, use it for the time period that you need. When you get your cash flows, repay it back. So I think it's a lovely product if used prudently.
Got it. If used prudently, that's the big caveat, right? Mohit, if you have anything to add to this question itself, if there are any limits to certain kind of mutual funds, be it debt, be it equity, if there are certain mutual funds which can't be considered for counting or, calculating that pledge that you're creating, and some benefits that you would want to talk about when it comes to loan against mutual funds.
I think Harsh has very beautifully put it out all. But against debt funds, typically the lending line can vary. If it is liquid funds or ultra short-term funds, then it can go as high as around 80% odd. For long-term debt funds or for some different varieties of debt funds, it can be around 75% also. That can vary from lender to lender. Against equities, typically, Sonal, the rate is 50% and that doesn't vary much. I think most of the lenders will follow a 50% LTV against equities. There are certain categories which are not eligible, especially locked-in funds or closed-ended funds. So if you have any closed-ended funds in your portfolio, if you have an ELS scheme, which is a tax saver scheme, then there is no line available because those can't be redeemed at the back-end call of the lender or the investor both. Right. And there could be certain categories or certain funds which are not approved. These could be, let's say, low AUM funds or very high risk funds or very volatile funds. And there could be certain stocks which are not eligible, which could be micro caps or small caps. And there could be certain bonds which are not eligible. So there is always an approved list with every lender, which is available against which the funds are disbursed. The second part to your question, Sonal, look, this is a sleeper line. It can be utilized at any point in time, especially for emergency scenarios. Let's say if you, God forbid, if you have an hospitalization where you don't have a cashless policy, you have to immediately make some upfront payments, then you can immediately withdraw funds. And as and when you get your insurance claims back, you can replenish the lines. They should not be utilized for speculative activities, which Harsh said. Typically that utilization though is not monitored, but it is kind of prohibited that you don't use it for further speculative activities. Should be used only for emergencies and exigencies in life. Let's say you need temporary bridge funding for 3 months, 6 months, for which you would not want to redeem your portfolio. And for those, the cases could be numerous. Let's say you don't want to incur an exit load, or let's say you don't want to pay capital gain taxes, or the markets are not very conducive for you to redeem right now. You just want a bridge funding for 3, 6 months or even a year. Then I think this comes in extremely handy that you pull out whatever amount is needed and replenish it back as and when you have the liquidity available for you. It works like a debit card. You also have a debit card. You can go withdraw any amount you want and you can put it back whatever amount you have handy. So I think it's a great facility for everyone to place on their strategic long-term portfolios only. Just mind it that you can't redeem once you have lien marked the funds, so you can't redeem them before opening the lien.
That's surely interesting there. But Harsh, how do mutual funds actually decide on the interest rates for this as well? Is it actually pegged against the repo rate, or what is it that we're watching out for there?
Very, interestingly, this is a secured loan, right? So the interest rate, as Mohit mentioned in the opening line, was that being a secured loan, the interest rates are lower than an unsecured personal loan kind of a product. So in this case, the interest rate currently are about 10.5%. That is on an overdraft facility. So it's not a term loan kind of a thing where you've taken the day you apply for the loan and you get the money or you get the line, you will start paying interest. So effective interest rate, if you see, supposedly you had this limit of 50 lakhs, you've used on and off. So effectually, you will see over a period of the entire year, 10.5% is annually. But if you've used it only for 3 to 4 months, you're paying interest only for that much time. So while I don't think it is linked to any repo rate or saying that it's an MCLR kind of a loan where it is linked to the repo rate and then it gets adjusted automatically, it's more to do with the cost of lending that possibly the lenders would want to evaluate. 10.5% is the rate as of today. And of course, if the interest rates go up and, the lenders would definitely increase. It has been revised upward once at least. So I guess you will not be able to link it to an external benchmark rate where you'll get an estimate of saying whether my interest rates are going to go down if RBI was to cut rates.
Got it. So this is how it works, and I'm assuming all the players have different rates, or is it largely similar across the board?
Is that question to me, Sonal?
Yes, Harsh.
Okay, so by and large, competition is very high in this segment because it's a loan against securities. You have a security against which you're giving loans. Interest rates are more or less in the same lines. You will not have somebody suddenly charging you 11% where the loans are so easily and freely available at 10.5%. The process of getting this loan is also very simple. You don't really have to run around to branches of any lenders. It's just an online process, and probably 15 to 20 minutes, you would have the money credited in your bank account if you wish. So, the execution is seamless. The product is very transparent. It's a secured product. It's very unlikely that the difference in the interest rate offered by a lender A and lender B would be in excess of 50 basis points. So, of course, as an investor, you would need to be cautious. You need to hunt if you can get anything cheaper. But 10.5% is on an average the rate as of now.
Okay, 10.5% is the average rate as of now. Mohit, you did mention that, obviously you shouldn't be using these funds when you take this loan against mutual fund. Don't be using it against speculative activities. But what are the other key risks against borrowing against these mutual funds? Are there anything that we should be keeping an eye out on as investors?
When you look like any other loan, this is finally a borrowing which has to be paid back, right? And you have pledged your assets. In this case, the assets are mutual fund units which you have pledged against the borrowing which you have taken. If at any point in time you are not able to repay back, or if you're not able to service the interest portion, then the lender reserves the right to sell your units and recover back the amount. That's point number one. Point number two, let's say if there is a 50 lakh line which you have taken and your borrowing is completely full, you have withdrawn 50 lakhs out of it, and suddenly the portfolio value of your mutual funds corrects. There is a big market correction, the portfolio value corrects, then this could trigger a margin call. So you would have to immediately replenish back the margin amount by which your portfolio has fallen, so that the line remains to a 50% LTV value. And if you don't have liquidity then, or if you don't have surplus funds to pledge then this could also trigger again a selling by the lender. So there are multiple risks. I think one very big caveat out here is never overdraw this line. Let's say if you have a 50 lakh line, just keep aside those 5 lakhs aside for the margin utilization, let's say because of any fluctuation or volatility in the market. Never try and utilize 100% of the line unless you have more units to be pledged or unless you sit on huge pots of liquidity. So that could be a very big potential risk out there.
Okay, take that point. Gentlemen, very interesting conversation, but I think we've covered a fair bit of it. We have to get into a quick break. On the other side, we'll talk about GST on the entire mutual fund trail and how does it impact investors per se. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Mohit Gang of Moneyfront and Harshvardhan Roonghta of Roonghta Securities. Now we are going to be focusing on GST and mutual funds. There are so many activities that take place in a mutual fund transaction, right? How does it impact an investor, and what are the different charges on an AMC per se? Let's just understand that. So Harshvardhan, let me take that question to you. What is the GST rate on the entire process, investing in mutual funds, redeeming investments, expense ratio, etc.?
So, well, Sonal, as far as an investor is concerned, as far as an investor is concerned, the investor pays a TER, the total expense ratio, and that total expense ratio includes all the costs that internally a mutual fund incurs towards operations of mutual funds. So, say for example, there is a scheme which has a TER, a declared TER of 1.5%. That 1.5% includes all the costs that the mutual fund would be incurring internally for, say, when they buy and sell shares, there's a brokerage they're supposed to pay. There are operational costs, there are regulatory fees, there are registrar fees, the custodian fees. All that fees that is put is clubbed together into 1.5%, which is a declared TER for a particular scheme. Now, this 1.5% also includes the GST. So as an investor, the only number that you are concerned about is what is the scheme TER that you're paying, the total expense ratio. So, well, and the rate, as you mentioned, in most of the services would be 18%. However, coming back to the point, as an investor, to avoid complications, the TER, the total expense ratio, is the number that they should be looking at.
Okay, TER is the number that they should be looking at, and most of them are charged at 18% itself. Mohit, what I also want to know is about advisory services, right? So how are these also charged under GST? Are these services more expensive? Is that some different rate there?
Happened post GST is that all services or all operations and everything pertaining to mutual fund activities or operations have come under a single rate of 18%. So whether it is something which is a distributor commission, whether it is a management fee, whether it is a broking charge or any other activity charge, it's all charged at 18%. And as Harsh said, it is inclusive in the TER of the fund. When it comes to the distributor commission or the advisory fee, which an advisor or a fee-only advisor or an RIA is charging, even there the GST rate is 18%. So if an RIA or a fee-only advisor is charging, let's say 1% or a 0.5% fee, then he or she will, over and above that, be required to charge an 18% GST also. Similarly, if a distributor is receiving commission from a fund house for his activities, that commission will include 18% GST. So that will have to be paid. Most likely, the fund house will deduct it from the commission itself and pay it on the behalf of distributor if he's registered with GST. For distributors who don't have a turnover over 20 lakhs, then this GST rate doesn't apply there, as in the fund house doesn't deduct it.
Got it. So majorly for any investor, it's going to be the total expense ratio, and GST is applicable on that, and it's covered under that TER already. So that's important for an investor per se. Mohit, coming back to you itself, are there still some tax loopholes in the mutual fund space which need to be addressed, be it the category or different schemes, not only from GST, but even direct tax perspective as well?
Look, so from a GST perspective, I think it's pretty uniform and fair now. I think it's all fair and square. From a DTAA perspective, which is the double tax avoidance agreement which India has with multiple countries, and from an NR tax perspective, I think there are pretty much there are a few loopholes which could be looked into, right? So and one of the bigger things which have come into notice is that, let's say if you are let's just take an example, let's say if you are residing in Singapore or in UAE or in Middle East, right? So India has a DTA agreement with them. And if you sell units of mutual funds in India, then obviously you're not getting taxed out here. You are supposed to, because of the DTAA, you are supposed to be taxed in the country of your residence. But these countries are all tax exempt. So technically you end up paying no tax. Now, what we have noticed in our observation is that there are multiple such cases where ultra HNIs who have large books of mutual funds, when they want to sell huge chunks, they typically change their domicile. They would stay in these countries or show domicile in these countries for over 183 days to claim domicile there, and then sell the mutual fund portfolio to avoid any taxation. Now, that's a big loophole, and I'm pretty sure it will get addressed in some manner or other, so that taxation is at par with the resident Indians on these cases.
Okay, so that was the new case. Harshvardhan, I know we had spoken about it earlier as well, but there have been, is there anything on your mind, do you think, apart from what Mohit says, should be addressed, or it's largely okay and there's nothing really that comes to your mind at present?
So, well, Sonal, Finance Minister has been very proactive in addressing the issues of the mutual fund industry. So recently, I mean, before the change that came in with the tax slabs, long-term and short-term being categorized as 12 months and 24 months, like all investments being bucketed under these two tenures, there was some kind of a difference between taxation on gold mutual funds with what a physical gold would be taxed at. So, that came in because of the taxation rules that changed for the debt mutual funds. And anything non-equity fell into that bracket. The point I'm trying to make is the finance ministry and the mutual fund industry and the regulators have been very proactive in addressing all those cases where there is any, differences or anything that needs to be addressed.
Right.
Now, with regards to the DTAA, I concur with Mohit on that part. But I guess there are certain areas which are more to do with international taxation than to do with direct tax.
That's right. That's right. Makes sense, Harshvardhan. Thank you so much, gentlemen, for joining us today. We spoke about a whole host of things and it really did make sense and help our viewers as well understand these new concepts. So thank you so much for tuning in with your expertise. With that, we'll take your leave on this edition of MF Con today, but stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index is the one that's managing to hold on to strong gains of 0.8%.
The stock in yesterday's trading session actually was quite strong, and it's continuing to defend this 20 DMA.
Because both the sides are looking to sign that the first tranche by September or October of this year.
We have a 42-point gain, 50, now 60-point gain on the index.
I think we look at the entire universe, internal and external, and choose the right candidate for the bank.
Listed at 13% premium yesterday, and even today the stock is up more than 5%.
Today there's some green, and I chose the right color today. So Nifty is up around 96 points.
Bansal said that the fintech revolution has eliminated the need for middlemen across sectors.
Now the Nifty up 50 points. It has come off from the highs.
Well, that was the day so far. Things are quiet on the index front as we wrap out today's trading session. Pretty directionless. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Surbhi. Hi, Surbhi.
Hi, Reema. And one would have to say that it's turned out to be a little disappointing given the promising start that we had in the morning. The Nifty at one point was galloping a good 70, 80 points. But then it's kind of fizzled out again. The market's directionless, at least at the index level. And it's not just the Nifty you can blame. Even if you look at the Bank Nifty or the mid-cap index, it's just very, very quiet. And the action remains restricted to individual stock names.
Indeed. So today you've got the Nifty weekly options expiry. So let's see if the last 1 hour we have some action. And then post-market hours, the US, you'll get the non-farm payroll data. It typically comes out on Friday, but considering US markets are shut tomorrow on account of the Independence Day holiday, that data point is getting advanced. But as Surbhi was saying, it's all about individual mid-caps. While the small-cap index, by the way, is up more than 0.5%. Look at DCM Shriram, 11% up. I think Motilal Oswal has hit a fresh 5 or 6 month high. Aster DM is gaining. A couple of these oil and gas names are higher. MRPL Oil India, case in point, rising nearly 3-4% on good volumes. And HDB Financial, we'll talk more about it, but that's clearly had a fantastic day too after a good day one. And sectorally in the large cap, if you had to pick one sector, I think it's auto. The Nifty Auto Index itself is up 1%, and its individual constituents, Hero MotoCorp, Maruti up more than 1%, and M&M and Tata Motors too higher.
Yeah, absolutely. So, this is what it is. It's all about individual stock names, and that's what's driving the action. On the large cap screen, I mean, for now, it's there's a hint of maybe defensive buying that's quite evident. So look at some of the pharma and healthcare stocks. So Dr. Reddy's, Apollo, these are seeing some buying. Supply is also up about 0.8%. So pharma, healthcare holding out quite okay. And auto stocks, interesting. It's cumulative action, small increases, not a big move on any of them. But nonetheless, whether it's Hero MotoCorp or Mahindra and Mahindra, even Maruti Suzuki, we saw Maruti have a good session even yesterday. For that matter, even a Bajaj Auto. So some gains are coming in over there. And we must add that some of the big stocks, the heavy hitting boys, like Reliance and like Hindustan Lever, for what it's worth, they're all on the upside of the screen, including actually HDFC Bank. So if you look at the Nifty contribution chart, then a lot of these bigger boys, they're still on the green side of things. So it's not too bad. Though, as we speak, the Sensex is just flashing a tinge of red. The Bank Nifty is flashing a tinge of red. So for sure, Reema, it promises to be a pretty exciting 60 minutes. I think it won't be as dull as what the day has been.
Okay, let's find out how you should position yourself then in the last 1 hour of trade. Mitesh is now with us with a few closing strategies. Mitesh, do you think things could turn around first in the last 1 hour, and what would the positioning be?
I think, pretty disappointing that we kind of bounced back from 25,400 and then, we didn't see any kind of follow through. So I think we are back to those 25,400. If in case we start breaking below that, there could be a chance that you might go to 25,200, but that should be it. And the market will again, go into some kind of consolidation. So nothing negative. Yeah, but I think, the fact that it's kind of come up from the day's high means that you need not be very aggressive on the long side.
Mitesh, what about individual stock names? What are you going with last hour?
So Bosch is something which has given a very strong pricing volume breakout by here with a stop at about 34, just below 34,000 for targets of 35,200. And the other one is Chambal Fertilizers. It's been consolidating on its 200 average value. The stock can now be bought with a stop at 552 for a target of around 580.
Okay, so looking at Bosch, Bosch indeed has moved up smartly, 5% or so higher. That's on the mid-cap side. On the large-cap screen, Mitesh, any takeaways? I mean, some of these auto stocks, like I was highlighting, even yesterday, they were up a little bit. But I don't know if there's any clear trade that you're seeing. Maybe an HDFC Bank, Reliance, Auto, any large cap?
Reliance has already rallied a bit, and HDFC Bank has kind of started to get into contracting kind of mode after making a fresh high beyond 2000. Within the large cap space, my sense is that for the time being, just avoid it out. You'll find trading ideas somewhere in pharma space, couple of IT names, and a few other stocks. So and cement is something which is very clearly outperforming. So the broader large cap, I would just stay away from it.
Got that. Let's talk about the big drama which is unfolding now at the airport. One day after Dream folks accused two airport operators of pressuring banks to block or stop transaction payments made to the company, Adani Airport CEO has made a clarification about eliminating middlemen in the airport lounge business. Madiha now joins in with the entire story. Madiha.
So Adani Airport CEO Arun Bansal has spoken about the airport's lounge business in a LinkedIn post. He said that passengers across India can now access lounges directly through Adani Airport's platform in partnership with other lounge operators. He said this has been made possible by the innovation coming out of the group's in-house digital lab. Bansal said that the fintech revolution has eliminated the need for middlemen across sectors. In this case, he is referring to lounge access providers like Dream folks. He went on to say that in today's tech-led world, only companies willing to disrupt themselves will survive. The rest will disappear, is what he said. Remember, this comes a day after Dream folks told CNBC-TV18 that it is being pressured by two large airport operators to exit the lounge business. They claim that there's a coordinated campaign to damage their reputation and push them out of the market. Now, for context, Dream folks is a lounge access aggregator. It offers lounge access not just at airports, but also at railway stations, highways, and even visa centers. Now, just to add some context for our viewers, here's how the lounge ecosystem operates. The airport operator awards the lounge contract or runs it directly. The lounge operator manages day-to-day services. This could also be the airport operator itself. The access provider, like Dream folks, connects passengers to lounges via partnerships. Then payment gateways like Visa, MasterCard and RuPay enable the transactions. And finally, banks and credit card issuers tie up with access providers like Dream folks to offer free entry to customers. So when Arun Bansal talks about eliminating middlemen, this means doing away with lounge access providers. So in an airport where Adani is the airport operator, lounge operator, it will also be the lounge access provider. This is what we've understood from Arun Bansal's LinkedIn post.
Okay, all right, Madiha, got that. Thank you for the context. Indeed, this is snowballing into an ongoing dispute of sorts from the looks of it. And today, for the second day running, we have the Dream folk stock under pressure. Last I checked, it was still down about 5%. Let's pull up Dream folks. And obviously, it's been a huge wealth destructor as well this year. Pull up a one-year chart or even a year-to-date chart of Dream folks. It's been a huge underperformer. Down, I think, 40-odd% in 2025 and down even more if you're looking at the last 12 months. 45% this year. That is Dream folk. Let's quickly get in a comment from Deven Choksi, who's joining in. Deven, you were, of course, hearing the story play out. You've heard the explanation from the Adani side as well. What's your sense? I mean, if someone has been holding the stock and if they were patient, thinking, okay, I've bought a good business, I like the company, let me, stay patient. If someone's not sold, I mean, what is it already too late? And on the flip side, would you at all look at venturing in now?
So good afternoon, Survi. I think while not completely sure about, what is the total dent in the revenue that this particular company would have in a course of time. But one thing which appears very clear to me is the disintermediation process. This disintermediation process is a profound one because as the use of, the fintech and the last mile connectivity by the aggregators like, I think, or the airport operators like Adani Airports, I think would really mean that I think companies like Dreamfox will have to reinvent their business model. Having said that, I think some of the smaller airports where I think the larger players' availability is not around, they can still continue to offer their services. But over a period of time, I think these particular services would remain under threat, also on the margin front. Apart from, I think, the technology dent, I think that you are going to see in this kind of situation. So not completely sure whether the investors should be holding into this particular company or not, because immediate attention may not come onto the revenue loss beyond a point. But I think a long-term threat cannot be denied if the disintermediation process is a reality.
Okay, that's quite a lot of wealth destruction taking place in Dreamfox. By the way, markets, the Nifty is now on the verge of breaching the 25,400. So things are unraveling, down 50 points in the Nifty. Reliance Industries has turned. So Reliance Industries is down close to about 1/3 of a percentage point. But from the day's high, we've seen it slip. That's the 12-month chart. If you could pull up an intraday chart, there you have Reliance Industries. What a sharp fall.
Very sharp fall. Very
sharp fall seen in Reliance Industries. So that's contributing on the way down. Exerting pressure is also L&T. Some of the PSU banks like State Bank of India, ITC, and Bajaj Finance. That's down about 4% now from the start of the week. So while HDB Financial is gaining, Bajaj Finance is seeing some of its value getting eroded, and there, 25,400 gone.
Yeah, this is a rapid fall that's come in, and the day just got a whole lot more disappointing for the bulls, because it's not like there's a major global sudden risk-off or anything. Most of the markets are holding up. Europe is seeing plenty of sort of green on the screen. This is India-specific. Maybe it's expiry-specific. And along with Reliance, look at the fall in stocks like Bajaj Finance, L&T, all sharp drops coming in. So we'll have to watch out for, once again, the FII number. Remember, in the morning, Nigel was also telling us that the FII positioning on the short side has been increasing. And from the looks of it, I don't think those shorts are running for cover anytime soon. Suddenly, it's a 60-point drop on the index, and a very, very rapid one at that. We'll try and get Mitesh back as well in a bit to do a quick technical check. But yeah, it's across the board. SBI, L&T, Mahindra & Mahindra, pretty much across the board. Devin, I mean, on the market as a whole, we've had a great last 2 months. Markets, run up very well. But I guess the old argument always comes back that at these levels, these valuations, do you have enough triggers to go higher? I mean, what have you been telling clients? Stay away from large caps, look at mid caps, vice versa. What's the broader call for the next couple of months?
Well, I think the mid caps are purely fueled by the momentum, and I think the momentum is driven out of too much of money chasing smaller equities or smaller holdings, and that's where probably I think the valuations are becoming more crazy. In the large caps, I think the potential remains still very, very high, because I think on one side we are talking about revival in the growth in the current financial year. On the other side, we are talking about, I think, the margin improvements for most of the businesses in the current financial year, largely because of the fact that I think compared to previous year, we are seeing the better impact of input cost in most of the businesses, including commodity businesses. Given that kind of a situation, our take is that I think some of the larger companies, the bigger companies, could possibly roll faster and possibly show better growth. For example, if today Bajaj Finance is 4 lakh crore plus kind of a AUM, HDB Financial is about 1,20,000 crore kind of an AUM, so 1/4 the size. Now, given the kind of growth rate that these kind of businesses are assuming of around 25% in the AUM, I think some of these companies or the businesses could possibly move faster. And that's where I think you will see the inclusion of the stocks into the portfolio of some of the investors, because the relative growth is going to be faster in some of these businesses. Similar situation we are seeing in the consumption story, largely in the discretionary and non-discretionary both. I think because of the disposable surplus availability in the hands of the consumer, also because of the lower cost of the fund, we are likely to see the consumption-related activity taking off in due course of time in this financial year. So we relatively remain bullish about the prospects, and at the same time, I think the larger companies could deliver bigger profits. That's a theory on which we are operating.
All right, let's get a handle then on the consumer names and the kind of updates that we're getting. on Q1, the quarter gone by. Avenue Supermarts and V2 Retail. Mangalam is here with the numbers.
Well, for Avenue Supermarts, it's a 16.2% revenue growth that the company has reported. It's slightly softer than what the company has been reporting on a historic basis in the first quarter of the last couple of years. The 2-3 year CAGR has been 17.2, 17.3% itself. And that's what analysts were pegging their estimates to be as well. So to that extent, mildly below street expectations. But if you look at the store additions over the last 1 year, that's been around 14.3%. This implies that there has been positive same-store sales growth. Morgan Stanley pegs that number to be around 3 to 4%, could be around 1 to 4% as well. So that's something we'll have to watch out for. The reason why the stocks recovered from the lows, is because 16.2% in this environment, not particularly bad. Product mix improvement is something that everyone is eyeing, along with their store opening plan, on which DMart has been fairly sanguine, saying that they look to increase the store addition or the pace of store expansion. And finally, in the consolidated numbers, we will also have DMart ready, so on which the scale-up of that will be something that the street will be eyeing. On V2 Retail, the revenue growth of 51% has been fairly impressive. But here as well, the stock came off highs because it's not led by same-store sales growth. Same-store sales growth actually is just around 5%. And the reason for V2's same-store sales growth being lower is similar to that of VMart, where Eid shifted into Q4 this time as against Q1 last time. And as a result of which, if you take that into account, then the same-store sales growth normalized has been 10%. So all these factors are in focus when the retail companies are, as far as the retail companies are concerned. We also have Bazar-style retail, which after the 37% revenue growth, reported 3% decline in same-store sales growth for the very same reason. And that stock too, fairly off the highs today.
Okay, all right, got it. Mangalam, thanks very much for running us through the numbers. Market keeping a hawk eye on these updates and, of course, eventually on the Q1 commentary as well. Devin, just come in a little more in terms of more detail. You said that, of course, you're keeping a favorable stance on consumer. But then I guess the expectations are also elevated. The market is hungry for growth. And look at, for instance, DMart today. Though they've delivered about 16%, like Mangalam was saying, the market still is not, in the mood for it. So within consumer, what are you most optimistic on?
Well, I think the important aspect would be the auto ancillary, in particularly within the auto segment. We would remain distinctly bullish about the prospects of commercial vehicles and the tractors. Given the kind of strength of rural economy today, and also due to the better start of the monsoon, we believe that I think this year is likely to be a good year for these two categories of auto. And that's where probably auto and auto ancillary businesses, I think within this bracket, discretionary consumption, could possibly see relatively higher amount of growth in the current year. Fortunately, the auto stocks are also having the prospects of better profit margin in the current year because of the lower input cost, lower raw material cost. And at the same time, for the buyer, because of the cheaper availability of finance, I think is also making sense today. So I think it's in a sweet spot as I see it, but I think one will have to be relatively more selective about the respective companies that one adds into the portfolio. Where the valuation upside is still available, I think those companies will be slightly better off compared to the overall basket.
The biases today at least shifted towards, say, a Hero MotoCorp or Maruti Suzuki in terms of gains, which could benefit if there is more money in the hands of consumer or the rural economy revives. Though in terms of pure numbers for the month of June, it was premiumization, Eicher Motors and M&M's Auto which stole the spotlight in the show. But let's get chatting about the Nykaa block deal. Mangalam is now joining in with the details. Mangalam.
Well, 2.1% equity was changed or exchanged hands in Nykaa in today's trading session. And since last evening, Vivek, our colleague, has been telling us that the likely seller are HP Singh Banga and family. They've sold about 2.1% equity. But that's one part of the story. The other part is I was just trying to look at the shareholding pattern of Nykaa. And ever so often, we do keep getting blocks in Nykaa itself. So HP Singh Banga, holds about 4.9% stake in the company as of March 2025. This obviously comes down by 2.1% if he is indeed the seller in today's trading session. He's been selling in the last couple of years or so. The other individual investors that I've been looking at, Sunil Kant Munjal is one. His stake come down from 2.5% in March 2024 to 1.4% over the last 12 months or so. In fact, the public shareholding of Nykaa, the number of shareholders itself, has come down from 5.85 lakh in June 2023 all the way down to 5.2 lakh the next quarter, thereafter 4.7 lakh in June 2024. And if you look at March 2025, the number is down to 4.72 lakh itself. So a large number of shareholders, individual shareholders, have come down, and that's reflective in the public shareholding of the company itself, which is halved from 26% in June 2023 to 13.8% in March 2025. Who's buying? Is it the FIIs? Turns out not, because even the FII shareholding of Nykaa has come down from 10.5% to close to 8.8% in the last 4 quarters or so. The increase in shareholding has come in from domestic institutional investors, which have increased their stake from 18% in June 2024 all the way up to 25% in March 2025. Who are these domestic institutional investors who've increased their stake in Nykaa? We have ICICI Pru, where the holding has gone up from 1.5% to 4.5% over the last 4 quarters. Nippon AMC 2 has increased its stake from 3% to 6%. HDFC Life, another life insurance company, which has increased its stake from 1% to about 1.3%. And we have Kotak MF as well, which has increased its stake. Remember, the stock in this year is up 24%, but prior to this year, between 2022 and 2024, was actually down 42%. And even if you adjust for the bonus and look at the issue price, the stock since IPO has returned just 8%. So are things turning around for Nykaa after domestic institutional investors are increasing their stake? The company has spoken about strong runway for the beauty market, also break even for fashion business this year, 30% CAGR for their own brands, and steady state margins of 10% for their fashion business. Let's see who wins the battle of shareholders in Nykaa from here on.
You know, I read in one of the articles, Mangalam, that, the gentleman who's selling today, the Banga family, they were early investors and they had bought into Nykaa when the market value or the market cap was $25 million. And now it would be, what, $6-7 billion.
Oh.
So, early investors, and he's reaped the benefit of that and now partially exiting. Thank you very much for putting the spotlight on how the shareholding of Nykaa has evolved over the last couple of years. Retailers are exiting and domestic mutual funds have been increasing their holding. Deven, you want to quickly comment on Nykaa? Things have improved from a shareholder point of view in terms of price gains this year.
Yeah, I think they're promising to do the bottom line profit performance in the current financial year. So hopefully, I think if the last quarter result around, I think that promise will get materialized at some point of time. In my viewpoint, I think everything seems to be in price. Maybe the market may remain a little bit more excited about quarter-over-quarter improved performance in this company's case. But more importantly, everything appears to be in price. Unless we see some scale-up, which is a significant scale-up, I think this kind of business would remain relatively expensive proposition for investors.
Okay. That is Nykaa. I think we just have time for one last question with Deven. Deven, I was actually looking at a report that we get from Knight Frank. I mean, they do this half-yearly real estate market update. And the one page on that presentation that really caught my eye was the pager on residential trends and how residential trends overall, the last couple of months at least, across markets, there is a gradual plateau. They're not falling. There's some plateauing happening. What would you say would be the takeaways for listed players? I mean, it could actually be irrelevant because one could argue that listed players are actually seeing the benefits of market share gains. More people are looking for branded houses and quality developers. So I don't know if there's any reason to be concerned from a listed real estate stock point of view. Your thoughts?
So, Surbi, I think between the two categories, the mass market community living and the luxurious housing, I think the mass market community living is having relatively surplus stocks in some pockets. I think one can't be saying that in every pocket it would be, but in some pockets, they may have, slightly surplus stocks, including in a city like Mumbai. We are seeing in some of the developers' case, some surplus stocks available, which they are trying to push hard to sell. Whereas on the other side, again, taking example of city like Mumbai, the luxurious housing business, is possibly moving at a reasonably good speed and at the same time, fetching better realization to the developer. In fact, from that study itself, one finds that in next 15-20 years from now, there would be a case of around 30,000 redevelopments in the city of Mumbai itself. Should that be the situation, and those redevelopments move in the direction of luxurious housing, quite possible that the companies focusing on luxurious housing would probably have relatively better time to talk about, because they're addressing the few people and at the same time, I think, getting the better realization out of those properties. So we remain selectively bullish about the prospects going forward. However, in the current listed market, most of the companies are completely pricing in the scenarios for FY27. So immediate upside of the headroom is seen limited, maybe some price correction, and that could be a better opportunity going forward.
Okay. All right, Devin, we'll leave it on that note for this afternoon. Thank you so much for joining in. Appreciate your time. Let's take a break. And as we do take this break, here's a quick reminder. Please do tune in to the all-new CNBC TV18 Prime. We bring you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Okay, welcome back. We've had a bit of a wobbly afternoon in the last half an hour or so. The market fell as much as 55 odd points on the Nifty. Then there's been some recovery, but it's still lower. Even the bank Nifty is down about 0.3%. So little, yeah, that's been how it is. Choppy today, especially in the second half. Well, how are we poised as we look at the second half of the year? Vikas Khemani of Carnelian Advisors is with us now. Vikas, thank you so much for being with us. So that's really the question, right? And I think the market is very fairly divided between the bull and the bear camp. The bears say valuations are high, earnings will be pedestrian, 10-11%. The bulls say at least we'll get 12% growth, a revival in earnings, and a consumption boost, an RBI boost. So the market's looking good. What do you think?
I think if you can make out from our past conversations, I'm definitely in the second camp where I think definitely earnings is on a very big revival. Post RBI action of aggressive interest rate cut and infusion of liquidity in the system, there's no doubt in my mind that corporate earnings would be better. Of course, there could be one quarter and there that nobody can time out. One important factor to watch out is, of course, the BTA with US, which is expected to happen on 9th July, and I think everything goes fine. Then I guess there are not much risk. So generally speaking, I'm quite optimistic, and I don't believe that India is very expensive. In fact, I feel that India will get further re-rated, in times to come. There's no market around the globe of the kind of size, growth, sustainable growth, quality of the growth. So everything is, I think, in place. In fact, most global investors are underweight on India. Indian investors are underweight on equities. So I think, in my opinion, those who are calling markets expensive will keep probably either missing out or keep sort of. There could be tactical correction here and there, but I'm sure those calling market expensive are not expecting it to come to 15-16 times price to earning ratio. So if it is a little bit of 5-10% correction here, that is par for the course. That happens all the time in the market. I'm not talking about that. But other than that, structurally, I don't think India is going to get derated further. In fact, I make a very big case for India getting re-rated further in next 3 to 5 years.
You said Indian investors are underweight India?
Yes, of course, because Indian household exposure to equities is still around 5%. If you look at, China is 15, US is, 30-35%. So it is a very small kind of, 10 years ago, Indians were only 1%. So it's only going to grow from here. Obviously, from 1 to 5 also looks a lot because we are not used to getting this kind of flows. And hence, that's the reason I think there's a lot of narrative which gets created that Indian SIP will stop, Indian flows will stop. But I don't think that's happening any time in a hurry. In fact, that's only going to get more. And once you have that perspective, I think in equities are only going to get bigger and better in everybody's portfolio.
Well, indeed, that's a structural tailwind and a long-term one at that. Because you're the master of finding, individual stock ideas. Tell us a little bit more, in terms of interesting ideas or trends that you've spotted, which could be big plays.
When kind of find trends are kind of pretty similar. You don't really find trends every now and then. We've spoken about CDMO, CRO being a big space, manufacturing in general being a very big space over the next 10 years, rising per capita income leading to the premium consumption is again a very, very big space which one can look at. And again, I'm not talking about all ideas in general, but you will have to identify specific ideas in those sectors. BFSI itself is a very big opportunity. According to me, if you ask me, the sheer quantum of the wealth, the absolute amount of wealth which will be created it will be in the banking BFSI sector, and more services sectors are coming into the space. So I see a situation where across the board, India will sort of do very well, specifically in BFSI, consumption, manufacturing. These kind of some place would be probably a little bit more niche.
Absolutely. Take your point. We have discussed, of course, agrochemical stocks also. It's something that you like. You're expecting, turnaround to play out. You won't name stocks, Vikas, but give us, a little more of a sense, a slightly deeper sense. For instance, you said premium consumption, but a lot of these stocks have also run up, whether it's hotel stocks, whether it is something like, real estate. Which way would you play premium consumption now? Through which micro segment?
You have to, and you're right in that sense. The interesting thing is that wherever, in consumption space, what's happening is consumption patterns are changing. What consumer consuming earlier may not be consuming. So new age and consumer are consuming different, and they are kind of basically they're consuming more, new and better, and that's how it happens. But those shifts are there. And one thing is very clear that premiumization is happening in every category. So those benefits, so wherever companies are aligned in this, you have to look at this. Now, hotels, of course, is a very big segment. The entire hotel capacity of India is less than Dubai. So it's a huge scope. But the point is that, it has its own, sort of valuation. I mean, its own, like you have to put a capex, which takes time. And by the time, so a lot of companies are going into a capex phase. And to that extent, I think, and valuations are like very demanding. So you've got to be careful. Very often, just because something is looking promising does not mean that it will, make money, or you have a money making opportunity based on the risk reward. Because as an investor, we have to see risk reward of investing is there or not. Very often fads do come about, and you get carried away by those fads and say that, so don't invest just based on like macro looks good, but you have to find micro risk reward also in the favor to make money.
In the past, you've spoken about infrastructure plays, I think, in railway and airports. So airports, of course, there are limited ways to play it. You only have, say, an Interglobe Aviation. But on railways, can you provide some more color on how you're playing it?
I think so. We don't have. I think in railway there's a lot of, in my opinion, fad and valuations are kind of on the other side. And so more than that, I think I'll probably comment on your infrastructure comment or question. That I think there's an interesting play where we can find deep value, and a very interesting value is in the EPC players, the pure play EPC players, where margin profile is very good and the working capital cycle has got compressed, because today execution has become very, very important, whether it is public contract or private contract. If I am doing a construction of a building, or construction of road, or construction of metro, the timeliness of thing has become very important. Hence, the working capital cycle has become important. Order book of all the companies are very large. Now, a repaired or better business model and available at 10, 12, 15 time price to earning versus all other players which we talked about, which are like, so structurally investment cycle is on uptick. The executor or doers of those those investment cycle are right now available at a reasonably good valuation. That's a one sub segment. I do believe that the risk reward is hugely in favor.
Okay, that's interesting. Yeah, EPC players, and we haven't seen the market to talk about them, and they've almost become forgotten. Pure EPC contractors. Got that point?
And here, one thing which, in my opinion, markets have missed is the repair on the working capital cycle. Historically, I think this sector has been struggling with the working capital because payments get delayed. But today, be it a private or public sector, everybody wants to get execution done faster. And because of that, the payments don't get delayed, generally speaking. I'm not talking about for everybody, but generally speaking. Hence, the working capital cycle is better. Hence, your cash flow generation also has become better.
Okay, all right. That's a very interesting perspective. Because before we let you go in manufacturing, and we always discuss this with you, it's a very wide, array. Everything can be clubbed under manufacturing. So you need to know what to pick and where to go. So give us some more nuggets. I mean, perhaps it's CDMO, that's what you're looking at. But within manufacturing, for instance, would you look at power, something else, auto ancillaries?
I tell you, I think broadly, you rightly said, it's broadly spread between auto components, chemicals, textiles, garments, power, capital goods, defense, electronics, multiple, right? But I think right now we find a lot of risk reward, especially in the chemicals, where most people are negative around it. Structurally, chemical is a very good play, and most people have kind of don't own it, and some companies have struggled. But we think the inventory cycles have cleared, bad cycle is behind, and risk reward is falling into place. That looks reasonably good, but differentiate between commodity and specialty chemical. That's where most of the fault, the mistakes gets made. And secondly, I think we think that even some of the auto component companies are also, again, I'm making a general statement, but you've got to look at company specific. They are also interesting. Risk reward is falling into place for many companies. These are two sub-segments. We have recently found some values and some ideas.
Okay, all right. Good clues there, I think, for our viewers to then go ahead and do their own homework. Thank you very much for joining in. Nice conversation as always. You have a good rest of the day. That's a view from Carnelian Asset Management, Vikas Kamani, with his thoughts on the market. Let's take a quick break on that note. We'll come back on the other side, and we'll, of course, have final trading ideas coming up with Mitesh Thakkar, and then we'll focus on some more stocks. Welcome back. Let's go back to Mitesh for some final advice and trading calls. Market got really wobbly. Let's pull up the Nifty again. Last half hour, we've seen some volatility come back in, but it's still within perhaps a trading range. Mitesh, yeah, there we go. Actually, no, I mean, yeah, we're back again down 50 points. We had tried to recover back up to the flat line, but again down 50. Mitesh, what do you make of the weakness?
I'm actually not, very happy about the way the markets have fallen because 12.4 was a good support. We got a bounce back, but then the follow through went missing, which means that there's a good chance that we might actually test 25,200, and that should be an important support area coming in. So if the market has to consolidate, possibly 25,200, 25,650, 700 probably could be the range. And on the stock side, I have one buy and one sell. BTST on 361 wealth management. I think that's BTST with a stop at 12.08 for targets of 12.45. While DLF and real estate stocks have slightly turned weak. So DLF is STBT. Keep a stop at about 8.36 for targets of 8.15.
Okay. Got that, Mitesh. Thanks very much for the calls. You have a good rest of the evening. We will see you again tomorrow. Let's move on now and talk about some of the updates that we're getting from the financial services space. Now, we all know about the new listing, HDB Financial Services. It was a good listing. I mean, yesterday itself, the stock was up 13%. It's actually put on some more gains today as well. Gaurav is bringing us some more analysis on the stock, how it fares compared to the peers and how the valuations look right now. Gaurav, take it away.
Well, yes, when we talk about HDB Financial, we have already seen good set of numbers from the company in terms of returns for investors, because the listing gain itself was at 13%. And let's not forget that even if we consider the listing gain, even if we consider today's gains as well, the valuations are still not as high as how we were expecting it to be, because the valuation is still trading at 3.5 times price to book value. So let's understand the business first. What are the good points and bad points? When we talk about good points, HDB Financial is one of the companies who reported good set of numbers in terms of gross NPAs if we compare it with the peers for the last few years. In fact, in FY25, gross NPAs were actually lower than its peers. Other than that, when we talk about some other points, we also have portfolio mix, which is actually very diversified, and that is the reason which gives an upper edge to HDB Financial over the other peers, because when we look at secured portfolio, it is around 73% of its current portfolio. When we look at PAT growth, there also we have seen a good set of number, 29% CAGR is what we have seen for the last 4 years. But on the other hand, there are some pitfalls where market is a little cautious. First is the AUM growth. For the last 4 years, AUM growth has been at a CAGR of around 20%, which is a little lower if we compare it with its peers. ROA is also at 2.2%, which is again a little lower, and the reason being that credit cost was actually high in FY25. Now, from what we have picked from the management commentary, credit cost is likely to stay a little high in the tune of 2%, and that is the reason there are some concerns around growth in ROA. But even if we consider all these factors, the valuations still seem fine, because at 3.5, it is still trading below what the street and the other players, if we compare it with its peers, is trading. Because when we look at Chola Finance, it is trading currently at around 4.5 to 5%, 5 times price to book. Bajaj Finance is also trading at somewhere around 5 times price to book. In fact, we also did a little bit of valuation check. If we take the stock even higher at the range of around 1,000 rupees, then also there will be a valuation comfort, because the stock will still trade at 4 times price to book. So definitely at the current price, it seems that the stock is finding some kind of comfort in valuation as well as growth. But it will be definitely a key thing to watch out for, an interesting play as how HDB Financial investors gain from here on.
Okay, all right. So right now, valuation comfort, which is not what you can say about a large part of the market. Gaurav, thank you very much for the latest there on HDB Financial Services. Is holding up well with a 22 rupee gain. Now, staying with the updates from the BFSI space, this is a CNBC-TV18 exclusive. Karnataka Bank saw leadership shake-up after the MD and CEO, Sri Krishna Harihara Sarma, resigned, citing personal reasons. Earlier, we caught up with Mr. P. Pradeep Kumar, the chairman of the bank, and spoke about the interim leadership arrangement and the impact of these changes on the business.
We have recommended an interim MD to the Reserve Bank of India. We are awaiting Reserve Bank of India's approval for the new interim MD. And we trust that the Reserve Bank's approval for the interim MD will be in place before the 15th July, when Mr. Sri Krishnan will be resigning. I can't say anything at that time who is the new interim MD. I mean, these are all, unless the regulator approves and I tell the stock exchange, I can't tell anybody else. So the bank's liquidity position is very comfortable. And if you had observed, our capital adequacy ratio is at 19.85, I think, which is one of the highest in the industry. So we have enough capital for growth for the next 3-4 years, and we have sufficient liquidity. I don't think neither liquidity or capital or growth is going to be affected.
Well, that's the word coming in from Karnataka Bank. Let's invite Ambrish Baliga on the last leg of this show. Ambrish, thank you very much for joining in. Things have been very, very quiet over the last couple of days. Perhaps just waiting for the India-US trade deal to get ironed out, negotiated. And we have it in full and final terms and what the contours will look like. And plus, the earnings season is awaited. What have you been doing with respect to your portfolio?
In fact, at this point of time, I've just been holding on with a clear view that in case we had seen markets going beyond 26,000 to possibly a new high, which was the view about 4 or 5 days back, at those levels, surely I would have booked some profits. But otherwise, I'm just holding on for the time being. I really don't see the markets going down too much from here. I think 25,000, 25,200, I think, is a very good support level. But at the same time, I'm also holding about 10% in cash, because in case we see a sudden dip for whatever reason, it could be because of the trade agreement issue or whatever it is. If we get an opportunity, I'll surely deploy that 10%.
Okay, all right. So speaking of deployment, Amrish, hi, afternoon. Let's talk about your stock pick for today. Which one is it?
The stock pick is Uno Minda, which is a global tier 1 manufacturer and supplier of automotive components and systems. I mean, they have a huge product portfolio, about 25 categories, but mainly into automotive switches, lighting, castings, seating and acoustic. And the new segment, they have EV-specific products, sensors, controllers, ADAS, blow molding products, and catering mainly to two-wheelers and passenger car segment, but now they are also focusing on CVs, three-wheelers and off-road vehicle segment, and mainly supplying to OEMs, but they also have a small replacement market, and 90% of the revenue comes from India. They have about 74 manufacturing facilities, about 37 R&D centers, and for the next 3 years, the revenue CAGR expected is about 15%. EBITDA CAGR is expected to be about 16%. I'm expecting an EPS for FY27 of about 23 rupees. With that, my target price becomes about 1265.
Okay. What about Bosch? That also could be a beneficiary of this anti-braking system if it's implemented for two-wheelers. Is that not correct? Have you done any analysis on it?
No, I have not looked at it in depth, so a bit difficult for me to really comment on this.
Fair enough. Lots of individual stocks are moving in the mid and small cap universe. DCM Shriram is now up nearly 15%. I think the stock has also hit a fresh high, moving above that, 14,000. DCM Shriram, 1400 mark now on DCM Shriram. You've got a Aster DM with a 9% up move. Motilal Oswal, Trans Rail Lighting. A Saxoft 12% up, Lloyd's. Any of these stocks, on your radar, have you looked at? Because these are big moves in one day.
Yeah, in fact, DCM Shriram is one of those which we've been tracking for a while, and I think the move has just about started. And in fact, here we believe we could see levels of about 1580, 1640 levels, possibly in the next 3 to 4 months.
Okay, that's DCM Shriram. Could move higher. Amrish, stay on. We just wanted to get our viewers to listen in to the views that we got from Vineet Sambre from DSP Mutual Fund and Hartmut SL from UBS Global Wealth Management. As we slip into a break, listen into these excerpts.
Long-term investors, I think the second view is more palatable. But let me say that I think at the moment, both the views are somewhere, I would say, balanced. And I think it is a time frame with which each of them are sort of looking at the situation at the moment. And clearly, as we have recovered from the market lows, which we had seen in the month of March to now, valuations have seen, it seems to be a bit punchy across the board, not just few sectors, but across the board. I would say that the macro factors are now more conducive for growth versus last year. This quarter, next quarter, we still have a slightly lower growth. So from that perspective, I would say that the growth outlook should start improving maybe towards the second half, and that's where one should start looking at some directions for the market. I think the portfolios really doesn't change as much really from the very short-term perspective, but broadly what we are trying to align our portfolio towards is these macro factors which are going to mean that the balance of trade could shift to consumers as a category towards the maybe end of this year. So maybe it would be a good way to create a basket of categories, a basket of companies within subcategories, maybe a white good as a category, apparels, innerwear, QSR, some of these, and take a broader call that if we broadly are with companies which are sort of leading companies within those spaces and likely to be beneficiary of the macro trends, I think we need to take them as a basket approach, and which is what we have also done as a part of our portfolios.
In our forecast, we have close to 7% probably earnings growth, which is fairly low. So if you're a company, an average company that says, okay, I compare myself with 7% with only, so to speak, 7% before, that's much easier to beat than if I compare myself with a 25% growth base, right? So that is easy, but there's also many sector-specific reasons. Certainly on the financial side, although that's probably a bit more fiscal year 27 focused, but then it's really when it takes off. So as an investor, only sort of 9 months away, but you want to start positioning for that. And then also, what comes to my mind is also a sector we like a lot is the consumer side. So all of these things lead us to double-digit earnings growth, we think, for 2 years in a row after we had sort of a mid-single digit. And then why wouldn't I invest in this market? We have an estimate of upside for the Nifty of about, give and take, 11%, maybe 12, somewhere thereabout. So we could talk about 27,500, somewhere there in that area for over a 12-month base. So I find it difficult to suggest to anybody not to go into it at these current levels.
We've got just about 5.5 minutes to go. And the market seems to be still dealing with this negative bias, 50-odd points lower on the Nifty as we speak. A couple of stocks actually down quite a bit. Interglobe Aviation is cooling off. It's down about 3.5%. There's a Nykaa, which we've discussed. Names like ICICI Pru are down. The life insurers on the Nifty anyway are lower, but even something on the general insurance side is on the downside. Let's revisit the move on Dreamfolks. Amrish, we were discussing this even before you joined us, right? Because the stock has destroyed so much of wealth already. What would the advice be to existing shareholders?
No, in fact, we were discussing this last week. I think that's the time the management had stuck their neck out and denied the rumors. Whatever happened is a part of the business. Whether it's a pressure tactic or a direct threat, This happens in a business, and especially when you're a tiny player on one side and you have a mammoth on the other side. But what I'm concerned about is the comments last week by the management that the contracts are in force and there's no issue. I mean, especially when there are strong rumors of ICICI and Axis moving out. And now within a week, you report that these banks have moved out. I mean, you may have been right in letter since the contracts were expiring on June 30th, but not really in spirit. I think that is what is bothering me because it should have been addressed. I mean, one need not have talked up the stock for a few days. I think the credibility is at stake. I mean, airport lounges is still a huge opportunity. I mean, there are many tier 2 airports which lack this facility, and that's growing. I mean, you have the other segments like lifestyle, wellness, golf. I think those are the other areas of opportunity for them. I think, I mean, the most important addressable issue out here would have been I mean, what's your plan B? Your plan A seems to have failed because of this. What is your plan B? I think this should have been addressed because 35 to 40% of the properties are at stake. So this is the issue which I saw, I mean, from today's announcement or the comments which came. So, at this point of time, I'll not really, go out and buy. I mean, although it's fallen a lot. I mean, unless I know as to where the company is going, I'll surely not look to venture out to buy.
And if someone already has a holding in Dreamforks, what would you advise?
I would say if you can afford to book a loss, book a loss.
Okay, got that. Blue Star, Amrish, we chatted with the management earlier and they did indicate that, Q1 was weak. In fact, the industry saw a degrowth of about 20-25%. But for the full year, they're saying that things will still pick up. I think they're guiding for a 10 to 15% growth for FY26. And even this commercial ACs, which are used in data centers, that's picking up. As a growth avenue. The stock today is higher by nearly 5%. What would your thoughts be on Blue Star?
I think that's a view coming out for the industry overall, that the last couple of months were not too great, but going ahead, clearly, they are looking at business picking up. And because of which you have seen this also in Voltas. Voltas also has been like one of the performers today, despite the way the markets are. So I think even at these levels, it could be bought at, I would say, both Blue Star as well as Voltas, because possibly over the next 1 or 2 quarters, we should see performance improving and the demand growth happening. So I think we should see much better levels from here.
Okay. I think we're running into market close now. So Amrish, just give us a second. We'll quickly recap what has been a disappointing day for the bulls, you'd have to say. I mean, if you look at it optically, it's not too bad. I mean, it's about a 0.2% cut, which is hardly anything. But why we're calling it disappointing is that the market has stalled. It has stalled every single day this week, 4 trading sessions in a row now, unable to decisively move higher. Perhaps some time correction going on, some caution, which is par for the course, 25,400 on the board. So let's talk about the large cap movers and shakers and what we have today. On the lower side, like I said, some of the insurance stocks are weak. SBI Life, for instance, down almost 3%. Even the other financial stocks, look at Kotak Mahindra Bank or a Bajaj Finserv or a Bajaj Finance. Largely speaking, financials have been weak, including banks and non-banks and insurers. SBI, another name on the weak list, is HDFC Life, also on the lower side. So that's one pocket of weakness. Adani Ports and Enterprises, 2 more stocks on the weak list. JSW Steel undoing some of the gains from yesterday. Remember, yesterday ferrous stocks had a good run. Today was not a follow-up day at all. Titan was also on the lower side today. So that's the red side of the screen. The flip side, there is some sense of safety buying perhaps in the market, quite evident. Apollo Hospitals, Dr. Reddy's, these are stocks on the upside. Cipla also 0.7% higher. Some buying on names like Infosys as well. Hero Moto and Maruti managed to stand tall, including an M&M actually. So some auto stocks managed to get a little bit of a gain, not too much, but some that stood out. Relatively speaking, Rima, the mid-cap index has done better. I mean, at least it's had a flat close, not down too much.
Individual stocks, though, were weak in trade. Nykaa on the back of that big block deal of more than 2%. Stock ending lower, 4.5%. PNB. The Q1 update showed that the advances growth in Q1 was about 9.5%, tracking lower than the company's full-year guidance of 11 to 12%. So the street was a tad bit disappointed. Avenue Supermart slipped. Again, the revenue growth of 16% lower than the revenue growth seen in the prior 2 quarters. Bharat Forge, where the North America, Class 8 trucks were a bit subdued, under pressure. And then you had cuts in Vedanta. Sigachi continues to lose ground. NBCC, Sagility, weak in trade. On the way up, DCM Shriram 19% up by the close of trade. Blue Star had handsome gains going for itself, and HDB Financial Services now at 867 versus the issue price of 740. Lots of action in individual stock, and that brings us to a close in this edition of Closing Bell. Thank you very much for watching. Don't go anywhere. Markets Forward is up next.
Markets failed to hold opening gains as financials declined. Nifty and Sensex and mildly lower. The mid-caps outperformed the blue chips.
DMart Auto Avenue Supermart was under pressure after missing estimates on Q1 sales and concerns over rising competition from quick commerce that some analysts believe can also dent the margins.
FSN e-commerce, the promoter of Nykaa, also ended lower after early investors Harinder Pal Banga and his wife Indira Banga sold over 2% equity for nearly 1,200 crore rupees. Fears of further selling remains an overhang.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading session. I'm Vinny Motiwala. With me is my colleague Hormaz Pataki as well. Hormaz, an interesting day coming in, but the whole week has been like this, right? A bit of a consolidation, a bit of a correction coming in after the run-up last week.
A very typical expiry day, as we have seen in today's session as well. And we've got you covered over the next 20 minutes with all the big news, the key developments on Dalal Street, the top corporate voices, and the events to track ahead. But of course, let's kickstart the show with today's market action. And it was, as a typical expiry session, as we just mentioned, we opened higher. We managed to hold on to some bit of gains for a better part of the session, at least till the first half. But then the selling pressure started to emerge in the second half of this weekly options expiry. The Nifty came off the highs of the day, huffed and puffed its way, but managed to hold on to that 25,400 mark by just. And the other good bit is the fact that it managed to defend yesterday's low. It did that convincingly yesterday. Today, not quite, but the broader markets did fairly well for themselves. And the key culprit of this has been the Nifty Bank. The Nifty Bank has been down almost 800 points now since it made its record high of 57,614. And from there, that underperformance has continued, and that has dragged the Nifty lower in evening.
Absolutely. That is something that dragged the Nifty lower today. But, just a couple of top sectoral gainers that I would like to highlight. Nifty Auto as well as metals. And among the losers, banks obviously is there, but PSU Bank saw a sharper drag like there in the overall market scenario, as well as Nifty Metal. That was among the drag coming in as well. So PSU Banks and metals were the top drags in terms of sectoral moves that we saw coming in today. But let's move on and look at the lineup that we have for you all in store today. We will start out with the top movers and shakers of the day with Vivek, and then move on and talk about some of these individual stock names. So we do have HDB Financial Services. That is remaining on our radar for the last couple of days. The stock rallied while Nykaa shares actually slipped by over 4% on the back of a major block deal. Meanwhile, Dreamfolk slips yet again after the closure of launch program. Last but not the least, we'll also delve into the market events that you should be keeping an eye out on in tomorrow's trading session. But first up, let's get started with our first segment for the day. We have Vivek joining in with us from the big wall to take us through the top movers and shakers of the day. Vivek, over to you.
Well, thank you so much for that. Like you mentioned, a roller coaster of a session. It did see significant volatility throughout the trading day. But quite a few stocks managed to do well. If you look at the list of gainers, pharma stocks today actually stood out. Most of the names doing quite well for them. So after a while, you did see the pharma pack move ahead despite the kind of uncertainty July 9th brings. So the entire pack, name like Natco Pharma, Ajanta Pharma, all of these stocks among the top gainers today. DCM Shriram, one stock as far as the NSE 500 was concerned, that particular stock managed to end the session significantly higher, almost 15% higher, strong volumes, top gainer on that particular index. And the other set of stocks that continued to do quite well for the second straight session was the entire hospital pack. So look at a name like Aster DM Healthcare, almost 10% higher, Indraprastha Medical, a Delhi-based company, again, that's doing very well, Max, Apollo, Fortis, all of these names doing very well in the session. One stock that had been under significant pressure in the last couple of trading weeks, in fact, today managed to bounce back quite significantly, almost 5% higher for Blue Star. They spoke to us earlier today, and they stuck to the FY26, 10 to 15% revenue guidance. The market taking positive cues from that particular interview. And lastly, Motilal Oswal Financial Services, that particular stock almost 9% higher, the top mid-cap gainer today. But quite a few stocks under pressure as well. And like you mentioned, the Nifty Bank was under pressure, largely led by the underperformance of the underlying constituents. So some of the banks, especially PNB, a slightly muted quarterly update, Kotak Mahindra Bank, a downgrade by Macquarie, all of these stocks ended the session significantly lower. Capital Small Finance Bank, one NBFC, slightly muted operational update, that stock ended near the day's lowest point. And also Nykaa, like you mentioned, the large block deal, the supply overhang over there, almost 4% lower. And SBI Life, both the insurance stocks, SBI as well as HDFC today under pressure, but SBI Life, the top Nifty laggard today.
Vivek, thanks a lot for that, a summarization of the movers and shakers in today's session. Let's go across to our guests then. We're being joined by independent market expert Amrish Baliga and Ruchit Jain from Motilal Oswal Financial Services. Ruchit and Amrish, good afternoon. Thank you for joining in. Ruchit gets the levels out of the way first. Still somehow managed to defend that 25,400 mark on the index even today for the second straight session. How important is that level? And if we do go below that on a sustained basis, what are the levels that you are watching out for?
Yeah, hi, very good afternoon to everyone.
Well, I think we are going through a phase of more of a time-wise correction within an uptrend, where last 3-4 trading sessions have been no more consolidation within the range. Yes, 25,400 is very important support. Looking at the lower time frame charts, where the markets have been bouncing back in last 2 or 3 trading sessions. But if we slip below the 25,400 next 1 or 2 trading session, then I think next logical support would be around the 20-day exponential moving average, which comes around 25,200 to 150 zone. So even if that if the market tries to test that 20-day support, that won't really change the broader trend, but rather that would relieve the overbought setups and could form a base for the next leg of rally. So it remains a buy and dip market as the overall trend remains positive, but just for very short-term traders or swing traders, some consolidation or time-based correction could continue.
Okay. Amrish, obviously I just want to know, because we are just going to be starting the earnings season as well. So what are we watching out for? Because now earnings will play a bigger role in terms of the moves that we'll see coming in for individual stock names as well. So what should we be watching out for overall in terms of markets? Larger end of the market or the mid and small cap?
No, I think it should be the larger end, in the sense the large caps is what we should be looking at. But again, I don't really expect too many positive surprises in like Q1. Basically because we started off with a tariff issue. I mean, that issue was there for at least the first 15-20 days of the quarter. And then, we had geopolitical issues. So I don't expect a major upside as far as earnings are concerned. I think it'll be somewhat similar to what we have seen in Q4 last year. And again, at the same time, I think the expectations from the analysts also are not too high. So I think that should be positive overall.
Interesting. On to the first mover of the day, and HDB Financial, the recent listing, they continued from where they left off yesterday. Remember, the stock listed at a 13% premium, and it built on to those gains in today's session as well, ending at 865. Gaurav is here with an analysis on the stock, the new listing. Gaurav, over to you.
Well, yes, as you rightly said, the continuation in the rally has been seen in HDB Financial. Even today, this 1 lakh crore AUM company has actually grown at around 20%, and we have already seen a good set of numbers in terms of valuation for the company. But at the same time, when we look at the current valuation, it still trades at a cheaper rate if we compare it with its peers. And let's understand how. When we look at some of the positives and negatives, there are actually few positives. First, let's look on the positive side. The gross NPA has been lower for the company, and that is the reason why there is actually some kind of advantage to HDB Financial over its peers. Other than that, when we talk about portfolio, it is well diversified. In fact, 73% of their portfolio is in secured segment, and it is well diversified and more granular if we compare it with the peers. And that is the reason it gives an upper edge to the company over other peers. When we look at PAT, there also we have seen 30% growth CAGR over the last 4 years, which is actually good if we compare it with other companies. But on the flip side, there are some negative points as well. First is that when we look at loan book growth, that was at around 20% CAGR, whereas we have seen peers growing their loan book at around 30% CAGR over the last 4 years. When we talk about ROAs, there also we have seen HDB Financial actually reporting a little bit of lower ROAs compared to peers, and the reason being that higher credit cost in FY25. From what we have picked from the management, they said that the credit cost is likely to remain in the same manner, and that is the reason there are some concerns around ROA. But considering all these factors, even after considering these, the valuation at 3.5 is still cheaper if we compare it with peers like Chola and Bajaj Finance, who are trading at 4.5 to 5 times price to book value. When we look at the valuation scenario, in fact, even if we consider the stock price going as high as 1,000 rupees, the valuation could still remain in the range of 4 times price to book value, which is again at a discount to its peers. So definitely, it seems that investors are finding some kind of comfort given the rally. Even if we consider coming days and some uptick in the stock price, it seems that there is some comfort in valuation for HDB Financial.
Okay, that's a word coming in on HDB Financials. But, let's talk about another stock as well before we go to our guests. Nykaa, that is the one we'll want to talk about because that was falling almost 4% in today's trading session. This came in after a big block deal, and an earlier backer in the firm is likely to have trimmed their stake. Now, what are the details on this one? What was the reason for that fall? Vivek is here to give us those details.
Well, late last evening, we told you about how, we were anticipating a large block deal as far as FSN e-commerce, that is the parent company of Nykaa, was concerned. And along expected lines today, two early backers, Harinder Pal Singh Banga, and along with his wife Indira Banga, today exited a little over 2% stake in the company. Remember, at the end of the March quarter, together they held over 5% stake. So the bigger worry is what actually happens to the remainder of the stake and whether it will continue to remain as an overhang as far as the stock of Nykaa is concerned. So over 2% equity, almost 1,200 crore worth of equity changed hands in the block deal today. The floor price of the block was at 200. And the stock, remember, throughout the trading session, and remember, the company just recently held an analyst meet. Post that, immediately you've seen a block deal coming in from a very early investor. So Nykaa, on the back of that, continued to remain under pressure today.
Indeed, under pressure is Nykaa. That overhang remains of any further potential stake sale from the early backers. Amrish, Nykaa, or even HDB Financial for that matter, this overhang of this insiders selling further stake, and more importantly, among all of these new age companies, this class of 2021, say the Paytms and the Nykaas, Nykaa has been sort of an underperformer, which has not done much from its IPO price. Your call here, because are there better opportunities in this space, or would you go for? Would you still stick to Nykaa if you have a longer term horizon?
No, I mean, Nykaa from a block deal perspective, yes, I mean, we saw a bit of a damage, but it is not really corrected so much. So I don't think that overhang of another 2 or 3% coming should really bother too much, because it's got really absorbed decently well. And if you look at the performance, it's been a stable growth. I mean, like we're talking of, a return of about 20-25% over the next 12 to 15 months as far as the stock price is concerned. I'm not really expecting it to be a multi-bagger, unless, of course, we see the operating margins improving quite sharply from here, and also the growth improving much more. But based on the consistent performance which they have shown, I think a stock like this can possibly give you 20-25% return over the next 12 to 15 months. So if one has, I think one should hold on. And if you're talking of HDB Financial, I think the IPO valuation was quite decent. Especially looking at the sort of grey market transactions which have been happening for the last, so many months. And since it was a large issue, really could not expect a huge premium on listing. So 13% premium was fine. But I think, over a period of time, we should see it gradually moving up. So I'll not be surprised if we see levels of about 1,000, 1,050 over the next possibly a month or two.
Okay. Keeping an eye out on HDB Financials as well. 1,000, 1,050 is what we could watch out for in the next couple of months. But let's move on banks. That is also in focus today. Why? Because we had PNB, Indian Bank, we had a CSB Bank as well, which came out with their numbers. Now, Q1 updates, that is what they came out with. What was the number looking like? What was it in terms for Nifty Bank coming in as well? We have Gaurav to give us all those details. Gaurav?
Well, yes, let's begin with Punjab National Bank. A weak set of number is what we saw from the company because loan book growth was just at 9.7%. Although deposit growth was strong, but let's not forget that CD ratio is now at 71%. So there is a risk that there may be some drag on the margins, and as a result, this stock was under pressure. When we talk about Indian Bank, there also we saw a decent set of numbers because loan book growth was actually in line with what they had guided. Even in terms of deposit, the growth was actually in line with the guidance of around 8 to 10%. Deposit growth was at around 9.2%, but there was another hiccup here because the deposit growth was largely led by term deposits, and that is something that was factored in the stock price as well. CSB Bank, on the other hand, came up with very good set of numbers. 30% growth is what we saw in loan book, and that was specifically pushed by the gold loan segment. In terms of deposit also, we saw 20% growth, and as a result, we saw some cheering up for the stock today. Capital Small Finance Bank, on the other hand, actually came up with weak set of number despite having low base, because when we look at the advances there, we saw a growth of around 16%, while deposits grew only by 17% on a year-on-year basis. Lastly, let's also not forget about M&M Finance, because disbursements were actually very weak for the company. It came in only at 1% on a year-on-year basis. AUM growth was at around 14%, and there were some concerns around the AUM growth, because if disbursements continue to remain weak, there may be AUM growth somewhere in the range of 12% is what the analysts were anticipating. But at the same time, Citi came up with a note and highlighted that there is a case that there may be some improvement in terms of asset quality. In fact, what they're saying is that the credit cost could be somewhere in the range of 2.1% versus what they were anticipating at 2.3%. So, and back of this, we saw a little bit of uptake in this stock today. So definitely on the back of the provisional updates, we are seeing some kind of action in banks and financials.
Gaurav, thanks a lot for that. Ruchit, the Nifty Bank has been the principal reason as to why the Nifty went higher last week, and now why is it moving lower this week? What are the levels you're watching out for on the Nifty Bank, and does this downtrend continue over the next couple of days because of the fact that you've seen almost an 800-point correction from the record highs already?
So I think some more dip could be expected in the Nifty Bank Index, primarily because the index has formed a higher high on the daily chart, but technically the RSI has not formed a higher head, which is a negative divergence. And whenever such divergences are formed, and the indices either go through some time-wise or a price-wise corrective phase. But again, like we spoke about the broader markets, that does not mean the overall change of the trend, but just a pause, we can say, within an uptrend could be seen. 56,500, 56,400 would be the immediate support for Bank Nifty Index, where the 20-day mark for the index lies. So I think some dip and some consolidation could be expected, but the overall trend remains positive, and hence as the index approaches the support end, that should be used as a buying opportunity, as the risk-reward ratio would again become favorable over there.
Okay. Keeping an eye out on those levels over there. But let's move on. And Adani Ports has said that the lounge access will no longer require middlemen. This comes a day after Dreamforks management said that it has been pressurized by two big airport operators to give up the lounge business. Madhya is here to give us the details on this front as well. What has Adani Airports actually highlighted? Madhya, over to you.
So Adani Airport CEO Arun Bansal has spoken about the airport's lounge business in a LinkedIn post. He said that passengers across India can now access lounges directly through Adani Airport's platform in partnership with other lounge operators. He said that this has been made possible by the innovation coming out of the group's in-house digital lab. Bansal said that the fintech revolution has eliminated the need for middlemen across the sectors. In this case, he is referring to lounge access providers like Dreamforks. He went on to say that in today's tech-led world, only companies willing to disrupt themselves will survive, the rest will disappear. Remember, this comes a day after Dreamforks told CNBC-TV18, as you were mentioning, that it is being pressured by two large airport operators to exit the lounge business. They claim there's a coordinated campaign to damage their reputation and push them out of the market. For context, Dreamforks is a lounge access aggregator. It offers lounge access not just at airports, but also at railway stations, highways, and even visa centers. Now, just to add more context for our viewers, here's how the lounge ecosystem operates. The airport operator awards the lounge contract or runs it directly. The lounge operator manages day-to-day services. This could also be the airport operator itself. The access provider like Dreamforks connects passengers to lounges via partnerships. Payment gateways like Visa, MasterCard and RuPay enable the transaction. And finally, banks and credit card issuers tie up with access providers like Dreamforks to offer free entry to customers. So when Arun Bansal talks about eliminating middlemen, this means doing away with lounge access providers like Dreamforks. So in airport, where Adani is the airport operator, lounge operator, it will also be the lounge access provider. That's what we picked up from Arun Bansal's LinkedIn post.
Madhya, thanks a lot for that. Amrish, a final word from you on Dreamforks. It's been seen a significant value destruction already, and with now these negative developments that have emerged, where do you see this headed? Because the damage is already done, because investors have lost money. And is there any reason or any good reason to catch a falling knife like that?
As of now, there is no reason for catching a falling knife because last week the management came and denied the rumors, and now they've come back and said that yes, it's true that from July 1st, the contract is off. But what I expected from them is that the plan A has failed. I mean, what they're doing for the last so many years. So what about plan B? I think they should have addressed that than coming and blaming possibly the big boy, saying that they forced us to move out. I was expecting them to talk something on plan B. So for the time being, I'll not cast the falling knife till I really understand the path ahead for this company.
Absolutely. Surely we'll keep an eye out on that. But on the technicals also, Ruchit, would you also be avoiding this right now? Given that fundamentally right now there are issues or, there are these problems going on, then what would you do?
It's definitely, because if you look at the positional charts and post the listing, the stock rallied till August 2023. And it's been almost 2 years, we have not seen any kind of high top, high bottom structure coming in the stock. Irrespective of the rally that we have seen in the broader markets in this phase, we have not seen any kind of participation coming in from Dreamforks. So there are no signs of change in trend as of now. So the underperformance could continue going ahead. So better not to do any kind of bottom fishing over here as well.
Okay. Thank you so much, Ruchit, as well as Amrish, today for joining us on the show, talking about the markets as well as individual stock names as well. But on that note, we'll slip into a very short break, viewers. And after the break, we'll get you the top corporate voices along with the key market events to watch out for in tomorrow's trading session after this break.
Welcome back. On to corporate conversations that we had through the day. First up is Karnataka Bank. Now, the lender told CNBC-TV18 that the name of an interim managing director has already been recommended to the Reserve Bank of India and is awaiting its approval. Now, this comes after Sri Krishna Harihara Sarma, the managing director and CEO, resigned recently. The lender expects the Reserve Bank of India's response to come before the 15th of July. Now, the bank is now hunting for internal and external candidates for its next MD and CEO and adds that the change in management will not impact its growth trajectory.
Next up is Blue Star. The management says room AC and air conditioning industry could see a 25% decline in the first quarter. This fall is largely driven by unseasonal rains and subdued residential demand. However, maintains the growth target for FY26 in the range of 10 to 15%. Meanwhile, the company aims to achieve 15% in RAC, that's room AC, air conditioning market share, by end of FY26. Commenting on the inventory position, the management said it doesn't think inventory is an issue and that the company has taken a 25% production cut in the past.
Next up in the list is Godrej Industries, and the company recently announced a significant capacity addition in its chemicals business with a 750 crore rupee investment. The management says that this investment will help generate an additional revenue of 1,000 crore rupees annually and added that the company aspires to grow its exports to over 25% and domestic sales by 10 to 12%. And that's not all. It expects the bulk to specialty ratio to be 50-50 by 2030 as compared to the current ratio of 80-20.
Okay, now let's go across to Upasana, who's standing by to tell us which are the key events to watch out for in tomorrow's trading session. Upasana?
Okay, so first up, let us look at the global economic cues. Coming to UK first, S&P Global Manufacturing PMI data will be out tomorrow. In Europe, PPI data for the month of June will be out. And mind you, ECB President Christine Lagarde will be speaking tomorrow. Also coming back to home, that is India, foreign exchange reserves data will also be out, so we'll be closely watching out for that as well. Now let us look at the key stocks in focus on the back of corporate action. Container Corp tomorrow marks as the record day for their bonus issue in the ratio 1:4. Paras Defense, record date for stock split from 10 rupees to 5 rupees, and stocks like Axis Bank, Bharat Forge, AU Small Finance Bank, M&M, Biocon, Nestle, Petronet, LNG, all of these will be in focus as all these stocks go ex-dividend tomorrow. Aztec Life Sciences, right issue in the ratio 1:7. Vintage Coffee, board will consider fundraising plans tomorrow. And lastly, VRL Logistics, board meeting is scheduled for tomorrow on the back of bonus issue. So all in all, looks like quite an eventful day tomorrow.
The bigger trigger that Upasana missed out was the fact that tomorrow is Friday.
Absolutely.
On this edition of Markets Forward, more news and updates continue on the other side from Vinny and myself. Thank you so much for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end with marginal losses after a range-bound session. Financial stocks lead the decline once again. Mid-cap index manages to end in the green. India and the United States likely to sign an interim trade deal within the next 2 days to avoid additional 26% tariff from the 9th of July. Sources say agri and dairy sectors will not be opened completely, but limited access is likely. India and the US all set to bolster defense partnership with a new 10-year framework, says the Pentagon. Defense Minister Rajnath Singh urges US counterpart Pete Hegseth to expedite delivery of engines to power the Tejas light combat aircraft. US and Vietnam agree on a trade deal, says President Trump. US agrees to reduce tariffs from 46% to 20% on Vietnamese goods. Vietnam will not impose any tariff on US goods. Global Trade Research Initiative calls the deal a cautionary lesson for India with strategic implications. As hundreds of Chinese technicians exit the Apple supply chain and electronics manufacturing units, government sources say companies must determine the best way to retain and manage talent. China has not announced any formal restriction, even as it tightens the tap on talent and tech. Maruti Suzuki asked the government to spare small cars from the new fuel efficiency rules, but most other car makers want the rules to stay. Sources say government is considering if small cars need separate rules. Delhi High Court restrains Yoga Guru Ramdev's Patanjali from airing disparaging advertisements against Dabur's Chyawanprash. Dabur's lawyer argued Patanjali made false claims that other manufacturers have no knowledge of Ayurvedic texts and formula used to prepare Chyawanprash. The CEO of Adani Airports declares the company is eliminating middlemen from the lounge business. This comes a day after airport service provider Dreamfolks accused two major airport operators of pressurizing its clients. The International Olympic Committee invites bids to broadcast the 2028 Los Angeles Olympics in the Indian subcontinent before the 13th of August, with T20 cricket set to debut at the LA Games. IOC is expecting strong interest among broadcasters in the region. All right, let's start with the day's market action. Sensex and Nifty see marginal cuts and failed to hold on to the gains. That is the latest. While financial stocks dragged the markets, broader markets witnessed range-bound trade with the mid-caps outperforming the blue chips. So that is the market update for you. And the top story we are tracking this evening: India and the United States could sign an interim trade deal within the next 2 days. Sources have said the discussions are in the final stages. India is expected to offer limited access in certain areas like agriculture and dairy. Abhimanyu Sharma joins us with the details. Abhimanyu.
Government sources have told CNBC-TV18 that an interim trade deal between India and the United States may be signed within the next 2 days. Now, intense negotiations are continuing between both the sides, and negotiations are at their final stages. Speaking of demands, India is seeking more market access for its labor-intensive industries. On the other hand, the United States is seeking more access in the dairy and agriculture sector as far as exports of these products into India is concerned. However, government sources have assured that India's farmers' interests will not be compromised at any cost, and both these sectors, namely dairy and agriculture, cannot be opened up completely. It is likely, though, that several niche and premium products from the US may be allowed sale into India as part of an interim deal which is being negotiated. It remains to be seen how early the negotiations are going to conclude, even as both the sides look to seal an interim trade deal before the 9th of July. That is when the reciprocal tariffs are slated to kick in. Earlier this week, CNBC-TV18 had reported that in case talks fail, 26% tariffs would be imminent. So all eyes, of course, would be on the talks which are taking place currently in Washington, D.C. And based on that itself, any further steps would be initiated by both the sides.
The U.S. Chamber, the U.S.-India Business Council, all of our members want to see this deal happen. It's very important for the United States and India, the two greatest democracies on earth, to have such a deal. I understand the trade negotiators are in town and working away. Secretary Bessent said the other day that a deal with India is very, very close, and we are cheering wholeheartedly for this deal to happen. It is my sincere desire and hope that both negotiating teams will push on through, because the only people who will really be gleeful about this deal falling apart are, frankly, Beijing and Rawalpindi and others. We need to have this deal go through. It's important for optics. It's important for business confidence.
And speaking of India and the USA, Defense Minister Rajnath Singh and his American counterpart Pete Hegseth have agreed to sign a 10-year framework. This is in a bid to further bolster defense and strategic ties between the two countries. The statement was made by the Pentagon a day after Defense Minister Rajnath Singh held a phone call with Pete Hegseth. Minister Rajnath Singh urged his US counterpart to expedite delivery of engines to power the Tejas light combat aircraft. Now, Vietnamese stock markets hit its highest level in 3 years after US President Donald Trump announced a trade deal. US will impose a 20% tariff on Vietnamese goods, while Vietnam will not impose any tariff on American products. Under the deal, transshipments from other countries through Vietnam will still face a 40% levy. More details are still awaited on the contours of the deal. CNBC's J. Pyong has the details.
6 days before the Trump administration's tariff reprieve expires, Vietnam clinches a trade deal with the United States. Though details are still scant, proposed tariffs on Vietnamese exports to the U.S. will go down from a proposed 46% to just 20%. It's a less severe blow on the fast-growing Southeast Asian country that counts on exports as a major economic driver, with 30% of these going to the United States. There is a catch, though, with the U.S. keeping a 40% tariff on Vietnamese goods that have been transshipped through the country from other places such as China. This was made to try and prevent other nations from using Vietnam as a backdoor from which to sell goods to the U.S. in an effort to avoid possible tariffs on their exports. In return, U.S. President Donald Trump claims that U.S. companies will get to sell American goods to Vietnam with zero tariffs and lower barriers. The clock is ticking for Asian countries like India and Japan to clinch a trade deal with the world's largest economy. However, the Vietnam-U.S. deal may provide a possible scenario or framework for other nations that are trying to get better terms and less punitive measures from Washington, D.C.
Now, Vietnam's dependency on U.S. for exports is extremely high. Vietnamese exports to the U.S. have nearly tripled since 2018, while U.S. exports to Vietnam have grown just 30%. Vietnam exported goods worth a record $136 billion with the U.S. last year. The Global Trade Research Initiative said that the trade deal between the US and Vietnam serves as a cautionary tale for India. The Global Trade Watchdog said, and I quote, "For Indian exporters eyeing Vietnam as a competitor and a partner in regional value chains, the deal presents both a cautionary lesson and strategic implications," end quote. Now, US President Donald Trump's mega budget bill is headed for a final vote in the US House of Representatives. The budget bill, which is crucial to President Trump's agenda and includes many promises on tax cuts, the US House of Representatives is debating the bill on the floor before its final passage. President Trump had earlier pushed for signing the bill into law by the 4th of July, which is the day America celebrates its Independence Day. As hundreds of Chinese technicians exit the Apple supply chain and electronics manufacturing units, government sources say companies must determine the best way to retain and manage talent. China has not announced any formal restriction even as it tightens the tap on talent and tech. Ashmit Kumar joins us now with the details. Ashmit, what are your sources telling you?
Well, just yesterday we had reported how there's a movement of Chinese employees back to their home country and that is inspiring a great deal of concern within the electronics industry. Now, we reached out to very highly placed government officials. What they tell us is that, yes, the government is seized of this issue. This is not news to them. They have been hearing about it for the last couple of months. They point out that there is no formal restriction as such that has been brought in by Beijing. So there's not much room to maneuver from a diplomatic standpoint. And then going on to say, sources telling us that this is, at the end of the day, an issue between a private company and between the relationship that it has with its employees. So this is an issue of talent retention, talent management. That is something that the companies themselves will have to do. But having said that, the government source is also telling us that there are multiple options available. There are possibilities of sourcing talent from geographies such as Taiwan, which again has a very strong ecosystem of electronics industry. Also going on to say that if asked, if requested by the industry, the government would be open to working with the industry to ensuring that there is localization of talent, there is training and grooming here within Indian borders that will meet the needs of the Indian industry. But that, of course, will be a mid to long-term project. For now, the short-term concern is that these number of Chinese officials, Chinese employees who are working for companies such as Foxconn for that matter, hires hundreds of these Chinese employees, a lot of them who have moved back. That has led to a great deal of concerns. These employees were working in sensitive areas of operations, production, training, quality. The fear is that perhaps going forward, in the near term at least, it might have a bearing as far as production is concerned, especially at a time when India was looking to boost the production, augment the local production of devices such as Apple products. So clearly a short-term concern. The government saying that it sees of the matter, open to working with the industry to find solutions, but broadly saying that this is, at the end of the day, an issue between a company, and that relationship has to be maintained by the company with its employees. Back to you.
Right. Thank you, Ashwin, for that update. Moving on, HDFC Bank CEO Shashidhar Jagdishan has approached the Supreme Court seeking to quash the FIR filed by the Leelavati Medical Trust. As reports, senior advocate Mukul Rohatgi has sought urgent listing of the matter in the Apex Court. The Supreme Court has agreed to list the case tomorrow. This comes just days after 3 judges from the Bombay High Court recused themselves from hearing the petition filed by the HDFC Bank CEO. The Delhi High Court has restricted Patanjali Ayurved from running degrading advertisements against Dabur's Chyawanprash. The High Court allowed an interim injunction on Dabur's plea, which alleged Patanjali's special Chyawanprash was disparaging Dabur Chyawanprash specifically. Now, shares of Tata Power decline in trade. This after the company was ordered to pay over $490 million in damages to Claros Capital following a partial award by an arbitral tribunal under the Singapore International Arbitration Centre. The arbitration was initiated by Claros in November 2020. Shares of Nykaa declined more than 4% after a large block deal over 2% stake changed hands today. Sources have said that the total transaction worth 1,200 crore rupees with a floor price set at 200 rupees a share. Sources have also said that early investors Harinder Pal Singh Banga and Indra Banga are the likely sellers. Now, e-commerce player Meesho has filed its IPO papers with SEBI via the confidential route. Sources say Meesho has selected investment bankers including JP Morgan and Morgan Stanley as advisors for the initial public offering. The SoftBank-backed platform plans to raise up to 4,250 crore rupees in primary capital through the IPO. Now, the company is eyeing a public listing around September to October this year. Now, Maruti Suzuki has asked the government to spare small cars from the new fuel efficiency rules. But most other car makers want the rules to stay. Now, sources say government is considering if small cars need separate rules. Parikshit Luthra joins us now with more. Parikshit, Motown is divided on the new fuel efficiency rules.
Well, yes, and Maruti is seeking a review because it's most impacted by these CAFE norms. 10 out of 17 cars of Maruti Suzuki are small cars. And this is the reason why they are requesting the government to review the corporate average fuel efficiency norms. The largest car maker in the country says the existing fuel efficiency regulations penalize lightweight cars and allow bigger cars to emit much more CO2. They have gone on to say that all countries have policy tools to protect small cars in their CAFE regulations, and India's current policy around fuel efficiency norms is counterintuitive. Maruti has said there is a need to protect small cars, keeping in mind per capita income in India. Sources say the current emission targets may force certain automakers to discontinue some models at a time when the industry is already in stress. And these are models of small cars. The matter has been discussed at the highest level. It's been discussed at meetings in the Ministry of Road Transport, the Power Ministry, the Ministry of Heavy Industries, the Ministry of Minister Nitin Gadkari also had a meeting with automotive CEOs, and this was one of the issues discussed. The industry is, however, divided. While Maruti Suzuki has sought review of CAFE norms, most car makers want earlier targets to stay. The government is considering whether separate CAFE norms for small cars under 1,000 kg is needed. The government is considering whether there should be separate fuel efficiency norms for both small and big car makers. Other OEMs, especially SUV makers, have opposed the proposal for lower CAFE targets for small cars, their argument being that small car sales are falling because of changes in customer preference, and there is no need to change the CO2 emission targets that were unanimously agreed upon by the industry in December 2024. All car makers have to meet emission targets as laid out in the government's fuel efficiency norms. The emissions of a company are calculated based on weighted average of annual sales, and there is a penalty for exceeding targets.
Thank you, Parikshit, for that update. Moving on, the Delhi High Court has issued a notice in response to a plea challenging the Delhi government's order on the fuel ban. The petition stated that petrol pump owners are being penalized for refueling end-of-life vehicles. The High Court has sought the government's reply on delegating enforcement action and introducing these penalties. Well, it's time for a short break, but coming up next, the International Olympic Committee invites bids to broadcast the 2028 Los Angeles Olympics in the Indian subcontinent before the 13th of August, with T20 cricket set to debut at the Games. IOC is expecting strong interest among broadcasters. More details when we return. Welcome back. The International Olympic Committee has invited bids to broadcast the 2028 Los Angeles Olympics in the Indian subcontinent before the 13th of August, with T20 cricket set to debut at the LA Games. IOC is expecting strong interest among broadcasters in the region. Shireen Bhan spoke with the top IOC executive for more on the media rights.
We're bringing into the sports program, after more a century of absence, the sport that the Indian population cherishes the most, cricket. I think we're really here in a place where this is a game changer for India, but it's also a game changer for the Olympic movement. So this is a win-win situation, and whoever is going to be the partner that will be our partner for the future will create history. Will create history not only in India but also across the world.
What is the expectation in light of what you've seen with Paris 2024 and the numbers that we've just talked about, with the many milestones, the records that were achieved with Paris 2024, now with the inclusion of cricket? What's the expectation in terms of what the media rights value could possibly be? And also, has there been any conversation with Viacom 18? Have they expressed any interest in possible renewal?
It will be a question, who is the best bidder that best responds to the criteria that I outlined earlier. In terms of value, we expect I cannot disclose, of course, any value that are confidential information, but the expectation that the amount will be a multiple of that amount.
Any update on where things stand on India's aspiration of hosting the 2036 Games?
Well, we've heard numerous times, the interest expressed by India, through various, I would say, level of government authorities about an interest in hosting the games in the future. We absolutely welcome this interest, and from a commercial standpoint, of course, this is great news for me. There's a process in place, and will I think all of us be following very carefully what that process leads to, and we absolutely welcome the interest of the Indian delegation here at Olympic House.
Right. The CEO of Adani Airports has declared that the company is eliminating middlemen from the lounge business. This comes a day after airport service provider Dreamfolks accused two major airport operators of pressurizing its clients. Shares of Dreamfolks continue to remain under pressure on back of the development. My colleague Madiha Mujawar joins us now with more details. Madiha, please take us through what Adani Airports has said so far.
So Adani Airport CEO Arun Bansal has spoken about the airport's lounge business in a LinkedIn post. He said that passengers across India can now access lounges directly through Adani Airport's platform in partnership with other lounge operators. He said this has been made possible by the innovation coming out of the group's in-house digital lab. Bansal said that the fintech revolution has eliminated the need for middlemen across sectors. In this case, he's referring to lounge access providers like Dreamfolks. He went on to say that in today's tech-led world, only companies willing to disrupt themselves will survive, the rest will disappear. Remember, this comes a day after Dreamfolks told CNBC-TV18 that it is being pressured by two large airport operators to exit the lounge business. They claim there's a coordinated campaign to damage their reputation and push them out of the market. For context, Dreamfolks is a lounge access aggregator. It offers lounge access not just at airports, but also at railway stations, highways, and even visa centers. Just to add some more context for our viewers, here's how the lounge ecosystem operates. The airport operator awards the lounge contract or runs it directly. The lounge operator manages day-to-day services. This could also be the airport operator itself. The access provider, like Dreamfolks, connects passengers to lounges via partnerships. There are payment gateways like Visa, MasterCard, and RuPay that enable transactions. And finally, banks and credit card issuers tie up with access providers like Dreamfolks to offer free entry to customers. So when Arun Bansal talks about eliminating middlemen, this means doing away with the lounge access providers like Dreamfolks. So in airport, where Adani is the airport operator, lounge operator, it will also be the lounge access provider. That's what we've picked up from Arun Bansal's LinkedIn post.
All right. Thank you, Madiha, for that comprehensive update. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV18.
Olympics held in 2024 was the most watched ever, with 13 times more engagement on social media handles and a 25% rise in the amount of coverage when compared to the Tokyo Games in 2021. The Games in France cost the government a little less than a third of what it cost Japan to host the Olympics. France's national auditing body's report shows that although the government's expenditure is higher than expected, it is far lower than previous games. The International Olympics Committee report also shows that revenue from the sale of media rights hit a record high of $3.2 billion. Viacom 18 bid $31 million for the rights to broadcast in the Indian subcontinent, saw its advertising revenue double. India is aiming to host the 2036 Olympics in Ahmedabad. What does the future hold for broadcasting the Olympics? Joining me now is Anne-Sophie Wormad, Managing Director, Television and Marketing Services at the International Olympic Association. Anne-Sophie, many thanks for joining us here on CNBC TV18. Let's get the big news out of the way, the launch of the tender for rights here in the subcontinent. What's going to be different this time around? Last time, Viacom 18 won the bids, and of course, full disclosure here, they are part of the same group that we operate under. So to start with, what's going to be different with the bids this time around, and how much more exciting will the bidding process be, considering that you have cricket as part of the LA 28 program?
Thank you. First, thank you, Shireen, for having me with you today. First, I'd like to rebound on the great things that you reminded us about regarding Paris 2024. I mean, this only brings, very, very good memories, because we're just coming out of the Paris 2024 games, which were a huge success for everyone. I mean, you mentioned a couple of stats, but I just want to remind everybody about the unprecedented and record audience that the Paris Games actually generated. I mean, just to simply think about, the world's population, 84% of the potential audience actually followed the games during that period of time. This actually amounts to almost 5 billion people that have been following the game. So this is staggering numbers. We're very, very happy about that, and it's great to remind ourselves of that great success. I mean, we live in a digital age, and of course, that success was also very, very clearly visible in terms of digital engagement, where we had 412 billion engagement record numbers, also just simply on digital. So amazing things to remind ourselves about. So you mentioned the media rights and the media rights tender. Of course, this is a very important milestone for us for a number of reasons. First, you're talking about a very an important milestone, or almost we're at the crossroads, or a paradigm shift is about to happen, because on the one hand, you have India as the fastest growing economy, also the largest, one of the largest world's population, and if you talk about also the neighboring countries within which this media tender will take place, this is probably the world's largest population that we're talking about. But not only a large population, but a very, very young population, very sports savvy population, very digitally engaged population, and a population that of young people that like to consume sports. So on the one hand, you have that context that we're in, and on the other hand, we just talked about the Olympic Games, and the Olympic Games is by far the largest multi-sport event in the world. And if you imagine those two things colliding together, and you add another layer, which is, hey, we're bringing into the sports program, after more a century of absence, the sport that the Indian population cherishes the most, cricket. I think we're really, really here in a place where this is a game changer for India, but it's also a game changer for the Olympic movement. So this is a win-win situation, and whoever is going to be the partner that will be our partner for the future will create history. Will create history not only in India but also across the world, and in particular because if you look at what this is gonna mean. Bringing cricket back into the Olympic sports program basically creates a new cricket competition. So whoever is going to be the winner of that bid will be bringing to the Indian fans for the first time ever cricket back into the game. So that's a historical moment. But it's also something very special, because the games will not be just about cricket, but we believe that also whoever is going to be the media rights holder will also become the catalyst for growth of other Olympic sports around India, and hopefully inspire young girls and boys in across India to maybe take upon a more active lifestyle and embrace new sports that they may not have known existed before.
Well, Anne-Sophie, you've used many words there. You've called it a paradigm shift. You believe that the induction of cricket into the LA program is going to be a game changer, and it's potentially going to be a game changer in terms of driving audience engagement, viewership, and perhaps media rights will factor all of that in as they bid. But, if you could lay out for us what's going to be different this time around as far as the tender itself is concerned, in terms of what is on the table that the IOC is offering for potential bidders.
So we will be opening the tender on the 3rd of July, and the tender will be open for until 13th of August. And it's an open and transparent tender. Of course, we're opening to any interested party in India, and the scope, the territorial scope, includes 7 territories. So you have India, of course, but we also have Bangladesh, we have Bhutan, we have Maldives, we have Nepal, Pakistan, Sri Lanka. So this is a wider scope than just India. So it's India really and the subcontinent. We will be opening the tender for a minimum of 1 Olympiad, and an Olympiad is, in our jargon, a cycle of 4 years, and those 4 years will include 1 Olympic winter game and 1 summer game. So 2026 in Milano Cortina taking place next year in February, but also the games of LA 2028 in a couple of years' times. Couple of things that are important for us is how are we going to determine who is the best partner for us, and from that standpoint, there are, I would say, qualitative criterias, but of course quantitative criterias. The qualitative criteria really are the most important to us, which is how can we make sure that we maximize the reach of the Olympic Games across India. So it's reach, it's engagement, it's across the different population in terms of year, gender. We're probably the event that is, I would say, the most balanced in terms of gender, not only participation, because you remember in Paris, it was the first time we had 50-50 parity between men and women participating into the games. But also we want to find a partner that supports the promotion of the Olympic values. Very, very important to us that those values are being promoted not only during games time. So we're not looking for a partner that only will work for us during games time, but we also want to look for a partner that wants to work with us, before the games, during the games, but also after the games. And of course, on the more quantitative side, this paradigm shift that I described above, the expectation, of course, will be that, the market will respond, and we expect, of course, an increase in the media rights value that is in line with the Indian market robustness and the vibrancy today.
So you preempted my question, Anne-Sophie. What is the expectation in light of what you've seen with Paris 2024 and the numbers that we've just talked about, with the many milestones, the records that were achieved with Paris 2024, now with the inclusion of cricket? What's the expectation in terms of what the media rights value could possibly be? And also, has there been any conversation with Viacom 18? Have they expressed any interest in possible renewal?
So, because of the vibrancy of, I think, the media market in India at the moment, we deliberately chose to open a formal, I would say, transparent tender where we're going to be inviting everyone, with the same conditions. So everyone will have the same time and under the same rules to actually bid. And of course, it will be a question, who is the best bidder that best responds to the criteria that I outlined earlier. In terms of value, we expect I cannot disclose, of course, any value that are confidential information, but the expectation that the amount will be a multiple of that amount.
A multiple of that amount. We're going to watch that process very closely. But Anne-Sophie, you talked about the vibrancy of the India market. You also believe that this is going to be a big commercial opportunity as far as the Olympic movement is concerned. And that's what I want to address with you, because I remember very distinctly when you were speaking in Paris, you said, and I quote, "We would love to welcome a first new top sponsor from India." And I'm sure there's going to be someone very, very soon. Anne-Sophie, where do things stand on being able to get your first top sponsor from India for the Olympics?
Serene, so we're a global movement. We're the top program, which is our sponsorship program and partner program, is the most important values-based sponsorship program in the world. And we bring together all the, I would say, top leading companies in their industries. We have representations of, the largest economies, so the Americas. We have representation in Europe. We have representation in Asia. And it's only fair, I think, to think that with, I would say, the growth and the fastest growing economy that India is undergoing at the moment, we would very much like to welcome a company representing that vibrancy in the market in India. I've had several trips to India since the Paris Games. We're going into the market regularly. We want to learn. We want to understand the market. We want to understand how we could best respond to the needs of Indian companies. And we would absolutely love to welcome an Indian company to the top program very, very soon, because this will be the ultimate testament of the strength of the Indian market across the world.
But Anne-Sophie, can you give me a little bit more color on what those conversations have led to? I mean, do you have any clarity on whether an Indian partner is likely to come on board, in the next few months, or will it take longer than that? Because, when you made that comment, it was August of 2024, so we're almost close to a year since then. So are we any closer to a decision and actually getting someone on board?
We're working very hard at it, Shireen. So you'll surely be notified when is the perfect time to announce it.
Okay, well, we look forward to that. But again, for the benefit of our viewers who are watching, Anne-Sophie, what does it actually take to get a top partner on board? I mean, how much will they need to put on the table outside of course, the qualitative stuff that you spoke of? But let's talk about hard cash. How much do they need to bring to the table to be able to come on board as a top partner?
So the conversation that when we start the conversation, it's about, first we need to find an alignment of values. So that's the number one criteria that we really look into when we're looking at speaking with companies. And we're driven by our values, friendship, respect, excellence. So we want to make sure that we find a partner that really, really shares the same values. And that's the number one criteria that we use in order to do this. The second part is, how can this relationship, the building of that partnership help support the Olympic movement as a whole, but also the delivery of the games in particular, because you want to work with companies that actually can make an impact in what we do, whether it is, in the delivery of the games itself, whether it's around sustainability or gender parity or inclusion. We want to make sure that we work with a partner that shared exactly the same values. And of course, at some point, you look into, what are the industries that are important for us in this respect. And, there's a multiple number of things that we need. So I am not, closing or excluding anybody. It's really about finding the right match. It always takes two to tango. So we're definitely in that period where we're speaking to various entities and understanding also what is important for them. Maybe it's also a question of educating a lot about what the Olympic movement does, how it can achieve the business objectives of companies. This is time that is well invested in making sure that we build a very strong relationship for the future.
Let's also talk about the possibility of India playing host to the Olympics. I mean, the Indian government has made its intent very clear that they are keen on 2036. In fact, I'm given to understand that a delegation is currently at the IOC headquarters meeting with IOC officials. Any update on where things stand on India's aspiration of hosting the 2036 Games?
Well, we've heard numerous times, the interest expressed by India, through various, I would say, level of government authorities about an interest in hosting the games in the future. We absolutely welcome this interest, and from a commercial standpoint, of course, this is great news for me. There's a process in place, and will I think all of us be following very, very carefully what that process leads to, and we absolutely welcome the interest of the Indian delegation here at Olympic House.
Well, while we cannot preempt who will finally host the 2036 Olympics, if you can give us some idea of the timelines of when a decision is likely, when we will know who is going to play host in 2036. If you could lay that out for us, if that's possible.
Well, I am not the person responsible for that process, so it's probably best that my colleagues who are leading these discussions expand on that question maybe a little bit further.
Okay, Anne-Sophie, let me ask you about what we've seen as far as the revenue of Paris is concerned, and we highlighted the fact that we've actually seen revenue higher in comparison to the 2021 games at 4.14 billion. Now, do you see the revenue mix changing? Do you intend to make a concerted attempt at pushing more on digital, because that has seen some very strong growth for you, to build on that momentum? How do you see revenue growing as well as the revenue mix changing, if at all? What is going to be the strategy to address that?
Yeah, well, the revenue is very, very important, and of course, you know, in my position, critically important. And the numbers that I can share with you is that for the IOC, for the period of the previous Olympiad, so the one that started in 2021 and ended with the Paris Games in 2024, we generated revenues of 7.7 billion over that Olympiad. So we're already now in the new cycle, a new Olympiad, and I can tell you that the similar amount has already been generated for that period. So including the game in 2026 and the games in 2028, and almost 7 billion already generated for the following Olympiad 2032. So we're really, really in a good place here, you know, with respect to, from a revenue standpoint, I would say. And this is critically important to us because, as you know, as a non-profit organization, we redistribute 90% of the revenue to support sports at all level on a global basis. So this corresponds to a 4.7 million a day that gets redistributed back into sport thanks to the revenue that we generate. So critically important for us. Your question about, you know, the mix of the revenues. Of course, we see digital increasing exponentially. I would say the digital consumption. So of course, in all the media components that we're talking about, including the tender that is opening in India this month. The digital component will be very, very important. One stat maybe just for specific for India. As a global average, we have about 10% of the consumption that is being consumed only on digital across the globe. And to show the vibrancy and the connectivity on digital of the Indian population, in India, that percentage was actually 40%. So the Indian population actually engaged digitally 4 times more than the average population across the world. So that definitely shows the vibrancy and I would say the early adoption of the Indian population to the digital consumption.
Well, yes, mobile first is something that we are now seeing much more of, even in markets like India. But Anne-Sophie, again, I go back to what's likely to change as far as this Olympiad is concerned. I understand that there was a very deliberate strategy on more product placement, etc., as far as your top sponsors were concerned. Can you run us through how many are on board currently? I know people like Allianz, AB InBev have renewed their commitment to the Olympics. How many are currently on board, and what's the expectation as you move forward?
We have currently 12 companies that are part of the top program, and we've been very, very busy at the beginning of the year. If you have followed, we have actually brought on board a new top TCL, Chinese company, fastest growing TV company in the world. So they just joined the program in January this year. So we're very happy to welcome them as part of our program. We have also renewed earlier this year two tops. One who had actually joined just the year before. So AB InBev, the beer company, joined the program just before Paris, and actually the success of Paris was so staggering for them that they actually asked us to immediately renew for post 2028. So we extended the ABI deal all the way to 2032, thanks to the great results that they witnessed in Paris. Same with Allianz. Same with Allianz.
Allianz and yeah.
Allianz is our sponsor in the insurance category, and Allianz was signed up until 2028, and similarly to AB InBev, their results in Paris actually immediately triggered an interest to go longer, and we renewed the Allianz contract all the way to 2032. And the reason why I mentioned those two partners is related to your question about visibility at the games. And I must say that we've continued to work together with our partners in order to make sure that we can continue to evolve the program in such a way that it remains relevant in today's marketing world. And you will see some innovation coming up in Milano Cortina, where we will find ways to actually organically integrate in a very, I would say, subtle way, additional brands that come and support either the athletes or the organization of the games or the experience of the fans within the venues.
Okay, so innovations there as far as marketing is concerned. But Anne-Sophie, let me end by asking you, you were talking about how Paris 2024 was all about gender parity, 50-50 parity for male and female athletes. The IOC has a change of guard as well, and now we have a woman at the helm, even as far as the IOC itself is concerned. How are things likely to change? What can we expect under her leadership? And more importantly, you give us a glimpse of what could potentially change on your marketing side with subtle innovations that you talked about, but overall on the commercial side, any big changes, any new surprises that we should be prepared for?
Well, a change of presidency is always an important moment in our movement, and what I can say is that there's definitely a refreshed energy, a new vibe coming in with President Kirsty Coventry, taking the lead on the 24th of June, so only a few days ago. So what we see already is that new vibe. She wants to run a consultation, and I think we're going to get a fresh direction, which is absolutely welcome. And speaking with our existing commercial partner, this new energy has been extremely welcome.
We wish you and the new IOC chief the very best of luck. But the big headline coming in there, the new tender will be launched. It is, of course, going to be open to all, and it could potentially mark a paradigm shift, in your words, and it could be a game changer with the inclusion of cricket in the LA28 program. How aggressive are the bids going to be? We will have to wait to see. 13th of August is the deadline. And of course, Anne-Sophie, many thanks for joining us here on CNBC-TV18 to take us through what you have lined up as part of the IOC for this coming Olympiad. Appreciate your taking time out to speak with us today. With that, it is time for us to wrap up this edition of the CNBC-TV18 special. From all of us here, goodbye. Many thanks for watching.
Hello and welcome. You're watching News Center and I'm Parikshit Luthra. The Cabinet recently approved a new scheme to boost research and development and innovation in future technology sectors like artificial intelligence, electric vehicles, renewable energy, semiconductors and deep tech. among others. The scheme has a corpus of 1 lakh crore rupees. Finance Minister Nirmala Sitharaman had announced the creation of this fund in her interim budget speech of 2024. The scheme aims to encourage private sector to scale up research in technologies that are of high strategic importance, as well as in sectors that are relevant for economic security. Under the scheme, a fund will be set up to provide financing to R&D projects in the form of long-term loans and with low or nil interest rates. Joining us now to discuss the importance of this scheme is Abhay Karandikar, Secretary, Department of Science and Technology. Thank you for being with us, sir. Let me begin by asking you how this fund will be operationalized and, number two, implemented.
So, Research, Development and Innovation Scheme, which was approved by the Union Cabinet on 1st of July. So, this will be operationalized as a special purpose fund within Anusandhan National Research Foundation. So, Anusandhan National Research Foundation was operationalized last year. ANRF has a governing board which is chaired by the Honorable Prime Minister, and Executive Council which is chaired by the Principal Scientific Advisor to the Government of India. So this RDI scheme will work as a special purpose fund within ANRF. Now this special purpose fund will be the holding fund. It will hold this 1 lakh crore corpus. But this fund will identify the second level fund managers. So second level fund managers could be the alternate investment funds or development financial institutions or some focused research organizations like Technology Development Board or BIRAC. This first level fund will channel the money through this second level fund manager, and the second level fund manager then will do the actual investments in the R&D projects of the private sectors. So this is how, in this, it will have a two-tiered structure, and it will work in this two-tiered structured mechanism.
Right. Who will be the target groups for receiving the funds?
So the target groups we are envisaging primarily the private sector, and in the private sectors it could be the corporates, it could be the industry R&D labs, or it could be the startups. Now for corporates and industries, the funding assistance or the financial assistance will be largely in the form of concessional loans. For startups, it could be both loans as well as equity. Under this fund, no grant will be given. No grant will be given to startups. It will be mostly, concessional loans, equity, or a combination of that.
Right. What is the kind of technology or the sectors where you would like to focus with this fund, sir? What would be the priority 3 to 4 sectors according to you?
Yeah. So, I think I just wanted to mention here that one of the major objectives of these Research, Development and Innovation Fund to spur the research in private sectors in some sunrise sectors. Now, it was, it is a general sort of belief that a cutting-edge technology development in these sunrise sectors, they have a long gestation periods, and the return on investments on some of these cutting-edge research and development and technology development may take a longer time. It is sometimes, uncertain also, so there is a lot of uncertainties involved. And as a result, therefore, the private sector investments in these sunrise sectors, and these sunrise sectors, they could be, the energy transitions, or they could be the biotechnologies, or they could be deep tech like quantum or robotics or space, or defense sectors. So it could be one of these sunrise sectors where cutting edge technology development requires a longer gestation period. So, and therefore our private sectors were actually hesitant to invest in these sectors. This fund will actually mitigate the initial risks and will invest in the cutting edge technology development in sectors such as energy transitions, precision agriculture, digital economy, deep tech like quantum, robotics, drones, space, or strategic security application technologies. So I think these are the sectors currently we are envisaging where it is very important for our country to develop strategic autonomy and develop indigenous technologies.
Right. So this means, sir, the government will be open to picking up equity in companies as well as startups?
Yes. I think under these initiatives, we will be also, setting up deep tech fund of funds, and through that deep tech fund of funds, equity in the deep tech startups will also be is also envisaged. Yes.
Right. Now, when you say a deep tech fund of fund will be set up, what would be the quantum of that fund within this larger bracket of 1 lakh crore?
So, the 1 lakh crore is the total corpus that, Honorable Finance Minister had made an announcement last year. In this year, 20,000 crore allocation has been done. The remaining, fund will be allocated in subsequent budgets, as we start deploying. Now, the exact allocations of this, how much it will go to the deep tech startups, in which sectors it will go, how much it will be given to the private sectors, R&D projects or corporates, these decisions, are currently being worked out. And as I mentioned, Anusandhan National Research Foundation, ANRF, it will be set up as a special purpose fund within ANRF. ANRF has an executive council that will be providing the overall superintendence over this fund. So all these, decisions we will be taking up in the coming months, identifying, the scope and type of the projects and also the quantum of funding that will go into various sectors.
Right. Now, when it comes to benchmarking or setting up a criteria for the companies, which will be a deciding factor for the government, could you give us a sense if there is any thinking on the kind of companies or the benchmark that will be laid out for identifying them?
No, actually, we are open to any private sector company, whether it is corporates or industry or startups. But there are only two criteria. One is the technology development should be really cutting edge and deep tech. This fund will not be used to subsidize the routine R&D of the private sector. So that is actually is very, very clear, because our objective is really to de-risk early investment where the private sector investment is not coming up. So we will not be using it to subsidize the routine R&D. So that is one sort of measure. The other measure is that we would also like the private sector, particularly the corporates, to also bring in some investments to the extent of maybe the 50% cost, 50% of the total cost of the project, so that, the corporates also have a skin in the game. So I think these will be the broader criteria. But of course, the detailed criteria, etc., are currently being worked out. And I think in the couple of months, from now, we should be able to, come fully roll out this scheme.
So you're saying, sir, the corporates, as part of the scheme, will be asked to pay 50% of the project cost, at least?
Yes. I mean, we are... we were expecting that, the corporates should also put in, amount so that, we see the their seriousness and their willingness to take the risks along with the government, because obviously the government is taking the risk in the cutting edge technology development. So this is one of the vehicles to de-risk, their full investment.
Right. I would also ask you about the possibility of acquiring technology from abroad when it comes to acquisition or buying of technologies and providing it to companies and startups in the country. Would you be open to doing that as well, sir?
Yes. I think as has been mentioned also, that this fund will also be used to do the acquisition of technologies. So suppose, some startup or some company wants to acquire a technology so that, it gives us an advantage of not starting from zero, but starting from some base which they have acquired and then leapfrog it to the next level. Yes, that fund can be used by the companies for the acquisition of those technologies as well. Otherwise, the basic objective is to do the R&D, do the commercializations, product development, etc. But it doesn't have to start from, zero. It could also start by acquiring some technology and then building onto it. And we will be open to supporting such measures.
Okay. I would also like to ask you about the rare earth magnet crisis in the country. Do we have the technology right now for refining the rare earths and then making magnets in the country? Because this seems to be a major problem. Would the government be open to acquiring technologies from friendly allies?
Yes, I think so. First of all, let me tell you that we do have the technology in some of our labs. And if some private sector corporates or some industry wants to take it further and commercialize, yes, I think that is a possibility. We can look at such project proposals. And alternatively, as you mentioned, since acquisition of technologies will also be supported through these initiatives, we are open to that. And it is not just the rare earth magnet, but even other sectors also. And these sectors include whether it is in the quantum, or whether it is in robotics, or whether it is in the space, or whether it is in the defense sectors, or whether it is in the biomanufacturing and biotechnologies. So in all sectors, this fund will be open. I think there is only one important criteria, and that criteria is that this fund is really meant for supporting the deep tech R&D, cutting edge R&D, where earlier the investments from the private sector is low, because private sectors are shying away from investing because of the long gestation period, because of the risks involved. And these sectors actually require patient capital, as has been mentioned several times. And this is, the government's bold initiative to provide that patient capital to the private sector.
Okay. My final question to you, sir, would be, will this be a limited time frame fund subject to the availability of funds within the 1 lakh crore corpus? Or would this become like a sovereign wealth fund, a rolling fund that will always be there now to incentivize cutting-edge R&D in the deep tech space?
Yes, I think we hope that this fund will be able to generate returns, because once you invest in, let's say, startups, we take equity, or once we give it to corporates, we hope that we will get these returns. We are, of course, expecting that we will get the 1 lakh crore return back, but even more than that. And then that can be rolled into the future projects. As you know that what is today sunrise sectors may change after 5 years. So that may also, we can also make, those changes as well. And thirdly, and most importantly, this should be considered as an initial investment by the government. We are hoping that by giving that initial patient capital, in the coming years, private sector's money will flow in to actually, scale these technology development to the next level. So we are hoping that when the government invests 1 lakh crore, maybe, this will catalyze investment of 10 lakh crores maybe.
All right. So that is an important point, sir, that you're investing 1 lakh crore in R&D. You would expect the private sector possibly to make more investments, perhaps even to the tune of 10 lakh crore rupees in R&D. Thank you so much, Professor Karandikar, for joining us here on CNBC TV18, giving us a very comprehensive view on how this policy is going to work.
Thank you. Thank you very much.
On that note, we take a short break, but on the other side, investment firm Recognize has announced successful close of its second digital services fund after securing over $1.7 billion in commitments. I caught up with the Recognize co-founder Francisco D'Souza on the firm's investment bets and growth plans going ahead. Stay tuned. Welcome back. You're watching News Center. Investment firm Recognize has announced a successful closure of its second fund after securing over $1.7 billion in commitments to back next-generation digital services companies. As per the company, Recognize Fund 2 was oversubscribed with strong participation from existing limited partners and significant demand from new blue-chip investors as well. Recognize invests in companies with enterprise values between approximately $50 million and $500 million. I caught up with Francisco D'Souza, managing partner and co-founder at Recognize, and began by asking him about the kind of companies Fund 2 will invest in.
Fund 2 is a continuation, Parikshit, of our original mission. We are focused on building the next generation of digital services companies. We invest only in digital services businesses. We tend to focus on businesses that have enterprise values of approximately $50 to $500 million and businesses that we think are refining the services industry using proprietary technology, AI, platforms, and IP. And our plan is simple. We bring strategic capital, we bring deep domain expertise and operational expertise in services firms, and a real partnership mindset with our portfolio companies to drive differentiation and growth.
Right. Within digital services, are there particular areas, particular kind of companies or startups which you're more interested in, especially in India?
You know, India is an incredibly important geography to recognize. We've made 14 investments at Recognize in the firm's life. 9 of those 14 had a presence in India. Of the 12 that are active now in the portfolio, 7 have a presence in India. 30% of the workforce across all our portfolio companies is in India. So India is a very important geography to us. And as we focus on this next generation of digital services businesses, we're investing in areas like services around cybersecurity, services around digital infrastructure, and so on. We continue to expect to have a significant presence in India.
All right. Now, coming to generative AI. Now, this is going to be a big focus area for the government on how to promote Gen AI. What's your view? If India has to win the Gen AI revolution, what do we need to do in terms of supporting startups and supporting the ecosystem in the country?
Yeah, look, I think, first of all, I think that speaking from a services standpoint, which is one dimension of the generative AI opportunity, I think that the underlying value of Indian IT and Indian technology services, that is the deep bench of talent, deep tech capabilities, the execution muscle, those things remain intact. AI will change the industry in, I think, very fundamental ways. I think we're going to have to learn how to build services companies, digital services companies, where humans and agents, humans and AI learn how to collaborate together, how to work together, how humans' potential can be amplified by AI. And I think that the government has an important role to play here. I think particularly in the areas of skills and skill retraining. I think potentially in the area of creating areas of investment focus, as the government did in the very early days of the IT services industry. But overall, I think that generative AI represents a considerable and substantial opportunity for India and for the Indian IT services ecosystem, and one that I'm tremendously excited about.
Right. Now, just to ask you about the kind of disruptions we are going to see as a result of the kind of tariff policies that Donald Trump is implementing. What would be your outlook for digital services both in the US and in India?
You know, look, I think that policies like we've seen recently create some short-term complexity. But I think as I go back to, I think the underlying value of Indian IT, the talent, the tech capabilities, the execution muscle, those things remain intact. And so I think that, IT services firms need to think about investing in local delivery models, investing in how to diversify go-to-market strategies, and importantly, leading with IP-driven offerings, which in some senses make policy and policy decisions less of a bottleneck.
Right. Which companies in the digital services segment do you think will really stand out, and those which will be in trouble by the end of 2025?
I think that if I were thinking about this, I would say that when I think about services companies, I think that the future is hybrid, and to me that means that services companies that embed AI, embed automation, embed proprietary IP and platforms are going to lead the charge. And I would be looking at the IP quotient of every services business and saying, how IP intensive is the business? I think the businesses that are more IP intensive are the ones that will, over time, win in the new model. And I would point to businesses like Palantir that have really, I think, created a services and a hybrid of services and product models as the ones that we should look to for the models of the future.
Now, in terms of investments, where would you say is the bulk of your attention? Would it be in the United States? Would it be in China? Would it be in Europe? Which are some of the geographies, most important geographies for you?
It's a complicated question only because we, in our businesses, there are the geographies where we where our clients are, the clients of our portfolio companies, and then there are the geographies where we go to find talent to be able to deliver, and those two things are often not the same. I think that when we look at client geographies, obviously the places which have been technology intensive will continue to be the places where we focus our attention. So geographies like the US, like Europe, both Central and the UK and Western Europe, to some extent Asia. But then when we think about the talent, the talent pools around the world continue to be in places like India, in Eastern Europe, in Latin America. So you see that reflected in our current portfolio, and I suspect that will continue to be the case going forward.
Francisco D'Souza, thank you very much for joining us. With that, it's a wrap on this edition of News Center. More updates continue right here.
Welcome to the Medicine Box. I'm your host, Ekta Batra, and today we are talking about something that is becoming one of India's biggest health concerns, obesity. The numbers are hard to ignore. Nearly 1 in 4 Indian women and men are now overweight or obese. Even our youngest are affected. The number of overweight children under 5 has jumped from 2.1% to 3.4% in just a few years. And here's what really stands out. We're gaining weight together as a family. Today, all adults are either overweight or obese in 1 in every 5th Indian home. A Lancet study now predicts that by 2050, 45 crore Indians, that's over a third of us, could be overweight or obese. And we may have one of the highest numbers of obese children in the world. This isn't just about how we look. Obesity is now being seen as a chronic disease. It often comes with a yo-yo pattern of weight gain and loss. And it plays a huge role in serious conditions like diabetes, heart disease, high blood pressure, cancer, and even Alzheimer's. In fact, 8 out of 10 people with type 2 diabetes are also overweight, a combination doctors now call diabesity. But here's what's new. For the first time in India, we now have access to 2 globally talked about drugs, Mounjaro and Wegovy. Launched just weeks apart, they've shown impressive weight loss results globally, and they're stirring up a lot of buzz. So the big questions are they the game changers we need? Who should take them? Are they safe? And what happens when you stop? We're joined today by Dr. Ambrish Mittal and Dr. Sonali Kagne. Welcome to the show.
Thank you.
Well, Dr. Sonali, let's kick off the show with you. If you could just give us the key differences between the 3 weight loss drugs that exist in India now. Wegovy, the injection by Novo Nordisk for weight loss, Rybelsus, which is the oral semaglutide by Novo Nordisk, and Mounjaro by Eli Lilly.
Okay. Wegovy and Rybelsus, the molecule is the same, which is semaglutide. The only difference is Wegovy is an injection which is to be taken once a week, and the oral tablet is to be, the Rybelsus, which is an oral tablet, it is to be taken once a day. If we compare the weight reduction efficacy of these 2 molecules, Wegovy is much better for weight reduction as compared to Rybelsus. Both these, the semaglutide molecule is, it belongs to the group of GLP-1 receptor agonist. Whereas now coming to Mounjaro, Mounjaro is a dual GLP-1 and GIP receptor agonist, and it is also an injection form which is to be taken once a week. The weight reduction efficacy of Mounjaro is currently the highest amongst all the molecules which are available. So it is to the extent of 22% average weight reduction compared to 17% with Wegovy and around 10% with Rybelsus.
Okay. All right. Dr. Mittal, how do these drugs work at this point? Because a lot of the feedback that we've got is that it sort of reduces the noise in your brain when it comes to cravings, when it comes to hunger pangs. Tell us, how do these drugs work?
So all these drugs work via the GLP-1 pathway. GLP-1 is a hormone that's secreted from the intestine and acts on the pancreas as well as the brain. Whenever we eat food, there is secretion of GLP-1. It acts, endogenous GLP-1 acts on the brain to control our appetite and satiety. It tells us when to stop eating. These drugs act through that pathway and they act on the brain to tell us to stop eating and also to reduce our appetite. So the primary weight reducing action of Ozempic or Wegovy or Mounjaro is via their brain action. There are other actions also, like slowing the movement of food in the stomach, but those are all secondary. The primary action responsible for weight loss is the brain action.
Dr. Mittal, now give us a sense, if somebody walks into your clinic with diabetes and say is overweight as well at this point in time, give us what you are prescribing to them based on different BMI scenarios.
So for diabetes management in an overweight or obese persons, GLP-1 drugs are the first line of choice now, more and more. And as they become more easy to use and more accessible, they should be offered to most patients with diabetes who are overweight or obese.
Okay, so would that be
BMI cutoff, yes. So those above 30, even without diabetes, would be candidates for these drugs. Those who have a BMI over 27 and have diabetes, you're talking about diabetes, so those above BMI 27 with diabetes will definitely be candidates and should be offered these drugs.
Okay, so somebody who has a BMI between 25 and 29 and is not diabetic,
correct,
would they be eligible for these drugs?
Ideally, we would like to look at the other causes, why they are gaining weight. We need to look into their lifestyle and try our best to, you know, kind of make them lose weight with these other modifications rather than jumping onto these drugs. Because most of the times when they are in this weight category, some incidents would have happened recently or in this last 2-3 years or so, because of which they have started gaining weight. For example, in a woman, it can be a postpartum condition. For someone else, it is a sedentary job which has recently been changed. For someone whose job, the working hours are so long that they are not finding time for the exercise, or recently they have changed their eating habits or something. So there is some factor because of which they have probably gained the weight, or they were overweight to start with for quite some time, but they have never taken some effort to lose weight. And most of the times the awareness that this BMI of 25, generally we label them as healthy rather than overweight or obese.
Yeah.
So we have to change that mindset. Most of the time, if you look at average build wise, it looks like, okay, this person is normal. So we probably have to change that definition in mind. And this is probably the best time in the weight journey, where if you are aware that this is not my ideal weight and this is a little overweight, and if you just take care of small factors, you will definitely lose weight, and we need not jump for these medications per se.
Okay, so in that case, it's only lifestyle modifications. And what if that same patient comes back to you and says, you know, I tried, I lost 10 kgs after 3 years, I put it back on, now what do I do?
So if in that category, they have already tried everything.
And they still don't have diabetes.
Fine. If they have already tried everything possible, still they are unable to lose weight, and they have some other comorbidities, not necessarily diabetes, but some hypertension, obstructive sleep apnea, or they have weight-related issues, then in that case we might consider for till the time they can probably continue their lifestyle and lead to a little weight loss, wherein they can just maintain the lost weight with the continued lifestyle modification.
Okay. Well, Dr. Mittal, what about somebody who walks into your clinic and has a BMI of over 40, is morbidly obese? What would you recommend to them?
So anyone who comes in with a BMI of more than 40, the first choice is always bariatric surgery. We've been saying this for years and years and years, but the problem is that most patients do not agree to go under the knife. So I think it's a huge task. And, such patients keep coming back. We keep discussing back and forth, lifestyle, a different diet. Now, at least if they disagree for surgery, we can help them. Maybe we won't bring them to target. It's very important to understand that if you lose 5 kilograms or 10 kilograms, you're helping yourself a lot. You need not always reach your target body weight. So if patient is unwilling for bariatric surgery, I would certainly put them on the GLP-1 drugs. In addition to this, there are patients who have agreed for bariatric surgery, but where the surgeon wants a little bit of weight loss to make the surgery easier or less difficult. And in those cases also, we are using these drugs quite liberally in preparing patients for bariatric surgery. So there is a role in those over 40 BMI, but there, of course, the first line treatment is bariatric surgery.
Okay, Dr. Sonali, what about you? Somebody comes in and says 110 kgs. What would you recommend to them?
So again, as I discussed, we need to start from the beginning, find out the causes, and depending upon the choice, basically, as Dr. Mittal has rightly mentioned, that many individuals, despite their BMI being even 44, 48, also sometimes they do not agree for the surgery most of the times. So in those cases, we might put them on this.
So do these drugs work effectively on them?
Yes. So basically the individual variation would be there, but these drugs which have shown this significant weight reduction in other BMI ranges, they will also have the effect in this BMI range.
say somebody who is 110 kgs loses 15% on this particular drug,
correct,
whichever one that you prescribe, and that has to be taken over a period of time, I assume, maybe around a year odd.
So basically, we need to continue to use that medication in order to, maintain the lost weight. It's not that we are using it for 1 year and then we are advising them to stop the medication, because as with any other weight reduction strategy that we use, be it diet, be it physical exercise, once we stop doing or taking that particular care, we tend to regain the weight.
So the weight will come back on once you stop using it.
Yes, definitely.
Okay. So I'll get back to that in just a minute. But this 110 kg person loses 15% of their body weight, comes down to say around, 93 kgs, best case scenario, say even 88 kgs. Then what happens? Do you continue prescribing the drug, and does the dosage of the drug increase?
Yes. So if we need to increase the doses to achieve the target weight, we will keep on increasing the dose to that extent which is, approved by the for the drug, for that particular drug. And on that maximum drug, we will look at the whatever weight the person is losing, and we'll continue that maximum tolerated dose to maintain the lost weight. And with time, the person might keep on losing the weight, and simultaneously the other lifestyle modification will also help for them to continue the weight reduction. See, the most important effect in this, someone who has been on a higher side on the weight and was unable to lose weight for some or the other reason for a very long period of time, once they start seeing the change in their body and they start losing weight, they become so motivated in following up with the diet, regular exercise, that they themselves would like to stop this drug over a period of time and continue the lifestyle modification, which I have seen in many of my patients. That kick for sticking to the lifestyle, that is given by these drugs. So as we call them as a facilitator for weight reduction, not in terms just of by the chemical nature, but because of the result that they are showing to the patients. So it is also quite useful in them.
Okay. But Dr. Mittal, this is not a magic pill. You still need to follow your exercise regime. You need to follow your diet. It's not a pill that you pop and then, the weight just melts off, is it?
Yeah, absolutely. And I think I strongly second what my colleague said. Basically, the fact is that people are frustrated because they've attempted all lifestyle measures and have not succeeded in losing weight, or if they did, it came back. Now, when they see changes in their weight with the medication, they become motivated. And I have many patients like she's describing, where once they get this result of 10 kg weight loss, it motivates them to follow their lifestyle much more intensively and to try that weight. But remember, again, weight loss drugs, Ozempic, Wegovy, Mounjaro, are all part of a program for weight reduction. It's a journey. They are not standalone drugs. You start taking the medication and lose weight, don't do anything else. You will lose weight if you just take the medication. And that's a bit of a risk, because you're just going to lose muscle along with fat, all those things. But if you are exercising regularly, taking the right diet, enough protein, enough fiber, enough hydration, you will get the maximum benefit from these drugs. Plus, you'll be able to reduce the drug dose as you go along, and some of you may even be able to go off it. So the key
But when you go off it, Dr. Mittal, just to interrupt you there, when you go off it, how do you sustain without the drug? Because it's going to be, a little more harder to do the exercise and to maintain the diet, because you had that additional push from the drug, but now you don't.
Absolutely, and that's the real question here with the use of these drugs. There is a certain category of patients, older, diabetics, overweight, where it's clear, like all diabetes medication, this is a lifelong medication. So no discussion. We start insulin injections, you take them lifelong. So similarly, if you're a 55-year, 60-year-old diabetic who's got onto this, very likely you're going to use it lifelong. And we do tell patients that you might need it lifelong. The issue will be about people who are just using it for just weight, and especially younger people. People who are in their 30s or 40s, how can we say it's going to be lifelong? Within those who are not very obese, who fall in borderline BMIs or just at 30, 29 and who worked very hard and brought their BMIs down, we will try and taper gradually. What I'm currently doing is most of my patients who started some time back are now on a maintenance dose or a very low dose of medication. And once they're stable on that dose, not putting on weight, I try and take them off. This I'm talking again of relatively younger patients who are not diabetic. For someone who has diabetes, it's an anti-diabetic drug. So it's pretty fair to use it lifelong.
Okay, what about the factor about side effects? What are the side effects that people need to be aware of? We've spoken about how, or it's publicly noted about, nausea, etc. But I'm going to just drill down on the more serious side effects which have been recorded. For example, there's a recent study which was published by JAMA linking GLP-1 drugs to age-related macular degeneration, and there are eye conditions that it's been linked to. How comfortable are you with that, Dr. Mittal?
So I think that's the single biggest question with these drugs at the moment. Firstly, clinical trials have not shown that. The data that's being presented, and I read the JAMA paper, is basically about large numbers of patients who have age-related macular degeneration or NAION, and they found that within those patients, the number of patients taking GLP-1 drugs was higher. Okay, so the association is not firmly established. There are plenty of studies showing no association. Having said that, we have to be alert about that. We cannot just dismiss it. Any signal should not be taken for granted. So therefore, as a precaution, I am advising eye check to all my patients before initiation of the therapy and once a year. That's the best we can do at present. If at all this effect is found, this side effect, I think it's exceptionally rare, and we really don't know the final answer yet as to whether it's really there or not.
Okay. Well, Dr. Sonali, there's a black box warning for thyroid tumors. How seriously would you take that? It's been found in animals and not in humans in terms of the clinical studies, but we don't have long-term data on that.
Correct. So basically these GLP-1 receptors, they are found in a huge number in the rodent's thyroid gland. Whereas if we compare it with the humans, we don't have the GLP-1 receptors, those many on the human thyroid, and therefore like Sir said, we have been using these drugs from last 20 years, but we could not find a significant increase in the number of this medullary thyroid carcinomas with the use of these medications as of now. Although we do take that in consideration if someone is been on these drugs and comes with the suspicion of that thyroid swelling or tumor. In that case, we might evaluate, and so because it's not seen in the trials in humans yet, there is no even the screening protocol that we should keep on screening the patients for these cancers.
Okay, so as of now, the rewards outweigh the risks, you would say, for thyroid as well as eye conditions?
Yes. Yes.
Okay. What about the muscle loss? Because that's, some people lose as much as 25 to 39% of muscle loss. In any case, Indians eat less protein and don't hit the gym on a regular basis for weight training. Is that a condition that you think about twice?
Yes. Basically, that is the most important factor to be taken into consideration, and that is why we should not just consider this medication as just a magic pill. And as we were discussing, it has to be a part of the a broad spectrum obesity program where we are all ensuring the high protein diet, ensuring the muscle strengthening, the weight training exercises along with these drugs and the lifestyle modifications, so that we can minimize the lost weight. Obviously, as you rightly said, when we are getting the benefits in terms of reduction of the comorbidities along with the weight loss, we are considering this medication irrespective of the lean muscle mass which we are muscle mass loss which we are seeing. But for that, we have to be always proactive in terms of preventing that lean muscle mass.
Okay. Well, I have a couple of viewer queries, and I'll just request you to keep your answers extremely brief for this. Dr. Mittal, about the misuse, the fear is that, people are fearing that their children could misuse the drug as they become teenagers, or that population wants to lose around 5 kgs, take the drug, stop the drug. Do you think that's a key risk, especially with the fact that semaglutide is now going to become generic and is going to be much more easily available?
Well, I would like to look at it positively. I think my patients have more options, and I think that if it becomes cheaper, it has, even greater number of people have access. But you're absolutely right. I agree. The potential for misuse is high, and we really need to regulate the sale of these drugs very tightly. Otherwise, yes, this kind of misuse is very much possible. In fact, I'm getting a lot of requests from people who are just like, a BMI of 24 and they want to be 23, something like that. So we need to be cautious.
Okay, Dr. Sonali, how do we address the larger issue of obesity in India? When your patient comes in, what is the first line of recommendation for you to the patient?
So I always start my consultation with the basic questions about all the lifestyle factors that we take into consideration, right from the diet, the exercise, their sleep hygiene, what time they get up, how long they watch the TVs or they have been working on the screen, and what are the how is the environment at home in terms of domestic environment, the socio-economic environment, and all those things needs to be considered because they are again equally contributing to the weight issue.
Okay, all right, Dr. Mittal as well as Dr. Sonali, thank you very much for joining in and giving us all of this perspective. Dr. Mittal, I do understand that you've written a book on weight loss drugs, so I'm sure that would be helpful as well. But thanks very much for joining in on the Medicine Box and talking to us.
23 years on, was this the right bet to make?
Absolutely. First, I want to start by congratulating you because you chose me as a participant in Young Turks back then, not knowing actually whether our fledgling enterprise and company was going to survive. Here we are, Sula celebrating our 25th anniversary this year. It's been a fantastic ride. I would not have given it up for a million years for anything else.
What's been the hardest part of the journey so far?
We are forever knocking on doors, even in our own country, saying, look, we are Make in India. This is a full 100% Indian farmer grown product. We are so proud of this. Please favor us. So that is something that is non-stop and still goes on today.
Has it gotten any easier? Has it gotten any better doing business in the wine business in India?
Oh yes, come on. I just want to look back at where we were in 2001, 2002. We were able to sell 40,000 bottles in 1 year. This year, 12 million bottles, 300x.
With the FTAs being inked or likely to be inked, the India-EU FTA, the US FTA as and when it happens, UK has been done. And, you know, the alco-bev industry is saying this is bad news. How do you see it?
There's a lot of work that we need to do to gear for that. The market is going to expand. There's no question about it. I do believe that there should be a minimum import price. That's something that we've made our position very clear to the Commerce Ministry, and we are always in discussion. So we do have a seat at the table.
What keeps you going today?
I think that there's probably nobody in India who knows wine as well as I do. I think that's a fair statement to say. And if anybody is going to continue to lead this wine revolution for another few years, that's going to be me.
One of the huge mistakes people make is that they try to force an interest on themselves. You don't choose your passions choose you. Jeff Bezos perhaps speaks for many entrepreneurs, including my guest today. He was first featured on Young Turks 23 years ago to talk about his fledgling startup that he was attempting to do the unthinkable, which was make in India in a heavily regulated sector. 2 decades on, Rajiv Samant is still making in India, now clocking sales of 1 million cases annually. From vineyards in Nasik to a spot on the Lal Street, it's been a journey of passion, perseverance, patience, and some pain too. So grab your favorite beverage and settle down as I talk to the man behind India's largest winemaker. Rajiv, it's great to have you back on Young Turks and good to see you.
Fantastic to see you, Shireen. 23 years later, wow.
And you're still around, and as am I.
We're still around and looking younger than ever.
Well, in your case, yes, I must admit. But, you know, what has the last 23 years been like for you? As I said, when we spoke, when you started Sula, you know, the decision to exit the valley, leave Oracle, move back to India, get into the wine business, you know, 23 years on, was this the right bet to make?
Absolutely. First, I want to start by congratulating you because you chose me as a participant in Young Turks back then, not knowing actually whether our fledgling enterprise and company was going to survive. You know, most companies don't survive beyond the first 3 to 5 years.
Mm-hmm.
And yet here we are, Sula celebrating our 25th anniversary this year. It's been a fantastic ride. I would not have given it up for a million years for anything else.
You know, 25 years on, and today you're a listed entity, Rajiv, and I will talk about the post-listing, you know, approach that you have and how that's changed your mentality to entrepreneurship as well. But as I pointed out, passion, perseverance, patience, but a fair amount of pain as well, right? I mean, let's talk about that. What's been the hardest part of the journey so far?
Absolutely. Look, when you were interviewing me back then, we were actually going through our maximum pain because regulatorily it was such a minefield. But then we got so many of the rules changed to benefit wine in Maharashtra, in Karnataka, and that really helped us. That really helped the wine industry and Sula take off. But in other states, I mean, we have so many blows that we take, you know, in so many states, they favor imported wines over Indian wines. So we are forever knocking on doors, even in our own country, saying, look, we are Make in India. This is a farmer, full 100% Indian farmer grown product. We are so proud of this. Please favor us. So that is something that is non-stop and still goes on today.
And those doors are not opening?
Those doors sometimes open a little bit, sometimes one will open, two will open, one will shut, so it's always constant. A large part of my job is not only running the company, but it's also meeting officials, powers that be, bureaucrats, trying to persuade them that there's this beautiful thing called Indian wine. It's really like a miracle. Come on, support us.
It really is like a miracle, isn't it? I mean, how many licenses do you need to apply for today to be able to sell in a market, for instance?
Oh, wow. When you ask me if I want to sell in India today,
Yeah.
We're talking about 26 different states that we are selling in, each one of them with a painstaking bunch of documents, etc., that you have to redo every single year. It's not automatic renewal. Every single year, you got to go through that label registration, etc., etc. So if you ask me how many documents do I sign in any given year, I would say well over 1,000 signatures from my side.
Okay. 1,000 doesn't seem that absurd though, right?
Okay. Maybe I'm totally underestimating then. So do you sign 1,000 documents in a year?
No, I don't.
There are many other people in our organization who sign many other documents. So mine are just, you can say, the apex documents, and still it comes to that.
So has it gotten any easier? Has it gotten any better doing business in the wine business in India?
Oh, yes. Come on. I just want to look back at where we were in 2001, 2002. We were able to sell 40,000 bottles in 1 year. This year, 12 million bottles, 300x. I look back at, what we expected to achieve back then. We never thought that we were going to reach this place. 1 million cases. Asia's largest wine producer outside China. I mean, this is really something. And today, Indians are drinking wine. Everybody knows what wine is. Everybody knows that wine is very different than spirits. There's a thriving wine market and, wine consumption that's going on that just did not exist back then. So I look back with thinking, wow, what we've achieved, a lot of pride. It's a totally different story. Of course, we have to keep progressing because we are listed. But come on, it's a totally different situation today than
What's
20
changed
years
as far
ago.
as the Indian consumer is concerned? Obviously, there's a greater awareness about wine. There's also more consumptive capacity. People are spending more. Discretionary income has gone up. But what have been the big trends that you've tried to cash in on?
Sure, awareness, sophistication, and also a much broader audience and a much broader base of consumers and consumption. When we first started, we were literally only in Mumbai, Delhi, Bangalore. That's it. Today, we are in probably 100 cities across the country with a decent amount of sale going on in most of those. Of course, wine still continues to be very much metro oriented. So if you look at it, probably metro sales are something like 70% of our sales. But at that time...
And not even all metros. It's very few metros that contribute to a lion's share of those sales.
But back then it was 99%, apart from maybe Goa, which you almost can count. But now it's, it's come down to 70%. It's still very much metro, but you have also tier 1 cities. You have states where we were just not available in at that time, and it's gone to then. And women, if you ask me in one word, today women are totally fine to have a social drink. And at that time, it still wasn't the case.
Well, I guess there are many trends that have changed, but are you worried about the trend that we're seeing now with Gen Z of moving away from spirits, moving away from alcohol? I mean, people are now setting up wellness, bars and so on and so forth. People are meeting at coffee shops and doing rave parties in coffee shops with coffee. Does that concern you that we're seeing a trend away from the spirits business?
A little bit, but not in a huge way. So yes, the trajectory might have changed and might have got dampened a little bit for all alcobev, including wine, including Sula. But the fact of the matter is India is a very different market. We can't take cues from what's happening in the US and in the West and, wholesale import that over here. Because yes, Gen Z is different. But remember, Gen Z in India is drinking a lot more, at least in terms of wine, than millennials, just because of women. In our parents' generation, women did not drink, or, very rarely, very few. Today, that's completely changed. So in the case of wine, it makes a difference. Yes, FY25 has been a little bit tough, but then if you
A
had...
little bit tough, or is that an underestimation of how tough it's been? Because it's been
It's
a
nothing,
flat year, right?
I want to point out that
Yeah.
flat is nothing compared to what happened to us during the economic crisis. That was a 20% reduction in our sales. But then, we had 50% growth before that, 50% growth after that. But, we've had years in the past where we had a 20% dip. I always say, look, if you want to get from this place to that place, it's never a straight line. It's going to go like this. So flat this year after 3 years of breakneck growth, perfectly natural, that's fine. It's a breathing space. And we move forward on our growth path.
How much of this is on account of inventory and stocking? How much of it is because demand has fallen?
It's a bit of both, but definitely the inventory and overstocking did have something to do with it. Coming out of COVID, things just exploded, and definitely you did have some amount of overstocking happening throughout the system, including at consumers' houses. You remember that we for 2 months or 3 months could not buy anything. People were desperate. I was getting calls from people saying, hey, can you send us some wine? I was like, I can't. And so people from having 2 bottles of wine at home and other things suddenly decided to stock 2 cases. Now they've probably come back to 3 or 4 bottles. That has also happened.
So, you were talking about the Gen Z customer. How are you now sort of gearing up to cater to what Gen Z wants, both in terms of the way that they're consuming, but also what they would like to consume?
So Sula, as you know, Shireen, has always been a pioneer. So many of the things we've done, new varietals, for instance, bringing it out for the first time. A wine in a can, that was a big one that we've just done recently, and it's taking off very nicely. We are so proud to be the partners on board Indigo in their new international business class. Our wines in a can were chosen directly by the CEO, and that's doing really well. So lots of things like that. We have a lot of projects going on. I know right now the big trend is lower alcohol, and that's something we are looking at. Most recently, we're launching a still muscat for the first time. Recently, we launched a Pinot Noir. So, in the wine sphere, we're doing a lot. We're giving the consumers what they want. And even in terms of tourism, we always have a pipeline of projects. Tourism, by the way, this year, things are going really well. I'm happy to say on that front. That continues to be a great growth business for us. So, lots and lots of more offerings.
It's interesting that you talk about low alcohol, because I think that this is perhaps a point that the FMCG business is going through as well. The low sugar, no sugar, sort of conversation is impacting the way that people produce their products, what they're launching as well. Do you see that as being a sort of inflection point even as far as your business is concerned? Is it big enough, you think?
Definitely, it needs to come onto our radar now. Definitely. However, having said that, let's remember that wine is still less than 1% of all alcobev consumed in this country. So there's still a lot of runway ahead. What I see as tremendous opportunity, unlimited opportunity ahead to still convert a few more people. If you're talking about moving low alcohol, remember wine itself within the alcobev category is low alcohol. So if you move from a spirit to wine, already you're moving low alcohol. I think there's, for us, far more opportunity there, considering that, 80% of consumption is probably spirits and 15-16% is beer. So moving people from spirits down to wine, I think, is a bigger opportunity than moving people in wine from, say, 12% to 7%. That's the way I look at it.
But is 12 to 7 something that you're considering looking at
Very
this point
much.
in time?
So our still muscat, for example, is going to be at 7%. It's going to be the first real Sula classic, with the iconic Sula Sun. Lower alcohol wine. So those are the kinds of things we're doing all the time. We had launched our Diya range earlier, which is very well known, very successful, and that is already at 8%, and already we sell a lot of it.
You talked about tourism, and that has become a big revenue generator for you. What do you believe is the road ahead as far as wine tourism is concerned? I mean, hospitality has taken off, especially post-COVID, and everyone is reaping the benefits of that, including you. Is that going to be much more of a focus area for you to offset the kind of flattish growth that you've seen this year on the wines business?
tremendous potential. There's no question of it. So we are not going to refocus because we've always been focusing. I have always felt since day one that wine tourism needs to be a big pillar of a successful wine operation anywhere in the world, and especially in India, where we need to put wines in front of people and get them to taste it. So as you know, it's people well aware that we have 4 lakh visitors a year coming to our vineyard. It's the most visited vineyard on earth, and still there's so much more work to be done. So I'm very happy to say, we have a new hotel opening up soon in just a month or two. We have new tasting rooms opening up. So I would say there's limitless opportunity in this sphere.
So how do you see the rise of the experiential economy? I mean, that's what everyone's talking about. Every brand is trying to find ways of creating immersive engagement experiences, outside of tasting rooms, outside of the boutique hotels and so on and so forth. How do you encourage much more of the experiential aspect of Sula? What's the thought on that?
Well, Sula has been way ahead of the curve.
You were actually.
Yeah, we launched our first Sula Fest in, I don't even remember the thing, but more than 15 years ago, or 17 years ago, we had our first Sula Fest. That was a revelation. That was for the first time that a consumer brand in India was holding a big party for thousands of people on their own campus and getting people to taste and experience for the first time right there. So we've still, we brought it back this year in 2025. Huge hit after 5 years of absence, and we have plans for rolling that out even further. But I must say that a tasting room is something special. So when you say people are even going beyond tasting rooms, I think that the experience starts with tasting room. And we have been so successful. We do something like 1 lakh tastings a year just at our campus. So that's the way. If you say, how are you getting people turned on to wine in India? Sula is way ahead of the curve.
So in terms of expanding the tasting room experience geographically, over the next few years, what's the expectation?
Well, I'm very pleased to say that we have a beautiful new tasting room coming up just outside Bangalore. We have our Domain Sula campus there, which has been around for a while. But this is taking it to a totally different level. And we hope to announce the opening.
What's going to be new? What's going to be different?
Well, it's a gorgeous tasting room with a gorgeous view, which we were not able to do so far on an elevated level. Right now, we have a much smaller experience there at Domain Sula outside Bangalore. We're going to be tripling the size, quadrupling the size of the whole property in terms of the tourism part of it, and it's going to be fantastic.
So take me through how.
And there's a vineyard view. So our current small restaurant there doesn't have a vineyard view, but the new tasting room is going to have a vineyard view, something like Sula at Nasik.
So what could this mean in terms of revenue and the potential for revenue growth over the next few years, just on the wine tourism, the tasting rooms and so on and so forth?
So you have to remember that the wine tourism, it gives you a small revenue boost in that year. But what it does do is it allows you to showcase your wines to so many more people. It allows you to have private events there, etc., etc. So you have a knock-on effect. You have a multiplier effect that gives you much more revenue over the years to come, which is a little bit more difficult to quantify. But suddenly, if you have a beautiful, gorgeous, desirable place to visit, to taste wine right where it's made, just, we're talking 2 hours outside Bangalore. So it's fantastic on the Mysore highway. It really opens up so much. So many more people will come there. I expect we could see 50% more footfall happening there than we have now.
The way that you name your wines, of course, Sula comes from your mother's name, but many of the names are deeply personal.
Absolutely. So that's another, remember I was talking about the design and naming is another thing that, I love doing. So yes, Sula is named after my mother, Sulabha. Rasa, some people say it's named after me, Rajiv Samant. The source.
It is, right?
You could say, but Rasa also means the essence, it means the juice. So there's so many other things that it could mean. So it all comes together very well, and we'll just leave it a little bit cloudy. The source, we decided to name our resort at Nasik, the source, because it was the source of all good wine in India. That was the place. And then we decided to name the wine after the source. Beyond, because you really feel like you're going beyond, leaving behind all the stresses, beyond all the stresses of everyday life. That's been a big hit for us as well. So I do enjoy definitely the naming. Madeira, one of our wines, was the name of my freshman dorm at Stanford. So that's how come Madeira. So
When you were at Stanford, did you think that this would be life for you?
I went as a good Indian boy expecting to be an engineer, I must admit, but very quickly realized that I preferred the arts, I preferred literature, and I preferred history quite often to engineering. So at some point, by the end of it, I suddenly realized that I probably wasn't going to be an engineer, even though I joined Oracle right afterwards, but I quickly quit. But never did I imagine in 1,000 years that it was going to be wine.
Except that it is, and that's how it's turned out to be. The sun is shining on Sula and the wine business. How did the logo come about?
So we wanted a very Indian feel to our wines. We wanted to say we are proudly Indian. You had a couple of guys before us producing wine who were very French in their outlook. They had very French sounding names, or their tagline was French vines, French traditions. We said, no, we are not French. We're making wine in India, and let's be proud of it. So the sun is a very proudly Indian sun. And then we were the first to write on our front label, produce of India, big and bold. So that's the way we did it. And we really struck a chord back then. A lot of people said, are you sure? And I said, yes, we're going to do this. And in fact, that's the way it's turned out. Dindori, which is a very famous wine of ours, our Dindori Shiraz is possibly India's #1 premium red, is a taluka of Nasik district. That was something, that Kerry Damsky, our our advisor, Californian advisor, said, why not name it? I must credit him with this. Why not Dindori? And I said, yeah, actually, that has a nice ring to it. So, those kinds of things, we've been very proudly Indian since day one and continue to be.
How much of the journey is serendipity?
There is some in that. I mean, my dad was born in Nasik, right? So this is a big thing. And then when I came back to India, I had no idea I wanted to make wine. And we just went there for a family function. And, we just went out to this small piece of land. I've probably said this in 2001 as well. And, that was a place, grassland, with lots of cobras, leopards, all what have you underneath. And that has become the beautiful piece of land that is Sula today, and has just created the wine revolution.
want to understand from you what it takes to actually be able to conceptualize what you want to take to the market, and then the process of actually getting it commercialized and into the market. What are we talking about in terms of timelines? Where do the ideas come from? How do you kind of refine the tasting experience and so on and so forth before you put it out into the market? What's that process? How's it changed over the years?
It takes a while. From drawing board to actual opening always takes a while. Even if you talk about a new wine that we want to launch, you know, you have to bring the planting material in from abroad. There's a quarantine procedure. Then you put it in the ground. Then it comes up. So you're talking about from the time you decide to the time the consumer gets the first bottle in the market is 5 years.
5 years?
When you talk about a new wine, 5 years. So you can betcha that we have some wines under development. Very exciting that we hope to announce soon. In the case of something like a tasting room, it's probably a little bit shorter than that. So much depends on government permissions. And that is something we always struggle with. We have to go, finally, we have to go and talk to the top boss in the state to say, please, we're doing something great. We're going to boost local employment. We're going to boost local tourism. Here's what we've done in Nasik. Please let us do this. And that normally works. But wow, the permissions, etc. But normally a little less, 2 years, 3 years with something like a tasting room rather than 5 years.
But you know, 5 years and it's capital intensive.
Infinite patience.
Infinite patience. Plenty of wine.
Yeah, and plenty of wine, sure.
But you know, so you've got to make your bets well in advance, right?
Yeah, you do. And that's something that we're very comfortable with. That's something we are masters of, if I may put it like that. And you know, we are optimistic about the growth ahead in this market. So we go ahead and greenlight a number of things that will only come to fruition 2 years, 3 years, 5 years
hence. So
hence.
what's the process? How do you get to that green light? I mean, is there a matrix that you kind of work with? What's the framework?
Well, it's a constant, analysis and R&D. So, for instance, for a new wine, we look at the world's consumption of wine. We see what is the world consuming, what are the 20 top red wines, the 20 top white wines, the 10 top rosés that the world is consuming. What do we have right now? What do we not have? Okay, so which one should we do? That's the one. So it's like this. I mean, it's very straightforward in that way. And there's always opportunities. There's always things that the world is consuming because the world changes. Yeah. And that we don't have here, and that we can be the pioneers in. So that's the way we target.
So what is the world consuming that we don't have here that you're going to be the pioneer, the pioneer in?
You know, I would be revealing too much if I told you that. But then our competitors will sit and then they will try to do it. But no, we have a couple of wines that are already under development. The cuttings are already in. They're coming out of quarantine soon, which we don't have and which the world loves. So we'll reveal it soon.
So how different are the trends in India versus global? I mean, I believe we're still pretty much a red wine country.
We are very much behind in terms of wine, of course, but I have no doubt that we will get closer and closer there. Yes, we are very much in terms of red, but then if you look across at China, China was 75% red. We are probably something like 65% red. But in the rest of the world, red consumption has really gone down. White consumption is going up. Rosé is stable. Rosé has been the growth wine of the last decade, you can say. Rosé and bubbles, Prosecco especially. So yes, India is still very much tending towards red, but I'm quietly confident that Indians will start to gain a palate for white. You know that Sula has always been known for our white wines. We have our beautiful Source brand, which is something you said, you just tasted it. It is a real superstar for us. FY25 strong double-digit growth for our Source brand. And the whites that are coming out of the Source, the Reserve Chenin Blanc, the Reserve Sauvignon Blanc, I think more and more Indians are going to get turned on to these wines. So, you know, it goes up and down. But yes, India has been mostly red.
You know, and again, we look at the bottles and we drink the wine, but I don't think anyone grapples with what it takes to put the wine into the bottle. And I want to go back to
that's why we are here.
To what's happening in the vineyards and how much of that experience has changed over the last 25 years, Rajiv, for you. You know,
it's night and day. It's really? Night and day. We didn't know what we were doing 25 years ago. And 25 years ago, I had to plant all the vineyards myself. And to show the farmers that this thing actually works, because nobody was willing to believe. And, you know, for a farmer, it's a 15-year commitment. So we had to do the first initial vineyards ourselves. And we didn't even know the concept of rootstock and things like that, which is so common now. Today, we are much more sophisticated, and yet we still have a long way to go. But, you know, I'm very happy to say our farmers, our grape growers, they are sophisticated people, and they pick it up really quickly. So we are always in discussion, always
How
deciding.
large is the Sula farming community today?
So we ourselves are dealing with something like 600, 700 farmers. That's farmers, not farming families. There's the entire farming families, etc., etc. We only do about 5% of the grapes ourselves as Sula that go into our wines. 95% is other farmers. And, that number is constantly growing. And so we're very happy that we're sharing it with all these farmers.
I was having a discussion yesterday, and this takes me back to a conversation that I was having with Ajay Banga, the chief of the World Bank, and he said, you need to ensure that agriculture becomes cool for the next generation of farmers to want to take it up. In your experience of working with farmers across vineyards in Nasik, now in Karnataka as well, how do you make agriculture cool?
Wow, that's an interesting twist. Well, I would say that there's already so many entrepreneurs trying to do things. However, there are a lot of factors that come in the way. So in India, ownership of agricultural land itself is so controlled. In Maharashtra state, a non-agriculturist can't just go out there and buy agricultural land. You got to take permission from the state. And you have to be an agriculturist, which means, probably your great-grandfather had to have a farm, and that's the only way you can have a farm. So there are a lot of things that come in the way. States are starting to get more savvy on it, but it's not easy. So first you have to have a farm in the family, or you have to have agricultural land in the family. Then you have to have the passion. But I do feel that wine grapes is a bit cooler than so many other things. So in terms of the next gen of farming families, of grape growing families, definitely wine is something that's seen as cooler anyway.
Yeah, that I would imagine you have the advantage there. But how much has changed?
Even though most of our farmers don't drink. So they never even taste the final product. So we have to tell them.
It's like chefs don't eat their own food, I guess.
Do they not?
I believe so. I don't know.
Looking at them, I would think many of them do probably.
But, how much has changed on account of the use of technology? How much of technology are you using now as far as the farming process is concerned?
Well, there's a lot that's happening today. So many of our farmers are using drones. So for instance, if you have a slightly larger piece of land, rather than seeing yourself, trying to go on foot to see which patches are doing well and which are not doing so well, one drone round and one drone shot, and you can see, where it's a little bit more brown, where it's more green, and then do the note full. Things like we've just introduced our first electric tractor. We are so excited about this because that we are a sustainability behemoth. We do 3 megawatts of our own installed solar PV capacity at our farm. So we have, unlimited power, solar, clean energy during the daytime. So we want to move all our tractors from sort of diesel guzzling tractors to electric tractors. So that's something that we're so excited about. And there's a lot of other stuff that goes on. But I mean, I would not say that it's, everything is digital and it's like sort of Homo Deus type situation. But definitely
no AI yet
going on. But I'm sure it's just around the corner because the kinds of emails we get all the time talking about drone technology, AI, this, that, it's exciting.
Well, what else is exciting now in terms of the trends that you're seeing globally as well as the trends that you're starting to see here in India, some of which you just spoke of. But what's exciting you? You said, the headroom for growth is significant because of the underpenetration. But what's exciting you truly about what you're seeing today? Give me a pulse check.
See, my life at Sula excites me every day. I'm so passionate about it. This has been my baby. I started doing this when there was nobody in this. So every day there's something that's exciting us, whether we're talking about the new varietal. I mean, for me, the first taste, I still remember the first taste of our first wine, which was our Sula Sauvignon Blanc, way back in 2000, and we knew we had done something special. It was like no other wine that had been produced in India until then. So the first taste of a new wine, it's like a new baby, sitting and doing, I love doing design. So that's a total, so this engages left brain, right brain. So in terms of the packaging, etc., that really turns me on. So how do we want to do something new? We have this muscat wine, what kind of bottle you want, what should it say on the label, what should the back label say, etc., etc. I think strategy, that always turns me on. And then design, etc. So there's so many things day to day.
So you're a design geek?
I am. Nothing moves out of our thing without first me signing off on the design.
One of the 1,000 signatures.
Yeah, no, that's not included. That's
not included.
Yeah.
That's separate.
Those are internals.
But you know, one of the big changes that we're potentially going to see in the Indian spirits market, in the wine market as well, is going to be foreign competition. Now with the FTAs being inked or likely to be inked, the India-EU FTA, the US FTA as and when it happens, UK has been done. And, you know, the Alco-Bev industry is saying this is bad news. How do you see it?
It's happening. And it's something that we have been gearing up for the longest time. We've always known, and we've been told by Commerce Ministry officials that, look, what we have here is not going to last forever. Gear up, be ready. And now it's here. So there's a lot of work that we need to do to gear for that. The market is going to expand. There's no question about it. I do believe that there should be a minimum import price. That's something that we've made our position very clear to the Commerce Ministry, and we are always in discussion. So we do have a seat at the table, I must say that. They're very aware of the fact that this is one of those few very farmer-friendly industries that's actually doing well. But yes, it is coming. There are going to be cheaper imported wines available. We also have to see whether we also want to play more in that business.
Yeah, I was going to ask you
that. But
you
know, our wines have to speak for themselves. They have to speak for Nasik. They have to be of quality and of the price that appeals to the consumer. At the end of the day, you can't get away from that. And I do believe we're in a far stronger position today than where we were 10 years ago. We are ready to compete.
So, you know, you said you're ready to compete. What's the strategy going to be as and when we do see the changes take place? Because a lot of these FTAs are still work in progress outside of the UK. But, you know, what is the strategy going to be? And going global, you know, we're talking about people entering India. What about Indian wines going global?
So Indian wines going global, that's going to be a little bit of a tougher proposition.
Why?
I think that Indian spirits probably have you know, they have such a long history. Indian wines are a little bit new, you know, competing with French. Let's talk about in India. You know, we have maybe a 6-month window in which we got to get our wines onto every single list. Once your wine is on a list, it's much harder to get it off. But if it's not on the list in the first place, then when you have your imports coming on, those wines are going to probably come on there. So get on.
You're really factoring in just a 6-month window?
Absolutely. Absolutely. We should not.
That's not a very long window.
It's not a very long window at all. So we are just working double right now to make sure that putting our wines in front of more people, boosting our tastings and experiences, getting on every wine list, boosting availability. That's what we're after right now.
So, you know,
those are the kinds of sort of nuts and bolts things that you got to do. And of course, quality has to speak for itself. Now you have a few different kinds of consumers. You have consumers for whom they always go for imported and foreign. But you have enough consumers also who are looking for something good that's produced in India, and they can say with pride, this, what I'm buying here from India, is easily as good as what I'm going to get from imported at the same price point. So we're going to appeal to them.
But, you know, and the price point is critical, isn't it? I mean, how do you go beyond playing just the price?
I think it has to be the quality price. So it's the value equation, not just the price point. What quality are you offering at a certain price? You have to be competitive. If your quality is, you know, if your price is whatever, low or high, but the quality is not in sync with what the market is looking for, you're out of business. So you got to try to improve your quality while keeping your prices in check. And I'm happy to say that we have always increased prices less than the rate of inflation. That's been our history since the day that we started, and even over the last couple of years. But the quality keeps getting better and better. Sula is winning awards all over the globe. That also shows that. So, you know, I think today we have a very compelling value proposition in our wines.
You know, going back to the India-EU FTA, and what is the ask, if anything, outside of do a minimum import price of the government, considering the fact that, you know, whether it's the EU or other countries, subsidies are fairly high, even in this sector. You know, is there a wish list that you've given the government?
See, we make it very clear, EU and UK are quite different. The UK doesn't give that much subsidy, for instance, to their spirits companies. The EU, on the other hand, for them, wine and vineyards is so important. They give something like 1 billion euros a year. in support in one way or the other.
1 billion euros a year.
1 billion euros a year under their common agriculture policy, the EU CAP, to their wine and vineyards. I mean, that's huge. How are we supposed to compete? We get a smidgen, maybe our wine industry gets €500,000 a year from the center. What we have had until now is tariffs. So we always point out that there's a big difference between spirits from the UK and wine from the EU. How are we supposed to compete when wines come in at €0.50 a bottle, which can happen? But I do believe that the Commerce Ministry is very cognizant of this. And so, let's see.
One will have to see. We can't preempt these things. But
we cannot. And we're a very small cog in the scheme of things, a very small cog. When you're talking about our textile industry and pharma and IT and, our workers, their visas and things like that, wine is tiny. So, however, the thing is, we are incredibly farmer friendly. 100% of what we produce as an industry comes from grapes grown in India.
I now want to turn to live post listing. And it wasn't like you were rushing to Dalal Street. You would have ideally not have liked to go public?
I won't put it like that, but we were not the ones who pushed to going public. We have had always since 2003, we've had private equity ownership. And at sometimes our private equity shareholders, our largest shareholders at that time, they had been on board for 14 years. Shireen, when they joined, they said, we're going to be long-term. We'll be on board for at least 5 years. Now, 14 years later, they said, Rajiv, time has come. So I said, okay, let's do it. So, of course, life as a listed company is very difficult. You're very much under the gun. You're very much under scrutiny. And you got to deliver quarterly results. Yes. And wine, as I just told you, some of our projects, it's 5 years to fruition. So it's not the easiest. But we are ready to face the challenge. And we are aware of the fact that, hey, you got to be on the ball. You got to look at every facet of what you're doing, and you got to get growth everywhere. So everybody here in the company today has a growth mandate, and it has to come sooner rather than later. So yes, it's a total change in focus. We got to wake up, can't sleep anymore. So here we are.
It's keeping you on your toes is what I can tell.
See, don't I look fit?
Yeah, super fit. You're getting all your steps
run
in.
a listed race every single day and a glass of wine in the evening.
And a glass of wine in the evening. But, to watch the stock ticker and from where you listed to where you find yourself today, it's a significant difference. You've seen a big cut as far as your stock price is concerned. Does that mean more wine? Drinking more wine.
Well, actually, I got to say myself that I've been cutting back a little bit on the wine consumption. Don't get high on your own supply, as they say. But, look, stock price goes this way, that way. You can't control it. What you have to make sure is that you have your plans, you have your strategies ready to deliver. Maybe some of your projects are going to take 2 years, 3 years, but you still got to get down to it and do it today. And then, hopefully things take care of themselves.
What was it like while you were doing the road shows and so on and so forth? I mean, what was the number one question that you were asked?
How are you going to get Indians to drink more wine? It's incumbent upon you as the largest producer. You're going to have to do this. And that's a tough ask. So we are first and foremost, we're trying to do our business, which, in the Indian environment.
But you're also seeding the market, which is what category creators need to do.
We are. So that falls upon us. And that was one of the biggest things, how are you going to get to move people away from spirits? Why has wine lagged? Then you had, does wine go with Indian food? I said, absolutely, it goes with Indian food. We had a colonial heritage that favored spirits. I remind everyone, those places which were French colonies, they prefer wine. The per capita wine consumption of those places is far higher. So it's very interesting when you start looking at it. You can't say, oh, does it come down to food or this? There are historical reasons which we are now trying to break through. We have to remember one thing, that whenever a country is a wine producer, wine consumption always and inevitably increases.
So you believe that that catch-up will happen now that we are producing and, of course, also consuming more?
Absolutely.
What is the growth trajectory then? I mean, what is the expectation? I'm not asking you for the next quarter or two, but what do you expect given incomes, disposable incomes going up, again, more awareness coming in and so on and so forth? What are you betting on at this point in time?
Look, that's a tough one. I don't want to, put my neck out here, but definitely, if you're not getting decent growth every year, I would say up to 10%, probably higher than that is going to be difficult at this point because there are a lot of factors, a lot of state regulatory issues. But that kind of CAGR is something that we would be disappointed if that's not the way that it's happening.
So 10% could be the expected run rate?
For the market, especially with imports coming in, etc.
Okay. So what does that mean then in terms of how you manage and run the ship? I mean, is there more that you can do to take costs out, run a more efficient ship?
Absolutely. So I think this year is a year that, we're looking to, the bottom line is most probably going to grow faster than top line. That's the way it is. There's a lot of work
That's a conscious decision.
It just shows how much work we're doing on the bottom. Top line is there certain limiting factors sometimes. You're still not out of urban slowdown completely yet. I think everybody agrees with that you still got a couple months to go. That's definitely impacted us fairly hard. Though we have a good comparative right now over elections last year, etc. There are some good comparatives. But in terms of bottom line, there's nitty-gritty work that you can do internally. I'm very happy to say that there's a lot of projects that are going to start showing and paying off soon.
What's been the most recent challenge that you had to deal with?
Well, I mean, the FTA is rolling out at a record rate, and it seems like people are competing and the government competing with each other on who can sign the FTA fastest. So, we are in there, but, fingers crossed. Without their states, some of the southern states, really we are seen as almost, you would say sometimes, worse than imported wines and spirits. And that's something that's sad.
Why is that the case, though?
I can't answer that. And it's grueling. You got to go, you got to do the meetings, and you find that for this reason, for that reason, you got to just keep on and on pushing away at it.
So, which means having a very thick skin and leaving your ego outside the door.
Absolutely. So in Chennai, for example, you can barely get our wines. Or if you get it, it's 50% more expensive than in any other place. So, it's difficult. It's sad because I do believe that Tamil Nadu is a very natural state in terms of wine consumption, etc. But that's one of the states where we are struggling, for example.
So which state is continuing to drive sales for you? I believe Telangana is sort of
Telangana has come up,
but has had its own challenges in terms of the ability
payments,
to pay. Yeah,
absolutely. So there we go. So you have this state that is doing so well for us. So Hyderabad is probably becoming the per capita wine consumption leader in India.
Really?
Yeah.
And why do you think that's the case?
I really haven't gotten into it to figure it out, but I do know that our Sula Shiraz Cabernet is huge. It sells more than the rest of the industry combined. That's India's #1 selling wine, by the way. But in Hyderabad, it's a superstar. But then, yes, there have been challenges on the payment front. So here you have your sales taking off, but your payments lagging. But I must say, to their credit, they are trying. And, I must say that outstandings have come down. So we are happy with the progress.
What's been the big surprise for you in terms of a market that you weren't expecting to deliver, like Hyderabad, that has delivered or is starting
Hyderabad
to deliver?
has definitely been the outlier. UP has been very interesting. And there's a couple states who we do believe are about to finalize, wine progressive policies, which will encourage people to set up wineries in state. So we are waiting.
Which states
eagerly.
would these be?
We'll have to see when that comes, though they do come to us as, advisors on that quite often. So really fingers crossed that we should be able to announce, going to a third state in the not so distant future.
Okay. That would mean within a year, less than a year, not so distant?
Not in our hands.
It depends on how quickly they sign.
If the policy comes out, within a couple months, we would probably be ready to make an announcement.
What keeps you going today? I mean, it's a tough business as we've discussed, but what keeps you going?
Well, it's my baby, right? So ups and downs and like great years and not so good years, etc. You got to take them all with it, and you just got to keep plugging away. I would not. I mean, what am I supposed like retire or something? There's no question of it. So
no,
I'm gonna no. That's not on the agenda right now. Sorry to say if anyone is expecting it, but no. I'm very happy, very much firmly in the saddle, and happy to be leading this. I think that there's probably nobody in India who knows wine as well as I do. I think that's a fair statement to say. And if anybody is going to continue to lead this wine revolution for another few years, that's going to be me.
Well, you clearly have made that unequivocally clear right here on the Young Turks.
There we go.
On the Young Turks podcast. Well, we hope you continue to lead the revolution, and with every sip, may the story continue to grow. But thanks very much for joining us again. 20 years on, it's been an absolute pleasure to revisit the story with you and to talk about the future as well, Rajiv.
Thanks, Shireen, and thanks for sticking with us.
Well, it's great to always have the Young Turks community back on the program. But for now, from all of us here on the Young Turks podcast, thanks very much for watching. If you enjoyed the conversation, then stay tuned for plenty more. From all of us here on the CNBC TV18 team, goodbye and many thanks for watching.
Welcome to a State Bank of India special as the Grand Old Bank celebrates its 70th birthday today. SBI is, of course, mini Indian economy, accounting for 20% of the country's bank credit, 22% of the country's bank deposits. 55 years ago, SBI was born when the Imperial Bank was converted into State Bank of India under the SBI Act. Since then, its deposits have grown, hold your breath, 25,500 times. Its profits in the latest year at 77,561 crores was 52,000 times what it was in 1955. When the nation is in trouble, it looks to SBI. At the height of the balance of payments crisis in 1991, SBI raised $1.6 billion through the India Development Bonds, and it repeated this feat again after a decade during the Pokhran nuclear test in 1998 when India faced sanctions. SBI personnel go on to head many other banks, Yes Bank included, and also staff the RBI and the SBI. You know, there is a deputy governor over there. Most important, SBI has changed with the times. In its 50th year, the bank gave its younger competitor HDFC solid competition in home loans and actually won that competition. Today, with its YONO, it is competing with even fintechs. And on that celebratory note, may I welcome the birthday boy of the day, SBI Chairman, Mr. Challa Srinivasulu Sethi. Mr. Sethi, thank you very much for dropping into our studio on what must be a big day back home at SBI.
Thank you, Lata. It's a great moment for all of us. And I wanted to be in your studio to celebrate this occasion.
We are honored. We are honored.
And, I think the journey of SBI is also synonymous with the journey of India. I think to that extent, it's a great moment to celebrate.
Absolutely, sir.
Thank you.
Actually, when SBI comes, one looks at the future. And so will our viewers. So just give us an idea. What are the immediate targets you have set the bank?
I don't call them targets, but we believe that if you have seen the journey of SBI, it always reimagined its role and stayed relevant.
Yes.
So we believe in SBI that going forward, while we have seen a lot of disruptions in the last 70 years, the disruptions will be much more frequent and much more deeper. So how do you handle these disruptions coming in, particularly in terms of your business models, in terms of the service delivery, in terms of customer protection? I think we all want to focus making SBI ready for another maybe 200 years. Okay. This is what. So the center to this plan is our digital transformation journey. While we have, as you mentioned, the scale and we have the trust of the people, but the scale and trust alone will not make you the best and most preferred bank.
Yes.
So we would like to assure our customers and stakeholders that our investment in technology, digitalization will continue so that the customer engagement with us, which will be much more seamless.
Okay. Well, actually, would you say that in the journey in the 75 years, the government and the regulators' attitude to SBI and state-owned banks has changed? I mean, first, PSU banks after nationalization were part of the fisc. There was financial repression. But in 1991, you all were listed. SBI was listed first. And after that, more recently, I mean, the CRR cut, there is no big danger in front of the country. Still, the CRR cut is given so that I think banks have a fair chance against mutual funds. Would you say the attitude is changing to give you all a fair chance?
See, the public sector banks are having a dominant market share.
Yes.
Some of them would have lost the market share, but I think they're all trying to...
Collectively, 60%.
Collectively, we are the dominant players in the industry, which means that any initiative, either by the government of India or by the regulator, cannot be meaningfully taken to the economy and the general public unless there is a wider participation of the public sector banks. I don't think there is any shift in the attitude. But one thing I can definitely tell you that maybe for the last 2-3 decades, or definitely in the current decade, is that we are getting a absolutely commercial banking approach within the public sector banks, and what I call ownership neutral approach towards serving the customers, and that is getting reflected. Obviously, the CRR cut is not meant for only.
You're getting a level playing field.
Absolutely.
Okay.
Absolutely.
That has been the tone of the Reserve Bank, but I think the banking sector, that is public sector and private sector, have got a better deal this year with liquidity being thrown in and the CRR cut. How are you looking at this combo affecting your credit growth? I believe the finance minister also met you all. Do you think this year the credit growth will be much better? Last year, I think we are finishing at 9-10%, FY25. What is your sense of this?
Since our silent period started now, I can't...
I'm asking you about the sector.
We can't talk only about SBI, but I think in general, what are the preconditions for any economic growth? I think those things are being ensured fairly well in terms of ensuring that the system liquidity is adequate, and as you mentioned, CRR cut will add further liquidity to the system. Apart from the benefit of protecting the margins, which cost of funds are reduced. The other thing is that the upfronting the rate cut. These are all indications, signaling obviously is towards ensuring that the growth is on the higher pedal. I think this is
higher priority.
Higher priority, and the Government of India's initiative of putting some extra money in the hands of the people to encourage the consumption by reducing the rate of taxation.
You give me numbers for the banking sector, sir. I know I don't want to corner you on your silent period issue.
The banks will definitely come back to the credit growth.
So you think we could do 13, 14? I don't know how well you remember the 2002 to 2004 period. Reserve Bank had cut rates from 15 to 8%. After the Pokhran, we had to raise our rates, and then Asian crisis, we brought it down dramatically. But credit growth didn't pick up for another 2 years. It remained at 10%. And then only in 2005, we see this 25% jump in credit. When it slows, takes time to grow.
Absolutely.
But now do you think it can be faster?
I think it is stage is set in my view, maybe a couple of quarters from here. One is the corporate credit has been a challenge for the last few quarters. It is mainly because they're all sitting on a
retained profit,
reasonable cash availability to them. And I believe that a lot of brownfield expansion, which is undertaken by them, is being taken by their own cash. And that is also getting reflected. If you see the SME growth, we are all witnessing good growth in SME, which means that SMEs are basically B2B businesses, right? If the corporates are not giving the orders, they're not going to perform better. So which shows that the corporates are spending and also giving the orders to SMEs. But the next inflection point for the capital expenditure would have to come. One is most of them are operating at 75 to 76% capacity utilization. And a sustained consumer sentiment and consumption growth. It is not that it's not there, but I think people would like to see the sustained level of that.
You're saying that capex has not picked up, but it is looking all set to pick up.
All set to.
Okay. What's your sense about margins? Again, for the sector, I'm not cornering you, because you're going to get this. The rate cut will take away your margins, but the CRR cut will give you back margins, and it comes with a multiplier. Yeah. Every subsequent deposit will give you some gain. So will you come back to your FY25 margins in 4 quarters, 6, or for the banking sector? Does it take 4, 6 quarters to come back?
Most of the banks have indicated that it will be a kind of U curve for the NIMs that you will have. I mean, there is no rocket science in that. There's a lag of deposits getting repriced, whereas...
How much? Is it 2 quarters lag, 4 quarters?
No, I think we'll have to look at Q4 end state.
Okay.
And most of us probably would be sticking to our margins at the Q4 end state. That is what I can tell you now.
I wanted to come to the SBI history itself. As you cast back 70 years, I guess you would have been at least for 1/3 of that.
More than that.
Yeah, more than that. Okay, 35.
37.
Half the history you have seen. Any one memory or any few things that absolutely stand out?
If I have to, of course, there are many things.
Yes.
SBI, there's no dull moment in SBI that I keep telling that. But if two things which we have to see from an institutional perspective, not from individual perspective, I think the liberalization has completely given a new paradigm for SBI. See, till that time, you're a dominant player. We still are a dominant player.
The deposit and lending rates were set by RBI.
Absolutely. And then you have new age players. Post-liberalization, you have new private
bank licenses.
And many things which have happened. My view, I think the watershed moment for banking as a whole and SBI in particular has been the post-90s.
Okay.
It has given both opportunities and risks. Risks of, we have completely had to remodel our risk management. That the global risk and your own internal economical risk, which needed to be relooked at, while the opportunities were aplenty.
Okay.
So I think that is one. And the second important element, I think, for the country, globally, I think, unprecedented COVID. Was another thing what we really learned many things. It was an extreme business continuity process ensuring, right? You can't have a better testing of your BCB preparedness.
That's right.
I'm very proud that SBI has come out extremely well in terms of our commitment to customers.
Oh yes, not just that. Look at the quality of the balance sheet. In spite of going through a period when people could not go to work.
Absolutely.
I guess you have a historic low in terms of net NPAs now, 0.5% or less than that.
Less than
that. That's quite a record. But since you say 1991, you all got listed in 1990, right? Now, will you use this 70th year to mark some listings? You already have 2 babies listed. Will more come?
No, the babies will, I think, have to still grow up. It will take some time.
Okay. The market is kind. You're not likely to use
not it.
All-time highs, very close. And what about SBI itself? You're not looking to use the market's good
we
mood?
We did take the enabling resolution for QIP
that is why I'm
of 25,000 crores. I think while the timing is not decided, we have time up to March 26 to launch this QIP.
Okay. So again, let me ask you to cast your mind back. What would you say were the most challenging moments for SBI? When did you all spend sleepless nights?
So, I don't think we spent sleepless nights because of, I think, crisis management inherent to us. Yes, I do agree. COVID was difficult, not because of any business environment. We had to protect the customers who are visiting our branches and, more importantly, protect our staff. I think if you really ask me from a management perspective, that was the most traumatic period which we all have gone through.
Okay.
And probably none of us have taken a day off, except when we ourselves got infected by COVID. Yeah.
Okay. What do you see as the advantages going forward because of digitalization? SBI had to bear the cost of putting a branch in a boat house in Kashmir, in a probably an island off the coast of Kochi, or up in the peaks at Kargil. You have, I think in Natula you have a branch. So you'll have had to put these distant branches. Do you think branch costs will come down now because you can reach people digitally? Do you think sizes of branches will come down?
No, first of all, I don't think SBI ever looked at this obligation as a burden.
No, didn't.
That also had helped us to have the reach, which is helping us to be a dominant player in deposits. First, that is what I wanted to say. But more importantly, 2 things what we are trying to do is, one is, of course, digitalization is going to help in reducing the costs and turnaround time.
Okay.
Today, we launched one business rule engine data-based SME lending platform.
Okay.
You would be surprised that approval is given in 40 minutes using the data. 40 minutes, which means that my operating people who are processing these loans can process more. So at the branch level, we have simplified the whole customer account opening journey. I keep saying that we open around 60,000 accounts every day. So when you're opening such large number, you have to cut down on our turnaround time. We used to take 3 to 4 hours to open the account, but on average it is now we are able to do it in 15 to 30 minutes.
Okay.
That means you can do more and you liberate your people to do various other activities. But what we are focusing is that how do you simplify the whole internal processes so that the customers can be served better. A lot of customer journeys have been reimagined. Today you can do the fund transfer in 3 seconds, 4 seconds.
Yes.
But why is that at the branch level there are cumbersome processes? We want to completely reimagine the internal processes so that our, we call a project called Operational Process Engineering, which will completely simplify the high volume business process.
Okay. But in that case, will you go down the path of unsecured loans since you are so confident of your digital data? Actually, the unsecured loans going bad, even in last year, when Reserve Bank blew the whistle, came as a surprise because we thought loans are being given by the entire banking sector on the basis of good digital data. Do you see now a chance of Reserve Bank lowering risk weights or banks themselves making more money on unsecured loans in the coming quarters?
No, I think the personal unsecured personal loans ecosystem looks better now, obviously. I don't think the risk weights will be reduced because it is only reinstated what was earlier the pre-COVID. But what do we see in the system is that the less delinquencies in the personal segment.
Okay.
I believe the system level, personal level loan growth will come back. Okay. It may not be 25-30% what we witnessed, but I think it will be a double-digit growth rate. But in our case, let me also tell your audience and you, is that we are the largest personal loan provider in the country. With
in volume,
you never said. So, which means that our data-based appraisal system has held on very well. And we have the lowest default rate in the personal loans.
Personal loans? Okay, that's good to hear. At the moment, what is the biggest loan growing category? I mean, what would you bet? Your guidance was 13% loan growth. So, which would be the winning horses?
See, in our case, the growth comes from all segments. Okay. That's an advantage for SBI. We have several swim lanes. I keep saying that if one swim lane is not moving faster, we will go to another one. But I think it will be a broad-based credit growth. But for the system, I think home loans will continue to play an important role.
Okay. Despite the fact that we hear real estate is speaking of, despite
in some markets maybe, but I think overall nationwide, I think the home loan segment.
Real estate could be peaking off even because of commercial buildings.
Yes. So. And also because of the luxury segment, I think there will be more focus on the middle level segment and also affordable segment.
Affordable segment. Okay. What's your going ahead? What do you see as the big challenge for SBI?
I did mention in terms of the challenges that how do you stay relevant?
Okay.
And when you are operating at scale, how do you manage your risk? I think this is very important. A lot of people keep asking is that, your profitability ratios are low and all. We have the largest number of people who are engaged in the risk and compliance management.
Okay.
When you have a scale of, for example, as on 31st March, we were 96 lakh crore business was managed by us, both advances and deposits together. And 23,000 branches, 235,000 employees, which means that your aggregate risk can go out of hand if you do not have very robust risk management practices.
Fair point, sir. Fair point. What is your sense of, have you given your team a target for cost to income? Analysts will repeatedly tell you that your cost to income is higher than other banks.
So the effort is to reduce and moderate that. But as I mentioned, I think there's only so much we can reduce on the cost to income ratio because we have one of the most compliant organizations in the country, which means that we've spent a lot of resources on the risk and compliance management. But broadly, I think we would like to maintain at the level what we had in 31st March.
Okay. Well, that's a pleasure, sir. Thank you very much indeed for coming to our studios to celebrate your birthday. And please take back a message from all of us, wishing every SBIite very many happy returns and many, many more years of fruitful service to the country. Thank you very much.
Thank you, Lata, for having me here. Thank you.
Well, that's it on this very special edition of Indianomics. Thanks for watching. Welcome to a State Bank of India special as the Grand Old Bank celebrates its 70th birthday today. SBI is, of course, mini Indian economy, accounting for 20% of the country's bank credit, 22% of the country's bank deposits. 55 years ago, SBI was born when the Imperial Bank was converted into State Bank of India under the SBI Act. Since then, its deposits have grown, hold your breath, 25,500 times. Its profits in the latest year at 77,561 crores was 52,000 times what it was in 1955. When the nation is in trouble, it looks to SBI. At the height of the balance of payments crisis in 1991, SBI raised $1.6 billion through the India Development Bonds, and it repeated this feat again after a decade during the Pokhran nuclear test in 1998 when India faced sanctions. SBI personnel go on to head many other banks, Yes Bank included, and also staff the RBI and the SBI. You know, there is a deputy governor over there. Most important, SBI has changed with the times. In its 50th year, the bank gave its younger competitor HDFC solid competition in home loans and actually won that competition. Today, with its YONO, it is competing with even fintechs. And on that celebratory note, may I welcome the birthday boy of the day, SBI Chairman, Mr. Challa Srinivasulu Sethi. Mr. Sethi, thank you very much for dropping into our studio on what must be a big day back home at SBI.
Thank you, Lata. It's a great moment for all of us. And I wanted to be in your studio to celebrate this occasion.
We are honored. We are honored.
And, I think the journey of SBI is also synonymous with the journey of India. I think to that extent, it's a great moment to celebrate.
Absolutely, sir.
Thank you.
Actually, when SBI comes, one looks at the future. And so will our viewers. So just give us an idea. What are the immediate targets you have set the bank?
I don't call them targets, but we believe that if you have seen the journey of SBI, it always reimagined its role and stayed relevant.
Yes.
So we believe in SBI that going forward, while we have seen a lot of disruptions in the last 70 years, the disruptions will be much more frequent and much more deeper. So how do you handle these disruptions coming in, particularly in terms of your business models, in terms of the service delivery, in terms of customer protection? I think we all want to focus making SBI ready for another maybe 200 years. Okay. This is what. So the center to this plan is our digital transformation journey. While we have, as you mentioned, the scale and we have the trust of the people, but the scale and trust alone will not make you the best and most preferred bank.
Yes.
So we would like to assure our customers and stakeholders that our investment in technology, digitalization will continue so that the customer engagement with us, which will be much more seamless.
Okay. Well, actually, would you say that in the journey in the 75 years, the government and the regulators' attitude to SBI and state-owned banks has changed? I mean, first, PSU banks after nationalization were part of the fisc. There was financial repression. But in 1991, you all were listed. SBI was listed first. And after that, more recently, I mean, the CRR cut, there is no big danger in front of the country. Still, the CRR cut is given so that I think banks have a fair chance against mutual funds. Would you say the attitude is changing to give you all a fair chance?
See, the public sector banks are having a dominant market share.
Yes.
Some of them would have lost the market share, but I think they're all trying to...
Collectively, 60%.
Collectively, we are the dominant players in the industry, which means that any initiative, either by the government of India or by the regulator, cannot be meaningfully taken to the economy and the general public unless there is a wider participation of the public sector banks. I don't think there is any shift in the attitude. But one thing I can definitely tell you that maybe for the last 2-3 decades, or definitely in the current decade, is that we are getting a absolutely commercial banking approach within the public sector banks, and what I call ownership neutral approach towards serving the customers, and that is getting reflected. Obviously, the CRR cut is not meant for only.
You're getting a level playing field.
Absolutely.
Okay.
Absolutely.
That has been the tone of the Reserve Bank, but I think the banking sector, that is public sector and private sector, have got a better deal this year with liquidity being thrown in and the CRR cut. How are you looking at this combo affecting your credit growth? I believe the finance minister also met you all. Do you think this year the credit growth will be much better? Last year, I think we are finishing at 9-10%, FY25. What is your sense of this?
Since our silent period started now, I can't...
I'm asking you about the sector.
We can't talk only about SBI, but I think in general, what are the preconditions for any economic growth? I think those things are being ensured fairly well in terms of ensuring that the system liquidity is adequate, and as you mentioned, CRR cut will add further liquidity to the system. Apart from the benefit of protecting the margins, which cost of funds are reduced. The other thing is that the upfronting the rate cut. These are all indications, signaling obviously is towards ensuring that the growth is on the higher pedal. I think this is
higher priority.
Higher priority, and the Government of India's initiative of putting some extra money in the hands of the people to encourage the consumption by reducing the rate of taxation.
You give me numbers for the banking sector, sir. I know I can. I don't want to corner you on your silent period issue.
The banks will definitely come back to the credit growth.
So you think we could do 13, 14? I don't know how well you remember the 2002 to 2004 period. Reserve Bank had cut rates from 15 to 8%. After the Pokhran, we had to raise our rates, and then Asian crisis, we brought it down dramatically. But credit growth didn't pick up for another 2 years. It remained at 10%. And then only in 2005, we see this 25% jump in credit. When it slows, takes time to grow.
Absolutely.
But now do you think it can be faster?
I think it is. Stage is set in my view, maybe a couple of quarters from here. One is the corporate credit has been a challenge for the last few quarters. It is mainly because they're all sitting on a
retained profit,
reasonable cash flow, cash availability to them. And I believe that a lot of brownfield expansion, which is undertaken by them, is being taken by their own cash. And that is also getting reflected. If you see the SME growth, we are all witnessing good growth in SME, which means that SMEs are basically B2B businesses, right? If the corporates are not giving the orders, they're not going to perform better. So which shows that the corporates are spending and also giving the orders to SMEs. But the next inflection point for the capital expenditure would have to come. One is most of them are operating at 75 to 76% capacity utilization. And a sustained consumer sentiment and consumption growth. It is not that it's not there, but I think people would like to see the sustained level of that.
You're saying that capex has not picked up, but it is looking all set to pick up.
All set to.
Okay. What's your sense about margins? Again, for the sector, I'm not cornering you, because you're going to get this. The rate cut will take away your margins, but the CRR cut will give you back margins, and it comes with a multiplier. Yeah. Every subsequent deposit will give you some gain. So will you come back to your FY25 margins in 4 quarters, 6, or for the banking sector? Does it take 4, 6 quarters to come back?
Most of the banks have indicated that it will be a kind of U curve for the NIMs that you will have. I mean, there is no rocket science in that. There's a lag of deposits getting repriced, whereas...
How much? Is it 2 quarters lag, 4 quarters?
No, I think we'll have to look at Q4 end state.
Okay.
And most of us probably would be sticking to our margins at the Q4 end state. That is what I can tell you now.
I wanted to come to the SBI history itself. As you cast back 70 years, I guess you would have been at least for 1/3 of that.
More than that.
Yeah, more than that. Okay, 35.
37.
Half the history you have seen. Any one memory or any few things that absolutely stand out?
If I have to, of course, there are many things.
Yes.
SBI, there's no dull moment in SBI that I keep telling that. But if two things which we have to see from an institutional perspective, not from individual perspective, I think the liberalization has completely given a new paradigm for SBI. See, till that time, you're a dominant player. We still are a dominant player.
The deposit and lending rates were set by RBI.
Absolutely. And then you have new age players. Post-liberalization, you have new private
bank licenses.
And many things which have happened. My view, I think the watershed moment for banking as a whole and SBI in particular has been the post-90s.
Okay.
It has given both opportunities and risks. Risk of, we have completely had to remodel our risk management. That the global risk and your own internal economical risk, which needed to be relooked at, while the opportunities were aplenty.
Okay.
So I think that is one. And the second important element, I think, for the country, globally, I think, unprecedented COVID was another thing what we really learned many things.